Hello, my dear students. Hope you guys are all doing good. And I also hope that you all would have started your preparation for the coming exams. If you have not yet done it, please do it now. And I'm very glad and excited to bring this marathon before you. And I am pretty much sure that this marathon is definitely going to be a value addition in your preparation. A lot of effort has been put to bring this marathon before you. I spent hours of time in preparing the material, planning the contents to be covered, and made sure that students will ultimately get benefited out of this. As you all are aware, today the complexity of the CA exams has increased a lot. This is very much true for auditing subject. Gone are those days where you will mug up the content and get qualified in the exam. Today, conceptual clarity is extremely important. If you would have already given an attempt for the auditing exam, you will be well aware of this. Sometimes you will read the question in the exam, but you will not be in a position to understand it. If you are unable to understand the question itself, definitely you will not be in a position to answer it. This is where the conceptual clarity comes into picture. And in this video, I had put a lot of efforts to make sure that you will get all the conceptual clarity required to attend the coming exams comfortably. So no more delay further, let us get our concepts cleared and also get equipped for the coming auditing exam. And one more thing guys, please don't forget to like and share this video with others and also leave your comments in the comment section below. And if you want to get access to the materials and other important resources shown in this video, please make sure that you are checking the description to this video once. So I will not keep you on wait for more time. Let us jump into the auditing marathon. Hope this marathon will help you out and all the very best guys. Let us try to start the discussion first with introduction to the auditing. See, introduction to the auditing is nothing but such a chapter which contains entire fundamental concepts relating to the audit. So this chapter gives us with enough of knowledge which we require in order to understand all the rest of the chapters. So those all fundamental things we have given it under one particular chapter named Introduction to the Auditing, which is going to contain all the fundamental aspects relating to the audit. So first we will start with what is the definition of audit, how the term the audit has been defined. So before we can understand the concepts relating to the audit, it is very much necessary on us for us to understand what exactly is the meaning of the term audit. The term audit has been technically defined in the standards, and the term audit is defined something like this. So if we go through the definition of audit, it has been defined as an audit is an independent examination of financial information of an entity, whether or not profit oriented, irrespective of its size or legal form, when such an examination is conducted with a view to expressing an opinion thereon. So how the term audit has been defined? It is an independent examination of financial information of any entity, whether or not profit oriented, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. So in order for this definition to be very much clear, first we should identify what are the key terms in the definition. So the key terms in the definition are: number 1, independent examination; number 2, financial information; number 3, profit orientation; number 4, size or legal form; and number 5, finally, to express an opinion on the financial statements. So first they are saying that audit is an independent examination. So what basically happens in the audit is examination is going to happen. So now what do you mean by examination? So examination means not the examination which you write. Examination, the general meaning of the term is verification, or even we can call it as checking, or even you can call it as scrutinizing. So whatever it is, we can call it by various other names. So what audit basically involves is examination. We do some verification there, we do some checking there, we scrutinize something there. And that examination process is not an ordinary examination process. That examination process is an independent examination. What kind of examination we do? So basically examination means verification, checking, scrutinizing. And that examination is not an ordinary examination which we do in the audit. It is an independent examination. Now what is independent examination? Independent means free from influence. What do you mean by the term independence? Free from influence, which means, for example, if I am able to take the decisions without getting influenced by others, if I am taking decisions without giving importance to other person's wishes and directions, if something is correct without any second thought, I am saying that as correct. If I feel something is wrong without any second thought, I am definitely saying that as wrong. So whenever I am saying something, I am not under anybody's influence, I am not showing any kind of bias, I am not showing any kind of partiality. Such an ability of a person to take a decision without coming under anybody's influence, without showing bias, without showing partiality, that characteristic, that nature of an individual, we call it as what? Independent. So audit basically is examination, and that examination process will be carried out independently without any influence. That process will be carried out. Okay, so we understood audit is an independent examination, but what are the things which we are going to examine? You told audit is an independent examination. Agreed. In audit, when I say I'm doing audit, I'm verifying, I'm checking, I'm scrutinizing. And that process of checking or examination, I have to do it independently. But what is the thing we have to examine, sir? That is addressed by the next part of the definition, in which they say that an audit is independent examination of financial information of an entity. What is the thing which is getting independently examined here? Financial information. So now what is financial information? So let me put it in simple terms. The term financial information means it is a combination of the financial statements and the underlying data which is used for the preparation of financial statements. What do you mean by financial information? Financial statements and the underlying data, the underlying source data which is used for the preparation of financial statements, which we simply call it as books of accounts. So as we all know, books of accounts are the source for preparation of financial statements. So the combination of financial statements along with the books of accounts, that collective information, we call it as financial information. So when I say we are doing audit, we are doing independent examination, and the thing which we are doing the independent examination is financial information, and the financial information means nothing but financial statements and the books of accounts. Now, what is the definition of the term financial statements? There are so many definitions given to the term financial statements, but we will talk about the definition given to the term financial statements under Companies Act 2013. And the definition to the term financial statements in the Companies Act has been defined in an inclusive manner. The definition of financial statements under Companies Act 2013 is an inclusive definition. When I say inclusive definition, we can broadly divide definitions into two categories. One is exhaustive definition and the other one is inclusive definition. If I give you example of exhaustive definition, whatever definition of auditing we are able to see it here, this is an exhaustive definition in which they will exactly say this is what the term means. But there will be other kinds of definitions which will not exactly define the term, but instead they say what is included in that definition. At some places, some definitions will be of such a nature that they don't exactly say what is the term, but instead they say what is included in that term. That kind of definitions we call it as inclusive definition. And in fact, the term financial statements has been defined in an inclusive manner. So it starts something like this. They say, as per Companies Act 2013, financial statement includes the following. The financial statements include the following items. Which are they? Number one, it includes balance sheet. Number two, it includes statement of P&L. Number three, it includes the statement of cash flow, or simply in our common terminology, we call it as a cash flow statement. It includes statement of changes in equity. It includes even notes annexed to or forming part of financial statements. Notes which are annexed to financial statements. Annexed means attached to the financial statements. If I have to put it in the knowledge which in the terminology which we are aware, nothing but notes to accounts. So financial statements as per Companies Act is an inclusive definition, and that contains 5 components. What are they? It includes a balance sheet. It includes a statement of P&L. It includes a statement of cash flow. It includes a statements of changes in equity. It includes notes to accounts. Now, what information will be shown by balance sheet? As we all know, it shows the financial position of the company as on particular date, and that date will be balance sheet date, which is generally 31st of March in our country. And statement of P&L, this statement will actually show the financial performance, whether the company has made a profits or losses during the year. Statement of cash flow. This statement shows whether the company has made total cash inflows or total cash outflows, and that inflows or outflows divided under three categories: cash flows from operating activities, cash flow from investing activities, and cash flow from financing activities. Similarly, the statement of changes in equity is a statement which shows the net increase or decrease in equity happened during the year. And when I say equity here, equity generally means share capital along with the reserves and surpluses. That cumulative balance, we call it as equity. And if I prepare a statement which will tell me the reasons for difference between opening and closing balance of equity. So if the opening equity balance is 100, if the closing equity balance is 120, I will try to prepare a statement which will explain me because of what reasons this increase of 20 crores happened during the year. That statement, we call it as statement of changes in equity. And apart from that, if we have a look at the financial statements of the companies, they will even contain notes to accounts also. Notes to accounts is also integral part of the financial statements. Notes to accounts is also an very integral part of the financial statements. So all these 5 items put together, they make financial statements. This is what the definition given to the term financial statements under Companies Act. And even books of accounts has also been defined. This definition is also an inclusive definition. They define books of accounts as something like this. It includes records maintained in respect of money spent and received by the company. It includes records which are maintained in respect of money received and spent by the company and the matters regarding which that receipts and expenditure takes place. Nothing but simply cash book. Like if I show you the definition here. So books of accounts is defined under section 2 subsection 13, and it is also an inclusive definition. Why? Because the definition is starting with the term includes. So it includes records maintained in respect of all sums of money received and expended by the company. Whatever records that you are maintaining to record the money received and expended and the matters regarding which you are spending or receiving this money. Nothing but, in simple terms, if I have to put it, cash book. So cash book is actually the record in which we will try to write down what is the money received, what is the money spent, for what matter we have received it, for what matter we have spent it. And even books of accounts includes records which are maintained for recording the details relating to sales and purchases. Whatever records which an entity is maintaining for recording the details of sales and purchases, that books also will come under books of accounts. And records maintained in respect of assets and liabilities of the company. Whatever records which an entity is maintaining to note down the details of assets and liabilities, that also will come under books of accounts. And then finally, the items of cost as may be prescribed under section 148 in the case of a company which belongs to any class of companies specified under that particular section, which is section 148. Nothing but cost records. But the thing which we need to keep in mind here is cost records will not form part of books of accounts of every company. Because cost records are not mandatorily applicable for all companies, there is a section 148 of the Companies Act which will set out the criteria which if the companies fulfill, cost records will become applicable for them. Only those companies for which section 148 is applicable, for those companies only cost records will form part of books of accounts. If there is a certain company which is not fulfilling the criteria required as per section 148, then they will not be required to maintain cost records. Then the cost records will not form part of their books of accounts. See, why I am stressing this much is sometimes they might pose you a true or false statement. Assume a true or false statement is tested. All companies must include in their books of accounts cost records. Assume a true or false statement is tested. All companies are mandatorily required to include cost records in their books of accounts. Is this given statement true or false? This statement is false. Why? Because cost records will not form part of books of accounts of every company. Cost records will form part of books of accounts of only those companies which are actually covered under section 148. Clear? So now this collective information, financial statements along with the books of accounts, this collective information, we call it as financial information. And if I am doing audit, what I'm actually trying to do in the audit is I'm trying to independently examine, independently verify, independently check. And what I am checking? Financial information I am checking. And what is meaning of financial information? Financial statements and books of accounts of the company. If I say I am conducting audit of Reliance Industries Limited, what I will do there? I will independently examine financial statements, books of accounts of Reliance Industries Limited. If I say I am conducting audit of so and so company X Limited, which means what I am doing there? I am independently examining financial information, that is financial statements and the books of accounts of X Limited company. Understood? So this is what actually happens in the audit. So audit is an independent examination of financial information of an entity. Now let us come to the next part of the definition, in which they are trying to say here whether profit oriented or not. What is the next part of the definition? Whether profit oriented or not, which means that the entity for whom you are doing the audit, whether that entity is a profit making entity or that entity is a non profit making entity, that doesn't have any impact on the audit. Whether you are conducting audit of a profit making entity, whether you are making audit of a non profit making entity, that doesn't have any effect on audit. Audit as a scope is not going to change. If I am conducting audit of a profit making company, Reliance Industries Limited, what I will do? Independently examine their financial information. Sometimes I might be asked to do the audit of non-profit making entities. If I give you examples of non-profit making entities, some trust like old age home, orphanages, etc., places of religious worship like temples, churches, mosques, etc. So even if somebody is asking me to do the audit of this non-profit making entities, there also I will independently examine financial information. I will not do something else if I am doing audit of non-profit making entities, which I will not do in the case of profit making entities. No, there will not be any change. If I am doing audit of a profit making entity, I will independently examine financial information. If I am doing audit of a non-profit making entity, there also I will independently examine financial information of that entity. So my client's profit orientation, whether my client is a profit making entity or non-profit making entity, that doesn't have any impact on audit. Next one, irrespective of its size or legal form, which means the size of your client and even the legal form of your client also doesn't matter in the audit. Even size of your client, even legal form of your client also doesn't matter, irrespective of the size, which means I might be doing audit of India's biggest company, Reliance Industries Limited. What I will do there? Independently examine financial information of Reliance Industries Limited. I am conducting audit of one small company in my locality which is hardly having a turnover of 1 crore rupees. I am conducting audit of a small company in my locality, in my close proximity to the office. For example, in this building my office is there, in the close building another company is there. Small company, hardly 1 crore of turnover. That company asked me to do the audit. What I will do there? Independently examine financial information. So whatever I do in that Reliance Industries Limited, the same things I will do it in the audit of this small company also. Just volume of my work will be high. Volume of the transactions which I will be verifying high. The volume of the books of accounts and financial statements will be high. The time which I spend will be high. That's it. Scope is not going to change. Scope remains the same in both the cases. In Reliance Industries Limited also my scope remains the same. In this small entity which is hardly having turnover of 1 crore also my scope remains the same, which is nothing but independent examination of financial information. I will not do something else in Reliance Industries Limited which I don't do in the small company which is having a turnover of 1 crore. Just volume is bigger, time which I am spending will be higher. That's it. The scope altogether is not going to change. And even they say irrespective of legal form, even legal form of your client also doesn't matter. What they're saying, irrespective of legal form, even legal form of your client also doesn't matter. Sir, now what do you mean by legal form, sir? Legal form means simply the legal constitution which you are giving to your entity. How your entity is legally recognized. Like if I want to start my business, I can start it as a sole proprietorship firm. If I want to join my friends in the business, I can create a partnership firm. If I want to do the business along with my family members, I can create a HUF. I want to carry out the business in an organized manner, I can create a company. So if I want to carry out some activity for non-profitable activities, I can create a society, I can create a trust. So nothing but very much similar to SSC, the person definition under Income Tax Act. So legal form means how your entity is legally recognized. Is your entity recognized as a partnership firm? Is your entity recognized as a sole trader? Is your entity recognized as a LLP? Is your entity recognized as a company? So that legal structure which you are giving to the entity, we call it as legal form. Now they are saying irrespective of legal form. What is the meaning of irrespective of legal form? What is the significance of irrespective of legal form? The significance of the term irrespective of legal form is even the legal form of your client also doesn't matter. Even the legal form of your client also does not matter. If you are conducting audit of a partnership firm, what you will do to that partnership firm? Independently examine the books of accounts and financial statements. If you are conducting audit of a company, what you will do there? Independently examine the financial statements of that company. If you are doing audit of a sole proprietor, what you will do there? Independently examine the financial statements of that sole proprietor. If I am conducting audit of a trust, what I will do? Independently examine the financial information of that trust. So size or legal form also doesn't matter in an audit. So now I hope everybody is clear with the definition till here. So what exactly happens in an audit? An audit is an independent examination of financial information of an entity, whether or not profit oriented, irrespective of its size or legal form. But what is the ultimate objective of that examination? I am not doing that independent examination for time pass. I am not doing that because I am having some fun in that. No, if I am doing independent examination, there should be some ultimate outcome out of it. Every work should contain outcome. No. So without outcome, if you are doing some activity, what is the purpose of doing it? Even in the audit also, if you are saying you are independently examining financial information of the client, what is ultimate objective of doing it? That is expressed in the last part of the definition, which says with a view to expressing an opinion. What is the ultimate objective of the entire process of audit? The ultimate objective of entire process of audit is to express an opinion thereon. On what you will express opinion? Whatever you have verified, on that you will express the opinion. On what you will express the opinion? Whatever you have verified, on that you will express an opinion. What is the thing which you have verified? I have verified the financial statements and books of accounts. Then on what I will express the opinion? On the financial statements and books of accounts only I will express my opinion. Understood? So the ultimate objective of this doing entire independent examination of financial information is to express an opinion on financial information, express an opinion whether the financial statements and the books of accounts are correct, whether they are giving true and fair view, whether they are misleading or not. You have to express that opinion on that financial information, whatever you have verified. And finally, that opinion on the financial statements could be either a good opinion or a bad opinion. Any opinion you take in this world, that can be only divided into two categories. You can call it as either good opinion, bad opinion, or even you can say positive opinion, negative opinion. Like for example, if I gave you some food to taste and tell me your opinion, if that food is tasting good, you will give a good opinion. Yes, the food is tasting very good. On the other hand, if the food is tasting very bad, you will give a bad opinion. No, this food is tasting very bad. So similarly, the auditor's opinion, the opinion which we are expressing ultimately out of this audit on the financial information, that could be a good opinion, that could be a bad opinion. If I am convinced that is financial information, whatever I have verified is correct, is not misleading, is correctly prepared, then I will give a positive opinion, good opinion I will give, which in technical terminology we call it as unmodified opinion. On the other hand, if I am not satisfied with the true and fair view of the financial statements, if I find some mistake in the financial information which I have verified, I will give a bad opinion. I will say these financial statements are not giving true and fair view. Clear everybody? So this is what the ultimate objective of the entire audit. Now everybody repeat the definition of audit along with me once for the last time. Audit is an independent examination of financial information of an entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. Understood? So as a part of this definition, we have covered various aspects. We understood what is independent examination, we revised what is financial information, and as a part of financial information, we revised the financial statements and books of accounts. We understood what is the size of the entity, what is the legal form of the entity, and what is the meaning of expression of an opinion. Clear? So now let us come to the next fundamental concept in this entire audit subject. So once we are done with this definition of audit, the next thing which we need to understand is what are objectives of audit? What are objectives of audit, or what are objectives of auditor also you can say. So now when I say objectives of audit or auditor, just now in the definition I have covered, the ultimate objective of the auditor is to express an opinion. That is the ultimate objective. And this opinion has to be expressed regarding two matters. This opinion has to be expressed regarding two matters. Number one, whether financial statements are free from material misstatements. Number two, whether financial statements are prepared as per applicable financial reporting framework. So the ultimate objective of the auditor is definitely to express an opinion, and that opinion has to be expressed regarding two matters: whether financial statements are free from material misstatements and whether financial statements are prepared as per applicable financial reporting framework. So we'll come back to the first point later. We'll come back to the first objective later. First, we will try to spend our time in understanding the second objective. What is that? Financial statements are prepared as per applicable financial reporting framework. Now we need to understand what is the meaning of this term applicable financial reporting framework. So let us try to divide this entire lengthy term, and we'll try to divide it into subparts, and we'll try to understand the significance and meaning of each of this part. Like first, I will start with framework. So what is the meaning of the term framework? Framework means, simply put, rules and regulations for doing some activity. What do you mean by framework? Framework simply means the rules and regulations for doing some activity. Like for example, if I have given you some rules and regulations for attending this class, that is a framework for attending the class. If you are about to write an exam, I gave you 10 instructions which you are supposed to follow, according to which you have to write the examination. That is a framework for attending the exam. So if I have given you some instructions which you are required to follow for attending an interview, that is a framework for attending an interview. So a set of rules and regulations, or even you can call them as instructions. So set of rules and regulations or instructions which are required to be followed for doing one particular task, that I call it as framework. Then what is the meaning of financial reporting? If you ask me simply, financial reporting is just an other name for accounting process. Financial reporting is just an other name for the accounting process. So financial reporting means the process of preparation and the presentation of financial statements, that we call it as financial reporting. So framework means set of rules and regulations. Financial reporting means the process of preparation and presentation of financial statements. Then finally, if you combine both the terms, financial reporting framework. Now what is the meaning of financial reporting framework? Financial reporting framework means the set of rules and regulations which are required to be followed in the process of preparation and presentation of financial statements, that we call it as financial reporting framework. That's all. Simple. Combine both the terms. Framework means set of rules and regulations. Financial reporting means the preparation and presentation of financial statements. If you combine both, financial reporting framework, which means what? The set of rules and regulations which are required to be followed in the process of preparation and the presentation of financial statements, that I call it as financial reporting framework, nothing else. The set of rules and regulations which are required to be followed in the process of preparation and presentation of financial statements. See, assume an entity wants to prepare the financial statements. A company wants to prepare the financial statements. Can the company prepare the financial statements as per their own wishes, as per their own thoughts, whatever they have? Or should they follow one specific set of rules and regulations? They have to follow a specific set of rules and regulations. Like if a company is preparing financial statements, they will follow Schedule 3 and accounting standards. Now, Schedule 3 and accounting standards is simply a financial reporting framework. The set of rules and regulations which an entity has to follow for the process of preparation and presentation of financial statements. Schedule 3 and accounting standards. Clear? So we understood financial reporting framework. But in the objective, they use some other term. They are saying applicable financial reporting framework. Now, what is this applicable financial reporting framework? First, before I explain this term applicable financial reporting framework, I want to ask one simple question. It is whose responsibility to prepare financial statements? Will the auditor prepare it, or management of the entity will prepare it? Auditor will never prepare it. Theoretically, not practically, but as per theory, if you observe, financial statements are always the preparation of financial statements preparation are always responsibility of management. It is always the responsibility of management to prepare the financial statements. Then what is auditor's responsibility? Auditor will verify whether management prepared the financial statements in a proper manner or not. So financial statements preparation is always and always the responsibility of management, whereas auditor's responsibility is to just verify whether the financial statements are prepared properly or not. So management, while preparing the financial statements, keeping in mind the nature of the organization and also keeping in mind the purpose of the purpose of the financial statements, the management will adopt, very important term, who will adopt, the management will adopt which rules and regulations they have to follow, that framework which management has adopted, keeping in mind the nature and purpose of the organization, that we call it as applicable financial reporting framework. Financial reporting framework means a set of rules and regulations which are required to be followed in the preparation and presentation of financial statements. Now, the management of the organization, while preparing the financial statements, keeping in mind nature of organization and the purpose of financial statements, the management will decide which set of rules and regulations will be applicable for them, and they will adopt it, that rules and regulations which are adopted by the management, very important guys, applicable financial reporting framework will be adopted by the management, not the auditor. Management, keeping in mind the nature of the organization, purpose of the financial statements, the management will decide which rules and regulations they have to follow, that rules and regulations which are adopted by the management, we call it as applicable financial reporting framework. Let me give you a few illustrations for the same. Assume the Reliance Industries Limited, the management of this company wants to prepare the financial statements. The management, while preparing the financial statements, keeping in mind the nature of the organization. What is the nature of the organization? Company. Since the nature of the organization is company, the management decided that, keeping in mind this nature of the organization which is company, they decided we will follow Schedule 3 and accounting standards. Now, Schedule 3 and accounting standards, which is adopted by the management of Reliance Industries Limited, will become applicable financial reporting framework for Reliance Industries Limited. Now, SBI management, while preparing the financial statements of SBI, keeping in mind the nature of this company SBI, which is a bank, they have decided that they will follow Banking Regulation Act in the preparation of financial statements. Since this is adopted by the management of SBI, this becomes applicable financial reporting framework for SBI. Now, the management of LIC, while preparing the financial statements, keeping in mind the nature of the organization, which is an insurance company, they have decided that they will follow IRDA rules and regulations in the preparation of financial statements of LIC. Now, IRDA will become applicable financial reporting framework for LIC. So, like this, keeping in mind the nature of the organization and the purpose of the financial statements, the management of the organization will select which set of rules and regulations they have to follow. That set of rules and regulations, we call it as applicable financial reporting framework. So, like the definition which I have given here, if you observe here carefully, applicable financial reporting framework. So, here if you observe this line, in view of nature of entity and purpose of financial statements, the management of the entity will adopt applicable financial reporting framework. They might ask you a true or false statements here. Entire sentence will remain the same, but only one thing will change. Now, they will replace the term management with auditor. They will give true or false statement, something like this. They will give the entire statement as it is, but they will replace only one term. The term management will be replaced by the auditor. Now, tell me, will that statement will be true? No. Why? Because the management will select what is the applicable financial reporting framework, not the auditor. So, you have to be very careful when you are reading the true or false statements. Never ever attempt the true or false statements unless reading it twice. So, you have to read it minimum twice before you can start answering MCQs and true or false statements. Clear? So, with this we are done with the first objectives, which is second objective, whether financial statements are prepared as per applicable financial reporting framework. Nothing but as an auditor, I need to express my opinion. Whatever financial statements which are prepared by the management, are they as per applicable financial reporting framework? If I am conducting audit of a company, I need to express opinion whether my client company prepared the financial statements as per Schedule 3 and accounting standards. If I am conducting audit of SBI, I need to express opinion whether my client's management prepared the financial statements on the basis of Banking Regulation Act. If I am conducting audit of LIC, I need to express opinion whether my client's management prepared the financial statements as per IRDA rules and regulations. Understood? So, this is what the second objective which auditor needs to comment. Now, since we have understood what is applicable financial reporting framework, let us try to understand what are the various types of framework also. We will even try to understand what are various types of frameworks. So now first we will try to understand the various types of frameworks on the basis of purpose of financial statements. On the basis of purpose of financial statements are divided into two categories. One is general purpose financial statements and special purpose financial statements. The definitions given are very straightforward definitions. They have told that general purpose financial statements are those financial statements which are prepared as per general purpose framework. Whereas special purpose financial statements are those financial statements which are prepared as per special purpose framework. Simple definition, no? Quite obvious. So they are simply saying on the basis of purpose, financial statements are divided into two categories: general purpose financial statements and special purpose financial statements. General purpose financial statements are prepared as per general purpose framework. Special purpose financial statements are prepared as per special purpose framework. But in order to make this discussion complete, first we need to understand what is this general purpose framework and what is this special purpose framework. General purpose framework means it refers to such a framework which fulfills financial information needs of various users of financial statements. If the single framework, the set of rules and regulations which you are following, if they have the capability to fulfill financial information needs of various users of financial statements, if a set of rules and regulations which you follow, if that set of rules and regulations are having capability to fulfill financial information needs of all the users of financial statements simultaneously, that framework we call it as general purpose framework. Let me give you example, but before I can give you example, we have to understand, we have to just quickly go through who and all are various users of financial statements. Management will prepare financial statements, but who will use these financial statements? Like if we take a list of the people who use the financial statements, number one, shareholders will make use of financial statements. Why they will use the financial statements? Because they want to know whether the company in which they have invested the shares, is that company making profits or is it making losses, assets are increasing, assets are decreasing, what is its net worth. Shareholders wants to track these details, and the only source of information through which shareholder can track this information is financial statements. So shareholder are one of the users of financial statements. They want to know about profitability and performance. Management also will use financial statements. Management will prepare. They will also use it. How come they will use it? For their decision making purpose, whether to continue the business or close down the business, whether to declare the dividend or reinvest the profits. So that decisions will be taken by the management on the basis of financial statements. Banks and financial institutions will use the financial statements to decide whether a loan can be given to an entity or not. Banks or financial institutions will use. Your creditors will use it to decide whether to sell the goods on credit basis or not, whether the company is a credit worthy company or not. How the creditors will come to know? By reading the financial statements. And even government will use financial statements. Why government will use financial statements? To know whether the entity is properly depositing the taxes, whether they are depositing correct amount of taxes or not. This even government wants to know. And how the government will come to know about it? By going through the financial statements. And even not just this financial statements will even be used by some entities like insurance companies, etc., for settlement of insurance claims, trade disputes, etc. Debtors want to use the financial statements because the debtors want to know the future viability. Before they can enter into long-term contracts with the company, they want to know future viability. Your customer wants to know whether this company can continue in the future or not. And not just that, there will be some research scholars, research analysts in the market. That research analysts like stock brokers, they will also use the financial statements for preparing their project reports. So like this, financial statements will be prepared by the management, and the same financial statements will be used by these many users for different purposes. Now, do you think the management of the companies will prepare separate set of financial statements for each of this user? For shareholder, different set of financial statements. For management, different set of financial statements. For banks, different set of financial statements. Do you think they will prepare different sets of financial statements? No. If you take Reliance Industries Limited, they will release one set of financial statements which are prepared as per Schedule 3 and accounting standards. Once they release these financial statements, the single set of financial statements will be used by shareholder, it will be used by management, it will be used by creditors, it will be used by the governments, it will be used by the debtors, it will be used by various other users. So if you observe, we followed one rule here, which is Schedule 3 and accounting standards, and this framework is capable to meet the financial information needs of so many users of the financial statement simultaneously. If you observe carefully here, the management prepared the financial statements using one framework. What is that? Schedule 3 and accounting standards. Now that set of framework, that one set of framework is used to fulfill the financial statements of all the users. If you go and give that financial statements to the shareholders, they will agree. If you go and give it to the management, they will agree. If you go and give it to the government, they will agree. If you go and give it to the debtors, they will agree to that. So this single set of framework is going to fulfill financial information needs of so many users of the financial statements simultaneously. So that framework, we call it as general purpose framework. One of the best example of the general purpose framework is Schedule 3 and accounting standards. Why? Because Schedule 3 and accounting standards will fulfill financial information needs of various users of the financial statements. Clear? And those financial statements which are prepared as per this general purpose framework, that we call it as general purpose financial statements. Clear? So now it becomes necessary for us to understand what is special purpose framework. See, if general purpose framework is the framework which fulfills financial information needs of various users of financial statements, then what will be the special purpose framework? What could be the definition of the special purpose framework? Yes, whatever comes to your mind. So smart people, the definition you would have already made it. So what is the definition which has come to your mind? The framework which fulfills financial information needs of specific users of financial statements. The framework which fulfills financial information needs of specific user, just one or two users financial information. If the framework is fulfilling that information, we call it as, that framework we call it as special purpose framework. The framework which fulfills financial information needs of specific users of financial statements, just one or two users of financial statements information will be fulfilled by you following some framework, that we call it as special purpose framework. Like for example, when the entity X Limited went to the banker for the purpose of the loan, the management approached the banker and told, sir, we need 100 crores of loan. Now the banker told to the company that, sir, if I have to give the loan of 100 crores for you, I want you to prepare the financial statements on cash flow basis. What the banker asked, sir, if I have to give you the loan, you prepare the financial statements on cash basis, not on accrual basis. As we know, general financial, normal financial statements, Schedule 3 and accounting standard financial statements will be prepared on accrual basis. But what the banker is asking is, sir, if you expect me to give you the loan, I will give you loan. But what I want is, you prepare the financial statements on cash basis and bring it to me, then I will give you loan. Now, why the banker will ask you for this is, there is a logic. Why? Because your accrued profit will not determine your repaying capability. Your cash profit will determine your repaying capability. If the financial statements are prepared on accrual basis and in the statement of P&L 5 crores of profit is there, can you give me a guarantee if the financial statements are prepared on accrual basis, will this 5 crores would have been completely realized in cash? May or may not be. We can't give that guarantee. This 5 crores might have been realized in cash or might not be realized in cash. But this 5 crores, this accrued profit of 5 crore rupees will not determine your repaying capability. You assume you have an accrued profit of 5 crores, but out of this only 3 crores is realized in cash. You have an installment to pay 4 crore rupees. Will you be able to pay? No. Why? Because you have realized only 3 crores. So banker is well aware that repaying capability will not be determined by accrued profits. The correct repaying capability will be determined by cash profits. So that's why banker has asked the company to go and prepare the financial statements on cash basis, then he will give you loan. Now, X Limited company has prepared the financial statements on cash basis, gave it to the banker. Banker gave the loan on the basis of cash basis of financial statements. Now, if the X Limited company take these financial statements which are prepared on cash basis and give it to the government for payment of taxes, will the government accept? No. If the company takes these financial statements prepared on cash basis, give it to the shareholder, will the shareholder accept this for decision making? No. If I go and give it to the creditors, will they accept? No. If I go and give it to some insurance companies, etc., will they accept this cash basis of financial statements? No. Here the company followed a framework which is cash basis, and that framework is fulfilling information needs of only one specific user, who is banker here. So this framework we call it as special purpose framework. The framework which is fulfilling information needs of just a specific user, not all the users simultaneously. So this framework, special purpose framework, which is prepared on cash basis of financial statements, that is fulfilling information needs of only banker, not any other user. This we call it as special purpose framework. Whereas if the framework is ready to fulfill financial information needs of various users simultaneously, that we call it as general purpose framework. Clear, everybody? And this general purpose framework, if it is getting accepted by so many users simultaneously, why it is getting accepted by so many users simultaneously is general purpose framework is having some characteristics. General purpose framework is having somewhat characteristics. What characteristics it is having? So the characteristics of the general purpose framework are, they are prepared on the basis of fundamental accounting assumptions. They follow fundamental accounting assumptions. They follow generally accepted accounting principles. They follow accounting standards, and the general purpose financial statements are prepared periodically. For a fixed period they will be prepared, and that periodicity in India is annually, which starts from 1st of April and which will end on 31st of March. So general purpose framework or general purpose financial statements will have 4 characteristics which will make them accepted by all the people, and those 4 characteristics are: they follow fundamental accounting assumptions, they are prepared as per GAAP, they are prepared as per accounting standards, and they are prepared periodically. Clear? So we revised 2 kinds of framework on the basis of purpose. One is general purpose framework and the other one is special purpose framework. Clear, everybody? There is even one more categorization of the frameworks on the basis of presentation. The 2 kinds of frameworks which we have seen just now are on the basis of purpose of the financial statements. But as I was telling, there is even one more different kinds of frameworks now on the basis of presentation of financial statements. So on the basis of presentation of financial statements, frameworks are once again divided into 2 categories. One is compliance framework and the other one is fair presentation framework. So let us try to revise now what is the meaning of the compliance framework and what is the meaning of fair presentation framework. First, talking about compliance framework, it has been defined as, it refers to such a framework where financial statements are prepared according to the requirements of framework without any deviation. How the term compliance framework has been defined? It refers to such a framework where the financial statements has to be prepared according to the requirements of the framework without any deviation. That means in case if the framework is strictly asking you to follow the requirements, they are not giving you any scope of a deviation. That kinds of frameworks we call it as compliance framework. Like as you could see here, the definition has been given: the framework in which the financial statements are prepared as per the requirements of such framework without any deviation. Deviation is not at all permitted. Whether by following that rules and regulations you get a true and fair view, you do not get a true and fair view, all that doesn't matter. What you are only supposed to do is whatever mentioned in the framework, strictly you have to follow. Whether they give true and fair view, that doesn't matter. Whatever is mentioned, you have to follow as it is. Like if you look at the example from the compliance framework, here banker asked me to prepare the financial statements on cash basis. And I actually prepared the financial statements on cash basis. But I know that by following cash basis of accounting, the financial statements will not give true and fair view. By following cash basis of accounting, I know that financial statements will not give true and fair view, but I strictly followed without any deviation. Why? Because if I prepare, then only banker will give me loan. So like this, if compliance framework refers to that kind of frameworks where you are supposed to strictly follow the requirements of the framework and deviation is not at all permitted. In any case, you should not deviate. Strictly you have to comply with. But fair presentation framework, as the name itself says, in this framework also, we try to prepare the financial statements as per the requirements of the framework only. But in the fair presentation framework, the management will be given a permission to provide additional disclosures, beyond the requirements of framework, or the management will be permitted to altogether deviate from the requirements of the framework so as to achieve fair presentation. So what is this fair presentation framework? In the fair presentation framework also, the management will try to prepare financial statements as per the requirements of the framework. But here you are given some freedom. Here you are given an option. What option you have been given? The management has been given the freedom to provide extra disclosures, extra explanation in the notes to accounts which are beyond the requirements of the framework. That means you can give extra disclosures which are not given in the framework, or we can even altogether deviate from the requirements of the framework. That means we can ignore whatever has been mentioned in the framework and we can follow something else which is not there in the framework. But for what purpose we have been given the freedom to provide additional disclosure or deviate? For what purpose this freedom is given? To achieve fair presentation. Here the main focus is not just on following, here the main focus is on achieving the fair presentation. Sir, how to give additional disclosure or how we can deviate from the requirements of the framework? So let me give you an example. Assume that an entity has bought some plant and machinery costing some 1 crore rupees of money. And as we all know, if the company is buying a fixed assets, it need to be depreciated. And if you go by the Companies Act, only two methods are permitted for providing depreciation. Either you have to follow SLM method or you have to follow WDV method. And even rates are also prescribed under Companies Act itself. If you follow SLM, depreciation rate will be 10%. If you follow WDV, depreciation rate will be 15%. Assume residual value as 0 for the sake of convenience in the discussion. So if you have to follow the requirements of the framework, if you have to follow Companies Act, either you have to follow SLM method or WDV method. If you follow SLM, the depreciation will be 10 lakh rupees. If you follow depreciation, if you follow WDV method, the depreciation will be 15 lakh rupees. If you follow the framework, if it is a compliance framework, we have to follow this strictly. Either we have to follow SLM or we have to follow WDV. If we are not at all permitted to deviate, either we have to follow SLM or WDV at the rates given here, then we call it as a compliance framework. Now, let me give you one extra information regarding the usage of the machinery. See, the usage of the machinery, this plant and machinery was designed in such a way that this machinery will be exactly produce 1 lakh units. This machinery was designed in such a way, it will produce exactly 1 lakh units. After producing 1 lakh units, it will stop working. Now in year 1, the manufacturing, the company has actually produced 20,000 units out of that machinery. The total capacity is 1 lakh units. But in year 1, the company has already used that machinery to produce 20,000 units. So if you observe carefully here, by looking at the usage of the machinery, one more method of depreciation will be appropriate here, which is production units method. Yes or no? Why? Because production units method reflect the actual consumption pattern. So it is a general rule that the depreciation method should reflect actual consumption pattern of the machinery. So now Companies Act is saying either follow SLM method or WDV method, but looking at the consumption pattern, not SLM, not WDV, production units method is a better measure of depreciation. But if the framework is a compliance framework, you are not supposed to follow production units. Whether it gives a true and fair view or not, we have to follow either SLM or WDV. So if no freedom is given for you to deviate from the requirements or to provide extra disclosure, that we call it as compliance framework. But in case if the freedom has been given for you, in order to achieve fair presentation, if the framework is giving you freedom, what freedom? To either provide additional disclosure beyond the requirements of the framework, or even the freedom has been given for deviating the requirements of the framework altogether. Sir, how can I provide additional disclosure, sir? Additional disclosure can be provided like in the statement of P&L, I will charge depreciation either as SLM or WDV only. Either I will charge depreciation as 10 or 15 lakhs only. But in the notes to accounts, I will add extra note. In the notes to accounts, I will add an extra explanation. What explanation I will add there is, since the Companies Act is asking me to follow SLM or WDV, I have charged depreciation as per SLM or WDV. But keeping in mind the consumption pattern of the machinery, neither SLM nor WDV will be appropriate. Production units method would have been much more appropriate. And if I follow production units method of depreciation, the depreciation would have been 20 lakh rupees and my profit would have been this much. This is giving much more fair presentation than SLM or WDV. But since Companies Act is asking me to follow SLM or WDV, I have followed it, but this will give me fair presentation. So if you observe, I am giving an extra explanation, extra disclosure in the financial statements, which is not a requirement of the framework. I am giving what? Extra explanation. Why you are giving this extra explanation? Why? Because it will help the users to understand the fair presentation. So if the framework is giving you freedom to provide disclosures beyond the requirements of the framework, or altogether the framework is giving me the freedom to deviate. If I deviate, what I will do is in the statement of P&L itself, I will directly charge the depreciation 20 lakhs. I will not follow either SLM, I will not follow either WDV. Directly on the face of the P&L, I will charge the depreciation as per production units method only. Here, if you observe, I have deviated from the requirements altogether. And why I have deviated from the requirements? Why I have deviated from the requirements is to achieve the fair presentation. I want to achieve fair presentation. For that purpose, I have altogether ignored whatever is mentioned in the framework and I am following something else to achieve fair presentation. So if the freedom has been given in the framework, either to provide additional disclosures or to deviate from the requirements of the framework to achieve fair presentation, that we call it as fair presentation framework. On the other hand, if no freedom is given for deviation, if no freedom is given for additional disclosure, we are supposed to follow strictly as it is whatever is given in the framework. Not even 1% scope is given for deviation. That we call it as compliance framework. The name itself says you have to comply, you have to follow strictly. Whereas if in the framework they are giving the freedom either to provide additional disclosures beyond the requirements, or if they are giving me the freedom to deviate from the requirements if required to achieve a fair presentation, that framework I call it as fair presentation framework. Clear everybody? And few more points to clarify here. Most of the special purpose financial statements will be prepared as per compliance framework, and most of the general purpose financial statements will be prepared as per fair presentation framework. What is one more point we need to keep in mind? Most of the special purpose financial statements are prepared as per compliance framework, and most of the general purpose financial statements will be prepared as per fair presentation framework. The logic is very simple. When I said general purpose financial statements, it has to fulfill financial information needs of so many users. No, when so many users will be satisfied when they give a true and fair view, or when they don't give a true and fair view? When they give a true and fair view. And where the true and fair view is possible? Only in the fair presentation framework. And one more point of difference here, in compliance framework, true and fair view might not be guaranteed. We cannot guarantee the true and fair view, but in the fair presentation framework, there will always be a true and fair view. So these are the types of frameworks on the basis of presentation. Compliance framework without any deviation, true and fair view will not be guaranteed in the compliance framework, and most of the special purpose financial statements will be prepared as per compliance framework. Coming to the fair presentation framework, here there will be freedom given for providing extra disclosures beyond the requirements of the framework, or even sometimes freedom will be given to deviate from the requirements of the framework altogether, with the main objective of achieving fair presentation. And in the fair presentation framework, there will always be a true and fair view, and most of the general purpose financial statements are prepared as per fair presentation framework. Clear everyone? So I have a question here. Whatever financial statements which every company is releasing, like you can download the financial statements of Reliance Industries Limited. They will be available in their official website. You can download the financial statements of Infosys company. Not just that, there will be so many other companies. All the listed companies will release their financial statements. They will keep it available in the public domain. Now, according to which framework all the companies are releasing the financial statements? What framework which they follow in all these financial statements of the companies released? Like Reliance will release the financial statements, Infosys will release the financial statements, TCS will release the financial statements. Will they follow compliance framework, or will they follow fair presentation framework? So whatever financial statements which are released by the companies, whatever financial statements which we will prepare for the general companies, they are as per fair presentation framework. Why? Because Section 129 of the Companies Act, which is talking about financial statements, they say that financial statements shall be prepared as per Schedule 3 and accounting standards, but at the same time they shall give true and fair view also. So what Companies Act has put the focus? They ask you to prepare the financial statements as per Schedule 3 accounting standards, but at the same time they will even ask you to give the they will even ask you to prepare financial statements as per true and fair view. And as we all know, where there will be true and fair view, in the compliance framework or fair presentation framework? In the fair presentation framework. And even if you do a in-depth understanding of Section 129 of the Companies Act, in one point they say that, let me show you the bare section of that Section 129 of the Companies Act. Section 129. I will show you, I will give justification why the financial statements as per Companies Act are prepared as per fair presentation framework. So if you go through one particular subsection, which is actually subsection 5, So if you read not subsection, yeah, subsection 5 only. So let me zoom out. So I hope you are able to see it here. So if you see this subsection 5 of section 129, they say that without prejudice to subsection 1, ignoring whatever has been mentioned in subsection 1, where the financial statements do not comply with the accounting standards, then the company shall disclose in the financial statements the deviation from accounting standards. Nothing but by way of subsection 5, 129 subsection 5, the Companies Act itself is giving the freedom to the companies. In case if you don't want to comply with the standard, don't comply. But tell the reasons in notes to accounts. That means indirectly section 129 of the Companies Act is giving the freedom to the companies to deviate from accounting standards. So that's why whatever financial statements which every company is releasing in the public domain, all that are fair presentation framework. Why? Because section 129 of the Companies Act has given the freedom to the companies to deviate from the accounting standards if required. Clear? So where are all discussion regarding the frameworks has started? So we are discussing objectives of the auditor. In that second objective we have discussed, which is whether financial statements are prepared as per applicable financial reporting framework. But we did not discuss at the first objective, which is financial statements are free from material misstatements or not. Now we need to understand what is this material misstatement. First we will understand the term misstatement. See, misstatement means very simple. If I have to put it in simple terms, misstatement in the financial statement means simply a mistake in the financial statements. But we as all know, simple things don't work in the exam. So we have to write a complex definition, which we will simplify later, then only we'll get the marks. So simply if I put it, misstatement means a mistake in the financial statements. But that is not how the term misstatement is defined. It is defined something like this: a difference between amount, classification, presentation, disclosure, which is there in the reported financial statements, and amount, classification, presentation, disclosure required as per applicable financial reporting framework, if they are not matching. So if you look at the definition of misstatement, how they have defined the term misstatement is the difference between amount, classification, presentation and disclosure, which is there in the reported financial statements, and the amount, classification, presentation, disclosure, which is there as per applicable financial reporting framework. Nothing but applicable financial reporting framework is asking the company to do something, but the management in the financial statements which they have prepared, they are doing something else. That difference could be in amount also. That difference could be in classification. That difference could be in presentation. That difference could be in disclosure. Like some accounting standard is asking you to recognize the revenue as 90,000 rupees. But the management in the financial statements which they have prepared, they have recognized the revenue as 1.5 lakh. So difference in amount. Which amount? Amount which is there in the financial statements, amount which is required as per applicable financial reporting framework. This difference we call it as misstatement. Or applicable financial reporting framework, some accounting standard is expecting the management to treat certain item as revenue expenditure, but the management in the financial statements, they are treating it as a capital expenditure. Difference in classification. Or applicable financial reporting framework like schedule 3 is asking you to present the financial statements in the vertical format, but management, they have made a difference in the presentation. They follow T format, difference in presentation. Or some accounting standard is asking the management to give some explanation in the notes to accounts, some disclosure in the notes to accounts, but management in the financial statements in which they have prepared, either they did not give that explanation or they have given that explanation in a wrong manner. Disclosure means nothing but an explanation in the notes to accounts. So even if there is a difference in the disclosure, that also we call it as a misstatement. So nothing but, if I have to put it in simple terms, applicable financial reporting framework is asking you to do something and management has done something else in the financial statements. That difference could be in amount, that difference could be in classification, that difference could be in presentation, that difference could be even in disclosure. That's why I say whenever we say mistake in the financial statements, we generally imagine that profit is wrong, assets are wrong, sales are wrong. This is what we imagine. But misstatement need not always happen only in amounts. Misstatement can even happen in the notes to accounts also. If the management does some mistake in the notes to accounts, that is also a mistake in the financial statements. Change your perception. Don't restrict your thinking. So we generally imagine misstatement means only which will happen in amounts. Amount is wrong, profit is wrong, sales are wrong. No, a misstatement can even happen in the notes to accounts. An explanation which is given in the notes to accounts also might contain a mistake. Clear? Now they are not just saying misstatement, but they are saying something else, material misstatement. But before that, one more thing here. A misstatement can happen because of two reasons. Misstatement can happen because of fraud also. Misstatement can happen because of error also. And as we all know, the differentiating factor between the two is intention behind it. Fraud is something which is always intentional. Error is something which is unintentional. That's the underlying difference between the two. And now if we come back to the objective, they are not just saying misstatement, they are saying material misstatement. Now what is the meaning of this term material? So material means significant or important or major. Nothing but as an auditor, you should not be concerned about each and every misstatement in the organization. You should be concerned only with the material misstatement. But the $1,000,000 question here is, when we call misstatement as a material. When we call a misstatement as a material, there is no exact definition, but what the standard has suggested is a misstatement will be considered as material if it could influence decision of users of financial statements. How the term material has been defined? Material misstatement. So material means significant or important. A misstatement will be considered as material if it influences, if it is having a capacity to influence, if it is having a capacity to affect the decision of user of financial statements, that I call it as material. Like for example, I am a shareholder of Reliance Industries Limited. I came to know that in the Reliance Industries Limited, 1 crore of fraud happened. Now, but the moment I came to know that 1 crore fraud happened in the Reliance Industries Limited, will I immediately sell the shares of the company? Definitely not. Reliance is of the size of 6 lakh plus crores of the company. 1 crore will not even come in the rounding off also. Reliance will prepare the financial statements which are rounded off to crores. So crores will go in rounding off itself. So I came to know that there is a misstatement, but is it affecting my decision? Is it making me to sell the shares? No. So this is a misstatement, but it is not having a, but it is not capable to influence the decision of user. So I will not call this as material. There is a misstatement, agreed, but it is not having the capacity to influence, to change the decision of user who is shareholder here. So should I auditor be concerned about this 1 crore of fraud? Not required. Why? Because it is not at all material. On the other hand, if I am conducting audit of 100 crores of company, in that company, if I came to know that 1 crore of fraud has happened, now this will become material. 1 crore is not material in Reliance because the size is so big, 6 lakh plus crores of turnover of a company. But if the same 1 crore fraud has happened in 100 crores turnover of a company, then I will call it as material. So the point which I want to make here is materiality is a relative term. Materiality is what? It is a relative term. It is, we can't absolutely define it. Materiality is a relative term. Relative means what? Which changes from facts and circumstances of each and every case. What do you mean by relative? The fact which changes by circumstances, the item which changes by circumstances. I will quote one simple thing which has, I will quote one simple example which has been quoted by Albert Einstein to explain the matter of relativity. So you know what Albert Einstein told regarding relativity? He tried to explain in one funny way. So relativity means if you spend 1 hour reading some book, 1 hour feels very lengthy time. But if you spend the same 1 hour with talking with some pretty girl, now that 1 hour will feel like just 5 minutes only. This is not example created by me. This is what the example created. This is what the example told by Albert Einstein to explain the concept of relativity. See, imagine if you are spending 1 hour in reading the book or in reading this auditing material, it will feel like a hell for you, that 1 hour. But if you spend the same 1 hour talking with some pretty girl or boy, if you are spending this 1 hour of time for talking with some pretty girl or a boy, the same 1 hour will feel just like a time of 5 minutes of time. Yes or no? So this is what the meaning of relativity. So if you feel 1 crore as material in one small company, the same 1 crore might not be material in another company. Understood, everybody? So materiality is a very relative term, the perception which changes from facts and circumstances of each and every case. Clear, everybody? So this is what the meaning of the term material. So as an auditor, we need to express an opinion whether the financial statements are free from material misstatements. Free from material misstatements means what? Whether they should contain a misstatement or they should not contain a misstatement. They should not contain a misstatement. On that, I have to express opinion. What should not contain material misstatement? Financial information. So with this, we are done with objectives also, the 2 objectives, and as a part of that objective, we have covered various concepts. One last topic I have to revise in the concept of this introduction to the auditing, which is the meaning of the term auditor. who is auditor. Simply the person whoever is doing the audit, we call him as auditor. And when I say a person whoever is doing the audit will be called as auditor, generally when we go for audit, a single person will not go and complete the audit. A single person single-handedly will not go and complete the audit. Whenever we say we are going for audit, we go as a team. And who will be there in this audit team means engagement partner, nothing but head of the firm. If I have to put it in even simple terms, whoever is signing the audit report, that person will be called as engagement partner. And also engagement partner, if I am an auditor, if I am a chartered accountant in practice, if I was allocated some audit, I will not go single-handedly and complete the audit. I will take the staff along with me. So myself will be called as engagement partner. Along with me, I will take some article assistants, senior article assistant, junior article assistants. Along with that, I will take a people called paid assistants. And along with them, some other people in my firm will be there whom I give a designation called audit manager. Sometimes I will give other designations like project manager. So like that, whenever I go for audit, I will not go single-handedly. I will take my entire team along with me. So assume I was allocated audit of the client X Limited. For this client's audit, we as a team are going. Myself being an engagement partner, one article assistant, one senior article assistant, one junior article assistant, two paid assistants, and one audit manager. So a team of how many people? 1, 2, 3, 4, 5, 6. A team of 6 people we are going and conducting the audit engagement of the client X Limited. Now we 6 people collectively will be called as engagement team. What we 6 people will be collectively called as engagement team will be called as. The point why I am saying this is when I say auditor, auditor just doesn't mean one person. Auditor means entire team. So wherever you are reading the term auditor, auditor doesn't mean just one person. This entire engagement team, whoever is going and doing the audit, they all will be collectively referred as auditor. Auditor is not just one person. The entire engagement team will be collectively called as auditor. But in two circumstances, auditor means only engagement partner. In how many circumstances? In two circumstances, when they refer auditor, in that two circumstances, auditor means only one person, engagement partner. Sir, what are the two circumstances in which auditor means only engagement partner? Two circumstances are number one, acceptance of responsibility, and number two, accountability before regulatory authorities. In two circumstances, that is number one, when you are required to take an responsibility, when it comes to acceptance of responsibility. Number two, when you are accountable before regulatory authorities. In those two circumstances, auditor means only engagement partner. As you could see, acceptance of responsibility and accountability before regulatory authorities. This simply means if somewhere it was mentioned, auditor shall sign the audit report. That is the matter relating to responsibility. When I say auditor shall sign the audit report, can an article assistant sign the audit report? No. Why? Because this is a matter relating to acceptance of responsibility. Here article assistant cannot say our auditings are told that engagement team includes even article assistants. All auditor means engagement team, and I am a part of engagement team being an article assistant. So I am also coming under definition of auditor. I will sign the audit report. Can the article assistant sign? No. Why? Because when I say auditor has to sign, by signing you are taking responsibility. Since it is a matter relating to acceptance of responsibility, auditor shall refer to only engagement partner. So that's why somewhere it was mentioned auditor is responsible for this, auditor is responsible for that. Their auditor doesn't mean entire engagement team. Their auditor means only engagement partner. And number two, when it comes to acceptance of responsibility before regulatory authorities, when you have to be accountable before regulatory authorities, like for example, if someone is if somewhere it was mentioned auditor will be liable for imprisonment. Accountability, you are responsible. If somewhere it was mentioned as if auditor does something wrong, auditor has to face a imprisonment of 2 years. Now if people have come for arresting the auditor, police has come, a case was proven, judgment was passed, auditor should be arrested and kept in jail for 2 years. Now people have come for arresting the auditor. At that point of time, engagement partner is not there. Can they take the article assistant and keep him in jail for 2 years? No. Why? Because it is a matter relating to accountability before regulatory authorities. If they are saying auditor is accountable for so and so thing, auditor is responsible for imprisonment, their auditor means only engagement partner. Understood? So in two cases, acceptance of responsibility and accountability before regulatory authorities, auditor means only engagement partner. In rest of all the cases, auditor means entire members of engagement team. Auditor means what? Entire members of engagement team will be collectively called as auditor. But in two cases, acceptance of responsibility and accountability Before regulatory authorities, auditor means entire members of the engagement team. Clear? Understood? So this is what the concept of fundamentals of auditing or introduction to the auditing. Clear everybody? That's all guys. So now we will try to start with the chapter nature, objective and scope of audit. So since we are done with the introduction to the audit, the next topic which we will be revising is nature, objective and scope of audit. This in fact I will say the first chapter. The chapter which we completed, introduction, that is just a basic discussion. You will not be able to find a chapter called introduction to auditing in the study material of ICI. This is something which we have created to make you aware of the topics which you need to understand, the terms which you need to understand for having detailed understanding of the subsequent topics. So with that objective, this particular chapter called introduction to auditing has been introduced. Now let us start revising the chapter named nature, objective and scope of audit. So here, as you could see, this is what the chapter, very simple chapter, very easy chapter, very fundamental things will be there. Let us try to have one quick revision of this particular chapter. So first, I will try to start revising with the different kinds of audit. See, practically speaking, let me ask you one simple question before I start this. Is audit mandatory for each and every organization? Is audit of the entities legally mandatory for all the organizations? The answer is straight away no. Audit is not legally mandatory for all the organizations. So depending on applicability of law, depending upon the requirements of the law, audits are broadly divided into two categories. Depending on requirements of law, the audits are broadly divided into how many categories? Two categories. Let us see what are they. So the two types of audit are number one, statutory audit and number two, non-statutory audit. So as we all know, the statutory audit, statute means requirement of laws and regulations. So those audits which are mandatorily required under any law for the time being in force, that we call it as statutory audits. So those audits which are mandatorily required as per the time being in force, as per any law for the time being in force, those audits we call them as statutory audits. Like if I have to give you examples for statutory audits, number one, company audit, which is actually mandatorily required under Companies Act 2013. I will say cooperative societies audit, which is required mandatorily under Cooperative Societies Act 2000, Cooperative Societies Act, and even we have this banking bank audit, which is mandatory under Banking Regulation Act. So like that, those audits which are mandatorily required under any law for the time being in force, that we call it as statutory audit. Whereas when I say non-statutory audit, the name itself says these audits are not mandatorily required under any law for the time being in force, but client voluntarily on his own choice, if he is coming and voluntarily getting the accounts audited, that we call it as a non-statutory audit. So examples of this audits are sole proprietors audit or partnership firms audit, or any other entity you take where the audit is not mandatory but the client is voluntarily getting the accounts audited, that we call it as non-statutory audit. And you might get a doubt here, sir, even though audit is not mandatorily required by any law or organization, why do clients voluntarily come and get their accounts audited, sir? Why? Because by conducting audit, there will be various advantages. Audit of financial statements will give you various advantages. So what are the various advantages which will be there if any client gets their financial statements audited? Number one, it will protect the interest of the shareholders. Let me take you through that question simultaneously. So what are the advantages of independent audit? Number one, it protects the interest of the shareholders. Like as you could see here, this particular answer, it safeguards the financial interest of the people who are not associated with the management. So you have to be very careful here, guys. Assume a true or false statements they are asking. It safeguards the audit of financial statements, safeguard the financial interest of the people who are associated with the management. Do you agree with that statement? No, the answer is false. The audit of financial statements protects the interest of the people who are not associated with management. Similarly, if you get the accounts audited, it acts as a moral check on the employees. It acts as a fear in the minds of the employees of the client from committing frauds or errors. It is helpful for settling liability for taxes. That means government will use your audited financial statements to determine whether you made the correct payment of taxes or not. And even it is helpful for negotiating the loans. If you have audited financial statements ready, you can directly go to the banker and have a better negotiation for the loans. And audit of financial statements will help in the settlement of trade disputes, insurance claims, etc. It is helpful for detection of wastages and losses which are happening in the organization. It is helpful for the client to find out whether necessary books of accounts are maintained by them or not. It is even helpful at the time of settlement of accounts, especially in the case of partnership firm at the time of admission or death of a partner. And finally, government also may require audited financial statements before they give any assistance like grants, etc. And even for giving businesses licenses for certain businesses, also government will ask you audited financial statements. So if you get your financial statement audited, these will be various advantages which company will enjoy. That's why any entity will enjoy. That's why even though the audit is not mandatory, some clients come and get their accounts audited. So those audits, we call them as non-statutory audits. So like this, on the basis of requirements of the law, audits are divided into two categories: statutory versus non-statutory. Now, few more points to differentiate between the statutory audit versus non-statutory audit. In the case of statutory audit, scope, objectives, that is what are duties of auditor, what are rights of auditor, what are duties of management, what are rights of management. So all these things will be decided under respective law. All these things will be decided under respective law. That means under whatever law the audit has been made mandatory, the same law will even tell you what and all will be your duties and responsibilities. Whereas when it comes to non-statutory audit, the duties and responsibilities, and that is scope and objectives of the auditor, will be decided by appointing authority through terms of engagement. Simply, whoever is appointing you, those people only will decide what will be your scope and objective. In which audit? In the case of non-statutory audit. Whereas when it comes to statutory audit, who will decide the scope and objective? They say respective law, and also they say terms of engagement. Which means in the case of statutory audit, law will decide the terms and conditions. But if the parties to the audit, that is if the client and auditor, if they want to extend the scope and rights of the audit, the scope and objective of the audit, they can extend it by way of mutual agreement. But in any case, the scope, the objective, which is already decided under law, can never ever be reduced. Those are bare minimum. If the parties to the contract, like if the client and auditor wants, they can extend the scope in the case of what? Statutory audit. But when it comes to non-statutory audit, exclusively the client will decide. There is no law interference there. But when it comes to statutory audit, first law will decide. But if the client and auditor want, they can extend the scope in the case of statutory audit, but they can never ever reduce the scope which is already decided. The scope decided by the law is bare minimum. Clear, everybody? Next one. So these are the main differences between statutory versus non-statutory audit. So we have covered two concepts, the differences between statutory versus non-statutory. As a part of that particular answer, we have even revised what are the advantages of independent audit also. Now, sometimes they will ask you a question: if you are doing audit, how you will satisfy yourself that financial statements are not misleading? Or even they might alternatively ask you a question: what are the factors which are required to be considered by the auditor before expression of an opinion? So that is what the question number one here, if you are able to see, they ask a few things here. Define the term audit, explain the points which the auditor should consider before expression of an opinion. Or even they might ask you a question alternatively: what are the factors which auditor should consider before expression of opinion? Or they might ask you a question: how the auditor would satisfy himself that financial statements are not misleading? So in multiple ways they can ask you the question. Now what answer you are supposed to write? What are the points which you will consider before expression of an opinion? So shall we have a look at it? Let us do it. See, very simple guys. Common sense you need to apply here, nothing else. Just a minute. Before I explain you about what are the points to be considered before expression of an audit, let me ask you, what is the main purpose of the audit? See, the main purpose of the audit, why audit as a function has been introduced, is to enhance, to increase the confidence of users of the financial statements. Why audit as a function has been introduced? The purpose of audit is to increase the confidence of the users of the financial statements. See, management does various activities in the organization. They will only prepare the financial statements. If those financial statements are directly given to the shareholder will not have confidence on those financial statements. He will not be able to comfortably take the decisions. So that's why what industry has thought is, once the financial statements prepared by the management, before they reach the ultimate user, in between, some independent party, independent qualified person like a chartered accountant should verify whether the financial statements are reliable or not. And if he expresses the opinion, that opinion will increase the confidence of users of financial statements, then they can comfortably make the decisions. So the purpose of audit is to increase the confidence of users of the financial statements. And also, auditor's opinion is not a guarantee. Auditor is just expressing an opinion. It is not a guarantee. It cannot be taken as guarantee regarding two things. So auditor's opinion is not a guarantee regarding future viability of the entity. Auditor has nothing to do with the future of the company. Auditor's opinion cannot be taken as a guarantee that the auditor is giving certification that company will continue in the future. No. So if I am giving positive opinion, nobody can take it as granted that I am saying company will continue comfortably in the future. No, we are not giving that guarantee. Our opinion has nothing to do with the future viability of the company. So that's why they say auditor's opinion is not a guarantee regarding future viability of the entity. At the same time, auditor's opinion is also not a guarantee regarding efficiency and effectiveness of management. Auditor's opinion is also not a guarantee regarding efficiency and effectiveness of management. When I gave a positive opinion, I am not saying that management are very honest, management are effective, superb management. No, I have nothing to do with the efficiency and effectiveness of management. When I am giving opinion, my opinion is just related to historical financial information, and that too I am giving only opinion. My opinion is not a guarantee for future viability of the entity, and even my opinion is not a guarantee regarding efficiency and effectiveness of management. So that's what the implications of auditor's opinion. Now coming to the main answer, which is what points are to be considered by an auditor before expression of an opinion. Very simple. First thing, I need to check whether the financial statements are matching with the books of accounts. As we all know, the financial statements are prepared on some source data. And what is the source data for the preparation of financial statements? Books of accounts. So as an auditor, first point which I need to satisfy myself is whether the financial statements are matching with books of accounts. Next one, second point, whatever entries which are there in the books of accounts, they should be supported by sufficient and appropriate audit evidence. First thing I need to check, financial statement should match with books of accounts. Second thing, whatever entries in the books of accounts are there, they should not be just written out of the air. That entries in the books of accounts should have sufficient and appropriate audit evidence. Like if I have seen a purchase general entry in the books of accounts, I need to have a supporting document like a bill or invoice. If I find a rental entry, rent payment entry in the books of accounts, I need to have a supporting document like a rental agreement. If I am able to find an entry for payment of insurance premium in the books of accounts, I need to have a supporting document like an copy of insurance policy. So like that, every entry in the books of account should be supported by sufficient and appropriate audit evidence. And next one, none of the entries should have been omitted. I should make sure that there are no omissions. At the same time, nothing which is not in the books of accounts has been found in the financial statements, nothing but fictitious entries. So if I put it in simple terms, third point which I need to satisfy here is there should not be any omissions. At the same time, there should not be any fake entries. Only genuine entries should be there. Number 4, information conveyed in the financial statement should be clear and unambiguous. Whatever information that is getting presented in the financial statements, that should be clear, unambiguous, that should be understandable, which should not create any kind of confusion. The information in the financial statement should give clarity, it should not create confusion. That I need to check. And the financial statements are properly classified, described and disclosed in conformity with accounting standards. Nothing but whether the financial statements are prepared as per accounting standards or not, that also I need to check. And finally, whether the financial statements give true and fair view of operational results, nothing but profit or loss, and also assets and liabilities. So these are the 6 points which I as an auditor consider before expression of an opinion. So what are that 6 points, guys? Number 1, financial statements are matching with books of accounts. Number 2, entries in the financial statement, entries in the books of accounts should have proper evidence. Number 3, there should not be any omissions or fictitious entries. Number 4, information conveyed should be clear and unambiguous. Number 5, the financial statement should be prepared as per accounting standards. Number 6, finally, financial statements are giving true and fair view or not. So these are the points to be considered before expression of an opinion. Now let us try to proceed further with remaining concepts from this first chapter. So the next chapter, and in fact, whatever we are going to discuss in this chapter, nature, objective, and scope of audit, the entire source for this chapter, nature, objective, and scope of audit, is two standards. Two standards actually, SA 200 and SA 210. So SA 200 is the standard which from which majority of the chapter has been taken. At the end of this chapter, there will be a few questions regarding engagement letter, etc. Those are actually taken from SA 210. So when I say I am teaching you the chapter nature, objective, and scope of audit, in fact I am trying to teach you these two chapters, these two standards, SA 200 and SA 210. So now let us try to proceed further with remaining questions. So second question, if you observe here, what are the objectives of auditor as per SA 200? SA 200, the first and foremost standard on audit, whose title is Overall Objectives of an Independent Auditor and Conduct of an Audit in Accordance with the Standards on Audit. So SA 200, the first and foremost standard, like AS1 is the first and foremost standard in accounts, SA 200 is the first and foremost standard in audit. And that particular standard's title is what? Overall Objectives of the Independent Auditor and Conduct of the Audit in Accordance with Standards on Audit. Now this standard has given some objectives to the auditor. What are they? Which we already know. The auditor has to obtain reasonable assurance about whether financial statements are free from material misstatements and whether financial statements are prepared as per applicable financial reporting framework. This point we have already revised in the introduction. So two objectives, auditor need to express an opinion whether financial statements are free from material misstatements and whether financial statements are prepared as per applicable financial reporting framework. But they use the term here reasonable assurance. We will talk more about this term reasonable assurance when we are revising the concept inherent limitations. Just remember, SA 200 is asking you to obtain reasonable assurance, but what exactly is reasonable assurance? We will try to understand it in a short while. Clear? And also one more objective is there as per this SA 200. So one more objective is to report on the financial statements and communicate as required by the SAs in accordance with the auditor's findings. Finally, whatever your findings are there after completion of audit, all that findings are required to be reported, and those findings are required to be reported as per the respective standards on audit. So first you need to express opinion. After that, in your opinion, in your audit, whatever your findings are there, all those findings are required to be reported as per the relevant standards on audit. So this is what question number 2 is here. Now coming to the third point, now first we will go to fourth question, which is regarding what are the principal aspects to be covered in the audit. Sometimes they will ask a question like this, what are the main aspects or what are the principal aspects which are required to be covered in the audit. So let us try to have a quick revision. What are that principal aspects which are required to be covered in an audit? First thing, we need to cover accounting and internal control system. First main aspect which we have to cover in our audit is verify the client's accounting and internal control system. Sir, what is this accounting system? Very simple, whatever software, policies, procedures which the client is following for maintaining books of accounts, we call it as accounting system. If your client is using the software called Tally for the purpose of maintaining books of accounts, Tally is an accounting system. Similarly, what is internal control system? Internal control system means any policy or procedure which is designed by management to prevent the mistakes from happening in the organization. What do you mean by internal control? Those policies and procedures which are implemented by the management to prevent a mistake from happening in the organization, that we call it as what? Internal control. Like for example, the management has installed the CCTV camera and covering the entire premises of the organization. Installation of that CCTV camera is a internal control. The management has put a policy that before any employee can enter inside the company, they have to show their identity card and also give access to their biometric. Then only the gate will open. Policy followed by the management, internal control. And the management has put a policy that security guard will be appointed at each and every entry and exit point, internal control. So like that, any policy or procedure which is designed, implemented or maintained by the management to prevent mistakes from happening in the organization, we call it as internal control system. So accounting system means simply the software policy which they follow for maintaining books of accounts. Internal control means any policy or procedure which the management is following for preventing mistakes in the organization. And one of the main aspect which I as an auditor required to cover is I need to first examine their accounting system and internal control system to know whether they are appropriate with the business. One of the main aspect which I have to cover. First, I should try to understand what accounting system my client is following, what internal control systems my client is following, whether they help the organization in recording of all the transactions or not. First, I need to study the client's accounting system as well as internal control system. And whatever accounting and internal control system which I have examined, that I need to review. I need to verify in an in-depth manner to find out whether this accounting and internal control systems are having any material inadequacies and weaknesses. Whether these internal control systems and accounting systems are they suffering from any weaknesses which is creating an opportunity to fraud, or which is creating an opportunity for having a fraud or error. Very simple points, guys. First main aspect, accounting and internal controls. I need to check whether my client is having proper accounting and internal control system. Now I need to study that accounting and internal control system in a much more in-depth manner to find out whether these internal controls are suffering from any weaknesses which create an opportunity for fraud or error to happen. And next one, I need to check arithmetical accuracy. What do you mean by arithmetical accuracy? Mathematical calculation, addition, deletion, closing balances calculation, balance sheet tallying, profit calculation. So as we all know, accounts involve math, not the advanced math like algebra, etc. We have basic math in the accounts like additions, deletions, and the most complex math calculation in the accounts is division. That's all, nothing else. So I need to check whether all the calculations are done correctly in the books of accounts. That is, I need to check the arithmetical accuracy. But I don't feel this point is still relevant today. Why? Because today all the basic math is handled by the accounting software. So we can rely on the softwares on today's environment. But whatever it is, one of the main aspect which has to be covered in the audit is checking of arithmetical accuracy. Then the next main aspect which needs to be covered in an audit is, the next main aspect which needs to be covered in an audit, verifying authenticity and validity, genuinity and validity of the transactions. Sir, how to verify genuinity and validity, sir? Simply by checking the supporting documents. This is also one of the main aspect. Find out whether the transactions are valid or not by checking the genuinity with the help of supporting documents. And also, I need to mainly check whether there is a proper distinction made between capital and revenue expenses. Whether the management has made proper classification between revenue expenses and capital expenses. And also, whatever entries which are recorded, whether they belong to current year, none of the previous year's income or expense should be recorded in the current year. None of the future year's incomes and expenses should be recorded in current year. I need to check that also. Then I need to compare balance sheet and P&L and whether they are matching with the books of accounts or not. Nothing but same point as we have seen in question number 1, whether financial statements are matching with books of accounts or not, that I need to check here. That is also one of the main aspect. After that, I need to verify items of the financial statements, like I need to verify with it when respect to assets, whether the assets are existing or not, whether the assets are completely recorded or not, the value at which the assets are shown are correct or not. I need to verify the assets. Similarly, I need to verify the liabilities. Not just liabilities, I need to verify the items of P&L also. So that's why I have given one broad heading, verification of items of financial statements, verification of assets, verification of liabilities, verification of incomes and expenses. Another main aspect. Next point, in case if you are conducting audit of a statutory entity like company or corporate entity like company, LLP, etc. In addition to above all points, even I need to check the statutory compliances also. Whether the entities, whether my client entity is complying with respective laws and regulations which are applicable for them, that also I need to check. And last point, if you observe, reporting. After completion of the entire audit, whatever your findings are there, that findings you should not keep it to yourself. That findings should be reported. How to report it, sir? By expressing your opinion in a written document. That written document which contains the auditor's opinion only, we call it as what? Audit report. So these are the main aspects which are required to be covered in the audit. What are they? Number 1, we need to verify accounting and internal control related points, arithmetical accuracy, checking the validity and the genuinity of the transactions. Number 3, we need to check whether there is proper classification made between capital versus revenue, whether incomes and expenses belongs to current year, verifications of items of the financial statements, statutory compliances, and finally reporting. So these are the main aspects which are required to be covered in an audit. Now let us come to remaining questions. We'll talk now about question number 3. So what is that question number 3 about? Let us have a quick revision. So question number 3, write a short note on scope of audit. Or even they might alternatively ask you a question, what and all factors you have to keep in mind while deciding the scope of audit. Nothing but as an audit, what will be included in your scope, what you are supposed to do, what you are not supposed to do. If you ask me, this the points which we will see in this answer are not something new. It is actually a combination of few points which we have read in the question number 1 and a combination of few points which we have read just now in the principal aspects to be covered in an audit. So let us try to revise it, what they are trying to say here. As an auditor, when you are conducting audit, you should cover all aspects of the organization which are related to financial statements. When I say you are supposed to verify financial information, it is not just that the management will give you a copy of financial statements, the management will give you a copy of books of accounts. You have to verify only that pieces of paper which are given to you. No. All the enterprise, all the parts of the organization, all the aspects of the organization which are related to financial statements, auditor should cover all. Like for example, if you are able to see the amount of closing stock of 10 crore rupees in the balance sheet, you will have the responsibility to even go to the warehouse and check whether really in the warehouse the 10 crores worth of stock is there or not. So like this, an auditor should cover all aspects of the organization which are related to financial statements. Number 2, as a part of your scope, you need to check whether the financial information is reliable or not. Whatever financial information is there, which is there in the financial statements, is it reliable? Is it trustworthy? Is it trustable? Now, how can I find out, sir? By checking the underlying source data. So nothing but by checking the books of accounts. So sir, how can I find out whether the entries in the books of accounts are reliable or not? Very simple. Once again, study the accounting systems and internal controls. That's what we have read in the principal aspects. First point, no, just that is getting repeated. So as a part of your scope, you need to check financial information is reliable or not. How you will come to know financial information is reliable or not? By studying accounting system and internal control system. Similarly, we need to carry out other testing methods, inquiries like inspection, observation, recalculation, reperformance. So many other techniques will be there, which we will cover as a part of subsequent chapters. So we need to even carry out that other techniques and verification procedures to find out whether the financial information is reliable. Next, I need to check whether there are proper disclosures given in the financial statements. Nothing but, if I put it in common language, whether financial statements are prepared and presented as per applicable financial reporting framework or not, I need to check. This point we already know. Now the question is, how I will come to know whether financial statements are prepared as per applicable financial reporting framework or not. Just see what they are saying, comparing the financial statements with underlying books of accounts. Once again, repetition, whether the financial statements are matching with the books of accounts or not. See, this point has been repeated in question number 1, principal aspects question, even in the scope of the audit. And even I need to check whatever assumptions, whatever judgments which my client has made, whether they are reasonable or not. So as we all know, management will prepare financial statements after making assumptions about so many items. As an auditor, I need to check whatever assumptions and estimates which my client's management has made in the preparation of financial statements, whether they are reasonable or not. And even I need to check whether the accounting policies are properly applied or not. So by checking these 3 things, I will come to know whether the financial informations are presented and prepared as per applicable financial reporting framework. Sometimes what will happen is the client might come to you and ask you to perform some duties which are beyond your scope. Like for example, you are appointed as auditor of some company. Now one particular client, that client is approaching you and asking you, sir, we have appointed you as an auditor. No, there is a case pending in the court of law. You fight the case on behalf of us. Are you supposed to do? Is fighting the case part of your scope? Are you competent to do it? No. As an auditor, what is our scope? Verify the financial information. If the client is asking you to do something which is beyond your scope and competence, auditor can simply reject it on the face. Or similarly, if the client is coming and asking you, hey auditor, we have appointed you as an auditor, please come and do the repair of the machinery. Are you supposed to do it? That is beyond your scope. That is beyond your scope and capability. So you are not supposed to perform those activities even if the client is requesting, which are beyond your scope and competence. You are straight away reject it on the face. And finally, in case if the management is putting a restriction on the scope, constraint on the scope, sir, what if the management is restricting me from not doing the audit, sir? They're not giving me access to the books. They're not letting me verify some aspect of the organization related to financial statements. Management is not giving me whatever information I'm asking. So like that, in some cases, what could be possible is the management might put a restriction on the scope of your work. They will not let you do the work properly. In that case, the standard has told one simple thing: if there is any restriction on the scope, the auditor can mention the same in the auditor's report. What auditor can do? You can mention the same in the auditor's report. Whatever restrictions that you have faced while doing the audit, without any hesitation, mention everything in the audit report. The management restricted me on these matters. So these are the aspects which are required to be considered while deciding the scope of audit. So what are the aspects which are required to be considered while deciding the scope of audit? We should cover all aspects of the organization related to financial statements. We should check the reliability of underlying information or financial information. We need to check whether financial statements are we need to check whether financial statements are properly prepared and presented as per applicable financial reporting framework. If they are asking us to perform some duties which are beyond our scope and competence, straight away reject it on the face. And if there is any restriction on the scope put by the management on your work, mention the same in the auditor's report. So this is what question number 5 is about. Sorry, 4 is about. But anyhow, question number 5 we have already completed, which is regarding different types of audit on the basis of requirements of law. Question number 6 also I have covered what are the various advantages. Now we will try to understand remaining concepts regarding this particular chapter. So first we will talk about qualities of an auditor. So if you want to become a good auditor, what kind of qualities you need to possess? So as per the standards, in order to become a good auditor, we need to have two kinds of qualities. One is professional or technical qualities and the other one is personal qualities. Professional or technical qualities are nothing but the list of our subjects. So if you want to become a good auditor, you need to have very good knowledge of accounting. You need to have very good knowledge of auditing. You need to have good knowledge of laws, general laws and also specific laws. You need to have very good knowledge of taxation related laws. You need to have knowledge of general management, computer and information systems, nothing but economic related matters. So if they ask you what are professional or technical qualities, without any second thought, just write the list of all the subjects which you are reading as a part of CA Inter. So professional qualities or technical qualities are nothing but the subjects over which we need to have good knowledge. Then just having professional qualities alone will not be enough. Even auditor need to have good personal qualities also. Like what kind of personal qualities, sir? When I say personal, when I give examples, like auditor should be a cautious person. He should be a careful person. He should have he should be doing the audit with utmost care. So let me show you that particular question. Qualities of an auditor. Yeah. So personal qualities like tact. You should be an intelligent person. Caution. You should be a careful person. You should be having firmness, strong enough, not physically strong. You have to be professionally, knowledge wise and decision wise you should be strong. Good temper you should have. You should maintain good temper towards the client. Integrity, you should be honest person. You should have decision making capability, and even you should have relevant experience of the industry. You should have good understanding of the industry. Judgment, good decision making capability should be there. Hell, a lot of patience is required. Clear headedness, clarity of thought is required. You should have a person, you should be a reliable person. The client should come and trust you. Such a reliable person you should be. So in order to become a good auditor, you should have all those good qualities which a good person will have. Whatever qualities that make a good person, all those qualities will be required to make a good auditor. So in order to become a good auditor, you need to have both personal qualities as well as professional qualities. Both should go hand in hand. So this is what regarding qualities of an auditor. Now talking about the next important concept, there are some ethical requirements which every auditor must comply with. In order to be called as a good auditor, the auditor should have some ethical requirements. And in fact, there are 5 ethical requirements which auditor must comply with. Number 1, integrity. Number 2, objectivity. Number 3, confidentiality. Number 4, professional competence and due care. And the last one, professional behavior. So these are the 5 ethical requirements which every auditor must comply with. Name them once everybody. What are the 5 ethical requirements? Integrity, objectivity, confidentiality, professional competence and due care, and professional behavior. So let us try to understand what does each of this ethical requirement mean. Number 1, integrity. Integrity means auditor should be a honest person, sincere person, straightforward person. He should not associate himself with any document which he believes to be false. On one hand, you are believing that information is false. How can you sign and let the others make believe that information? You can't do it. So being an auditor, you should be a honest person. Don't associate yourself with any other document which you believe that contains a false or misleading information. Number two, objectivity. Objectivity means unbiasedness, impartiality. You should not show bias towards any clients. You should be fair enough while making decision. Confidentiality. Being an auditor, we enjoy a privilege. We get all the information from the client. Client will not say why I should provide this information to you, to the auditor. This question will not be raised by the client. So being an auditor, we are enjoying such a privilege, and that privilege comes with responsibility also. Whatever information that we are getting it from the client, that information should be kept confidential. You should not go and distribute it to everybody. So sometimes while doing audit, we might get access to price sensitive or confidential information of the client. That information should be kept secretive. That should not be disclosed. Fourth ethical requirement, professional competence and due care. Nothing but our profession deals with such subjects which requires continuous updation. Every year, finance minister comes and conducts a meeting on February 1st. Budget will come, tax laws undergo changes. Once in a while, GST council will meet, they will release a circular, indirect taxes laws will undergo changes. Sometimes laws will be scrapped altogether, a new law will be introduced. Like Companies Act 1956 was scrapped and Companies Act 2013 was introduced. All the earlier indirect tax laws were scrapped and new indirect tax law GST has been introduced. So being an auditor, we deal with such as subjects which undergo continuous changes. Being an auditor, it is our responsibility to keep ourselves updated with all the changes which are happening in our subjects. That is what the meaning of professional competence. We have to make ourselves competent by updating our knowledge on all the updates happening in our professional areas. And also we should have due care or diligence also, you can say. That means we have to do the audit with utmost care. We should not be negligible while doing the audit. Then last one, professional behavior. Whatever work we are doing, that work should be as per laws and regulations, and we should not do anything which brings a discredit to the profession. We should not do any such task which brings a bad name to the profession. So these are the 5 ethical requirements which every auditor must comply with. What are they? Integrity, objectivity, confidentiality, professional competence and due care, and professional behavior. These are 5 ethical requirements. Now we will try to understand few more concepts relating to relating to independence. So independence is something which I have explained at the time when I am revising the definition of audit. So I told audit is an independent examination. So what is the meaning of the term independence? Like as I've already explained, the term independence means the auditor should be able to take decisions without any influence from others. So that's how the term independence has been defined. The judgment of a person should not be subordinate. The judgment of a person should not be changed. The decision of a person shall not be changed according to the wishes or directions of another person, especially who have engaged him. So at the time I am an auditor, if I am taking decision, I should take the decision without getting influenced by my wishes, without getting influenced by directions and wishes of the management who have appointed me. So if I think something is wrong, I should say it, yes, this is wrong. Before giving that negative opinion, I should not think what my client what will happen to my client if I give a negative opinion. The moment that thought comes to your mind, independence has gone to hell already. So like this, as an auditor, you should have such an important quality or characteristic, independence, which means your decision should not be changed according to the wishes and directions of another person, especially those who have appointed you. And whenever I say independence, there will be 2 aspects related to independence. Or I can say it as independence will be of 2 types. Independence of mind, and the other one is independence of appearance. Independence of mind, and the other one is what? Independence of appearance. So independence of mind means it is a state of mind which makes a person to take the decision without any bias. Independence of mind means what? It is a state of mind. It is an agreement of mind. If I agree in my mind to act independently, if I am making a decision in my mind, I am doing audit of this client, I will not show any kind of bias. I will not change my decision according to other person's wishes. Whatever I feel it as correct, that only I will say. So if I made a state of mind, if I made an agreement of my mind to act independently, that we call it as independence of mind. Whereas independence of appearance means I should be not related to any of my clients. Like for example, if I am conducting audit of a client, audit of a company in which my father is a director, I am not appearing to be independent here. What is causing me to compromise on the independence? I am having one close relationship with the client for whom I am doing the audit. So not having any kind of close relationship with the client for which you are doing, that we call it as independence of appearance. So independence of mind means it is a state of mind. If I agree in my mind, for example, I am doing audit of the client X Limited. In this client, my father is a CEO. My father is a CEO. I am conducting audit of this client X Limited. Before going to the audit, I agreed in my mind. I will independently do the audit. I will not show any kind of bias. Okay, independence of mind is there, but you are not independent of appearance here. Why you are not independent of appearance? Why? Because it is clearly visible. You are not appearing to be independent. You are not looking as independent. Why you are not looking as independent? Why? Because you have a relationship with the client. No. Your father is a CEO of the company where you are looking as independent. So you are not appearing to be independent. You are not visible as independent. Understood? So independence will be of two types. One is independence of mind and the other one is independence of appearance. Independence of mind means it is agreement of mind to act independently. Independence of appearance means not having any kind of relationship with the client which will make your independence getting compromised. So like this, independence will be of two types. And there are some safeguards to independence. Sir, how to protect my independence? So what the standard will simply try to say is, before accepting the audit only, check whether you will be able to do the audit independently or not. Before you say yes to the audit assignment, before accepting the audit only, you have to make an assessment. If I accept this particular client's audit, am I in a position to do the audit independently, or is there a possibility of compromising independence? If you feel that yes, I can act independently, then only accept the audit. If you feel that there is some threat to independence, there is some danger to the independence, there is a possibility of compromising on the independence, then don't accept the audit only. I'm talking about before accepting the audit. So before accepting the audit, check whether you can do the audit independently. If in case if you find any threat to independence, check whether you can remove it. If you are not able to remove that threat to independence before accepting the audit only, you know that don't accept the audit at all. Now, sometimes what will happen is, after I have accepted the audit, then I will come across some threat to independence. Then what I should do? At the time of accepting, no threat to independence. But after accepting the audit, sometimes I might face some threat to my independence, danger to my independence. Then what the standard is, then what the standard tries to say is, if after accepting the audit, if you are facing any threat to independence, there also, if possible, try to eliminate it, try to remove that threat. If you are not able to remove that threat, withdraw from the audit. What the standard is suggesting, altogether resign from the audit. No longer you are permitted to continue the audit. So like this, there are some general safeguards which an auditor needs to follow to protect his independence. Before accepting the audit only, check whether you have any danger. If yes, remove that danger. If you are unable to remove that danger to independence, eliminate from, don't accept the audit only. After accepting the audit, then if any threat arises, if possible, try to remove it. If you are unable to remove it, then withdraw from the audit. Clear? So these are the safeguards to independence. Now I have one more point to explain, which is threats to independence. Which is what? Threats to independence. So there are some threats to independence. When I say threat to independence, which means there are some events or circumstances which have a possibility of auditors' independence getting compromised, which has a danger of auditors' independence to get reduced. So what are that threats to independence? Let us try to understand them. So IFAC, there is an international federation called IFAC. That IFAC has identified 5 kinds of threat to independence. How many threats they have identified? 5 threats. Who identified? IFAC, International Federation for Accountants, has identified 5 threats to independence, which are, as you could see here, self-interest threats. Then you will have self-review threats. After that, advocacy threats, familiarity threats, and intimidation threats. So let us try to understand what are these 5 threats and when do they occur. First, talking about self-interest threat. Self-interest threats occur when the auditor is getting benefited from some financial interest in the company. Self-interest threats occur when the auditor is getting from financial interest in the company. Like examples are, you are having shares in the company, or you have taken some loan from the company, or you are exclusively dependent on client's fees. You are not having any other client, you are exclusively dependent on client's fees, or you have close business relationship with the client, or you are expecting a potential employment with the client. That means the client is offering you, I will make you CFO next year. Or your client told, I will tell the fees after completion of audit, contingent fees for the audit engagement. That means your client is saying, sir, you do the audit, I will decide the audit fees after completion of the audit. That means he is indirectly coming with a favor that, sir, if you give me a positive opinion, I will give you more fees. If you give me unfavorable opinion, I will give you less fees. So like this, if the auditor is having benefited from some financial interest in the company, then which kind of threats occur? Self-interest threats occur. See, the most example thing in this particular answer is you have to remember this example. Which example will fall under which threat? This is most important. They might ask you in the form of case scenario based MCQs, or even they might ask you in the form of true or false statements. So please thoroughly go through the examples of all the threats to independence. Very important. I do expect in this attempt they might definitely ask a question, either a true or false statements, or in the case scenario based MCQs regarding this threats to independence. They will give an example and find out which kind of threat it is. Clear? So this is what self-interest threat, when auditor is getting benefited from some financial interest in the client for which he is doing the audit. Then we have next one, self-review threat. Sir, what is a self-review threat? So the name itself says the auditor is reviewing his own work which he has performed as a part of previous assignment. What do you mean by self-review threat? The auditor is reviewing his own work which he has done as a part of previous assignment. You are reviewing your own work. Like for example, you provided the services of accounting and bookkeeping services for the client and you prepared financial statements for them. After that, if the same client is asking you to do the audit, that is a self-review threat. Why? Because being an auditor, you have to verify financial statements and books of accounts which are prepared by yourself. Self-review threat. Or you have been the director of the company for some while, and once you resign from the director, the company is appointing you as an auditor. So here also self-review threat. How come? Why? Because if you are a director in the company, you would have already associated in the preparation of financial statements. Now, if you are appointed you as an auditor, you are supposed to verify the same financial statements which you have verified. Understood? So this we call it as self-review threats, when auditor is reviewing his own work without which he has performed as a part of his previous assignments. The third one comes advocacy threat, and when this advocacy threats occur is when the auditor promotes the client's opinion without any reasonable basis. When the advocacy threat occur, when the auditor is supporting the client's opinion without any reasonable basis. See, this will mainly happen in the case of when the auditor is acting as a client's advocate for income tax related cases, etc. For example, if a company appointed auditor to fight the income tax case for them. So when auditor is appointed as an advocate, his objective will be to support the client. Advocates know that their clients will do the mistake, but still they will try to support the client. So a company has appointed an auditor, a chartered accountant, to fight the case for them before income tax department. Now, being an advocate, he has to support the client's opinion. Even after knowing your client has done a mistake, still you will try to support the client. If the same chartered accountant is appointed as an auditor, what will happen is you have to find the mistake. You have to report the mistake. So you are holding two contradictory positions. Acting as an advocate, you are supporting the client's mistake. Acting as an auditor, you have to report the mistakes. At one place, you have to say your client is correct. At another place, you have to say the client is wrong. So exactly two contradictory positions. So this is called as advocacy threats. Somewhere independence will get compromised. So advocacy threats occur when the auditor promotes the client's opinion without any reasonable basis. Then finally, familiarity threat. The familiarity threat, the name itself says these kind of threats occur when the auditor is having some close personal relationship with the client. When the familiarity threat occurs, when the auditor is having some close relationship with the client for which he is doing the audit, like the auditor is having some close relative who is in the top level management of the company, or you are acting as an auditor for significant amount of time, for last 20-30 years you are continuously acting as an auditor of a company, or even you are accepting significant gifts and hospitality from the client. So here also examples are very important. So please make sure that you are going through the examples. Understood? So one conclusion is familiarity threat occurs when the auditor is having some close association or relationship with the client which is auditing. And then finally we have intimidation threat. Intimidation threat, as the name itself says, auditor wants to act independently, but he is being threatened from acting independently by way of blackmailing, by way of threatening, by bringing a pressure on him to reduce the audit fees, or giving some blackmail threats. So the auditor wants to act independently, but he is prevented by the client from acting independently by way of threatening, blackmailing, etc. That we call it as intimidation threat. So these are the 5 threats to independence which are identified by whom? Which are identified by IFAC, called full form is International Federation for Accountants. What are the 5 threats which are identified? Self-interest, self-review, advocacy, familiarity, and intimidation threats. Clear? So this is what the concept of independence. We understood meaning, types of independence, and even we understood safeguards to independence. At the same time, we have even understood what are the threats to independence. Clear everybody till here? Now we will now we will try to revise the most important concept from this particular chapter, which is inherent limitations of audit. Very important concept from the examination perspective. So let us try to revise what is this inherent limitation and what are those inherent limitations. First of all, the meaning of the term inherent limitation. So they say that the process of auditing is suffering from some drawbacks or limitations which are of such a nature that no matter whatever you do, you cannot avoid them. The process of auditing is suffering from some limitations which are of such a nature that too unavoidable. Those limitations are of such a nature that no matter whatever you do, those limitations cannot be avoided. So the process of auditing is suffering from some limitations which are unavoidable in nature, and those limitations we call it as inherent limitations. The process of auditing is suffering from some limitations which are of such a nature which are unavoidable in nature. Those limitations we call them as inherent limitations. And because of these inherent limitations, there are some consequences. Because of these inherent limitations, there are some consequences. Number one, because of these inherent limitations, the auditor can only obtain reasonable assurance but not absolute assurance. Because of these inherent limitations, we can expect auditor to only obtain reasonable assurance but not absolute assurance. Now, what is the meaning of reasonable assurance, sir? The term reasonable assurance has been defined something like this. Reasonable assurance is a high level of assurance but not absolute assurance. How the term reasonable assurance is defined? It is a high level of assurance but not absolute assurance. Now, first we need to understand what is absolute assurance. Absolute assurance means giving 100% guarantee. And the standards are saying that as an auditor, you can get high level of assurance, you can get high level of confidence, but auditor can never ever get absolute assurance. Auditor can never ever give guarantee. So because of inherent limitations, auditor can only obtain reasonable assurance. Auditor can obtain only high level of assurance, but he can never ever obtain absolute assurance. That's why from the beginning I was always saying auditor can only express opinion, but I never said auditor will give a guarantee. So why auditor can't give guarantee, sir? Why auditor can't obtain absolute assurance, sir? Why? Because there are some limitations. These are these inherent limitations which will make the auditor's opinion can go wrong. Understood? So because of these inherent limitations, there is a possibility that auditor's opinion can go wrong in the future. That possibility will always be there. No matter how effectively you do the audit, no matter how sincerely you do the audit, no matter how much effort you put from the auditor's side, still there will always be a chance of auditor's opinion going wrong because of inherent limitation. So that's why we always say auditor can only obtain reasonable assurance but cannot obtain absolute assurance. Sir, why auditor cannot obtain absolute assurance, sir? Why? Because it is suffering from some inherent limitations. Not just that, there are even other implications also. Like as I was telling, always auditor can only give opinion but not guarantee. Sir, why auditor can give only opinion? Why not guarantee, sir? Once again, the reason is inherent limitations. Number 3, because of inherent limitations, there is always a auditor's opinion can go wrong in the future. So because of inherent limitations, no matter how effectively you do the audit, still there will always be a chance for auditor's opinion going wrong. And also there is always audit risk associated with the auditor. Audit risk cannot be eliminated or audit risk cannot be reduced to zero. So audit risk means nothing but risk of auditor's opinion going wrong. And I am telling, because of inherent limitations, there is always a possibility of auditor's opinion going wrong. When I say there will always be a possibility of auditor's opinion going wrong, that means there will always be a audit risk no matter whatever you do. So audit risk cannot be eliminated or audit risk cannot be reduced to zero. So these are four implications of inherent limitations, or because of these inherent limitations, this is what the impact will be there on the audit. So what are the four implications of inherent limitations? Everybody repeat. Auditor can only obtain reasonable assurance but not absolute assurance. Auditor can express only opinion but not guarantee. There is always a possibility of auditor's opinion going wrong. Auditors can never be eliminated. Auditors can never be reduced to zero. There will always be a audit risk. What is the single reason for all these four consequences? The single reason is the process of auditing is suffering from some limitations, which are of what nature? Avoidable or unavoidable? Which are of unavoidable in nature. Because of this, these many consequences will be there. So we understood what are the consequences of inherent limitations, but what are inherent limitations? What are inherent limitations of audit? So inherent limitations are of four types. Let us try to understand what are that four categories of inherent limitations. Four types of inherent limitations are there. So which we have given it here in question number 7. Let us try to have a look at it. So what are inherent limitations? Number 1, as you could see here, nature of financial reporting. Number 2, the second inherent limitation, which is nature of audit procedure. Third one, timeliness of financial reporting and balance between benefit and cost. And then finally, we'll have one more thing, which is other matters or other limitations also you can say. So let us try to understand what is this each category of inherent limitation. First, we will start with nature of financial reporting, which means that financial reporting means the process of preparation and presentation of financial statements. And the first limitation, what they are saying is the process of preparation of financial statements itself suffers from some limitations. The process of preparation of financial statements itself suffers from some limitation. Now, what is that limitation? So, the limitation is the management while preparing financial statements, there will be various items of the financial statements where management cannot measure everything with accuracy. Some items involve making of assumptions and estimates by the management. There will be various items of the financial statements where management cannot exactly calculate the amounts. They need to do some assumptions and estimates. Like if you take depreciation calculation involves a lot of assumptions and estimates. Like useful life, residual value, all these are assumptions. Provision for bad and doubtful debts, once again assumptions and estimate. So like this, the management while preparing financial statements in different areas, they are required to make assumptions and estimates. And whenever I am saying that I will use assumption and estimate, there is always a there will always be a possibility for that estimate going wrong or not. What do you mean by estimate? When you don't know something with accuracy, then we use estimate, no? And when I say I'm using estimate, that estimate will always have a possibility of going wrong or not. Similarly, the management will make assumptions and estimates while preparing financial statements, and these assumptions can go wrong in the future. And when these assumptions go wrong in the future, financial statements also go wrong. And when the financial statements go wrong in the future, auditor's opinion also will go wrong. Like for example, in year 1, the company has bought some plant and machinery. They made an assumption that plant and machinery will work for 10 years. But in the second year, what happened is because of short circuit, that entire plant and machinery got burnt. So management calculated the depreciation, estimating useful life as 10 years. This is what the estimate they have made, but actual life turned out to be 2 years only. Now, your assumption has gone wrong. If your assumption has gone wrong, financial statements also will go wrong. No. If that financial statements has gone wrong, the opinion given by the auditor on that financial statements also will be wrong. But is it mistake of auditor? No, it is not a mistake of auditor. This limitation is there with the financial reporting process itself. What is that limitation? Usage of assumptions and estimates. Can this limitation be removed? Removing this limitation means what? Preparing the financial statements without using even a single assumption or estimate. Can you do that? No, we can't do it. We can't do it. So the process of auditing is suffering from some limitation, which is nature of financial reporting, which means the financial statement preparation process itself is suffering from some limitation, which is usage of assumptions and estimates. And these assumptions and estimates can go wrong in the future. And when these assumptions and estimates go wrong in the future, obviously financial statements also will go wrong, which can make auditor's opinion also can go wrong. Clear? So that is the first inherent limitation, nature of financial reporting. Now talking about second inherent limitation, which they are saying the nature of audit procedures. What is the second inherent limitation? Audit procedures. Now, audit procedures are also suffering from some limitation. The procedures which will be performed by the auditor, they are also suffering from some limitation. What is that limitation is, because of some practical constraints or because of some legal limitations, the auditor might not be in a position to obtain audit evidence. Either because of practical limitations or because of legal limitations, sometimes auditor might not be able to get the evidence. And if you are expressing the opinion without obtaining the evidence, then obviously there is a chance of your opinion going wrong. No. So that is what the limitation associated with nature of audit procedures. Because of some practical limitations or because of some legal limitations, auditor will not get all the evidence required. Like some examples of the circumstances also they are telling, because of which auditor might not be able to obtain evidence. Number one, management themselves may not provide the information, either intentionally or unintentionally. You go to the management and ask them some information. Management themselves might not provide the complete information to you. And if the management themselves are not providing complete information, then obviously you are expressing the opinion on insufficient evidence and your opinion can go wrong. And sometimes, no matter how effectively you perform audit procedures, frauds will be carried out in a very sophisticated and careful manner that fraud, no matter how effectively you perform audit procedures, you might not be able to find it out. So sometimes fraud may involve sophisticated and carefully organized schemes which are designed to hide it. So whatever audit procedures which you perform to gather audit evidence, those normal audit procedures might not be able to gather audit evidence regarding frauds which are sophisticatedly and very carefully carried out. Like PNB scam happening from past few years. Don't you think auditors were able to find it out? Might not be. Why? Because the fraud might be carried out in a sophisticated manner. They have carried out in a very careful manner. So even auditor, after putting all their efforts also, they are not able to find it out. So like this, sometimes frauds will be carried out in a very sophisticated and carefully organized manner. No matter how effectively you perform audit procedures, you might not be able to identify those kind of carefully organized scams and frauds. And then finally, audit is not like an investigation, official investigation. So you might have heard about official investigations, like income tax raid will happen, where their officers, government officers will come with lot of supreme powers. They will come and break somebody's wall. They will come and break somebody's premises to find out the black money. Do you think auditor also will have all that powers? If you are conducting audit of some company, can you break the walls of the client? Can you break the ceilings of the client? Can you cut the communication, stop the movement of the client? No. Then what client will do? Then what client will do if you do these kind of things? He will hold you by the collar and throw you out of the company. So being an auditor, our audit is not like investigation. So whatever powers that are available for official investigators, those powers will not be available to the auditor. Since we don't have such extreme super powers, so we can't obtain all the evidence required. So the process of auditing procedures itself is also suffering from some limitations. Because of practical and legal limitations, we can't obtain audit evidence. And if we don't obtain audit evidence, then our opinion can go wrong. And 3 examples they have given regarding that limitation. Sometimes management will not provide you with the information. Sometimes fraud will be carried out in a sophisticated and carefully organized manner. And audit is different from investigation, so some powers might not be available for us. Then talking about the third inherent limitation, time and cost benefit comparison. See, as we all know, audit has to be completed within a reasonable time and cost. You will not be given enough of time. You will not be given 2-3 years of time to complete the audit. You will not be given thousands of crores of money for doing audit. So audit always has to be completed within reasonable time and reasonable cost. See, if audit has to be completed within reasonable time and cost, can we do 100% verification of the client? No. Assume Reliance Industries Limited. If you want to do 100% verification of Reliance Industries Limited, it will take 2-3 years of time. But auditor will not be given that much amount of time. Audit report has to be given within reasonable time and within reasonable cost. If auditor has to complete the audit within that reasonable time and cost, there is no other option. Auditor has to verify the transactions on sampling basis. Obviously, no. That's why we follow sampling in the audit. But if you follow the sampling basis, there is a risk there. What is the risk by following sampling? Sampling means what? Out of 100% of the transaction, you verify only one small sample taken. Now, if out of 10,000 transactions, assume you have taken a sample of 1,000 transactions. If you verify 1,000 transactions, you are indirectly saying that you did not verify 9,000 transactions. In that 9,000 transactions which you did not verify, there might be a fraud also, there might be an error also. So, because audit has to be completed within reasonable time and cost, we have to verify the transactions on sampling basis. And if we verify the transactions on sampling basis, there is always a possibility of not finding out frauds and errors. Clear, everybody? So this is also one inherent limitation. But here there is one important statement, very, very important for true or false statements. The matter of difficulty, time or cost involved is not in itself a valid basis to omit an audit procedure for which there is no alternative. That means you can't simply use time and cost as a reason for altogether omitting audit procedure. You are not performing any audit procedure, and when someone is asking you, boss, why you did not audit procedure, why you did not perform audit procedure, can the auditor escape saying, I did not have enough of time, I did not have enough of cost, so that's why I did not perform audit procedure, that's why altogether I omitted audit procedure? Can the auditor use time and cost as a reason for altogether omitting audit procedures? No. See, time and cost constraint will save you only from not obtaining absolute assurance. Time and cost constraint will not save you from not even obtaining reasonable assurance. Within the limited time, within the limited cost, it is your responsibility to obtain reasonable assurance. If you do not get guarantee because of time and cost constraint, okay, law will spare you. But if you do not get reasonable assurance also within the limited time and cost, then law is not going to spare you. This sentence is very important. They can play with you like anything in the examination. So what they will ask you is, the matter of difficulty, time or cost involved is in itself a valid basis for the auditor to omit an audit procedure. Do you agree with that? No, it is not in itself. Sometimes what they will do is, entire sentence they will give as it is, but they will remove this word no. When there is alternative, they will say. But no, the sentence will make sense only when the term is when there is no alternative. So like this, they can play with you in the examination like anything. So please be careful about this particular sentence. They might twist the question in multiple ways. Sometimes they will remove not here. Sometimes they will remove no here. So sometimes they will say not to omit the audit procedure. So like that, they can play with you. Please be careful. These kind of sentences, you try to get the conceptual clarity. You try to read it twice or thrice and get hold of the concept there. Clear? This is the third inherent limitation. Now let us come to the last category of inherent limitations, which is other limitations. So first they have given three broad categories: nature of financial reporting, nature of audit procedures, time and cost constraint. Now there are some other limitations also which doesn't fall under above three categories. And the thing here is, in these other limitations, the severity of the limitations is even higher. In these other limitations, whatever they are about to explain in this paragraph, the severity of the limitations is much higher. So like if you read the introductory line here, in case of certain subject matters, limitations of auditor's ability to detect material misstatements are particularly significant. See, in this, which means that in the case of these other limitations, the chances for auditor's opinion going wrong are much higher. So what are that other matters? See, in one of the past examination, there was a question. They asked some question like this. In case of certain subject matters, nothing but this sentence they have taken. This sentence they have given as it is in the question. In case of certain subject matters, limitations on auditor's ability to detect material misstatements are particularly significant. Explain what are those matters. This is what the question. So they have given this statement: in case of certain subject matters, limitations on auditor's ability to detect a misstatement are particularly significant. Explain what are those matters. Nothing but they are indirectly asking you to write what are those other limitations in which the significance is very higher. So indirectly they are asking what are other limitations. Just you are supposed to write the 4 points given here, 3 marks. So the difficulty lies in understanding the question, guys. That's why I always say, when you are reading the subject of audit, conceptual clarity is much important. Just by hearting the content alone will not be enough. Understanding the concept is very important. By reading the question, you should be in a position to find out which question they are asking, to which concept this question belongs to. That is the most important thing in the auditing exam. Especially memorizing or by hearting the content is not going to help you out. So this is how the questions were tested. So now let us try to understand what are those other limitations where impact is very higher. Number one is fraud, particularly fraud committed by top level management, senior management. If they are involving in the fraud, there it is even more difficult to find than the employee committed fraud. And whenever there are existence of related party transactions, if there are related party transactions are there, then also the chances of auditor's opinion going wrong are very higher. Why? Because when it comes to related party transaction, the scope for manipulation will be much higher. And even non-compliances with laws and regulations, even auditor might not be able to find non-compliances with all the laws and regulations. So some non-compliances with the laws and regulations might not come to auditor's notice no matter how effectively he does the audit. Along with that, if there are any events or conditions which cause entities ability to stop as going concern, that is also very difficult to find out. So these four are other matters, other inherent limitations where the impact is much higher. What are that four other events? Number one, fraud, particularly involving senior management. Number two, existence of related party transaction. Number three, non-compliances with the laws and regulations. Number four, entities' ability to stop as a going concern. And if you observe carefully, each and every matter of other limitation will be covered in a detailed manner in the standards on auditing. So fraud regarding senior management, that will be covered in the fraud and responsibilities of auditor chapter. SA 550 will be covered in the standards on auditing. SA 250 also will be covered in the standards on auditing chapter, and SA 570 will be covered in the standards on auditing chapter. So these are the four matters where the impact of the inherent limitations is even more significant. So this is what regarding inherent limitations, four categories of inherent limitations we have seen: nature of financial reporting, nature of audit procedures, and then we have understood even time and cost benefit comparison, and then finally other limitations. Now we have one more small question. See, I told that audit is different from investigation. No, audit is an audit is not like an official investigation, so some powers might not be available for the auditor. Now in study material, there was one of the question. This is something newly added information in the study material. So I do expect this question is having high chances of getting tested in the examination. This question is having high chances of getting tested in the examination. So I will revise this also. Very simple. What are the differences between audit and investigation? They will ask you here. So if I tell you what is the difference between audit and investigation, see, investigation is a special assignment. Investigation is a special assignment. It will always be done with special purpose. Like investigation might happen for finding out the frauds. Investigation might happen only on one particular item of financial statements. Like investigation can only happen only in the area of purchases. So audit is different from investigation. Why? Because investigation is a critical examination, in-depth examination of accounts, always with a special purpose. What happens with a special purpose? Investigation always happen with a special purpose. Whereas audit assignment is a general assignment. We will not do audit only to find out frauds. Audit we do with a general objective of expressing an opinion. So it is a general assignment, but investigation is always a special assignment which will be done exclusively with the objective of finding out the frauds. And one more thing, audit will happen regularly. Whether you find a fraud, you don't find a fraud, year after year audit will happen regularly. But investigation will be happening only if required. Investigation will not happen year after year. Investigation will happen only when required. Whereas audit will happen year after year. Whether you find a misstatement, don't find a misstatement, whether you find a fraud, you don't find a fraud, all that doesn't matter. Audit will happen every year. Investigation will happen only when required. And one more point of difference, in audit we don't start with a completely negative attitude. In audit, we don't start with the notion that in this company compulsorily fraud is happened, I have to find it out. Will we start audit with this completely wrong notion? No. But investigation always starts with the wrong notion. If I am doing investigation, I will start with completely negative attitude only. In this company, there is some fraud which I have to find out. That's all. So audit will never start with completely negative notion, but investigation always starts with negative notion. And one more point of difference, if I have to say, audit is a reasonable assurance assignment, investigation is an absolute assurance assignment. Audit gives you reasonable assurance, whereas investigation will always give you what? Absolute assurance. In investigation, we try to get absolute assurance of the audit. Clear, everybody? And along with that, one more important point. Most of the cases, what will happen is investigation results from prima facie findings of the auditor. Which means in most of the cases, auditor will do the audit. He will have some findings. On that findings, detailed investigation will be ordered. This is what in most of the cases will happen. So this last sentence is very important. It is quite possible that sometimes investigation results from prima facie findings of the auditor. Whatever findings of the auditor are there from the audit, those findings may call for requirement of investigation. Clear? So these are the simple differences between audit and investigation, and I do believe that there are more chances that this question might get tested in the current examination. That's what I am believing. So that's why I thought of revising this particular point also. Clear everybody? Next one. Let us now try to proceed further with remaining concepts. Now we will discuss two important characteristics which every auditor must possess. So what are that two characteristics? Let me list them out. So the two important characteristics which every auditor must possess are: number one is professional skepticism, and number two is professional judgment. So there are two important characteristics or qualities, you can say, which every auditor must possess. Number one is professional skepticism, and the other one is professional judgment. So first I will try to revise what is this professional skepticism. Professional skepticism refers to three things. Number one, it refers to maintaining an attitude of questioning mind. Number two, it involves being alert to unusual circumstances, And number three, critical assessment of audit evidence. So professional skepticism includes the three things. It involves attitude of questioning mind, maintaining an attitude of questioning mind. You should not blindly believe anything. Whatever information that you are getting in the client, you need to have a questioning mind. So attitude of questioning mind. Number two, it involves being alert to unusual circumstances. Whenever you come across unusual circumstances, you should not ignore it. You have to remain alert to it. And whatever audit evidences which you are gathering, to that audit evidences, you have to make a critical assessment, critical analysis of audit evidence you have to do. So this, in short, I call it as ABC of professional judgment, ABC of professional skepticism, attitude of questioning mind, being alert to unusual circumstances, critical assessment of audit evidences. Now, when I am saying you have to remain alert to unusual circumstances, the standard has also given examples of unusual circumstances to which you should remain alert. So they have given examples of three unusual circumstances to which auditors should remain alert. Number one, you should remain one example of unusual circumstances is conflicting audit evidences. When you find conflicts between multiple audit evidences, see, for one item of financial statement, we can get evidence from multiple sources. When all the evidences are related to single item, they should all match with each other. But what is happening is, auditor got evidence from multiple sources regarding same item, but they are conflicting with each other. They are having mismatch against each other. So conflicting audit evidences is one of the example of unusual circumstance to which auditor should remain alert. And also, when you have doubts regarding reliability of audit evidence, whenever auditor comes across any circumstances of reliability of audit evidence, doubts regarding reliability of audit evidence, like you have seen some invoice, on that invoice corrections are there, so you are able to see some strike offs. So like that, whenever you come across any circumstances which bring into question the reliability of audit evidence, the trustability of audit evidence, that is also one unusual circumstance to which auditor should remain alert. Similarly, if you come across any situation of possible fraud, to these circumstances also you should remain alert. So three examples of unusual circumstances to which auditor should remain alert: when you have conflicts between multiple audit evidences, when you have doubts regarding reliability of audit evidences, and whenever you come across situations of possible fraud. And when I say you have to make critical assessment of audit evidences, that means you have to critically analyze audit evidence, whatever you have gathered. And when I say critically analyze audit evidences, you have to analyze audit evidence from multiple perspectives. Like you have to analyze, is evidence obtained is sufficient? Is evidence obtained is appropriate? Did you get the evidence from reliable sources? And is there any requirement of alternative or additional evidences? So like this, from multiple perspectives, you need to critically analyze the audit evidence. So what questions you have to ask regarding evidence? Whatever evidence that you have got, is it sufficient? Whatever evidence you have got, is it appropriate? Whatever evidences you have got, are they reliable? Whatever evidences you have got, will they be sufficient, or do you need any alternative or additional evidences? So these are three aspects of professional skepticism. And one more thing here, by maintaining an attitude of professional skepticism, auditor can reduce certain kind of risk. What will happen? By maintaining an attitude of professional skepticism, auditor can reduce certain kind of risk. So what kind of risk will be reduced by maintaining an attitude of professional skepticism? Three kind of risk will be reduced. Number one, overgeneralizing while taking decisions. By maintaining professional skepticism, the auditor can reduce the risk of overgeneralizing while taking the decisions. What do you mean by overgeneralizing? Overgeneralizing means, I started with the verification of purchases. I did not find any misstatement in the financial statements. Now, doing overgeneralization means I'm coming to a conclusion that since in the purchases I'm not able to find misstatement, in all other areas also there will not be misstatement. This is overgeneralization. Is this overgeneralization good or bad? This is bad. But if you have a questioning mind, you will not do this overgeneralization. If you have questioning mind, you will feel that if in the purchases area there is no misstatement, there could be misstatement in other areas. So by maintaining professional skepticism, you can reduce the risk of overgeneralizing while taking decisions. Number two, by maintaining professional skepticism, you can reduce the risk of overlooking unusual circumstances. You will reduce the risk of ignoring unusual circumstances, you will pay more attention. Similarly, by maintaining professional skepticism, you can reduce the risk of taking inappropriate decisions regarding audit procedures. That means by maintaining professional skepticism, you will take more appropriate decisions, which is indirectly told as it will reduce the risk of taking inappropriate decisions, which means you will have a chances of taking more appropriate decisions. So by maintaining professional skepticism, these three kinds of risk will be reduced: overgeneralizing while taking decisions, overlooking unusual circumstances, and taking inappropriate decisions regarding audit procedures. This is what simply the meaning of professional skepticism. Now, one more quality which every auditor must maintain is professional judgment. Professional judgment simply means whatever decisions the auditor is taking, that decision should be on the basis of knowledge, experience, and training of the auditor. Whenever auditor has to take the decisions, he should not come to a decision whatever comes to the mind. For example, he has to take a decision regarding positive opinion or negative opinion. He can't simply take a 1 rupee or 2 rupee coin and toss it and say if heads comes positive, if tails comes negative. No, your decision should not be like this. Whatever decisions which are taken by the auditor, that should be supported by auditor's knowledge, experience, and training. So the ability of the auditor to take decisions using his knowledge, experience, and training, that capability we call it as professional judgment. And auditor, whenever he has to take the decision at the beginning of the audit, at the occurrence of the audit, or at the conclusion of the audit. So throughout the audit, whenever auditor is required to take the decisions, the auditor should take all that decisions using his knowledge, experience, and training. That quality of the auditor, we call it as professional judgment. That's all. This is what regarding professional skepticism, professional judgment. With this SA 200 related discussion we have completed. Now let us try to proceed further with remaining concepts from this particular chapter. We will try to have quick understanding regarding them. So now there is one small concept from SA 220 which says before you take a decision regarding accepting or continuing client relationship. Before you take a decision regarding accepting or continuing client relationship, what factors the auditor has to consider? Before you take a decision of accepting or continuing client relationship. But first we should know, SA 220, this concept is from. But before that, we should know when we will take a decision regarding acceptance, when we will take a decision regarding continuing of the client relationship. So like for example, if a new client is approaching and asking you to do the audit for the first time. You have no past experience working with the client has come to your office for the first time and asking you to do the audit for them. If you have to take a decision, here what decision will you take? When a new client approaches you and asks you to do the audit, will you take a decision regarding accepting or continuing? Here you have to take a decision regarding whether to accept the client relationship or not. Sometimes existing client only will approach. You know the client already very well. In the past year also you have done some audits for him. So if an existing client comes, but if he is coming with a new engagement, existing client, but what? New engagement, just a minute. When existing client is coming to you, but he is bringing a proposal for new engagement. Like last year for X Limited, I have done the company audit. In the current year, the same client X Limited is approaching me and asking me to do the tax audit. Same client only, existing client only, but he is coming with a proposal of new engagement. Last year I did company audit. In the current year, he is asking me to do tax audit. So if the existing client is there, but he is coming up with a new engagement, here also I have to take a decision regarding whether to accept or not. But existing client, if he is coming with a proposal of existing engagement, then I have to take a decision whether to continue the client relationship or not. Like last year I did the company audit for X Limited. In the current year also, the same client is coming to me and asking me to do company audit only. So existing client, existing engagement, I have to take the decision regarding continuation of client relationship. So whatever it is, before you take a decision whether to accept a client relationship or before you take a decision whether to continue the client relationship, what factors auditor will consider? And those factors are given under SA 220. Those factors are given where in essay 220, and essay 220 will ask you to consider 4 factors before taking that decision. So what are that 4 factors? Number 1, you have to consider integrity of the management and those charged with governance. Integrity of management and those charged with governance. Nothing but whatever client which has approached you asking you for doing the audit, you need to check whether the management of that client are honest people or dishonest people. If I came to know that the management of my client are honest people only, I will try to accept the audit. If I am a risk aversive auditor and I came to know that my client's management are not honest people, they are dishonest people, I will try to stay away from that audit assignment. So first I have to check integrity of the management and those charged with governance. Number 2, I need to check if I accept or continue this audit, am I in a position to comply with ethical requirements, especially independence. I need to check what? If I accept or continue this client relationship, am I in a position to comply with ethical requirements? That I need to consider. Similarly, I need to consider, am I competent enough? Do I have enough of competence and capability? If I accept this particular client's audit, do I have enough of time and resources to complete the audit? It should not be like out of excitement I have accepted the audit. Later I realized I don't have enough of time and resources to complete the audit. Now if I stop the audit in between, my client will suffer and even I will also suffer. So that's why before accepting or continuing the audit itself, you need to decide, do you have enough of capabilities to complete the assignment which you are accepting? Similarly, even I need to keep in mind significant matters which have arisen during the course of previous audit assignments. This point is particularly suitable in the case of existing clients. If you have already done some assignments in the past, if any significant matters have arisen during the course of previous audit assignments, I will consider them also while taking decision to decide whether to accept or continue the client relationship. So these are the 4 factors which auditor should consider before accepting and continuing client relationship, and where these factors are given in essay 220, the factors are given. Clear? So now we will try to understand essay 210, agreeing to the terms of audit engagement. One important topic from this essay 210 is engagement letter or letter of engagement. So now what is this engagement letter or letter of engagement? Engagement letter or letter of engagement is nothing but a written document which is given by auditor to the client. Which is given by whom? Auditor to the client. And what will be there in this written document, sir? Nothing but all the terms and conditions of the audit will be there. So engagement letter is a written document which is given by auditor to the client regarding the terms and conditions relating to audit. So that document which contains the terms and conditions relating to audit, rights of auditor, duties of the auditor, management duties, management responsibilities, fees. So all these terms and conditions are written down in a piece of paper which will be generally prepared by auditor and given to the client. So that written document only we call it as engagement letter or letter of engagement. Sir, what is the purpose of having that written document on a piece of paper? So simply to reduce the chances of misunderstanding between auditor and client. So if auditor and client, if they don't write the terms and conditions in the piece of paper, what will happen is tomorrow there might be so many conflicting issues between auditor and client. Like management will come and say auditor is required to prepare financial statements. Auditor will say, no boss, that is not my responsibility, it is your responsibility. But the client is not agreeing. So these kind of issues can come up between auditor and client. In order to reduce the chances of misunderstanding between auditor and client, before you are accepting the audit, all the terms and conditions relating to the audit will be put down on a piece of paper which will be generally drafted by the auditor and given to the client. Auditor also will sign it, client also will sign it. And one copy of this engagement letter will be kept with the auditor, one copy of engagement letter will be kept with the client, so that in future if any conflicts come, they can refer that engagement letter and solve that misunderstandings. Clear? And one more question here, where engagement letter is highly recommendatory, in the case of statutory audit or in the case of non-statutory audit? Engagement letter is highly recommendatory in the case of non-statutory audit. Where it is highly recommendatory? Non-statutory audit. Why? Because in the statutory audit, even if you don't have engagement letter, law will come to your rescue. Why? Because in case of statutory audit, law will tell terms and conditions. So in the case of engagement letter, even if you don't have engagement letter, law might come to your rescue. But in the case of non-statutory audit, there is no law which is governing the audit. So in the case of non-statutory audit, the chances of misunderstanding are very higher, and in case if the misunderstanding comes there, it will be highly difficult no law will come to the rescue. So that's why engagement letter is highly recommendatory in the case of non-statutory audits. And what contents should be there in the engagement letter? Let us have a look at it. What should be the contents of the engagement letter? So if we have a look at it, yeah. So contents of engagement letter, as you could observe here, title should be there, one appropriate heading should be given, generally at the center of the page, engagement letter or letter of engagement, heading will be given. Addressee will be there, addressee will be the management of the client. Then you have to include a paragraph regarding objective and scope. A paragraph should be there explaining about responsibilities of auditor, a paragraph relating to responsibilities of management, and you should identify what is the applicable financial reporting framework, and even you have to give reference to expected form and content. That is how you are going to prepare the audit report. Finally, auditor will sign it and it will be given to the client. Client also will sign it, and client, by signing the document, he is indicating that he has agreed to the terms and conditions mentioned in that engagement letter. Finally, date and the place also will be included in that engagement letter. Clear, everybody? So this is what the contents of the engagement letter are. Understood? And that engagement letter has to be prepared as per SA 210. These contents are mentioned actually in SA 210. Clear? Understood? Next one. Let us now try to proceed further with next question. So requirement of engagement letter in the case of recurring audits. First, we need to understand what is the meaning of the recurring audit. So recurring audits means, first I will tell you the meaning of recurring audit. Recurring audit means if the last year auditor is also appointed as current year auditor, that audit assignment we call it as a recurring audit. Last year auditor is only appointed as current year auditor, then we call that assignment as recurring audit. Now assume that if the last year auditor himself is getting appointed as current year's audit, last year he would have already given the engagement letter. Now the same auditor is getting appointed for the same company in the current year. Is there any requirement on the auditor to give the engagement letter once again in the current year? Like for example, for the year 1920, Mr. X was appointed as auditor of the company A Limited. For the year 1920, auditor gave engagement letter. Client also signed it. Now the same person is appointed as auditor for the year 2021 also for the same company. Now in the current year also, is he required to give the engagement letter once again? Is it mandatory? Last year he has given. Now once again same company, same auditor. So is there any requirement to give engagement letter once again in the current year? The standard does not make it mandatory. They have left it to the choice of the auditor. Standard does not make it mandatory. The standard has left it to the choice of the auditor. Boss, you decide. We don't want to interfere. Depending on the facts and circumstances, let the auditor himself decide in the case of recurring audit whether to give the engagement letter or not. But standard is not making it mandatory. It has been left it to the choice of auditor. But however, standard is giving us some circumstances where even though it is a recurring audit, it might be advisable to send a engagement letter year after year. Standard is telling us a few circumstances where even though it is a recurring audit, still in some circumstances you need to send engagement letter. In normal circumstances, you need not do it. But if you come across any of these following circumstances, then even though it is a recurring audit, you need to give engagement letter year after year. So what are that circumstances? If there is indication that last year management misunderstood the objective and scope of the audit. Last year you gave engagement letter, but management misunderstood the terms. So clarify it now by giving engagement letter once again. Or if any terms are revised, then also give engagement letter once again. Or senior management has undergone some change, board of directors have changed, and give the engagement letter once again. Or a change in ownership. Similarly, significant change in nature or size of the entity's business, or change in some laws and regulations, or change in financial reporting framework like change in Schedule 3 or accounting standards, or the change in auditors reporting requirements. If any of these circumstances happens, then even though it is a recurring audit, it is advisable to send the engagement letter year after year, even though it is a recurring audit. Clear, everybody? Now, next thing, let us try to have one more small concept will be there in between. Yeah, preconditions to management. So one more thing, as I have told, in the engagement letter, there will be a paragraph called responsibilities of management. Responsibilities of management have been given other name also. We even call it as preconditions of the management. So preconditions of an audit. If they ask you the question, what are responsibilities of management? Even if they ask you the question, what are preconditions to an audit? Or even if they ask you the question, premise of an audit, everything shall be the same. So what are that management responsibilities, or what are that preconditions, or what are that premise to the audit? So what are management responsibilities, guys? Very simple. Management is responsible for preparation of financial statements. Management is, so I'm explaining, I'm revising. What are that preconditions to audit? Management responsibilities are premise to audit. Number one, management is responsible for preparation of financial statements, that too as per applicable financial reporting framework. Number two, management is responsible for implementation of internal control to prevent misstatements from the organization. Number three, the management should provide auditor. The management should give the auditor access to all the information and explanation required for the purpose of audit. The management should give access to all the books and accounts which are there in the company to the auditor. And in that books of accounts and financial statements, if the auditor needs extra clarification and explanation, it is also management responsibility to provide extra information and explanation. And even management should provide access to the employees or other staff in the organization without any restriction to the auditor. Clear? So what are management responsibilities? Prepare financial statements as per applicable financial reporting framework, design and implement internal controls, to provide auditor with access to all the books and documents, to provide additional information and explanation to the auditor, and even give access to the people in the organization without any restriction, so that auditor can go and get whatever information he wants from that respective staff of the client. Clear? So these three are functions or responsibilities of management. We can even call them as preconditions for an audit, or we can even alternatively call them as premise for an audit. No matter any of these three questions they are asking, we will write the same answer. Next, one more thing, a small concept will be there, in which they say, what if there is a limitation on scope prior to engagement acceptance? Before you accept an audit, then only if the client is coming and asking and putting the restriction on the scope of your work, what you will simply do. Prior to acceptance of the audit, before you even accept the audit, if the client is coming to you and asking you to reduce the scope, like for example, the management of the client has come to you, they told that, sir, you do the company audit for us, statutory audit you do for us, but in the statutory audit, we will not give access to sales related information. We will not give you even single invoice relating to sales. But you have to do the company audit for us. What you will do if you are in the position of the auditor? I will say simply get lost. I will not accept the audit only. Why? Because before accepting the audit only, if the client is putting the restriction on the scope of my work, why I will accept the audit here? What is the need for accepting the audit? So that's what even the standard says. If there is a limitation on scope prior to the acceptance of the audit, don't accept that audit at all. Don't even accept the audit. So why, sir, why we should not accept audit? They say the reason that, why? Because if the client is putting restriction, if you even continue the audit, you will not be in a position to obtain audit evidence. If you are not in a position to obtain audit evidence, you will not be able to obtain reasonable assurance. If you are not able to obtain reasonable assurance, ultimately you will give disclaimer of opinion only. So when you know that you are going to give disclaimer of opinion before acceptance of the audit, how it will be professional for you to accept the audit? So that's why before accepting the audit only, if the client is putting a restriction, don't accept the audit at all. It will not be professional on the auditor to accept that audit. Don't accept the audit, simply say no. Why? Because even if you accept the audit, you are ultimately going to give disclaimer of opinion. What is disclaimer of opinion? We will try to understand in a detailed manner in the chapter Audit Reporting. Clear? So one more last concept is there. With that, I will wind up my revision of nature, objective and scope of audit, which is changes in the terms of engagement after accepting the audit. Changes in terms after accepting the audit. That means a client approached you asking you for doing the audit. He did not put any restriction. All the terms and conditions, we have written it on a piece of paper. We have drafted engagement letter. Auditor signed it, client signed it, everything was fine. At the time of accepting the audit, no restriction. But when I actually started doing the audit, then the client approached me and asked me to change the terms. At the time of accepting audit, he did not put any restriction. But when I am actually started doing the audit, now the client is approaching me and asking me to put some restriction. He's asking me to change the terms when after accepting the audit. If at the time of accepting the audit only, if he put the restriction, I would have said no to the audit. But he did not put the restriction at the time when I'm accepting. When I actually started doing the audit, now the client is coming and putting a restriction on my scope, or he's asking for changes in the terms. Now what I am supposed to do? First, before I talk about auditor's responsibilities, let us try to understand what could be the reasons why the management will come to you and ask you for the changes in the terms. why the need arises for the management to approach the auditor asking for changes in the terms. Why the need arises for the management? What will be the reasons for the client to make a request to the auditor asking for him to change the terms of engagement? Number one, it could be mainly because circumstances might have changed. The circumstances which are prevailing at the time of accepting the audit, the same circumstances might not be available when I am doing the audit. Like for example, at the time when I accepted the audit, there was no restriction. But after I have accepted the audit, then the GST department came and seized the go down. That's why the client is asking me, sir, at the time you accepted the audit, there was no seizing of the go down. But after you have accepted the audit, now the go down is seized. So that's why we request you to exclude that inventory verification from your scope. So like this, sometimes circumstances might change, which might make the client to come to the auditor and request for changes in the terms. Or sometimes the client might have misunderstood the original terms. That's why he might approach you now asking for a change in the terms. Or sometimes with a view to intentionally restrict the scope of the auditor. Sometimes with a view to intentionally restrict the scope of the auditor also, the client might approach you asking you for changes in the terms of engagement. So a request from the client to change the terms of engagement can happen because of any of the reasons. It could be because of change in circumstances. It could be because of misunderstanding of the terms originally agreed. It could be even because of restriction on the scope of the auditor. So these could be the reasons why the client will approach you asking for the changes. Now what auditor shall do? Let us try to understand. So whenever the client is coming to you and asking you for the changes in the terms, first thing we need to check, is there a reasonable justification for the same? First thing we need to check is what? Is there a reasonable justification for the same? So reasonable justification means, yes, there is a valid reason the client is asking the changes in the terms, because there is a valid reason. Proper justification is there why the client is asking me to change the terms. So if there is a reasonable justification, the standard has told, okay, agree to the changes. No problem, agree to the changes in the terms. But if you are agreeing to the changes in the terms, old engagement letter will not be valid. Cancel that old engagement letter, draft a new engagement letter containing that revised terms and conditions. So if there is a reasonable justification, you can agree to the changes, but old engagement letter will still no longer be valid. You have to draft a new engagement letter containing revised terms and conditions. Sir, what if there is no reasonable justification? So if there is no reasonable justification, straightforward, the standard has told, do not agree to the changes. Say to the client on the face, sir, I will not agree to the changes. Why? Because you are not giving me valid reasons. See, when you don't agree to the changes, two things can happen. Management will permit you to carry out the audit as per the original terms. When you say, sir, I will not agree to the changes, management will not try to bother you. They will let you do whatever you want. If the management is permitting you to carry out the audit as per original terms, no issue, continue the audit. But sometimes what will happen is, you do not agree to the changes, but the management will not permit you to carry out the audit as per original terms. Management is asking you to change the terms. You said no. When you said no, the management is not giving you enough of permission to carry out the audit as per original terms. You told, sir, I have to go and verify the stock. Management told no. No, sir, don't go to the warehouse and verify the stock. I asked them reasons. They gave some bullshit reasons, not at all valid. So I told, no, sir, I will not agree to your reasons. I have to go to the warehouse and verify the stock. But the client is saying, no, sir, you can't go. I have deployed some 10 people there. You can't cross them and go inside the warehouse. So there is no reasonable justification. I am not ready to agree to the changes in the terms, and the client is not permitting me to carry out the audit as per original terms. He has deployed the people to stop me from entering into the warehouse. Now what the standard says is, withdraw from the audit. Now what the stand says, withdraw from the audit, resign from the audit. You are no longer permitted to continue the audit. There is no requirement on you to continue the audit. Withdraw from the audit. Understood? So what, once again, if I do a quick revision, if there is a reasonable justification, agree. So, but draft the new terms and conditions in a new engagement letter. Number two, if there is no reasonable justification, do not agree to the terms. When you don't agree to the terms, if the management is permitting you to carry out the terms as per original audit, well and good, continue. In case if the management is not permitting you to continue the audit as per original terms, management is not permitting you to carry out audit as per original terms, then you have to withdraw from the audit. You are no longer supposed to continue the audit. You have to withdraw. So you have to be very careful. They might ask you a case scenario based MCQ, something like this. For example, assume that they have asked a question, something like this. So they're asking a question that management came to the auditor asking for changes in the terms. there is no reasonable justification for the same. This is what the statement given. Management approached the auditor asking for the changes in the terms, and there is no reasonable justification for that. What should be auditor's action? Four options are given. Option A, do not agree to the changes. Option B, withdraw from the audit. Option C, both A and B. Option D, none of the above. What option will you choose from? Once again, I am repeating the facts of the question. They have told management approached the auditor asking for the changes in the terms, but there is no reasonable justification. What auditor should do? Option A, do not agree to the changes. Option B, withdraw from the audit. Option C, both A and B, that is do not agree and also withdraw. Option D, none of the above. Which option will you choose from? The correct option will be only option A, not option C. If you are thinking it is option C, it is a wrong. Why it is wrong? Why? Because when there is no reasonable justification, we will not agree to the changes. Withdrawal will happen only when the management is not permitting me to continue the audit as per original terms. Withdrawal is not a direct to go to option. I did not say whenever there is no reasonable justification, directly resign from the audit. No. When there is no reasonable justification, first ask the management to permit, do not agree to the changes. And if the management has permitted to continue the audit, I can happily continue the audit. The withdrawal comes into picture only when the management is not permitting you to continue the audit as per original terms. Here they did not say management did not permit you to continue the audit as per original terms. Just they told what? There is no reasonable justification. So I will not agree to the changes. Withdrawal is not a direct to go to option. So correct option will be do not agree. If I change the facts, if I change the question, see question remains the same, but options are changed. Option A, they are telling do not agree to the changes. Option B, they are telling withdraw from the audit in case if the management did not permit you to carry out the audit as per original terms. Option C, both A and B. Option D, none of the above. Now you can choose option C. Why? Because in option B, they have clearly told that withdraw from audit only if the management did not permit you to continue the audit as per original terms. Instead of saying that, if they have given only directly withdraw from the audit, you choose only option A. But in case if they have given detailed option withdraw from the audit, if the management is permitting you not to continue the audit as per original terms, then you can choose both A and B. Hope you have understood. See, this is how the scenario based questions will be tested. Not the direct MCQs which you expect. This much conceptual clarity will be required to answer the scenario based MCQs given in the examination. Clear everybody? So this is what the question is about. Changes in the terms of audit engagement. So with this, we have done a comprehensive revision of the chapter nature, objective and scope of audit. These are the key concepts from the nature, objective and scope of audit. In this video, I am going to revise the chapter which is company audit. So as we all are aware, company audit is such an important chapter as a part of our CA into examination, and there were a few attempts in which the marks from this chapter alone constituted for 15 marks also. But in the worst case scenario also, we can expect a minimum of 8 to 10 marks from this chapter called company audit. So in this video, I will try to revise this entire chapter company audit within a very minimum amount of time possible, and at the same time I will try to make sure that we are covering all the key aspects and important aspects of this chapter company audit. So without any delay further, let us directly jump into this chapter company audit revision. So company audit, as a part of this particular chapter company audit in the auditing subject, we are nothing but discussing a few sections of the Companies Act here. So that's why I say when I say we are discussing the company audit chapter, we are nothing but discussing a part of the law here. So section 138 till section 148 of the Companies Act, and in fact speaking from section 139 till section 148 of the Companies Act, we are going to revise now. So first let us try to start our revision from understanding with section 141 of the Companies Act. So section 141 of the Companies Act is such a section of the Companies Act which is dealing about who is eligible and who is not eligible for getting appointed as an auditor. Section 141 of the Companies Act is going to talk about who can be appointed as an auditor, who cannot be appointed as an auditor. So this section 141 contains 4 subsection. Let us start with subsection 1, which is talking about qualifications. Who is eligible for getting appointed as an auditor of a company? So the act simply says, section 141 subsection says, an individual can be appointed as an auditor provided he or she should be a chartered accountant having certificate of practice. In simple terms, we call it as practicing chartered accountant. Or even a firm or LLP also can be appointed as auditors provided majority of the partners shall be practicing chartered accountants. When I say majority, it should be greater than or equal to 50%. Assume there is a partnership firm in which there are 4 total partners are there. Out of them, 2 are practicing chartered accountants, 1 is a cost accountant and 1 is a company secretary. Can this firm be appointed as an auditor? No. Why? Because they are putting a condition majority. In our case, only 2 partners are practicing chartered accountants. In 4, 2 is exactly 50%. Exactly 50% does not constitute a majority. In order to call it as a majority, it should be greater than 50%. So a firm or LLP can be appointed as an auditor provided majority of the partners in that firm shall be practicing chartered accountants. That's what simply section 141 subsection 1 says, who is eligible. Now coming to section 141 subsection 2, it will be talking about signing of the auditor's report. Who will sign the auditor's report? See, when an individual is appointed, no confusion, the same individual will sign the audit report. What if a firm or LLP is appointed as an auditor? If a firm or LLP is appointed as an auditor, not all partners will sign on behalf of the firm. One partner who shall be a practicing chartered accountant shall sign on behalf of the entire firm. So assume there is a firm ABC and Co which has been appointed as an auditor. Not all the partners will sign. Any partner who shall be a practicing chartered accountant. Assume that in this firm A and B are practicing chartered accountants. C is a cost accountant. Now who can sign the audit report on behalf of this firm? Either A or B will sign the audit report on behalf of the entire firm, and the partner whoever is signing the audit report, that person we generally call him as engagement partner, we call him. So this is what section 141 subsection 2 says, talking about signing of the audit report. An individual, the same individual, if it is a firm or LLP, then any partner who is a practicing chartered accountant can sign on behalf of the entire firm. Coming to subsection 3, which is the most important section when it comes to examination, majority of the times the question will get tested from this particular subsection 3 only. So 141 subsection 3 will be talking about disqualifications. When I say disqualifications, what do I mean by that is who is not eligible for getting appointed as an auditor. That means even though you are a practicing chartered accountant, even though you are an audit firm or LLP in which majority of partners are practicing chartered accountants, still if you attract any of the clauses given under section 141 subsection 3, then you will not become eligible for getting appointed as an auditor. So what I am saying, even though you are a practicing chartered accountant, even though you are an audit firm in which majority of partners are practicing chartered accountants, but still if you attract to any of the disqualifications contained in section 141 subsection 3, you will become ineligible for getting appointed as an auditor. So what are that disqualifications? Let us have a look at it. So the following persons are not eligible for getting appointed as an auditor of a company. Even though they possess chartered accountancy qualification, even though they are chartered accountants, even though they are qualified under section 141 subsection 1, but still if they attract any of the disqualifications given here, any of the clauses, if they get attracted, they will become disqualified. What are they? Number 1, a body corporate other than LLP. A body corporate can't be appointed as an auditor of a company. Generally, who will come under body corporate definition? A company will come under body corporate definition, which means a company cannot be appointed as auditor of another company. So assume that there are 4 practicing chartered accountants, A, B, C and D. 4 are practicing chartered accountants. They want to carry out the practice collectively. They have incorporated a company, A, B, C, D Private Limited, and in the name of this company, they want to provide audit and taxation services. Can this company be appointed as auditor of another company? No. Why? Because it is a what? Body corporate. So that's the logic why we don't frequently find audit companies like the way we find audit firms. Why? Because if the practicing chartered accountants incorporate their entity as a company, they will lose one revenue generating area, which is a what? Company audit. So that is what the first disqualification. A body corporate can't be appointed as auditor of company. But they are saying other than LLP, which means what? So if you literally look at the income LLP Act, even LLP also will come under body corporate definition. But even though LLPs will come under body corporate, still they are permitted to do the company audit. Why? Because if you read the first clause, they are saying a body corporate other than LLP, which means other than LLP, whatever other body corporates are there, they can't be appointed as an auditor, which means that LLP is eligible for getting appointed as an auditor. Other than LLP, whatever other body corporates are there, generally companies can't get appointed as auditor of another company, but LLP can be appointed as an auditor of a company. Clear? That's the logic why big four entities are able to do the audit. Why? Because all the big four entities, if you observe, for audit division, they have incorporated themselves as LLP, and LLPs are permitted to do the audit, but companies are not permitted to do the audit. Second one, an officer or employee of a company. A person who is an officer or employee in a company, the same person can't be appointed as auditor in the same company. Why? Because this will come under self-review threat. So in order to avoid that self-review threat, the Act has given this disqualification: an officer or employee of a company can't be appointed as auditor of another company. When I say officer, who will come under officer definition? Directors will come under officer definition. Key managerial person will come under officer definition. So like that, if you are an officer and or employee in the company, for the same company, you can't act as a auditor. Now talking about clause C, a person who is a partner or who is in employment of an officer or employee of a company. A person who is a partner or who is in employment of an officer or employee of a company. So what do they mean here is, assume that there is a company X Limited, in that there is a person Mr. A. He is an officer or employee in the company X Limited. Who? Mr. A. So Mr. A is an officer or employee of a company X Limited. Can Mr. A act as an auditor? No. Mr. A can't act as an auditor. Which clause? 141 subsection 3 clause B, which says an officer or employee can't be appointed as an auditor. Whereas, assume that there is another person, Mr. B. Now what is this person Mr. B is? He is a partner of Mr. A, or he is an employee of Mr. A. That means A and B are practicing chartered accountants. They are having outside a firm A, B and Co. So B is a partner of Mr. A, or B is an employee of Mr. A. Now 141 subsection 3 clause C says that even this person Mr. B is also disqualified. Why? Because Mr. B is a person who is a partner or who is an employee of an officer or employee of a company. Mr. A is officer or employee, so he is disqualified because of 141 subsection 3 clause B. Now Mr. B is also disqualified. Why? Because he is a partner or he is in employment with Mr. A, who is an officer or employee of a company. Clear, everybody? So C point says a person who is a partner or who is in employment of an officer or employee of a company is also disqualified. Next one, talking about point D, a person who or his relative. And one more thing, in 141 subsection 3 clause D, there will be 3 subclauses. Let us try to quickly revise what are that 3 subclauses. First, we will start with subclause 1, a person who or his relative. So let me diagrammatically present it. A person, nothing but a person who is a practicing chartered accountant, or his relative, or his partner. Partner in the sense business partner, not life partner. Life partner will come under relative definition. So what if they are doing? If they hold any security, if they hold any shares, debentures, etc. kind of investments, where in the company, in the holding company, in the subsidiary company, in the associate company, in the subsidiary of holding company, then they will become disqualified. Who? A person that is a practicing chartered accountant or his relative or his business partner, if they are having any security or shares, where in the company for which you are doing audit, in its holding company, in its subsidiary company, in its associate company, or even subsidiary of holding company, then you become disqualified. Clear? Now there are some doubts to be addressed here. Relative. See, why basically this disqualification is to avoid that self-interest threat. Why? Because your auditor is getting benefited from some financial interest in the company. So now there are few points to sort out here. Sir, who will come under relative definition? So the Act has not given you permission to define who is your relative, who is not your relative. The Act has not given you that scope. The Act is saying we are defining the term relative. That's what you have to follow. Whether you like it or not like it, these people will be coming under your relative definition. Sir, who are that people, sir, who will come under relative definition? So if you see here, they are all members of HUF, and also they are husband and wife, person and a spouse, and also one person is related to another as given below: father, mother, brother. So here if you see father, mother, brother, sister, son, including all their step relationships, daughter's wife, daughter and daughter's husband. So these people will come under relative whether you like it or don't like it. These are relatives, that's all. If any of these people are having shares in the company, then you become disqualified. Clear everybody? So this is what regarding relative definition. So, but however, for this rule, there is one exception. So the general rule says that if a practicing chartered accountant, relative or his partner, if you have any shares or securities in any of these companies, you become disqualified. Now I am saying for this rule, there is an exception. Exception means what? That means in some cases, even if you have shares, that will not make you disqualified. Sir, what is that case? So that particular case is when a relative is having shares, he can hold the shares up to face value of 1 lakh rupees. How much? Up to face value of 1 lakh rupees of shares can be held by whom? Relative only. Neither the practicing chartered accountant nor partner. If a practicing chartered accountant or his partner, even if they have single share also, they will become disqualified. But a relative can hold the shares in the company or the group companies up to a face value of 1 lakh rupees. So you have to be more concerned only with this face value. Sometimes in the examination, they will give you questions like purchase price is this much, market value is this much, all these things they will give. Just ignore all that. The relative can hold shares up to a face value of 1 lakh rupee. We should be concerned with only face value. What is the market price irrelevant? What is the purchase price irrelevant? All these things are irrelevant. And this exception becomes applicable only for whom? Relative, not to the practicing chartered accountant or his partner. So this is what 141 subsection 3 clause D subclause 1. Let us try to revise now 141 subsection 3 clause D subclause 2. Now subclause 2 says that a person or his relative or his partner, if they have been indebted for an amount exceeding 5 lakh rupees to the company, holding company, subsidiary company, associate company, subsidiary of holding company, then also they become disqualified. So what they are saying, either a practicing chartered accountant by myself or my relative or my partner, if any of us are indebted to the company for an amount exceeding how much? 5 lakh rupees. Then to whom? To the company or any of these group companies. Then what we become? We become disqualified. So does that mean we should not be indebted? No, you can become indebted, but try to make sure that the indebtedness is up to 5 lakh rupees only. You should not get indebted to the company for beyond 5 lakh rupees even by 1 rupee also. However, there are some special points here. What are that special points is, sometimes what will happen is they will give you in the question, the auditor has bought the goods from the company on credit basis. So and so auditor is there, he bought the company on credit basis and the total purchase value made was 6 lakh rupees and it was bought on credit basis. Is the auditor indebted here? Yes. Even if you buy the goods on credit basis also, you will become indebted. They will give extra point on the question. In the question, what they will say is the company has offered the credit period to the auditor in the ordinary course of business. Like any other customer, they have treated this auditor also as an ordinary customer and they have sold the goods on credit basis. So it is a common practice of the company. They did not give any special privilege to the auditor. For everybody, they will sell the goods on credit basis only. Will this make any difference on the answer? No, this shall not make any difference on the answer. So the point which I want to conclude here is, the moment if the auditor is indebted for more than 5 lakh rupees, you will become disqualified. Whether this indebtedness happened in the ordinary course of business or is it a special privilege given only for the auditor, all that doesn't matter. The moment you are indebted for more than 5 lakh rupees, that's all, you will become disqualified. And few more points, like if you collect the fees on advance basis, then also you will be considered as indebted. So does that mean auditor should not take advance? No, take the advance, no problem. But try to make sure that you are taking the advance up to 5 lakh rupees only. Don't try to take the advance for more than 5 lakh rupees. And one more thing, however, if the auditor collects the fees on progressive basis, that will not make him indebted. Sir, what is the difference between advance basis and progressive basis? Advance means without doing work, I am collecting the fees. Progressive basis means I am proportionately doing the work and proportionately collecting the audit fees. Like assume the total audit fees was 10 lakh rupees. I have done 60% of the audit and collected 6 lakh rupees of audit fees. So here I have proportionately done the work and proportionately I collected the audit fees. This I call it as progressive basis. So if the auditor collects the fees on progressive basis, will he be considered as indebted? The answer is no. However, if he collects the fees on advance basis, then he will be considered as indebted. Clear? So these are some special points regarding 141 subsection 3 clause D subclause 2. Now talking about 141 subsection 3 clause D subclause 3, very simple clause. A person being a practicing chartered accountant or his relative or his partner, if they have given any security or they have given any guarantee on behalf of some third party for an amount exceeding 1 lakh to the company, holding company, subsidiary company, associate company, subsidiary of holding company, then also they will become disqualified. So in the previous points, in the subclause 2, they have become directly indebted, but in subclause 3, what they are saying is they did not become directly indebted. This practicing chartered accountant or his relative or his partner, they have given guarantee. They acted as a surety or they are acted as a guarantor. Some third party has taken the loan from the company, but but this auditor or relative or partner, they are acting as what? Guarantor. And if the amount of guarantee given is more than 1 lakh rupees, then you will become disqualified. So this is what section 141 subsection 3 clause D subclause 3 says. So with these 4 clauses we have revised clause A, clause B, clause C and clause D. Now let us talk about clause E. So what does clause E say? So if you have a look at clause E, a person or firm, if they are having any business relationship, if they're having any business relationship with the company, holding company, subsidiary company, associate company, subsidiary of holding company, subsidiary of associate company also. So one important point, very much important for MCQs and true or false statements, for the purpose of clause D, group companies contains only 5 companies. For the purpose of clause E, group companies contains 6 companies. Subsidiary of associate company also will get added to the list in case of section 141 subsection 3 clause E, whereas subsidiary of associate company will not form part of group companies as per section 141 subsection 3 clause D. See, now out of this also they can frame a question. Assume a true or false statement has been given. Assume that the auditor is having shares in some company X Limited, which is subsidiary of associate company of some Y Limited. So is the auditor eligible for getting appointed as auditor of Y Limited? Once again I am saying, assume that there is a person, Mr. X, he wants to get appointed as auditor of X Limited. However, Mr. A is having shares in Y Limited, and the relationship between these two companies is Y Limited is a subsidiary of associate company of X Limited. Is the auditor qualified or disqualified? Auditor is qualified only. He will not become disqualified. Why? Because subsidiary of associate company is not there as a part of 141 subsection 3 clause D, which means you can hold the shares in the subsidiary of associate company. You can become indebted for more than 5 lakh rupees in case of subsidiary of associate company. You can give a guarantee on behalf of some third party for an amount exceeding 1 lakh rupees for a subsidiary of associate company. Whereas for the purpose of 141 subsection 3 clause E, you cannot have business relationship with the subsidiary of associate company. So if you have any business relationship, apart from providing services of audit, if you buy goods from the company or if you receive services from the company, then you will become disqualified. But however, this rule is putting so much of practical impact, so much of practical difficulties. So what Act has come up with is exceptions. That means certain kind of business relationships are permitted. See, if you literally go by this rule, what will happen is, which means if I am conducting audit of Reliance Industries Limited, I should stop using GeoSIM. I should stop going to the Reliance markets. I should not use any kind of Reliance product. If I am conducting audit of Indigo Airlines, I should stop myself from traveling in the Indigo Airlines. So like this rule is putting so many restrictions. So that's why what Act has told is certain exceptions we are giving. That means some kind of business relationships you can have that will not make you disqualified. Sir, what are that exceptions, sir? Number 1, professional services which are permitted to be rendered both under Chartered Accountants Act and also under Companies Act. There are some professional services which a chartered accountant can render in addition to company audit, which cannot make him disqualified. Sir, examples of professional services are tax audit, GST audit, these kind of extra relationships you can have. And apart from that, those business transactions which are in ordinary course of business and also which are happening at arm's length price. If the transaction is happening in the ordinary course of business and if the price charged is arm's length price, then also that will not make you disqualified. Like if I am conducting audit of Reliance Industries Limited, I can still use a Jio SIM. Why? Because for Reliance, ordinary course of business is what? Providing telecom services also. So in the ordinary course of business, I am receiving services. I am using Reliance Jio SIM. But what should happen is, whatever price an ordinary customer pays, even I should also pay the same price. No special discount from me, no added advantages for me. So like this, if the transaction is in the ordinary course of business, but the price charged is arm's length price, then also you will not become disqualified. So this is the general rule. If you have any business relationship, that will make you disqualified. However, certain business relationships will not make you disqualified. What kind of business relationship? Professional services which are permitted to be rendered under Chartered Accountants Act and Companies Act, and also those transactions which are in the ordinary course of business and the price should be arm's length price. So this is what regarding clause E. Now coming to clause F, a person whose relative is a director or who is in the employment of the company as a director or KMP. Very simple clause, no complications here at all. Like I am a chartered accountant, I have some relative. My relative is in some top level management of the company, or he's some key managerial person in the company. Like I'm a practicing chartered accountant, my father is a CFO in some company. Don't appoint as an auditor of that company. Or my brother is some a director in the company, don't act as auditor of that company. Why? Because very simple logic here, there is a familiarity threat here. So in order to avoid that familiarity threat, the act has simply told, if your relative is some key managerial person or director in some company, don't act as the auditor of that company. So simple. Now coming to point G, very important, a person who is in full-time employment elsewhere. If I am a practicing chartered accountant, but if I am having a full-time employment elsewhere, then I will not become eligible for doing audit of any company. So I should not be a full-time employee. And there is one more point also, a person or partner of a firm holding appointment of more than 20 company audits as on the date of proposed appointment. And one more thing, what they're saying is, if you already have 20 company audits, you are no longer eligible for accepting a new audit. This limit of 20, we call it as ceiling limit, which means, sir, can a practicing chartered accountant do any number of company audits? No, a practicing chartered accountant can't do any number of company audits. There is a restriction, there is a limit on maximum number of company audits which a practicing chartered accountant can do. And what is that limit? 20. A practicing chartered accountant can do maximum of 20 company audits only, not beyond that. Now there are some special points regarding the ceiling limit. So what are that special points? Means this limit of 20 shall be counted per person who is a practicing chartered accountant. Limit of 20 shall be counted per person who is a practicing chartered accountant. Now what does that mean, sir? Assume there is an audit firm in which there are 3 partners are there who are practicing chartered accountants. Now how many company audits this audit firm can do? Since there are 3 practicing chartered accountants, for each practicing chartered accountant, limit of 20 will be counted. 3 into 20, totally 60 company audits this audit firm can do. However, there is an audit firm in which 10 partners are there. Out of them, 8 are practicing chartered accountants, 2 are non-practicing chartered accountants. How many audits this audit firm can do? Not 10 into 20. Why? Because the limit will be counted per practicing chartered accountant. Out of this 10, only 8 are practicing chartered accountants. So 8 into 20, 160 audits, company audits, this particular audit firm can do. Sometimes what else even could happen is, a person can act as a partner in multiple firms. Assume this individual, Mr. A, he is a partner in ABC and Co also. He is a partner in another firm, PQR and Co also. He is also a partner in another firm, XYZ and Co. Now, since he is partner in 3 different firms, will he get a limit of 20 in each of the entity? No, he will not get a limit of separately 20. Then what will happen? So for this individual practicing chartered accountant, a total limit of 20 only will be given. It is his choice how he wants to allocate it among different firms. Like if he has already done 10 audits here, how many more audits he can do in these 2 firms? 10 only put together. Now assume that in the PQR audit firm also, Mr. A has already signed 5 audit reports, 5 company audit reports. Now how many more audits can be done in the name of XYZ and Co? 5 only. Just because a person is practicing in different entities, he will not get a limit of 20 everywhere. He will be considered as a single practicing chartered accountant. The limit of 20 only will be given. It is his choice how he wants to allocate it among different firms in which he is a partner. However, there are certain companies which should not be counted in ceiling limit, which means there are certain companies for which I can do any number of audits. They will not be counted in the limit of 20. What are that companies? One person company, dormant companies, small company, and a private limited company having a paid up capital of less than 100 crores. For these four kind of companies, I can do any number of audits. They will not come in my limit of 20. Apart from this, whatever other companies are there, like private limited companies having a capital of more than 100 crores, sorry, more than or equal to 100 crores, public companies, listed companies, banking companies, insurance companies. So like this, apart from this four, whatever other categories of companies are there, they will only come under the limit of 20. And the ceiling limit is concept not just there in the company audit. The similar kind of concept is there even for the tax audit also. But for tax audit, the limit is 60. For company audits, the limit is 20. But for tax audit, the limit is what? 60. So this is what regarding ceiling limit. This we have discussed it as a part of 141 subsection 3 clause G. Now let us try to understand clause H. Clause H is very simple. A person, a practicing chartered accountant who has been convicted by a court of an offense involving fraud for a period of 10 years, he cannot get appointed as an auditor of a company. So if today a court has convicted, a court has passed an order that assume today is the date, assume some 26th of January. So on this date, 26th of January, some 2023, on this date, the court has passed an order that so and so person, Mr. X, practicing chartered accountant, conducted a fraud in the company. Now, from the date of this conviction, from the date of this passing of the order, until 10 years are not elapsed. From this date until 10 years, this person, Mr. X, can't get appointed as auditor of company. Not just in the company in which he has committed a fraud, he cannot get appointed as auditor of any company for the span of 10 years. This is what clause H says. So that's what I say. Committing fraud looks very fancy, but that comes with all these consequences also. For 10 years, you will lose the power to do the company audit. Next one. Last point. Any person who directly or indirectly renders any services as specified in section 144 to the company, its holding company or its subsidiary company. Now what is this is, as an auditor, if you want to do company audit, you should not provide certain services which are mentioned under section 144, which we call them as prohibited services. Sir, why the name prohibited services? Why? Because if you want to do company audit, you are prohibited from doing the services. Sir, what are those services, sir, which I am prohibited to do? So there are 8 services which are prescribed, which an auditor is prohibited to do. What are they? Accounting and bookkeeping services, internal audit services, design and implementation of financial information system, actuarial services, investment advisory services, investment banking services, outsourced financial services, management services. So being a practicing chartered accountant, if you provide any of these 8 services, you will become disqualified to act as a company auditor. So you can provide either company audit services or the section 144 services, but not both simultaneously. Both can't happen at the same time. Either company audit services or section 144 services, but not both simultaneously. Clear? And this services, this section 144 services should not be provided to the company. Even you should not provide it to its holding company. Even you should not provide it to its subsidiary company. That's all. For clause D, group companies are 5. For clause E, group companies are 6. For clause I, the group companies are only 3. You should not provide section 144 services to the company, to the holding company, to the subsidiary company. Clear? So these are the disqualification. If practicing chartered accountant or audit firm gets attracted to any of these disqualifications, then you become disqualified. You are ineligible for getting appointed as an auditor. So this is the most important concept. Now, in section 141, we are done with 3 subsections. Now, the last subsection is section 141 subsection 4, which is about subsequent disqualification. Now, what is this subsequent disqualification? The name itself says, at the time of appointment, you did not attract any of the disqualification. But after you are validly appointed as an auditor, then if you attracted to any of the disqualifications, what will happen, sir? At the time when I'm getting appointed, I did not had any shares. But after getting appointed, I acquired the shares in the companies or group companies. What I'm supposed to do? The act simply says that if it is a case of subsequent disqualification, immediately vacate the office. Immediately leave the office. You are no longer permitted to continue as an auditor. The act will not permit you. Immediately vacate the office. However, for this rule also there is one exception. That means in one case, even though you attract subsequent disqualification, you need not vacate the office immediately. What is that case, sir? That particular case is if the reason for subsequent disqualification is relatives face value of shareholding has exceeded by 1 lakh rupees, then immediate vacation does not apply. So as we know, relative can hold the shares up to a face value of 1 lakh. At the time when auditor is getting appointed, either relative does not have shares or relative is having the shares up to a face value of 1 lakh. But after getting appointed as an auditor, then the relative bought some extra shares and his face value of shareholding has increased to 1 lakh. General rule is what? This is a subsequent disqualification, immediately vacate. But I am saying it exception. Exception means what? In this case, you need not vacate the office immediately. Then what will happen? So, if this is the reason for disqualification, you need not vacate the office immediately. 60 days of time limit will be given for you to take corrective action. Sir, what could be corrective action? So, corrective action could be go to the relative, convince him, make him sell the shares, bring the face value up to 1 lakh rupees. If you are able to do it within 60 days, no need to vacate the office. If you are unable to do it within 60 days, then vacate the office. And this exception is available for only one case if the relative face value of shareholding exceeded 1 lakh. What if the practicing chartered accountant himself bought the shares after getting appointed as an auditor? Immediately vacate. This exception 60 days will become only in one case if the relative's face value of shareholding exceeded 1 lakh rupees. Clear? This is what section 141 subsection 4. So with this successfully we are done with section 141, which is talking about eligibility, ineligibility criteria. Now, the next set of questions will be regarding procedural formalities like procedure for appointment, procedure for selection, procedure for removal. All these things will be there. Let us try to have a quick revision of that also. First, we will talk about procedure for selection of auditor. Sir, how the auditor will be selected, sir? So out of so many individual practicing chartered accountants, out of so many audit firms, how the auditor will be selected? To understand this selection process, one of the prerequisites is understanding about audit committee. So some companies are required to create an audit committee. Audit committee means nothing but a sub-team of board of directors. Sir, which companies are required to create audit committee? So the applicability criteria is something like this: all listed companies. And if it is a public company but not yet listed, if it satisfies any of these three conditions, what are they? If they have a paid up capital of 10 crores or more, if they have a turnover of 100 crores or more, if they have outstanding loans or borrowings or debentures of 50 crores or more. If any of this condition is satisfied by a public company, then they will constitute audit committee. Listed company, no need to check for any conditions, directly audit committee they have to constitute. Private companies are exempted from audit committee. Now, what should be the composition of audit committee? Audit committee shall consist a minimum of 3 directors. How many? Minimum should be 3 directors. Out of them, majority must be independent directors. In 3, what is the majority? 2. All the members of audit committee shall be able to read and understand financial statements. All the members, whoever are there in the audit committee, they should be able to read and understand financial statements. Now, what audit committee will do, so? Audit committee will look after all the financial statement and audit related matters. Like specifically, if we see the functions of audit committee, they will involve in the recommendation for appointment, deciding the remuneration, appointment of auditors, etc. They will check whether auditor is independent and whether he is performing effectively or not. They will examine the financial statements and audit report. They will make subsequent modifications and also approval of the related party transactions. They will check intercorporate loans and investments, and also they will value the assets, etc. So these are the functions of audit committee. Now, why did we understand about functions of audit committee? Why? Because in the selection process, audit committee is going to play a key role. Now, in order to understand selection process, we will divide the companies into 2 categories. Those companies in which audit committee is constituted and those companies in which there is no audit committee. So if audit committee is constituted, what will happen is audit committee will do some analysis and select the auditor. They will do the various analysis like how many number of partners are there, what are their educational qualifications, what is their experience, existing number of partners. So audit committee will do all the analysis. They will select the auditor and recommend the name to board of directors. Now once the name has been recommended to board of directors, two things can happen. Board of directors may agree with the recommendations of audit committee. Board of directors may not agree with the recommendations of audit committee. If the board of directors agree with the recommendations of audit committee, they will recommend the same name to members or shareholders. They will pass a resolution, auditor gets appointed. If the board of directors do not agree with the recommendations of audit committee, here the problem arises. The act says then the matter should be referred back to audit committee, which means audit committee has selected some auditor, recommended the name to board of directors, but board of directors are not happy. Board of directors are saying no, we are not agreeing with this auditor. Then what they shall do, refer back the matter, which means ask the audit committee to reassess and suggest some other name. Now after referring back the matter, two things can happen. After referring back, two things can happen. What two things can happen after referring back the matter? So after referring back, what would happen is audit committee agree to changes the recommendation. Audit committee might do the analysis once again and they might change the recommendation. See, if they changes the recommendation, well and good, they will recommend another name to board of directors. They will agree it, matter gets closed there. This is not a problematic scenario. What is the problematic scenario? Audit committee did not agree to change the recommendation. That means board of directors are saying, sir, we are not happy with your recommendations, please change it. Audit committee is saying, no, we did correct recommendation only, we will not change our recommendation. Now if you observe here, there is a deadlock in the management. Board of directors are not ready to agree with the audit committee's recommendation. Audit committee is not ready to change its recommendation. Complete deadlock in the management. Now someone should be given an upper hand to take this matter further. So what act has told is, if audit committee deemed to agree and the board of directors are not ready to go with the audit committee's recommendations, board of directors have been given superior power. The act told board of directors can ignore audit committee's recommendation and they can select the auditor doing their own analysis and recommend that name to shareholder. But let the shareholder know the fact that being a board of directors, you disagreed with the recommendations of audit committee. Don't just let the shareholder know the fact, also let them know the reasons why you have disagreed with the recommendations of audit committee. Now the shareholder will have recommendation done by board of directors. Along with that, reasons also will be there. The shareholder will take appropriate decision. So this is what the process for selection of the auditor, how one individual or audit firm will be chosen. And that too when audit committee is constituted. They will select, recommend to board of directors. If they agree, well and good, recommend to shareholders. If they do not agree, refer back the matter. After referring back, if audit committee changes the recommendations, well and good. If audit committee didn't change the recommendation, then the board of directors can select the auditor, recommend the name to shareholders, but let them know the fact that they disagreed and also let them know the reasons for the same. Clear? See, we have discussed only one case. If audit committee is there. What if there is no audit committee? If audit committee is not there, headache itself is not there here. What will simply happen is, since there is no audit committee, board of directors only will do the analysis. They will only select the auditor, recommend the name to the shareholder, matter gets closed, audit committee recommending, board of directors disagreeing, all this headache and issue will not be there. Board of directors only will simply select the auditor, recommend the name to shareholders. That's it, so simple. Now let us talk about appointment procedure, how the selected auditor will be appointed. And for the purpose of appointment procedure, the companies are broadly divided into two categories. One is government company and the other one is non-government company. And in each of the company also, we have divided auditors into two categories, first auditor and subsequent auditor. Here also first auditor and subsequent auditor. First auditor means nothing but the person whoever is getting appointed as auditor for the first financial year. Subsequent auditor, that means after the first financial year, for the subsequent years whoever is getting appointed, that person we call him as subsequent auditor. Now talking about government company, first we'll start with non-government company first auditor. Who will appoint the first auditor in the case of a non-government company? So in the case of non-government company, the first auditor appointment power has been given first to board of directors and they shall do it within 30 days from the date of incorporation of the company. If company incorporated, 30 days is also over, but the board of directors did not make an appointment, then the power will go to shareholders and they shall do it within next 90 days, and that too at an EGM, extraordinary general meeting. That's all. Board of directors 30 days, shareholders within next 90 days at EGM. If it is a case of government company, here the power has been given to C and AG within 30 days from the date of incorporation. C and AG will make an appointment. If they, sorry, within 60 days, C and AG will make an appointment. If they fail, the power will go to board of directors, and within 30 days they shall do it. And one more thing, if board of directors also fails, then the power will go to shareholders. They shall do it within next 60 days at an EGM. So 60, 30 and 60, whereas here board of directors and shareholders 30 and 90. In both the cases, tenure is going to be till the conclusion of first AGM. Tenure is till the conclusion of first AGM in both the cases, in government company as well as non-government company. So this is what the procedure for appointment of first auditor. And one more thing here, very important point. When I say board of directors will make an appointment, how the board of directors will make an appointment? Will signing of appointment letter by one of the board of director or managing director, will it be enough? No. When we say appointment to be done by board of directors will conduct a board meeting, and in that board meeting resolution will be passed, then the auditor will be appointed, not just one or two persons signing the appointment letter. Clear? So in the first AGM, first auditor's tenure will be over. Now what about subsequent auditors? So now talking about subsequent auditor of a government company, the power has been given to C and AG, and they shall make an appointment of an auditor within 180 days from the commencement of financial year. Within how many days? Within 180 days from the commencement of the financial year, C and AG shall make an appointment of a subsequent auditor, and tenure will be till the conclusion of next AGM. After that, once again, next year will start. Within 180 days from the commencement of the financial year, C and AG will appoint, and that subsequent auditor's tenure will be till the conclusion of next AGM. Like this, year after year, the process will keep on happening. Now, coming to subsequent auditor of a non-government company, the Act has told that the subsequent auditor of a non-government company shall be appointed by shareholders at AGM, and the auditor so appointed will hold the office from the conclusion of first AGM till the conclusion of sixth AGM, which means the subsequent auditor of a non-government company will be there in office for either 6 AGMs, or alternatively we can say the subsequent auditor of a non-government company will conduct audit of 5 financial years. Clear, everybody? The subsequent auditor will be appointed in the case of non-government company by the shareholders, where at the AGM. And what will be his tenure? From that AGM in which he is appointed till the conclusion of 6th AGM. Which means, now once again, in the 6th AGM, like if I have to give example, assume that subsequent auditor was appointed at first AGM. He will be there in office till 6th AGM. Now once again, in the 6th AGM, this subsequent auditor's tenure will be over. Once again, shareholder will appoint subsequent auditor. Now what will be that subsequent auditor's tenure? From this AGM till the conclusion of next 6th AGM. So like this, subsequent auditor of a non-government company will be there in office for 6 AGMs, we can say, or alternatively we can say that he will do the audit of 5 financial years. Clear? So this is what the procedure for appointment of subsequent auditor of a non-government company. So this is what regarding the appointment procedure. That's all so simple. And one more thing here, before you make any appointment, the company must obtain written consent of the auditor. Before you perform this appointment procedure, the company should get written consent. What? Sir, if we are trying to appoint you as an auditor, in case if you are appointed as an auditor, are you ready and willing to act as an auditor? Get the written consent. And also, auditor should provide some certificate regarding certain matters. Regarding what things he need to provide certificate? That he is eligible for appointment and is not attracting any of the disqualification. His appointment will be within the term as provided, nothing but rotation concept, which you will see later. Then the proposed appointment is within the limits, that limit of 20. And also whether there are any pending cases against the company, or whether there are any pending cases against the firm or partners, that list of pending cases also. So the certificates containing these 4 matters should be obtained by the company from auditor. Clear for all appointments. And one more thing here, within 15 days of auditor's appointment, the company shall submit one form with ROC. Who has to file? company has to file one form with ROC, which is form number ADT1 within how many days? Within 15 days of appointment of the auditor, the company should file form number ADT1 with the ROC. So this is what regarding appointment procedures. Now, let us talk about other procedural formalities. How to fill the casual vacancy. Procedure for filling of casual vacancy. First of all, what is the meaning of casual vacancy? Casual vacancy means a vacancy getting created in the office of the auditor by any reason other than expiry of the term. Which means auditor's tenure has not yet completed, but because of some reasons, the auditor's position has become vacant, which means currently no one is acting as an auditor. If currently no one is acting as an auditor, should that position be left vacant or some measures should be taken to fill that? Definitely some measures has to be taken to fill that. So how to fill that casual vacancy? Let us try to understand. For the casual vacancy also, we will divide companies into two categories: government company, non-government company. See, if it is a case of government company, whatever may be the reason for casual vacancy, the filling is very simple. First, the power has been given to C and AG. Within 30 days of such casual vacancy, C and AG will fill it. In case if the C and AG fails to do it, then the power will go to board of directors. Within next 30 days, they will do it. That's all. Whatever may be the reason, C and AG will do it within 30 days. If they fail, the board of directors will do it in next 30 days. Whereas if it is a case of non-government company, here we need to check the reason. Is it because of resignation or is it because of other than resignation? If it is because of any reason other than resignation, like death, subsequent disqualification, whatever it is, if it is because of any reason other than resignation, the procedure is very simple. Board of directors within 30 days, they will fill it. Whereas if it is a case of resignation, here also what will happen is the board of directors will do it within 30 days, but that appointment shall be approved, should be ratified, should be approved by whom? Shareholders. Within what duration? So within 3 months from the date of that board's appointment, the appointment shall also be approved by shareholders. Then only the casual vacancy filling will be valid. If it is a government company, no need to check the reason. Whatever could be the reason, very simple procedure. But this resignation or other than resignation will arise only in the case of non-government company. If it is other than resignation, very simple, board of directors within 30 days. If it is a case of resignation, board of directors within 30 days, but it shall also be approved by shareholders within 3 months. Clear? So this is what the procedure for filling of casual vacancy. And one more thing, sir, what is the tenure of the casual vacancy auditor, sir? Till the conclusion of next AGM. Whenever next AGM happens, till the conclusion of next AGM only, the casual vacancy auditor's tenure will be there. That's all. This is what regarding tenure of the casual vacancy auditor till the conclusion of next AGM. Now, as a part of this casual vacancy answer, we have seen that the auditor can resign from the company. But whenever auditor resigns from the company, he need to follow some protocol. He just cannot keep a WhatsApp message to the board of directors. From tomorrow, I am not coming to the audit. He need to follow some formalities. What is that formality is? From within 30 days of resignation, auditor should file form number ADT3. Within 30 days of resignation, auditor should file form number ADT3. That too within how many days, sir? Within 30 days, they have to file it. To whom it has to be filed? With the company 1 copy, with the ROC 1 copy, with the C and AG in case if it is a government company. If it is not a government company, only company and ROC. If it is a government company, company, ROC and C and AG within 30 days, auditor has to file this form number ADT3. Sir, what if it does not file, sir? What will happen? What will happen? Simply penalty will happen. So what is the amount of penalty? The penalty will be, the auditor will be punishable with a fine, which shall be minimum 50,000 rupees or auditor's remuneration, whichever is lower. If auditor does not file form ADT3 within 30 days, he shall be liable with fine, and minimum penalty will be either 50,000 or remuneration of the auditor, whichever is less. And not just that, for every day of continuing failure, 500 rupees per day will be added, and the maximum penalty can go up to 2 lakh rupees. So minimum penalty will be either 50,000 rupees or remuneration, whichever is less. Assume that auditor's remuneration is 30,000. 50,000 or 30,000, whichever is less. Minimum penalty will be 30,000. But for every 1 day of continuing failure, what will happen? 500 will be added. Like if you are filing it on 40th day, minimum penalty 30,000, 10 days of delay. Within 30 days you have to file, but you are filing within 40 days. So 10 days delay, 500 into 10, 5,000 each, he will pay 30,000. So like this, for every 1 day of continuing failure, 500 will be added, but this maximum penalty cannot go on any higher side. There is a maximum limit on penalty. Like this, if you keep on adding 500 rupees per day, the maximum penalty it can go up to 2 lakh rupees. Assume that if you have calculated this maximum penalty at some point of time, it was calculated that 2,50,000 penalty amount is coming, but auditor is not required to pay 2,50,000. Why? Because the penalty is capped at 2 lakh rupees. Clear? So this is what will happen in case auditor has resigned and failed to file that form number ADT 3. Clear? Now coming to the next thing, like the way auditor can resign before expiry of his term, even the management of the company has also been given the power to remove an auditor also. But even for removing the auditor also, there is a dedicated procedure which company needs to follow. Now, what is the procedure for removal of an auditor? Let us try to understand it. So the procedure for removal is something like this. First, it should start with the board of directors conducting a board meeting, and in that board meeting, resolution of the board of directors will be required. What resolutions are? Board of directors ordinary resolution will be fine. So if the company wants to remove an auditor before expiry of the term, first it should start with the board of directors conducting a board meeting, and in that board meeting, resolution, which resolution? Ordinary resolution of the board of directors is required. Now within 30 days of that board resolution, the company should submit a form called form number ADT2 with the central government. For what, sir? Asking the approval of the central government for removal of an auditor. So board of directors shall conduct a board meeting, and in that board meeting, ordinary resolution, within 30 days of that resolution, company will file one form. Which form? Form number ADT2, with whom? Central government. For what purpose? Asking the central government to give approval. If the central government gives approval, within 60 days of receiving the approval, company shall conduct one general meeting, and in that general meeting, special resolution of the shareholders will be required. Which resolution? Special resolution. So the three people are involved in the removal process of an auditor. Who are the three people? Board of directors should conduct a board meeting, pass a board resolution, and within 30 days application should be submitted to central government, and central government also should give approval, and within 60 days of receiving the central government's approval, general meeting of the shareholders is required, and in that general meeting, special resolution of the shareholders also will be required. These three kind of procedures are to be followed, and even order also should be same, in the same order. First board of directors resolution, then central government approval, then only shareholders resolution. Sometimes they might try to give you in the question, first board of directors has passed a board resolution, shareholders has passed a special resolution, then approval of the central government has been obtained. Is it valid? No. Order also should be same. Board resolution, central government approval, after that shareholder special resolution. Clear? So this is what the procedure for removal of auditor by the company. And one more thing, before removing an auditor, an opportunity of being heard also should be given. This is very important. An opportunity of being heard should be given. Next, even tribunal also can remove the auditor. The tribunal has also been given the power to remove an auditor, but the power to remove the auditor, for that also there is a procedure. So how the tribunal can remove the auditor? So here also someone should make an application to the tribunal. Sometimes without any application, tribunal on its own can initiate an action, or application can be made by central government or any person concerned. When I say any person, they literally mean any person, need not be shareholder, need not be debenture holder, even a common person also can make an application. So tribunal on its own can initiate an action, or even an application can be received from central government or any other person concerned. So to whom application has to be submitted? So to the tribunal only application has to be submitted. Now what is the procedure for removal? So once application has been received by the tribunal, tribunal will keep on proceeding with the hearings. Now, after listening to the arguments, if the tribunal is satisfied that yes, auditor has acted in a fraudulent manner, the tribunal will pass an order removing an auditor. Once the tribunal passes the order, the auditor shall stand removed. However, if the central government made an application, the order should come out very quickly. Tribunal cannot take their own time. The tribunal shall pass the order within 15 days when in case application has been submitted by central government. And in that case, the power to reappoint the auditor also will be given to central government only. When central government gave an application. So once again, I am telling, if the central government makes an application, tribunal shall do the faster processing of the case. Order should come out within 15 days of application. And in that case, the power to reappoint the auditor will be given to central government only. Sir, what if others made an application, sir? If others made an application, then what will happen is now the tribunal can take their own sweet time and can pass an order within their reasonable time. And in that case, if the auditor is removed, then who will appoint the auditor other than application made by central government? Then it will come under normal casual vacancy related matter. Normal casual vacancy procedures will become applicable. Clear? So central government will get the power only if central government made an application. However, there is even one more point. See, if the court is passing an order, the person can't be appointed for 10 years, no? On the other hand, if the order has been passed by tribunal that an auditor has been involved in committing a fraud, then the person can't act as auditor for 5 years from the date of such conviction. How many years, guys? For 5 years, a person can't get appointed as an auditor in case if the conviction is made by tribunal. However, if the court is passing an order that auditor involved in a fraudulent manner, then the restriction will be there for 10 years. Clear, everybody? So this is what regarding the removal of auditor by the tribunal. Clear? Now, there is even one general question. It was asked in one of the RTPs and also it is there in the study material. As I have told you, when you are removing the auditor, central government's approval is also required, no? Why central government approval is required for removing an auditor? Why can't the board of directors and shareholders simply remove the auditor? It is simply a common sense oriented question. The answer you have to write something like this. If you are removing the auditor before expiry of the term, it is a matter requiring serious attention. It is a somewhat severe matter. Why? Because you are removing an auditor before his tenure got over. So that's why here there is a possibility of auditors' independence getting affected. So that's why if you make an application to the central government, they will check the reasons and they will decide is the removal of the auditor is valid or not. So simply to protect the independence of the auditor, central government's permission has been made necessary while removing the auditor. Clear? So that's what one small question will be there, that also we have revised. So with this we have seen with procedure for selection, procedure for appointment, procedure for removal by auditor, removal by tribunal. There is even one more procedural formality which we need to understand, the important concept which is about rotation of auditors. What is that? Rotation of auditors. Now what does this rotation of auditors means is, if an auditor is permitted to continue for any number of years, he will become more familiar with the client and that will lead to familiarity threat. So that's why in order to break that familiarity threat, the Act has introduced a concept called rotation, which says that after an auditor conducted audit for certain number of years, the auditor shall not be appointed once again in the same company. So after certain number of years of continuous service, the same individual or audit firm shall not be permitted to act as an auditor. So that concept we call it as what? Rotation. Now first let us try to understand applicability. Sir, does auditors of every company are required to be rotated? Does every company has to follow this rotation concept? No. Rotation concept is applicable only for certain companies. What are that companies? Let us have a look at it. So applicability of rotation of auditors, it is not applicable for all companies. Then for which companies? All the listed companies, rotation concept becomes applicable. If you are an unlisted public company, if you satisfy any one of these two conditions, what are they? If they have a paid up capital of 10 crore rupees or more, if they have a borrowings from public financial institutions or banks or public deposits of 50 crores or more. If any of these two conditions are satisfied by a public unlisted company, then also rotation will become applicable for them. Even rotation concept is applicable for private limited companies also. If they satisfy any of these two conditions, what are they? If they have a paid up capital of 50 crores or more, or if they have a borrowings from public financial institutions, banks or public deposits of 50 crores or more. So only for these companies rotation concept will become applicable. However, specifically the rotation concept is not applicable for one person company and small companies, even it is not applicable for government companies. So this is what regarding applicability. Now let us try to understand what is the manner of rotation. After how many number of years the auditor should be changed. Act says if you are appointing an individual as an auditor, an individual can't be appointed for more than one term of 5 consecutive years. An individual can't be appointed for more than one term of 5 consecutive years. If you are appointing an audit firm or LLP, irrespective of number of partners, a firm or LLP can't be appointed for more than 2 terms of 5 consecutive years. Sir, if an individual completes one term of 5 consecutive years, or if an audit firm completes 2 terms of 5 consecutive years, or alternatively, we can call it as 10 continuous years also. So the act is saying an individual can be appointed only for 5 years. A firm can be appointed only for 10 years. Sir, if an individual or audit firm completes their term of 1 or 2 terms of 5 consecutive years, can't they get reappointed in the same company throughout the rest of the life? No, they can get reappointed, but subject to a gap of 5 years, and this gap of 5 years we call it as cooling period or break in service, we call it. Now what does this rotation concept look like? It looks something like this. If you are appointing an individual, he will do the audit for 5 years. Now for the coming 5 years, the same person can't be appointed as an auditor of the company. Now, after this 5 years gap, we call it as break-in service or cooling period. Once this 5 years gap has been given, the same individual can be appointed once again for how many years? 5 years. After that, once again a gap of 5 more years. Then once again 5 more years he can get reappointed. After that, once again gap of 5 years. The same thing happens with audit firm also, but instead of 5 years, the audit firm can be appointed for 10 years. Once they complete this 10 years, for the coming 5 years, they can't get appointed as an auditor. Once they give the gap of 5 years, once again they can be appointed for 10 years. Then once again give the gap of 5 years. After that, the same firm can be appointed once again for 10 years, like this, so on and so forward. Clear? So this is what the concept of rotation. An individual can be appointed for one term of 5 consecutive years. An audit firm can be appointed for 2 terms of 5 consecutive years. After that, they have to compulsorily undergo a gap of 5 years, which we call it as break in service or cooling off period. Now, there are some special points to understand here. So what are that special points means? So they say that if an incoming auditor and outgoing auditor both are having common partner, then even such incoming auditor also cannot be appointed as an auditor. So what does that mean? So assume there is a company X Limited. There is a firm ABC and Co. Just now they have completed 10 continuous years. An audit firm is there, this company X Limited, to which rotation concept is applicable. Just now they have completed 10 continuous years of service. Can they get reappointed once again? No. For the 5 years, this firm cannot be appointed as an auditor. Now for this 5 years, this company is looking for appointment of another audit firm PQA and Co. But the problem is, in this outgoing auditor and in this incoming auditor, they both are having a common partner, Mr. A. Incoming auditor and outgoing auditor both are having what? A common partner. Because of this reason, not just this audit firm, even this audit firm PQA and Co. also can't be appointed as an auditor. So if the incoming auditor or the outgoing auditor both are having a common partner, then even such incoming auditor also can't be appointed during that cooling off period of 5 years. Clear, everybody? And not just that, there is even one more point. So now one more point. So even they say one more point further. What even they say is, if the incoming auditor and the outgoing auditor both are working under same network, both are working under what? Same network, then also incoming auditor can't be appointed. Which means, once again, let us take an example. Mr. A, individual practicing chartered accountant. He was conducting audit of the company X Limited. Just now he has completed 5 years of continuous service. Can he be reappointed? No. Now this X Limited is considering appointing another person, Mr. B. But the problem is, Mr. A and Mr. B both are working under same brand name, or they are working under same trade name, or they are having one common control. So like this, if the incoming auditor and the outgoing auditor both are belonging to same network, then even such incoming auditor also can't be appointed during that cooling off period of 5 years. Clear? And what do you mean by firms belonging to same network? Either they are operating under same brand name, or they are operating under same trade name, or they are having some kind of common control. So then we call them as firms operating under same network. So if the incoming auditor and the outgoing auditor both are belonging to same network, even such incoming auditor also can't be appointed during that cooling off period of 5 years. And one more last point here is, assume there is a company X Limited, there is a firm ABC and Co. Just now they have completed 10 continuous years of service. As we know, this firm can't be appointed during the coming 5 years. But what has happened here is, one of the partner, Mr. A, who is a partner in charge and who certified the financial statements, resigned from this firm and he joined another firm, some PQR and Co. What is happening here? One of the partner who is a partner in charge, who is a main partner in the audit firm, which has completed 10 years of service. In that audit firm, the main partner resigned from the outgoing firm and joined another firm. Even such auditor also can't be appointed during this cooling off period of 5 years. Now this point is different from common partner. See, in the common partner, what is happening is, a person is continuing in both the firms. But in this point, what is happening is, one of the partner resigned from this outgoing firm and joined another firm. But even in this case also, this firm cannot be appointed during this cooling off period of 5 years. But the partner who is resigning and joining other firm should be partner in charge. He should be the main partner in the firm. So if assume that in this case, A is the partner in charge, B and C are other partners. If they resign and join another firm, then there is no restriction. Then this firm can be appointed. Restriction is there only for partner in charge. If he is resigning and joining another firm, then only there will be restriction. Clear, everybody? So these are the key concepts regarding this rotation of auditors. Understood? So with this, we are done with rotation of auditors also. So with this, most of the procedural formalities we are done. Now coming to the next few concepts, like what are powers and duties of the auditor. So talking about rights of the auditor or powers of the auditor. As we know, company audit is a statutory audit, and we even know that in the statutory audit, the respective law or regulation itself will decide what are powers of the auditor. So the law has given some powers to the auditor. Let us see what are they. Number one, as you could observe here, the auditor will have access to books and documents of the company. The auditor will have access to books and documents of the company. The auditor at all times, wherever the books are kept, they might be kept at registered office, they might be kept at branch office, doesn't matter. Auditor will have access to the books at all times. But don't take at all times so literally. At all times means working days and business hours only. However, this right is not just restricted to financial books. He can have access to other documents also, like statistical books, memorandum books, or cost records, inventory records. All these records also he can have access. And one more thing, in case if you are doing audit of the consolidated financial statements, you will not have access only to the holding company's books of accounts. You will have access to subsidiary, joint ventures and associate companies books also. And even though there is a separate branch audit, appointed, still the principal auditor will have access to branch books of accounts even after having a separate branch auditor also. And the auditor's right is not just restricted to having access to books and documents. In that books and documents, if he needed some extra clarification, explanation, or if he is having some doubts, he is having right to obtain that extra information and explanation from the management or officers or employees of the company. So that right to obtain extra information and explanation is also been given. And also, auditor will have right to receive the notices of every general meeting, and even he will have right to attend every general meeting. So whenever any general meeting is conducted, whether AGM or EGM, whether financial statements are discussed or not discussed, all that things doesn't matter. Auditor will have right to receive general meeting. Every general meeting he will have a right to receive, and in addition to that, he will even have right to receive the notices of the general meeting. And one more thing, it is not just right of the auditor to receive the general meeting. Why? Because section 146 clearly says that the auditor shall attend general meeting. So we can say that auditor, it is both the right as well as duty of the auditor to attend the general meeting. Clear everyone? And apart from that, whatever his findings are there, he can report that to the members of the company. Whatever his observations are there, whatever his findings are there, whatever his opinion is there, everything he can express is through his opinion in the form of written audit report. And that report should be prepared after taking into account the provisions of this act, nothing but Companies Act, and also keeping in mind accounting and auditing standards. And finally, in this audit report, auditor will express opinion regarding what? The state of company's affairs, nothing but the state of assets and liabilities, the profit or loss, and also cash flow for the year, whether all these are giving true and fair view or not. On that, he will express his opinion also. And one more last right to lien, which means the auditor has right to retain the possession of the client's property for not collection of the fees. And which audit property will be there in auditor's possession, which client's property will be there in auditor's possession for non-payment of the fees? Generally, the client's books of accounts will be there in auditor's possession. If the client is not paying you the audit fees, the auditor can exercise right of lien over client's books. But however, even though this right has been given, but auditor can't practically exercise it. Why? Because section 128 of the Companies Act says books of accounts must be kept at the registered office. So if you want to exercise right of lien, you have to move the books of accounts from registered office. That itself will lead to violation of the Companies Act. So even though the right of lien has been given to the auditor, but it is practically impossible for the auditor to exercise right of lien. And also there are some case laws. It is very unprofessional for the auditor to exercise right of lien. Like it is similar to a doctor saying to a patient, you are not giving me the fees for this operation, I will keep your kidney, give me the fees and take back your kidney. Very unprofessional, no? Somewhat similar to that. So even though the right of lien has been given to the auditor, but auditor can't practically exercise it because of Companies Act and also because of some practical case laws. And so these are the powers of the auditor which are given to him under act itself. Neither management nor shareholders, no one can restrict these rights. If they want, they can extend, but no one can restrict these rights. And now the act is not just giving rights to the auditor. As we all know, rights always comes with responsibilities. So let us try to understand what are that duties or responsibilities of an auditor. So talking about duties of the auditor, see, we have seen right to report to the members. And I will say right to report or reporting to the members is not just a right, it is even duty also. Why? Because no one will say audit is completed unless and until you give your audit report. And it is whose duty to prepare the audit report? It is obviously the auditor's duty to prepare the audit report. So that's what the first point is. That was the first responsibility. Auditor shall prepare an audit report and submit it to members of the company. And not just preparing the report alone will be enough. Auditor should even sign the audit report also. Why? Because without auditor's signature, the report will not make any sense. And it is whose responsibility to sign it? It is auditor's responsibility to sign it. And whatever audit you are doing, that audit you have to do it after complying with the auditing standards. You can't do it as per your own wishes. So you have to comply with the standards on audit released by the ICAI and which are prescribed by central government. So section 143 subsection and clearly saying it is responsibility of auditor to comply with standards on audit. And who will prescribe the standards? Central government. See, standard setting procedure is something like this. First, ICAI will develop a standard, and that developed standard will be given to central government. Now central government will give it to NFRA. NFRA will review this standard, give their recommendations. Now after considering these recommendations, central government will finally prescribe the standards. So whatever standards are there which are prescribed, all those standards are required to be complied by the auditor while doing audit. That is also one of the duty. And finally, this point we have already seen, duty to attend the general meetings. Auditor will have right as well as duty to attend the general meeting. Why? Because section 146 clearly told auditor shall attend general meeting. Shall means they are making it compulsory. So auditor shall attend either by himself or through his authorized representative. When I say authorized representative, that person also should be qualified to act as an auditor. And this right is restricted only to general meetings, not board meetings. He can go and attend general meetings, but he cannot go and attend the board meetings also. So these are rights and duties of the auditor. Now we have even one more duty on the auditor, to report on fraud. So whenever auditor came to know about any fraud happening in the company, he needs to do some reporting. So how to do that reporting? That has been given under 143 subsection 12 of the Companies Act. And this 143 subsection 12 of the Companies Act has divided the auditor's responsibilities into two categories. What are they? The fraud in which amount involved is 1 crore or more, the fraud in which the amount involved is less than a crore. And the fraud in which the amount involved is 1 crore or more, their central government reporting will become applicable. Here there is no central government reporting. Now what should be the manner of reporting is, first, the matter should be communicated to audit committee. If audit committee is not there, then to the board of directors. Within how many days? Within 2 days of knowledge of the fraud. Here you have to be very specific. Why? Because 143 subsection 12 says, if audit committee is there, the fraud should be communicated to audit committee only. If audit committee is not there, then to the board of directors. Don't be of a wrong notion that auditor can choose either audit committee or board of directors. No. If audit committee is there, to the audit committee only. If audit committee is not there, then to the board of directors. So auditor should report the fraud to the audit committee. If audit committee is not there, to the board of directors. Within how many days? Within 2 days of knowledge of the fraud. And give them 45 days of time for getting their replies. Within 2 days of communication, then give them 45 days of time for reply. And within 45 days, two things can happen. Reply is received. If reply is received, the act says within 15 days of receiving reply, the matter should be reported to central government by submitting an form number ADT 4. And what and all you will send it to central government is the report which we have sent to audit committee or board of directors. Along with that, what replies you have received. Along with that, any remarks of the auditor on that replies. All these three will be sent to the central government. In which form? In form number ADT 4. And all this information should be sent on letterhead of the auditor. Nothing but a pre-printed document which contains details of the auditor, his address, telephone number, etc. That we call it as letterhead. So this information should be printed on letterhead, signed by the auditor, and even containing the seal of the auditor, stamp of the auditor. And when I say you have to report it to central government, to whom in the central government you will report? To the Secretary, Ministry of Corporate Affairs. So within 45 days, if reply is received, within 15 days of receiving reply, report the matter to central government in form number ADT 4. And what and all you will send? Report which you have sent to audit committee or board of directors on that what replies you have received, and along with that auditor's remarks. And all this information should be on letterhead of the auditor. It should be signed by the auditor. It should contain a seal of the auditor, and it will be sent to Secretary, Ministry of Corporate Affairs. In case reply is not received, then also the act will say report to central government. But here the act is silent on time limit. Even if reply is not received within 45 days, still you have to report to central government, but the act is silent on time limit. However, you can derive the time limit from other case. Within 15 days from the expiry of 45 days, you have to report to central government. Like that you can derive. Not important from examination perspective. Just remember, if reply is not received, report here also you have to report to central government. Here also form number ADT 4 only. What and all you will send here? What I will send is report which I have sent to audit committee or board of directors, along with the fact that reply is not received. I will mention reply is not received. That report along with this fact, I will report it to central government in form number ADT 4. Here also letterhead etc. will be there. Here also Secretary, Ministry of Corporate Affairs. So these are the reporting requirements in case if the amount involved in the fraud is 1 crore or more. However, if the amount involved in the fraud is less than a crore, here central government reporting will not become applicable. Here what will happen is, here also the matter will be communicated with audit committee if it is there. If audit committee is not there, then to the board of directors within 2 days. What and all auditor will report? 3 things. Nature of the fraud along with the description. What is the approximate amount involved and who are the parties involved. With that, auditor's responsibility will come to an end, but the board of directors will give something called a board's report. In that board's report, board of directors should give disclosure. Auditor's responsibility ends here. But board of directors, when they give the board's report, in that board's report, board of directors should give some disclosure. What disclosures they have to give? Same above three things: nature of fraud along with the description, amount involved in the fraud, parties involved in the fraud, along with that what remedial actions are taken. Auditor reported the fraud, no. What rectification actions are taken by the management? That remedial actions are also required to be reported. So these will be the reporting requirements in case amount involved is less than a crore. And all these reporting requirements are equally applicable. This 143 subsection 12 reporting requirements are equally applicable even for cost auditor and even for secretarial auditor while continuing their respective services. Clear everybody? So this is what regarding reporting requirements under 143 subsection 12. Now, talking about penalty related provisions, this penalty things you can manage. Sir, what will happen in case company or auditor fails to comply with the provisions of Companies Act? Very simple. If the company is doing any of the non-compliance, if the company is not following any of the section 139 to 148, then what will happen is the company will be punishable with a penalty not less than 25,000 rupees, but it may go up to 5 lakh rupees. And every officer who is in default, he shall be facing a penalty of minimum 10,000 rupees, which can go up to 1 lakh. On company also there will be a penalty. On every officer in default also there will be a penalty. Now, what is the punishment for auditor if he fails to comply with the provisions? If it is unintentional contravention, by mistake, if some non-compliance happened, minimum penalty 25,000, maximum it can go up to 5 lakh rupees or 4 times of auditor's remuneration, whichever is less, maximum penalty. Whereas if it is intentionally done, with a view to cheat shareholder, debenture holder, somebody, then what will happen is, in addition to penalty, he has to face imprisonment. Not just imprisonment, here penalty also will be very higher. Here penalty will be minimum 50,000, maximum it can go up to 25 lakh rupees or 8 times of the remuneration of the auditor. If it is unintentional, 5 lakh or 4 times. If it is intentional, 25 lakhs or 8 times of the auditor's remuneration. Not just that, along with that, you need to refund whatever remuneration you have received. And on because of your audit report, if anybody has faced any damages, you have to make good their damages also. You have to compensate for damages also. And in case if audit firm has committed contravention, all the partners will be jointly and severally responsible. Whereas the criminal liability will be there only on concerned partner, whoever committed mistake. Like fine and imprisonment is there. Imprisonment has to be faced by only that concerned partner who did the mistake. Whereas fine, whatever fines are there, that is a responsibility of entire firm. All the partners will be collectively and jointly responsible. Whereas if it is done only, if it is a imprisonment case, this criminal liability has to be faced only by that partner whoever has committed mistake. Whereas civil liabilities like fines and penalties have to be faced by the entire firm and all partners jointly and severally. Clear? So this is what regarding provisions of Companies Act relating to audit. However, two concepts are there that also I will try to cover. Sorry, three concepts are there that also I will try to cover quickly. One is branch audit, joint audit, internal audit. Let us now talk about first branch audit. Sir, who can do the audit of the branches? Today it is very quite common. A business will be located at one head office and it will have so many branches. Now, who will do the audit of accounts of that branch? Very simple. Principal auditor himself can do the audit of the branches, or another practicing chartered accountant can be appointed as auditor for conducting the audit of accounts of the branch. Whereas if the branch is located outside India, if the branch of the company is located outside India, the accounts of that branch office can be audited either by principal auditor, or another practicing chartered accountant in India can go and do the audit of that branch located outside India, or even a person who is qualified to act as auditor as per laws of that respective country. Like Indian companies there, they're having a branch located in US. Who can do the audit of that US branch? Either principal auditor can do, or any other practicing chartered accountant from India can go and do, or a person who is eligible to act as auditor as per US laws, like a local CPA also can do the audit. So this is what regarding who can act as a branch auditor. Now coming to a few more things, who will appoint the branch auditor? Generally, branch auditors are also appointed by members only. However, the shareholders, if they want, they can delegate the power to whom? Board of directors. See, appointment of normal auditor can't be delegated, but appointment of branch auditor can be delegated to shareholders, can be delegated to board of directors by the shareholders. Power lies with shareholders, but if they want, they can delegate the power to board of directors also. Next, how the reporting will happen, sir? How the reporting will happen is, branch auditor will do the audit, prepare an audit report on the branch. That audit report will be sent to principal auditor. Now, principal auditor, using his work and also using the branch auditor's work, he will form an opinion on the entire company, and that principal auditor's report will be circulated to the shareholders. So what are reporting requirements? The branch auditor will conduct audit, prepare an audit report on the branch, and that report will be submitted to principal auditor. Now principal auditor will use his work and also branch auditor's work, prepare a report on entire company. That report will be circulated to the shareholders. That's all. And whatever reporting requirements that are applicable for principal auditor, all that reporting requirements will be equally applicable for branch auditor also. Clear? So this is what regarding branch audit. Now, talking about joint audit. So if we try to understand joint audit, let me briefly cover this also. Joint audit means when more than one auditor. When I say more than one auditor, it could be more than one individual, it could be more than one audit firm, or it could be a combination of individual or audit firm. So when more than one auditor, more than one individual, or more than one audit firm, or more than one individual or audit firm, so if they are getting appointed, if more than one auditor is getting appointed for the same company, for the same financial year, and also if they have same scope of work, that kind of audit we call it as joint audit. If more than one auditor has been appointed for same company for the same financial year and also for having same scope of work, then such a kind of audit we call it as what? Joint audit. Now, why more than one auditor will be appointed? Why? Because there are some advantages. Sir, what are that advantages? Workload of the individual auditor will get reduced, and also work will get completed in less time, and improving the service, improving the quality of the service. Auditor will get better service. And also sharing of expertise. Since more than one auditor is appointed, they can share their expertise. There will be even a mutual consultation among the joint auditors, and ultimately client will be benefited because of this. So because of this reason, the joint audits are happening. So like reduced workload, lower, less time audit will get completed, better quality of service, client will be benefited, healthy competition. So because of all these advantages, joint audit is getting conducted. But the joint audit does not come only with advantages. Along with it, it is even bringing disadvantages also. Like what disadvantages? So fees, increased cost to the company has to incur extra cost. And when you look it from the auditor's perspective, sharing of the fees, they have to share the fees with others, reduction in the audit fees, that is a disadvantages for the auditor. And in addition to that, even they will have disadvantages like lack of coordination. They will not coordinate with each other. A joint auditor might not coordinate with another person, he might not cooperate with another joint auditor. And also they will ignore the areas of common concern. Some common areas no one will look after, they will keep on playing the blame game there. And also there will be superiority complexes, ego complexes also will be there. So joint audit is coming with disadvantages also, it is even coming with advantages also, but advantages outnumber disadvantages. So that's why the companies are preferably going for joint audits. Now, in case if the joint auditors are appointed, how the work will happen? Will joint auditors will do the work separately? Like SBI is an example of joint audit. 12 audit firms are appointed for conducting audit of SBI. Does that mean will 12 joint auditors will do audit 12 times separately? No. So when joint auditors are appointed, they will divide the work among themselves. On what basis the work will be divided? So it could be on the basis of items of financial statements like assets, liabilities, incomes and expenses. It could be on the basis of geographical locations. It could be on the basis of it could be even on the basis of financial statements, items of financial statements over geographical locations over. It could be even divided on the basis of period of financial statements. It could be even divided on the basis of various businesses also. Like if you take Reliance Industries Limited, one joint auditor is saying I will look after petroleum and telecommunication, and the other one is saying I will look after retail and fashion segments. So like this, on different basis, work can be divided on the basis of items of financial statements, geographical locations, period of financial statements, and even on the basis of businesses also the work can be divided. So we have seen how the work will be divided. Now let us talk about responsibility. There will be two kinds of responsibilities. One is separate responsibility and the other one is joint responsibility. Separate responsibility means each joint auditor will be held responsible only for the work which was allocated to him. Like if joint auditors divided the work on the basis of items of financial statements, one joint auditor is looking after incomes and expenses. Other joint auditor is looking after assets and liabilities. A will face the consequences only for any mistake happened in work allocated to him. B will face the consequences only for the work which was allocated to him. So like this separate responsibility means each joint auditor will be held responsible only for the work which was allocated to them. Now, coming to joint responsibility or combined responsibility, which means that all the joint auditors will be collectively held responsible in some matters. So, what are that cases, sir, in which all the joint auditors will be held responsible? There will be 5 cases in which all the joint auditors will be held collectively responsible. Number one, if there is any undivided work, when some work is not divided, and in that work only if something goes wrong, who will be held responsible? All the joint auditors will be held responsible. And not just that, decisions which are taken by all the joint auditors, if any decisions has been taken by all the joint auditors, if something goes wrong in that definition only, who will face consequences? All the joint auditors. Not just that, matters which are brought to notice of all, if some information has been brought to the notice of all the joint auditors and no one has taken an action, then also everybody will be held responsible. And whether the financial statements are prepared as per applicable financial reporting framework or not, whether audit report has been prepared as per auditing standards or not, for these 5 items, who will be held responsible? All the joint auditors will be collectively held responsible. Now, talking about reporting requirements, how the reporting is going to happen. How the reporting will happen means, generally all the joint auditors, once the work gets completed, they will have a discussion, they will discuss all their findings, they will come to one common opinion, and that common opinion will be expressed through a single audit report, and that single audit report will be signed by all the joint auditors. So how the reporting will happen? All the joint auditors will come together, have one discussion, form one common opinion, and this common opinion will be expressed to all the joint auditors by way of a single audit report. However, what if there is a disagreement? What if the joint auditors are disagreeing? For example, assume there are 12 joint auditors for SBI, 11 people are saying unmodified opinion, but one joint auditor is saying modified opinion. Since majority are saying unmodified opinion, should he go with the majority? No. The standard did not say go with the majority. The standard, what it has told us, if there is a difference of opinion, the auditor can give separate audit report containing his own opinion. So if there is a disagreement of opinion here, what will happen is 11 joint auditors will give single audit report which will contain unmodified opinion. This one joint auditor will give single audit report which contains a modified opinion. Sir, which report will be circulated to shareholder? Both the reports will be circulated to shareholders. Which opinion shareholder should rely? That is up to shareholder's choice. That is his headache, leave it to him. But however, our responsibility will come to an end when both the reports are circulated to the shareholder. Which one he will rely? That is shareholder's choice. Clear, everybody? And also one more thing, the standard has told each joint auditor can rely on the work of another joint auditor without any review. No review is required. A joint auditor can believe the work of another joint auditor without conducting any review. Why? Because the other person is also equally qualified like you. So this is what regarding joint audit related provisions, and whatever we have discussed till now, all these things are really, all this content has been taken from SA 299. So whatever we have content, whatever content we have discussed till now regarding joint audit, everything has been given under SA 299. Now one more last concept regarding that, internal audit. Let us try to end our revision with that. Yeah. So here we have internal audit. So let us try to understand what are the provisions of this internal audit. First one, meaning, what is internal audit? So internal audit is also an independent activity. It is also an objective assurance. In an unbiased manner, we try to provide assurance, and it is a consulting activity. Internal audit is a problem solving activity, and which is designed to add value and improve an organization's operations. If you take normal statutory auditor has nothing to do with generating the value for the company. He will not contribute for improving organization's performance. But internal auditor is exclusively appointed not just to express an opinion, to add value. He will find out weakness. He will report that to the management, and he will not just report to the management. He will even give recommendations for improvement. Recommendations for improvement will never be given by the statutory auditor. But internal auditor, the definition itself says he has been appointed to add value and even improve organization performance, which statutory auditor will never do. Statutory auditor's objective is what? Just to express an opinion. But internal auditor's objective is what? To add value, to generate value for the client. And applicability, to which companies internal audit is becoming applicable? For every listed company. And if it is a unlisted public company, And if it is a unlisted public company, they will say if it satisfies any of the four conditions. Which four conditions? I will tell you shortcut to remember. So four things you remember: 25, 50, 100, 200. Twice the previous figure. So biggest figure is 200. Generally biggest figure in the financial statements is turnover. If turnover is greater than or equal to 200 crores in the preceding financial year. The smallest figure 25, generally it is referring to deposits. Deposits will be very minimal in value. If deposits is greater than or equal to 25 crores, then the internal audit becomes applicable. Then we have 50, 100, which is lying in the ratio of 2:1, and we know ideal debt equity ratio is 2:1. Debt should be 2 times of equity. So here 2 times ratio is 100, that is referring to outstanding borrowings if it is greater than or equal to 100 crores. 50 is equity, nothing but paid up capital, which is greater than or equal to 50 crores. That's all. So if you are an unlisted public company, if you satisfy any of these four conditions, what are they? Outstanding deposits of 25 crores or more, and paid up capital of 50 crores or more, turnover of 200 crores or more, outstanding loans or borrowings of 100 crores or more. That's what I have tried to explain here in the form of a shortcut: 25, 50, 100, 200. Biggest figure turnover, smallest figure deposits, remaining two items 2:1 ratio, debt and equity, outstanding borrowings and paid up capital. That's all. So this is for a public company. If it is a private company, out of these four, only we need to check two conditions. This last two conditions, outstanding borrowings and turnover. Only if only any of these two conditions get satisfied, then private company also internal audit become applicable. So out of above four conditions, only two here we need to check. Amounts will be same. So what are the two conditions? Turnover of 200 crores or more, outstanding loans or borrowings of 100 crores or more. Now, who can act as an internal auditor? So here they are saying any individual, partnership firm, or even a body corporate also can be appointed as an auditor. See, a body corporate can't be appointed as a statutory auditor, but even body corporate can be appointed as internal auditor. So who is eligible to act as an internal auditor? Let us see. A chartered accountant, whether engaged in practice or not, a cost accountant, whether engaged in practice or not, or even any other professional as may be decided by the board. A chartered accountant, whether he could be in practice or not. A cost accountant, whether he could be practicing or not. Not just chartered accountant, cost accountant. Even board of directors can appoint a person of any other profession also to act as an auditor. So then why they have told chartered accountant, cost accountant? To avoid our egos from getting hurt. That's all. So simple. So by the end of the day, any professional can be appointed by the board of directors to conduct internal audit. And who will decide objective and scope? So who will decide objective and scope? Here, if audit committee is there, audit committee will decide. If audit committee is not there, board of directors will decide objective and scope of auditor. Internal auditor, Companies Act doesn't want to interfere in the deciding of objective and scope. And one more point, internal auditor may be an employee or may not be an employee of the company. Whereas the statutory auditor can never be an employee of a company, but they have given that freedom when it comes to internal auditor. Internal auditor may be an employee or he may not be an employee of the company. Clear? So this is what the things which I thought of covering in the company audit revision. So we have spent somewhere around 1.5 hours, and this discussion, this revision is very worthy. It will fetch you minimum of 10 marks in the examination. We are going to revise now the next most important chapter, which is going to be audit reporting, which carries a very good weightage in the examination, and also from the practical perspective it is going to be very, very important. So without any delay further, let us directly start doing the revision of this chapter, audit reporting. So what exactly is this chapter made of? So first, if I put out the context which is there in this entire chapter called audit reporting. See, this chapter is actually a combination of 4 standards. And basically, this is the chapter which is going to talk about how to prepare audit report, in what format audit report has to be prepared, what content should be there, what terminology should be used. So all these things, that guidance is contained in this particular chapter called audit reporting. So if I tell you what exactly we are supposed to cover as a part of this particular chapter. So as I was saying, there are 4 standards, 700 series of standards, which are talking about the preparation of audit report and its contents. So those 4 standards are going to be SA 700, then we have SA 701, then we have SA 705, and then we have SA 706. So these 4 are the standards which are going to give a comprehensive guidance regarding how to prepare audit report, terminology, format, sentence formation. So all that guidance is there in this particular 4 standards: 700, 701, 705, and 706. Along with that, there are certain sections of the Companies Act which are putting some extra reporting requirements on the auditor in the auditor's report. So there are three sections actually of the Companies Act which are putting some additional reporting requirements on the auditor, which are going to be 143 subsection 1, 143 subsection 3, 143 subsection 11. So this things which I have listed down here, these four standards, 700, 701, 705 and 706, along with that, three sections of the Companies Act, 143 subsection 1, 143 subsection 3 and 143 subsection 11, all of this put together will make up this chapter called Audit Reporting. And once again I am telling, very important chapter, both from the examination perspective as well as from the practical perspective also, it is going to be very important. So now we will start revising with SA 700. So SA 700 is the basic standard which is going to talk about what and all are contents of the audit report. What should be the format of the audit report? That discussion was given under SA 700. So let us try to understand now. Let us try to revise now quickly the standard which is SA 700. We will start with that. So once again I am saying, if you want to download the material which I am showing here in this video, please check the description below once. There I have given complete details how you can get access to the material whatever I am showing you here. So we will be starting our revision with SA 700, and as you could see, the title of the standard is Forming an Opinion and Reporting on Financial Statements. So as we all know, the ultimate objective of the auditor is to express an opinion. First, you have to form your opinion on the basis of whatever audit evidence you have gathered. And once you form that opinion should not be kept to yourself. That opinion should be expressed. And how that opinion will be expressed? That opinion will be expressed in the form of a written report, which we call it as an audit report. So auditor's ultimate objective is to express an opinion, and how to express that opinion, not just coming before the shareholders and saying it orally. That opinion needs to be expressed in the form of a written document. That written document in audit terminology, we call it as audit report. And how to prepare that audit report, that is what this standard is going to exclusively focus on. So now in this standard, there are so many contents which have been given. But first, I will take you through directly the contents of the audit report. What exactly should be the contents of the auditor's report? So here I have listed down the contents of the audit report. As you could see, title, addressee, opinion paragraph, basis for opinion paragraph, material uncertainty relating to going concern, key audit matters, emphasis of matter, other matter paragraph. Then we have responsibilities of management for financial statements, auditors' responsibilities for the audit of financial statements, reporting on other legal and regulatory requirements, signature of the auditor, place of signature, date of signature, and finally, you did. So these should be the contents in your audit report. Now we will try to revise each and every content in a detailed manner. So what will come in the title? So generally, the title of the auditor's report should be Independent Auditor's Report. What should be the title of auditor's report? The title of audit report should always be what? Independent auditor's report. So for example's sake, we will take one live audit report. So we will try to revise the things simultaneously along with the practical perspective in mind. So we'll download one, or I will show you one practical audit report. With that, we can take the practicality and conceptual clarity both hand in hand. So let us do it now. So for example's sake, I will download the Reliance Industries Limited audit report. So we will have a look at that simultaneously. So let me open that material here. So this is what the annual report of Reliance Industries Limited. We will directly go to that particular section of the annual report which contains audit report. So this is what the audit report will look like. This is the audit report given by auditors of Reliance Industries Limited. And the first and foremost content of the audit report, as we have read in the standard, is what? Title. There should be title. So if you see here, the title is given. What is the title given? Independent Auditor's Report. So the title should always be Independent Auditor's Report. Now after that, the second content which should be given is addressee. Now who will be the addressee? Addressee in the sense, through the audit report, you are expressing the opinion. To whom you are expressing the opinion? So that addressee you have to mention. And if I say addressee depends on the client's organization. Like if I am conducting audit of a company, my addressee will be shareholders of the company. If I am conducting audit of a partnership firm, my addressee will be partners. If I am conducting audit of a sole proprietorship firm, my addressee will be the concerned sole proprietor. So who should be your addressee? That depends upon legal form of your client's organization. So for example's sake, as we are looking into this Reliance Industries Limited audit report, since it is a company, who is addressee here? Members or shareholders. So title has been given, then addressee has been given. So let us come to the next content. So once you have given title and addressee, let us come to the point first. Let us come to the point directly. So why we are giving audit report? So audit report is basically a document through which auditor expresses his opinion. So once you have given the title, once you have given the addressee, first come to the point directly, we will talk about the opinion. Finally, give the opinion what you are supposed to give on this financial statements which you have verified. Now we need to understand this opinion in a detailed manner. So basically, as per SA 705, so in order to have a discussion regarding opinions, now we are switching from SA 700 to SA 705. So let us try to understand the various kinds of opinion as given under SA 705. Then we will come to the next contents. So SA 705 says that opinion can be, auditor's opinion is broadly divided into two categories. Number one, unmodified opinion, and the other one is modified opinion. Auditor's opinion can be broadly divided into two categories, unmodified opinion and modified opinion. Now, what is unmodified opinion? What is modified opinion? Let us try to revise them. Modified opinion, unmodified means simply a positive opinion. Unmodified means simply what? A positive opinion, which means you have verified the financial information of the client. You did not find any material misstatement. You did not find financial statements to be misleading. That means financial statements are giving true and fair view. So as an auditor, when you are satisfied by obtaining audit evidence that the financial statements of the company are giving true and fair view, they are not misleading, they are properly presented, then I will give unmodified opinion. Nothing but in common terminology, in common parlance, positive opinion, clean opinion we are giving. And if they ask you to write the definition of unmodified opinion, what you are supposed to write is auditor will give unmodified opinion when the auditor is satisfied that yes, financial statements are prepared as per applicable financial reporting framework, and also auditor is satisfied that financial statements are free from material misstatements. So when the auditor obtained audit evidence and on the basis of that evidence, auditor is satisfied that yes, financial statements are prepared as per applicable financial reporting framework and also the financial statements are free from material misstatements, then the auditor will express an opinion called unmodified opinion. There are even other names for unmodified opinion. We can even call it as unqualified opinion, or alternatively, we can call it as clean opinion also. What we can call unmodified opinion is having other names. It can also be called as unqualified opinion, or even it can be called as clean opinion. And the standard says that if you want to give unmodified opinion, you cannot use your own terminology. The standard has even given the prescribed terminology, prescribed sentences or phrases which you are supposed to use. So the standard says that in case if you are giving unmodified opinion, use the terminology, use any one of the terminology, either use the terminology financial statements give true and fair view, or alternatively use the terminology financial statements present fairly in all material respects. Financial statements present fairly in all material respects. So either use any of these phrases, that's all. Don't use your creativity and draft new sentences. When you want to give unmodified opinion, you have to use one of these two phrases. Either you have to say financial statements give true and fair view, or alternatively you can say financial statements present fairly in all material respects. Only one of these two phrases you have to use it. So the moment you find these phrases, any of these phrases in the auditor's opinion paragraph, that opinion is what opinion? Unmodified opinion. So this is what the definition of unmodified opinion. Now, when modified opinion will be given? So, see, if unmodified opinion is given when auditor is satisfied that financial statements are giving true and fair view, when modified opinion will be given is when the auditor is not satisfied with the true and fair view. When the auditor found that financial statements are a bit misleading, when the auditor found that financial statements are not presenting fairly all material respects. So, if the auditor is not satisfied with true and fair view, then auditor will give modified opinion. And this modified opinion will be of three different categories. Number one, qualified opinion. Number 2, adverse opinion. And number 3, disclaimer of opinion. So whenever auditor is not satisfied with the true and fair view, the auditor will modify the opinion. He will give a negative comment in his auditor's opinion, and that modified opinion can be given in 3 ways. That those are qualified opinion, adverse opinion, disclaimer of opinion. Now let us try to understand when auditor will give qualified opinion, when auditor will give adverse opinion, when auditor will give disclaimer of opinion. That we will try to have a quick revision now. So first we will talk about qualified opinion. First we will talk about qualified opinion. So the auditor will give qualified opinion in 2 circumstances. Auditor will give qualified opinion in 2 circumstances. Number 1, when auditor has obtained sufficient and appropriate audit evidence. When the auditor has obtained sufficient and appropriate audit evidence, and on the basis of that evidence, auditor concluded that financial statements contain misstatement. So auditor has obtained sufficient and appropriate audit evidence, and on the basis of that evidence, auditor concluded that financial statements contain a misstatement which is material. Which is what? Material. It is big. There is a misstatement which is material enough, but the misstatement is not pervasive. Misstatement is what? Not pervasive. So you have performed audit procedures. After performing audit procedures, you have obtained audit evidence, and on the basis of the audit evidence, you have concluded that financial statements contain a misstatement, and the effect of misstatement is material. It is big enough, but it is not pervasive. It is not so big enough to say entire financial statements are wrong. Then the auditor will give qualified opinion. Like if I give you one example to make you understand this, assume I am conducting audit of financial statements of company, extract of the balance sheet I am giving. So the balance sheet details are something like this: fixed assets 200, current assets, the total of current assets like inventory, reserves, trade receivables, cash and cash equivalents. Those are also some details are given like 50, 50 and 50. So total of the balance sheet is 350. There are some liabilities also. Even when I verify liabilities, the total also here is 350. The place only where the balance sheet will not match is our exam. Balance sheet will always match in our real life. So this is what the extract of the balance sheet. Now I started performing audit procedures on this balance sheet. When I verified fixed assets, I found sufficient and appropriate audit evidence. No, nothing misstated. All the fixed assets are perfectly fine. I verified trade receivables. Here also everything is fine. I did not find any misstatement. I verified cash and cash equivalents. No misstatement. Similarly, I verified equity and liabilities. There also I am not able to find out any material misstatement. But when it comes to inventory, I am able to find a misstatement here. When I perform audit procedures in the inventory area, here I am able to find out misstatement. And the amount of misstatement which I have found is 5 crore rupees. How much misstatement I have found? 5 crore rupees of mistake. I was able to find it in the area of inventory. In rest of all the items, I did not find any material misstatement. Rest of all the items are giving true and fair view. So this is a case where auditor is having sufficient and appropriate audit evidence. Is the evidence available? Yes. And on that basis, auditor concluded that there is a misstatement. Is there a misstatement? Yes. How much misstatement? 5 crores. Is it material? Yes, it is material. Why? Because in 350 crores, 5 crores is somewhat material. It could influence the decision of users of financial statements. But is it so big enough to say entire financial statements are wrong? Which means on the basis of 5 crores, can we say entire financial statements are wrong? No. That means it is material, but it is not so big enough to say entire financial statements are wrong. That means it is not pervasive. So since auditor has obtained sufficient and appropriate audit evidence, on the basis of that, he concluded that financial statements contain a misstatement. The effect of the misstatement is material, but it is not pervasive. I will tell you in a short while what is the meaning of the term pervasive. We will try to understand it in a short while. So in this case, what opinion auditor will give? Qualified opinion auditor will give. Clear everybody? So one case I have told in which qualified opinion will be given. And there is one more case in which qualified opinion also can be given, which is auditor unable to obtain sufficient and appropriate audit evidence. As an auditor, you are unable to obtain sufficient and appropriate audit evidence, and the possible effect of that undetected misstatements is material but not pervasive. It will look somewhat similar to the previous case only, but the difference here is, in the previous case, auditor was able to obtain sufficient and appropriate audit evidence, but in this case, auditor is unable to obtain sufficient and appropriate audit evidence. Like if I give you example for this, we will take the same kind of example, but little bit change in the observations. Assume I am conducting audit of this particular company. Here also I have started performing audit procedures. I verified fixed assets, no misstatement. I verified trade receivables, no misstatement. I verified cash and cash equivalents, no misstatement. I verified equity and liabilities, no misstatement. But in inventory, I am not able to verify 5 crores worth of stock. In the previous case, I told auditor found a misstatement by verifying it. But here what I am telling is, I am not at all able to check the stock only. I am not able to verify the stock worth 5 crore rupees. I am not able to verify. So I am not in a position to obtain sufficient and appropriate audit evidence. Out of 50 crores, 5 crores worth of stock, I am unable to obtain audit evidence. Now, if this 5 crores worth of stock, which I am not able to get the evidence, if it goes wrong, what will be the impact? Will it be material? Yes. See, that's why I use the term possible effect. So whenever you are using the terminology unable to obtain audit evidence, you can't directly say effect of the misstatement. You have to use what? Possible effect of misstatement. Sir, why possible effect of misstatement, sir? Just a minute. Yeah. Why possible effect, sir? Why? Because you are unable to obtain audit evidence. So we are just assuming what could happen if that item goes wrong. So I am not able to obtain evidence regarding 5 crores worth of stock. If this 5 crores, even if it goes wrong also, the possible effect is material. It is significant, but it is not so big enough to say entire financial statements are wrong. It is not pervasive. So qualified opinion can be given in two cases. Either you have a evidence or you don't have a evidence. But the effect or possible effect of the misstatement should always be only material but not pervasive. Clear, everyone? So there is even a terminology. When you want to give qualified opinion, you have to use a terminology something like this. There is some dedicated terminology which you are supposed to use. Sir, how to identify the opinion is a qualified opinion? By looking at terminology. So what terminology auditor should use? Auditor should use a terminology except or subject to certain items that I will explain. What are those items? Except or subject to certain items. Financial statements give true and fair view. Financial statements give what? True and fair view. That means there are just one or two items which contain material misstatement. Apart from that, rest of all the items are giving true and fair view. So if you find this particular terminology, except or subject to certain items, financial statements give true and fair view, that is what qualified opinion means. Now, can you call this as completely positive opinion? By using this sentence, am I giving completely positive opinion? No. Why? Because I am saying some items are there, no, which are materially misstated. So that's why it is not a completely positive opinion. At the same time, it is not a completely negative opinion. It is a moderate negative opinion. Clear? So whenever you find this terminology, except or subject to certain items, financial statements give true and fair view, that opinion we call it as what? Qualified opinion. This is how to identify the qualified opinion. Understood? So qualified opinion, we have revised two circumstances in which qualified opinion will be given. Now let us try to understand when adverse opinion will be given. See, adverse opinion will be given only in one case, and that case is auditor is able to obtain sufficient and appropriate audit evidence. Auditor is able to obtain sufficient and appropriate audit evidence, and on the basis of that audit evidence, auditor concluded that financial statements contain a misstatement. Financial statements what? Contain a misstatement, and the effect of the misstatement is material, and it is not just material, it is even pervasive also. That means I conducted audit of financial statements. I have obtained audit evidence, and those evidences are saying that financial statements contain a misstatement. That misstatement is not just material, it is so big enough to say financial statements are completely wrong. So when I have evidence and I have concluded that financial statements contain a misstatement, the effect of the misstatement is not just material, it is even pervasive also, then I will give adverse opinion. Sir, what kind of terminology should be used in the adverse opinion, sir? The terminology which the standard is suggesting you is directly saying the opinion paragraph, financial statements do not give true and fair view. What terminology we have to use in opinion paragraph? Straight away in the opinion paragraph we have to say financial statements do not give true and fair view. Don't believe this financial statements. Financial statements are completely wrong. So that's what the adverse opinion, completely negative opinion. And when it will be given? When you have sufficient and appropriate evidence available, and on that evidence you have concluded that financial statements contain a misstatement whose effect is not just material, it is even pervasive also. And what terminology I have to use? Financial statements do not give true and fair view. Then comes the last kind of modification, which is disclaimer of opinion. Which is what? Disclaimer of opinion. Sir, when disclaimer of opinion will be given? So it is also given in one case when auditor is unable to obtain sufficient and appropriate audit evidence and the possible effect of that undetected misstatements. That means those items which you are unable to obtain audit evidence, if they go wrong, the possible effect will be not just material, it is even going to be pervasive also. That means you are not able to obtain evidence regarding so many items, and if all that items goes wrong, the effect will not be just material, the effect will be pervasive. So in that case, auditor will give disclaimer of opinion. And the terminology which auditor should use in case if he is giving disclaimer of opinion is, he should use the terminology, we are unable to express an opinion on financial statements. The moment you find this terminology, that is what kind of opinion? Disclaimer of opinion. Clear everyone? So one last time I am repeating, qualified opinion. What terminology will be there? Except or subject to certain items. Financial statements give true and fair view. Adverse opinion, completely negative. I will say financial statements do not give true and fair view. Disclaimer of opinion, I will use a terminology, we are unable to express an opinion on financial statements. Why? Because we are unable to obtain evidence regarding those matters which are material and pervasive. Clear? Qualified opinion will be given in two cases, adverse opinion will be given in one case, disclaimer of opinion will be given in one case. Understood everybody? So that is what three kinds of modified opinion are, and these three kinds of modified opinion are actually explained in SA 705. Whatever different kinds of modified opinion which I have explained you, everything has been explained from which standard? From SA 705. So let me take you there. So if you go to SA 705, the title itself is Modifications to the Opinion in the Auditor's Report. That means this standard is talking about how to modify the auditor's opinion in the auditor's report. And as I have told, there are three different kinds of modified opinion. Number one, qualified opinion, which can be given in two cases. Number two, adverse opinion, which will be given in one case. And number three, disclaimer of opinion, which also will be given in one case. Now, we need to define modified opinion in such a manner that it takes into its perspective qualified also, adverse also, disclaimer also. See, modified opinion, three categories are qualified, adverse, disclaimer. Now we need to even define this modified opinion, no? And we need to define modified opinion in such a manner that under its definition, it will consider qualified also. Under its definition, it shall include adverse also. Under its definition, it should include disclaimer also. So let us see how the term modified opinion has been defined so that it will take into its perspective all the three different kinds of modified opinions. So if you have a look at it, the auditor shall modify the opinion in the following circumstances. When the auditor concludes that based on audit evidence obtained, that means auditor has obtained sufficient and appropriate audit evidence, and on that basis he has concluded that financial statements are not free from material misstatements. So as an auditor, you had evidence, and on that basis of evidence, you are concluding that financial statements are not free. That means financial statements are containing some material misstatements. In this case, which kind of modification will be given? In this case, either qualified or adverse will be given. Sir, why qualified or adverse, sir? Why? Because since you have evidence, and if you concluded that financial statements contain misstatement, which is only material but not pervasive, then I will give qualified. In case if I have concluded financial statements contain a misstatement which is material and also pervasive, then I will give adverse. So first point will take into its perspective qualified as well as adverse. Or we will modify the opinion when the auditor is unable to obtain sufficient and appropriate audit evidence. As an auditor, you are not able to obtain sufficient and appropriate audit evidence to conclude whether the financial statements are free from material misstatements. That means you are unable to obtain audit evidence. In this case, which opinion will be given? In this case, either qualified or disclaimer will be given. Why? Because this is a case of non-availability of audit evidence. So either qualified or disclaimer will be given. And B point, if you observe here, factors which are helpful in deciding which type of modified opinion will be given. Whether you have to give qualified, whether you have to give adverse, whether you have to give disclaimer, that depends on what circumstances. Simply, if you ask me, two circumstances will decide which kind of modified opinion will be appropriate, and those two circumstances are availability or non-availability of audit evidence. Number two, pervasiveness of the misstatement. If you observe all the three definitions, whatever I have told, either qualified, adverse, disclaimer, which kind of modification has to be given, that depends on only two circumstances. One is availability or non-availability of audit evidence. Other one is pervasiveness of the misstatement. Depending on these two things, we will decide whether qualified will be appropriate, adverse will be appropriate, or disclaimer will be appropriate. And one more important thing from SA 705, definition of the term pervasive. Definition of the term pervasive. Sir, you are saying misstatement, pervasive misstatement you are saying, but what exactly is the meaning of the term pervasive? Very important from the examination perspective. So the term pervasive misstatement can be defined as, we call a misstatement as pervasive. We call a misstatement is having pervasive effect when the misstatement is not confined to one or two elements of financial statements. That means a misstatement is not just restricted to one or two items of financial statements. It is spread across all the items of financial statements. That means misstatement is there in so many items of the financial statements, that we call it as pervasive. Or even though if the misstatement is confined to a specific item, it is representing substantial portion of the financial statements. Sometimes misstatement will be restricted to only one item, but the amount which it is representing is so big enough to say entire financial statements are wrong. Like for example, assume if I have taken a balance sheet, so many items are there in the balance sheet. If the misstatement is there in all the items, if the misstatement is spread across so many items, then we call it as pervasive. Or sometimes what will happen is misstatement will get restricted only to one item. Take for example, fixed assets, 100 crores are there. Misstatement is there in only 100 crores of these fixed assets, and the amount of misstatement is 80 crores. Here the misstatement is restricted only to one item, but it is representing a very big portion of the financial statements. The total of the balance sheet itself is 20. Out of that, in the fixed assets alone, 80 crores of misstatement is there. So even if it is confined to one or two items, but if it is representing substantial portion of financial statements, then also we call it as pervasive. Or if the management has made mistake in those kind of disclosures which are fundamental to users' understanding of financial statements, then also we call it as pervasive. If the management made a mistake in those kind of disclosures in the notes to accounts, the management has given such a wrong explanation in those notes which are very fundamental to users understanding of financial statements. Like management made some wrong disclosure regarding going concern, since it is very fundamental to users understanding, that misstatement also will be called as pervasive. So this is how the term pervasive has been defined. Even I have given definition here regarding the term pervasive. So if you observe, if it is not just confined to specific items of the financial statements, even if it is confined, it could represent a substantial portion of the financial statements, or in relation to those disclosures which are fundamental to users' understanding of the financial statements. So with this, we are done with different kinds of opinion, and along with that, the definition of the pervasive also we have seen. From where we have come to this discussion? From where we have come to this discussion is, we are discussing something about contents of the audit report. In that third content, we are discussing opinion. So we have seen how opinion will be divided. So whatever it is, depending on facts and circumstances, the auditor should express an appropriate opinion. But in addition to the opinion, some extra information also should come in your opinion paragraph. Not just opinion, in addition to the opinion which you are expressing, some other information also shall be presented in the opinion paragraph. Sir, what extra information should come in my opinion paragraph in addition to the opinion which I am expressing? So SA 700 says 5 things must come in your audit report in the opinion paragraph along with the opinion. What are they, sir? So number one, you have to identify the entity whose financial statements you are auditing. Nothing but I tell the name of the entity whose financial statements you are auditing. Number two, you have to mention a fact that financial statements have been audited. Mention one statement that we have audited the financial statements. Number three, identify the title of each statement. Nothing but explain what and all are titles of items of financial statements. Like you should say, financial statement contain balance sheet, P&L, cash flow statement, etc. And also, you should give reference to notes and summary of significant accounting policies. And finally, you should even give reference to date and period covered by financial statements. These are five things must come in your opinion paragraph. So what are the five things which must come in your opinion paragraph? So the five things are: number one, identify the entity. Tell the name of the entity whose financial statements you are conducting the audit. Number two, state the fact that financial statements are audited. Give a description of title of the components of financial statements. Give a reference to notes and significant accounting policies. Number five, give a reference to period and date covered by the financial statements. So for practical sake, if I have to show you all these five details, you'll be able to find it in this paragraph. Like if I take you through this paragraph, they are saying we have audited the accompanying standalone financial statements of Reliance Industries Limited. Two things are covered here. One is name of the entity they are telling, even they are telling the fact that they have audited the financial statements, which comprises balance sheet, statement of profit and loss, statement of cash flows, statement of changes in equity. Nothing but title of the components of financial statements. And they include notes to the standalone financial statements and summary of significant accounting policies. Fourth point, reference to notes and significant accounting policies. Last one, date and period covered by financial statements. That is also given here. Financial statements as at March 31, 2022. So these five items must come in your opinion paragraph. Clear? So successfully we are done with the third content, opinion paragraph. Now, once the opinion paragraph is over, the next content which should come in your opinion, which should come in your audit report is basis for opinion. Now, what information will be presented in the basis for opinion paragraph? SA 700 says four things must come in your opinion paragraph. Four things must be presented in the opinion paragraph. So what are that four things which must be presented in the opinion paragraph is: number one, you have to say that you are doing the audit as per standards on audit. You should mention you are doing the audit as per standards on audit. Number two, state that you are independent of the entity and you comply with ethical requirements. Number three, give a reference to auditor's responsibilities paragraph. Number four, even you should mention whether evidence which you have obtained is sufficient and appropriate audit evidence. So in your basis for opinion paragraph, four things must be stated in the basis for opinion paragraph. What are the four things which must be stated? So here I have given detailed description. Number one, mention that you are doing the audit as per standards on audit. Number two, you have to give reference to auditor's responsibilities paragraph. Number three, state that you are independent of the entity and you comply with ethical requirements. Number four, state whether auditor believes that audit evidence which auditor has obtained is sufficient and appropriate. So even in the audit report also, if you do the detailed reading, that's what the four items which will be presented in the basis for opinion paragraph. Clear everybody? Now one more point to add here. SA 700 and 705, if you do a collective reading, they say that if you are giving unmodified opinion, the title of opinion paragraph will remain just opinion and the title of basis for opinion will remain just as basis for opinion paragraph when you give unmodified. But whenever you are giving modified opinion, either that could be qualified adverse disclaimer, the titles of opinion and basis for opinion paragraph also should be changed. So what I am trying to say is, in case if you give qualified opinion, the title of opinion paragraph should not be just opinion. The title of opinion paragraph should be qualified opinion. And the basis for opinion paragraph title should be changed to basis for qualified opinion. Similarly, if you give adverse opinion in the audit report, the heading of the opinion paragraph shall not be just opinion, it should be adverse opinion, and basis for opinion paragraph should be changed to basis for adverse opinion. The same thing will happen even for disclaimer also. Opinion paragraph heading should be disclaimer of opinion and basis for opinion paragraph should be changed to basis for disclaimer of opinion. But in case if you are giving unmodified opinion, the opinion paragraph heading will just remain opinion and basis for opinion will just remain basis for opinion. If you see the practical reports here, auditors of Reliance Industries Limited are giving unmodified opinion. That's why they have just given the title as opinion here and basis for opinion also has been given as just basis for opinion. In case if the auditors would have given modified opinion, they would have changed the titles of opinion and basis for opinion paragraphs appropriately. And in addition to that, in case if you give modified opinion, in the basis for opinion paragraph, along with these four things, some extra information also should come. If you give unmodified opinion, basis for opinion paragraph will contain only these four matters. But in case if you give modified opinion, that could be qualified adverse disclaimer, whatever it is. In case if you give modified opinion, along with these four matters, even you should mention in the basis for opinion paragraph, what are the reasons why you are giving modified opinion. If you give, once again I am repeating, if you give unmodified, only these four things will come in basis for opinion. If you give modified, along with that four things, few more information also should come in basis for opinion paragraph. What is that? The reasons why you are giving modified opinion, be that qualified, be that adverse, be that disclaimer, the reasons why you are giving modified opinion, that reasons also should be stated in the basis for opinion paragraph. And wherever possible, you should quantify the amount of misstatement. That means you have to calculate the amount of misstatement. That figure should be stated in the basis for opinion paragraph. In case if you are unable to quantify, mention the same thing, that you are unable to calculate the figure exactly. Understood? So if you modify your opinion along with these four things, even tell the reasons why you are giving modified opinion. Clear everybody? So with this we are successfully done with the fourth paragraph also, which is basis for opinion paragraph. The next paragraph is about material uncertainty relating to going concern. So material uncertainty relating to going concern is a paragraph which will come as a part of SA 570. When we revise the standards on auditing regarding SA 570, then you will get to know what is this material uncertainty relating to going concern paragraph. So there it will be covered. But just remember here, as a part of contents of audit report, even one paragraph relating to going concern also will come in our audit report. So ignore this for the time being now. This will be covered as a part of SA 570 in the standards on auditing. Now let us come to the next point, key audit matter. Now what is this key audit matter? So in order to understand this key audit matter, we have to go to the standard SA 701. Which is talking exclusively about communicating key audit matters in the auditor's report. So first we should define what is the meaning of the term key audit matter. So the definition of the term key audit matters is those matters which in auditor's professional judgment were of most significant while conducting the audit of financial statements. How the term key audit matters has been defined? Those matters which in the auditor's professional judgment, that means auditor using his knowledge, experience and training, he should select a few matters which he feel it as very important in the audit of financial statements, and those matters we call them as key audit matters. Like if I take you through the definition of the key audit matters, I will take you through SA 700 and 701. Quickly we will revise, very simple standard. So how the term key audit matters is defined? Key audit matters are those matters that in the auditor's professional judgment were of most significance, most important in the audit of the financial statements of current period. And key audit matters are selected from those matters which are communicated with those charged with governance, which means that if you want to include certain matter in the key audit matter paragraph, first you have to communicate that matter with the those charged with governance, then only you have to include it in the key audit matter paragraph. So now what is the purpose of communicating key audit matters, sir? The main purpose of communicating key audit matter is to enhance the communicative value of the auditor's report. Nothing but to increase the information provided by the auditor's report. The industry felt that audit reports are all looking uniform, exactly same. Industry members felt that audit report is not providing any extra information. So in order to increase that communicative value, to provide more transparency about the audit, this key audit matter has been introduced. So if they ask you purpose, we have to write to enhance, to increase the communicative value of auditor's report. Next one. So communicating key audit matters provide additional information to the users in addition to the opinion, etc. If you give the key audit matters, that will provide extra information to the users of the financial statements so that they can comfortably understand how the audit has taken place. In addition to that, few more things here. This is very important. Communicating key audit matters is not a substitute for three things. Communicating key audit matters is not substitute for three things. Number one, communicating key audit matters is not a substitute for those disclosures which the management has to give in the financial statements as per applicable financial reporting framework. Communicating key audit matters is not a substitute for those disclosures which management is supposed to give in the financial statements as per applicable financial reporting framework. If I put it in simple language, see, management is required to give so many disclosures in the financial statements as per applicable financial reporting framework. Now, the client for whom you are doing the audit, that management has forgot to include some disclosures in the financial statements. Now they are coming to the auditor and asking, sir, we are supposed to give some disclosure, but we forgot to do it. Why don't you include them as a key audit matter? We forgot to give some disclosure in the financial statements. Anyhow, you will give the audit report. No, in that audit report, under key audit matter paragraph, you explain the disclosure which we are supposed to give. Can the auditor agree to that? Definitely not. Key audit matter paragraph is not introduced as a substitute for disclosure in the financial statements, which means the standard did not introduce key audit matter so that if the management forgets something, auditor will include it here. No, whatever disclosure which management has to give in the financial statements, that should be given in the financial statements only. The management cannot come and ask the auditor. Even if they ask, auditor can't include it in the key audit matter paragraph. So key audit matter paragraph is not substitute for those disclosures which the management is required to give as per the applicable financial reporting framework. Number two, it is also not a substitute for giving modified opinion. For example, if you found out a material misstatement, can you say, I will give an unmodified opinion and explain about that misstatement in the key audit matter? No. Key audit matter paragraph is not introduced as a substitute for modified opinion. You can't do it. If you are supposed to give modified opinion, you have to give modified opinion. You can't say, I will explain that in the key audit matter paragraph. It is not a substitute for modified opinion. It is also not a substitute for material uncertainty relating to going concern paragraph. If some information is required to be disclosed in material uncertainty relating to going concern paragraph, that information should be explained in that paragraph only. Auditor can't say, instead of explaining it in the material uncertainty paragraph, I will explain it in the key audit matter paragraph. No, the matter which has to go to material uncertainty paragraph, that will go there only. You can't use key audit matter paragraph as a substitute for that matter which is required to be disclosed in material uncertainty. And whatever key audit matters which are getting explained in the audit report, on any of the matter, auditor is not giving any separate opinion. Auditor is not giving any separate opinion on any of the key audit matter. He's just letting you know what difficulties he has faced during the audit. We should not consider the key audit matters. On the key audit matters, auditor is giving separate opinion. Like if you observe here in this audit report, there are some key audit matters given. Like first, auditors of Reliance Industries Limited, they are giving capitalization and useful life of tangible and intangible assets as a key audit matter. Does that mean auditor is giving separate opinion on this matter? No, auditor is not giving any separate matter. Just he's letting you know what is the significance of this matter. That's it. So auditor will not give any separate opinion on any of the key audit matter. Understood, everybody? So this is what regarding purpose. So when they ask you purpose, write two things. The main purpose is to enhance, to increase the communicative value of auditor's report, and it is not a substitute for three things: for disclosures which are required in the financial statements, for modified opinion, for material uncertainty relating to going concern, and auditor is also not giving any separate opinion on any of the matters stated therein. Next one, applicability. Sir, is the key audit matter required to be explained in each and every audit report? The answer is no. For the time being now, key audit matters are applicable only in case if you are conducting audit of listed entities. Sometimes your client might not be a listed entity, but some law or regulation may require you to communicate key audit matters. Then also you have to include. So in two cases, it is mandatory in case if you are conducting audit of a listed entity or if there is any law or regulatory requirement. In all other cases, the auditor himself will decide whether he wants to give key audit matter or he doesn't want to give key audit matter. That means in rest of the cases, it is choice. But in two cases, it is mandatory. In case if you are conducting audit of listed company, or even though if it is not a listed company, if some law or regulation is asking you to include key audit matter, then we will compulsorily include key audit matter. In rest of the cases, let the auditor himself decide using his professional judgment. Then presentation. So obviously presentation is whatever key audit matters you want to include it in a separate paragraph with the heading key audit matter. You have to include a separate section in the audit report, give a separate heading key audit matter, and in that paragraph, whatever key audit matters you want to explain, you explain it. And you have to use some introductory language. What introductory language? You have to use this language. Key audit matters are those matters that in the auditor's professional judgment were most significant. Nothing but definition of key audit matters you will write. And even you will say that these matters we have considered while doing audit of financial statements, and we do not provide a separate opinion. So as a caution, we tell it to the shareholder, boss, we are just highlighting this information. We are not giving any separate opinion. So this introductory language you have to use. Then you can start explaining about that key audit matters. Now coming to the next point, how to determine key audit matters, sir. In the definition, the standard has simply told it depends on auditor's professional judgment. But standard should help out the auditor know from where he can go and select the key audit matters, or what factors he has to consider in determining key audit matters. That is also given here. The auditor should start looking for key audit matters from three areas. The auditor should start looking for key audit matters from three areas. From those areas which have a very high risk of material misstatement, as you could see, you could select the key audit matters from those areas where the risk is very, very high. Or you can select the key audit matters from those areas which involve so many management assumptions and estimates, like provisions, depreciation. These are the areas where so many estimates and assumptions will be made. These areas also can be selected as key audit matter. Or if there are any significant events or transactions that have occurred, like amalgamation, etc., that events also can be taken as a key audit matter. So as an auditor, you can start looking for key audit matters from these three areas. What are they? Areas where there is a high risk of material misstatement, those areas in which significant assumptions and estimates are there, or significant events or transactions that have taken place during the year. And also, in some cases, we should not communicate key audit matter. When so, the standard has straight away told that in case if you are giving disclaimer of opinion, you should not disclose the key audit matter. In case if you are giving which opinion? Disclaimer. If you are giving disclaimer of opinion, you should not communicate key audit matter paragraph in your audit report. Your audit report should not contain a paragraph called key audit matter. Why? Because if you are giving disclaimer of opinion, you are saying that you are not able to express an opinion. That means you are unable to do the audit. When you are unable to do the audit, how can you identify significant matters from the audit? So that's why in case if the auditor is giving disclaimer of opinion, you should not include a key audit matter paragraph. However, even though when you are not giving disclaimer of opinion, some matters shall not be communicated as a key audit matter. If you give disclaimer, there is no paragraph called key audit matter. But in some cases, even though you are not giving disclaimer, that means you are giving other kinds of qualified, adverse or unmodified, then certain matters should not be communicated as a key audit matter. Which one, sir? That means if you are not giving disclaimer, that means if you are giving unmodified, qualified, adverse, key audit matter paragraph will be there. But some items should not come in that paragraph. What are they? When law or regulation prohibits some matter to be disclosed, there is some restriction from the law or regulation not to disclose certain matter, those matters should not come. Similarly, the next point, if you observe, the auditor determines that the matter should not be communicated because of possible adverse consequences. The auditor feels that because of disclosing this matter as a key audit matter, it will have more negative consequences. Then also auditor will not disclose it. Finally, the matter is highly confidential or sensitive. If the information is very sensitive or confidential, then also auditor shall not disclose it as a key audit matter. So once again, I am repeating, when it comes to prohibition, when auditor gives disclaimer, don't include key audit matter. Even when you are not giving disclaimer, some matters shall not be disclosed as a key audit matter, which are going to be those matters which law or regulation prohibits. The auditor feels that will have adverse consequences, or the matter is highly confidential or sensitive. So this is what SA 701 is about. So successfully we are done with one of the content, key audit matters, in our audit report, and we have revised even SA 701 also. So let us try to proceed further now with remaining contents of the auditor's report. So if we go back to the SA 700 once again and have a look at remaining contents once. Yeah. So key audit matters we are done, SA 701 we are done. So now talking about the remaining two contents. One is regarding emphasis of matter paragraph and the other one is other matter paragraph. And in order to understand what is this emphasis of matter and other matter paragraph, we have to go to SA 706 now. Now let us try to understand what is this emphasis of matter paragraph and what is this other matter paragraph. So SA 706 will be talking about emphasis and other matter. So first we will talk about emphasis of matter paragraph. So what is the meaning of the term emphasis of matter? So if you literally go by the definition, the dictionary meaning of the term emphasis means to highlight. What is the definition meaning of the term? What is the dictionary meaning of the term emphasis? To highlight. So emphasis of matter paragraph is a paragraph which will be used in the audit report to highlight some information which is already presented or disclosed in the financial statements. So emphasis of matter paragraph is a paragraph which will be used in audit report to highlight some information which is already presented or disclosed in the financial statements. That means some information is there which is already presented or disclosed in the financial statements by the management, but you thought that that matter is very much fundamental to users' understanding of the financial statements. The matter which is already disclosed or presented in the financial statements by the management, and the auditor feels that that is very fundamental to users understanding of the financial statements, then the auditor should highlight that in the emphasis of matter paragraph. Like if we go to SA 706 and read the definition of emphasis of matter paragraph, the same thing will be mentioned there also. Like if you see it here, emphasis of matter paragraph is a paragraph which is included in the auditor's report that refers to a matter which is appropriately presented or disclosed. Management has already presented or disclosed that in the financial statements, but in the auditor's judgment, it is very important for the user's understanding of the financial statements. Such matter, auditor will highlight it in the emphasis of matter paragraph. Sir, are there any examples of the circumstances which can be used as emphasis of matter paragraph? Yes. So the examples of circumstances which can be highlighted in the emphasis of matter paragraph could be, so some examples as I have given here: uncertainty relating to future exceptional litigation, nothing but some pending cases going on against the company. The company is going through some case. In case if the company fails the case, the consequences will be very huge. And the management, without their mistake, they have clearly explained that in the notes to accounts. So and so pending case we are going through, they have disclosed it in the contingent liability without their fault. So now can I give modified opinion? No. Why? Because management, without their mistake, they have disclosed everything in the financial statements. But this contingent liability, this pending litigation is so important for users' understanding of the financial statements. This is what I felt. So now I want to highlight this information in my auditor's report. The information is there which is already presented or disclosed in the financial statements, but still it is fundamental to users' understanding. I want to highlight it in my auditor's report, where I will highlight in the emphasis of matter paragraph. I will highlight. One more example: if there is any significant subsequent event that occurs between the date of financial statements and the date of auditor's report. Similarly, if any subsequent event happened, an adjusting event is there, so which has been adjusted in the financial statements, but I want to highlight this information to the shareholder. How can I highlight it? I can highlight it in the emphasis of matter paragraph. Similarly, if your client is applying, if the client is applying some accounting standard earlier than the effective date, early application of a new accounting standard that has a material effect on financial statements. Like ICAI released one accounting standard and they expected the companies to comply with it from 1st of April 2023. But what your client has done is, well in advance, 1 year before only they have started applying this standard. So this had some significant effect on financial statements. This you want to highlight it to the shareholder, where you will highlight emphasis of matter. Or a major catastrophe or calamity, some big fire accident happened, some floods have happened, some calamity, some disaster is there, because of which the company has faced a huge losses. These kind of information, if you want to highlight it to the shareholder, here also I can highlight it in emphasis of matter paragraph. So these are a few examples which can be highlighted in the emphasis of matter paragraph. So what are the 4 examples I have told? Pending litigations, subsequent events, early application of accounting standard, or a major catastrophe or calamity which has taken place during the year. Next, sir, what is the manner of presentation, sir? Very simple. Highlight that matter in a separate paragraph. Give a separate heading in the audit report, emphasis of matter paragraph, and in that you try to highlight the information. I don't know whether it is here or not. Yeah, in the Reliance Industries Limited audit report, it is there. So like as you could see, the manner of presentation here, it has to be included in a separate paragraph with the heading emphasis of matter paragraph. A separate heading should be given. Similarly, along with that, include in the paragraph a reference to the matter being emphasized and also relevant disclosures which are given in the financial statements. See, you are using emphasis of matter to highlight some information which is already there in the financial statements, no? So that's why in the emphasis of matter paragraph, even give reference where you can go and find that information. Like here, if you observe, the management has highlighted some information. The management has already given some disclosure in note number 32A of the financial statements. Now, as an auditor, you are highlighting that matter. So in the emphasis of matter paragraph, you should tell where you can go and find that information in the financial statements. Like if you read here auditor is saying, we draw your attention to note number 32A. That means auditor is indicating there is some information in note number 32A of the financial statements which auditor is expecting the shareholder to go and refer that matter. So that's why emphasis of matter paragraph should include a reference where that matter can be understood in a detailed manner in the financial statements. Like here the auditor is saying, please go and refer to note number 32A. See, if you have to give reference, first the matter should be already presented or disclosed in the financial statements, no? So that's why we say emphasis of matter paragraph is used to refer such information which is already presented or disclosed in the financial statements. And apart from that, you should include a line that you are not modifying the opinion because of this matter, you are just highlighting it. Why? Because some people might take it wrong that even with a good intention you try to explain some matter in the audit report, some shareholders might take it wrong. So that's why add one line that we are not modifying our opinion, just we are highlighting it. Like as you could see here auditors have told our opinion is not modified in respect of this matter. We are not modifying, just we are bringing it to your attention. That's all. And like the way key audit matter is not a substitute for three things, emphasis of matter paragraph is also not a substitute for three things. Same three things, whatever we have just now covered in 701, key audit matters is not a substitute for three things. Even emphasis of matter paragraph is also not a substitute for three things. What are that three things? It is not a substitute for those disclosures which are required in the financial statements to be made by management. It is not a substitute for giving a modified opinion when required. It is also not a substitute for material uncertainty relating to going concern paragraph. Clear? So this is what regarding emphasis of matter paragraph. And the other paragraph which SA 706 will deal about is other matter paragraph. So this is regarding emphasis, but SA 706 talks about one more paragraph which is other matter paragraph. Now when we use other matter paragraph, or what is the purpose of this other matter paragraph? Very simple. You are using emphasis of matter paragraph to highlight some information which is already presented or disclosed in the financial statements. On the other hand, if you want to bring to shareholders' attention some information which is not presented or disclosed in the financial statements, then we use other matter paragraph. As simple as that. That's all, as simple as that. So if emphasis you are using it for highlighting that information which is already presented or disclosed, other matter paragraph will be used to highlight that information which is not presented or disclosed in the financial statements. If I have to give exact purpose, basically we use other matter paragraph to explain about auditors' responsibilities, to explain about any extra responsibilities taken by the auditor, or to explain about any cut down of the responsibilities happened in the auditor's responsibilities. So auditor's responsibility related matters will be explained in other matter paragraph. Like for example, you are not the branch auditor, one separate person was appointed as a branch auditor, explain it in the other matter paragraph. Or there is also one more joint auditor, explain it in the other matter paragraph. So like that, responsibility related matters will be used in the other matter paragraph. That's all regarding emphasis of matter and other matter. And one more last point in the standard, they say that communication with those charged with governance. Before you want to include either emphasis of matter or other matter paragraph, first auditor should go and communicate that with those charged with governance. Sir, this matter I want to include it in emphasis. This matter I want to include it in other matter paragraph. First go and communicate with those charged with governance. Then only you can make use of emphasis or other matter paragraph in the auditor's report. Clear? So successfully we are done with the remaining the two contents of the audit report, emphasis of matter paragraph and other matter paragraph. And as a part of that, we have even revised the standard SA 706 also. Now let us pay attention to remaining contents of the audit report. Like if I take you back to the remaining contents of auditor's report. So here if we come, the next content in the audit report is responsibilities of management for the financial statements. In the audit report, you have to use a paragraph explaining about what are responsibilities of the management. And here also, four things should come in the responsibilities of management paragraph as per SA 700. Number one, you should mention that management is responsible for preparation of financial statements, that too as per applicable financial reporting framework. Number two, you should tell that management is responsible for implementation of internal controls. Number three, you should mention that management is responsible for making an assessment relating to going concern. Number four, you should mention those who are responsible or those who are looking after financial statement preparation. Nothing but that's what they say it as, those who are having oversight of financial reporting. Nothing but you should identify in the management responsibility paragraph who is looking after that preparation of financial statements. If the board of directors are taking care of the preparation of financial statements, I will mention the same thing, the responsibilities of management, those charged with board of directors are responsible for preparation of financial statements. So like that, who is having oversight, who is controlling that financial reporting process, that also I should identify and mention it in the responsibilities of management. That's all. So these four things must come in your management responsibility paragraph. What are the four things? Preparation of financial statements, a design and implementation of internal control system, making an assessment regarding going concern, and who are having oversight over financial reporting process. Now coming to the next paragraph, auditors responsibilities for the audit of financial statements. Immediately after management responsibilities, you have to include one more paragraph in the audit report explaining about your responsibilities, nothing but auditors responsibilities. So what I will try to mention in the what I will try to mention in the auditor's responsibilities, nothing but your overall responsibilities. Like you should say, as an auditor, I need to obtain reasonable assurance whether financial statements are free from material misstatements, and define what is reasonable assurance. Say that reasonable assurance is a high level of assurance but not absolute assurance. You should say that you need to obtain reasonable assurance whether the financial statements are free from material misstatements. That is also one responsibility. Mention that. Next, you have to mention when misstatement will be considered material. You should say that misstatement will be considered material only if it could influence the decision of users of financial statements. Let them know that you have to comply with standards on auditing. And also you mention your responsibility of maintaining professional skepticism and professional judgment. Tell them that you are required to verify the internal controls. Tell them you are required to check the consistency of accounting policies. You have to verify the reasonableness of accounting estimates. So like that, simply whatever your responsibilities are there, give a brief about your responsibilities in the auditor's responsibility paragraph. Like if you see here, extract I have given here, the objectives of the auditor are to obtain reasonable assurance. This point you mention. And as an auditor, you have to give the audit report that contains an opinion. And what is reasonable assurance? It is a high level of assurance but not guarantee. And misstatement can arise from fraud or error, and they are considered material only if they influence the decision of users of financial statements. And you need to exercise professional judgment. You need to maintain professional skepticism. You have to identify and assess risk of material misstatement. You need to understand about internal controls. You have to evaluate and appropriateness of accounting policies. So in simple, what and all are your responsibilities that you have to mention in the auditor's responsibility paragraph. The next content is reporting on other legal and regulatory requirements, which simply means apart from the standards on audit, if some law or regulation is putting some extra reporting requirements on the auditor, then the auditor will use this report on other legal and regulatory requirements to highlight what are those reporting requirements. Simply, if I have to give example, like just in the introduction of this chapter, I have told there are three reporting requirements under Companies Act on the auditor: 143 subsection 1, 143 subsection 3, and 143 subsection 11. Under these three sections, there are reporting requirements on the auditor. But under which paragraph of the audit report, auditor will comment on these reporting requirements? He will make use of this particular paragraph, reporting on legal and other regulatory requirements. So this paragraph will be used for the purpose of those reporting requirements apart from standards on auditing like Companies Act, Banking Regulation Act, etc. Then comes signature of the auditor. After giving all the contents, auditor's signature should be given, and how to sign it. So for that also they have given instructions, like you have to mention the name of the firm, firm membership number should be there. Along with that, on behalf of this firm, the name of the partner who is signing, his membership number also should be there. Clear everybody? So the audit report, while signing the audit report, the auditor should sign in his personal name, mention his personal membership number, tell the name of the firm also, and even give the firm's registration number also. So all these details should be given in the signature. And apart from that, date of signature, nothing but the date on which you are doing the signature, the date also should be mentioned, like the date on which you are signing the audit report. Along with that, place of signature also. Place of signature means simply the city at which you are signing the audit report. That place of signature also should be there. And then coming to the next point, last point, UDIN. So what is this UDIN number is, as you could see in the signature, there is some 18 digits of alphanumeric number given below the auditor's signature, which we call it as unique UDIN. UDIN full form is unique document identification number. Nothing but in the recent times, forgeries and also some non-chartered accountants misrepresenting themselves as chartered accountants, they have started signing the document. They have started creating fake stamps of the auditor. They used to forge the chartered accountant signature. So these kind of scams have happened a lot. So in order to increase the reliability of the auditor's signature, ICA has brought up this concept called UDIN, which has to be mentioned on every audit report which auditor is signing. So nothing but this UDIN is like OTP. Like we get OTP when we authorize a bank transaction, no? Similarly, whenever auditor is signing any audit report, he will log into a website called UDIN portal. From there, he will generate this unique number, UDIN number, which will come as a OTP to his mobile number. And that UDIN number should be mentioned in the auditor's report. With this UDIN number, one can find out whether this signature is really done by this practicing chartered accountant or somebody else. So that can be verified through this UDIN number by going to the website called UDIN portal and all. So in order to increase the authenticity of the auditor's signature, ICA has come up with this innovative concept called UDIN, and it has made mandatory for all the documents signed by chartered accountants to contain this UDIN number. Clear? So these are all the contents of the audit report given in SA 700, and as a part of revision of these contents, we even revised 4 standards if you observe carefully. 700 contents we have seen, 705 modifications to the auditor's opinion, 701 communicating key audit matters, 706 emphasis of matter and other matter paragraph. So 4 standards we have successfully revised. Clear everyone? So now let us revise few other aspects which are left out from this particular chapter. Now we have one more last point to be revised from this SA 700, which is relating to evaluations. So if we complete that revision of the evaluations, with that all the 4 standards revision will be completed. Then we will start revising the reporting requirements as per Companies Act, that is 143 subsection 1, subsection 3, subsection 11, whatever those reporting requirements are there, that we will try to revise. So first let us complete that revision regarding evaluations. So SA 700 says that as an auditor, before you can express your opinion on the financial statements, you need to do 2 kinds of evaluations. Evaluations means nothing but analysis. So as an auditor, before you form your opinion on the financial statements, you need to do 2 kinds of evaluations, which are going to be, number 1, qualitative aspects evaluation, and the other one is specific evaluations. So let us try to understand what is this qualitative aspects evaluation and what is this specific aspects evaluation. First, coming to qualitative aspects, when I say qualitative, it is something referring to other than amounts and balances. As a part of our audit, there is no doubt we will analyze whether the amounts are correct or not, whether the balances are correct or not, whether the balance sheet is matching or not, calculated profit figure is correct or not. Yes, our audit involves hell a lot of quantitative matters, but audit doesn't involve only numbers and figures. Sometimes we need to evaluate qualitative aspects also. Other than amounts and balances, sometimes we need to analyze some extra things. Sir, what is that example of that qualitative aspects? One best example, if I have to give, accounting policies. See, if I am checking whether the client's accounting policies are correct or not, like if the client is following WDV method of depreciation or diminishing value. So when diminishing value method of depreciation will be appropriate when the usage of machinery reduces year after year. On the other hand, if the client is following SLM method of depreciation, when SLM will be appropriate when the expected pattern of consumption is uniform. So if I am checking this particular thing, whether accounting policy is appropriate or not, that is not a quantitative aspects. I'm not looking at figures and numbers, but instead I'm looking at something other than figures and numbers. So this kind of things we call it as qualitative aspects. So that's what they try to explain in this entire paragraph. While doing audit, we might find out so many areas where management will be doing so many assumptions and estimates. And sometimes while we are checking this accounting policies and all, we might find bias of the management in selection of accounting policies. Sometimes management will not be objective. They will try to show the bias when selection of accounting principles. Or even you might find lack of neutrality. You might find that management is not taking decisions in an unbiased manner. They are showing some partiality towards some accounting policies. So whenever you come across any bias or lack of neutrality in selection of accounting policies to that transactions, we should immediately become alert. Why? Because bias or lack of neutrality indicate that management is trying to do some manipulation. And even they are giving some examples of indicators of lack of neutrality. Sir, will I get any hint here? So here management might show bias in selection of accounting policies. To find it out, will I get any hints, sir? Yes. Some examples they have given, like selective correction of misstatements. You have taken to the client some 10 misstatements, 10 errors you have found. You went to the management and told, sir, I have found this 10 errors. Please do rectify. But what management is doing is, out of the 10 misstatements, they are rectifying only 7, which has the effect of increasing the profits. The remaining 3 they are not rectifying because that will reduce the profits. Don't you think this is a clear indicator management is biased? Yes, management is biased here. Similarly, management is making wrong accounting estimates. They are showing bias in selecting accounting estimates. Like for example, a debtor is about to go bankrupt completely. When the debtor is about to go bankrupt completely, 100% provision should have been created. But what management is doing is they have created only 50% provision. Even after they came to know that debtor is about to go bankrupt and nothing is recoverable from his account. They should have created 100% provision, but management has created only 50%. This is also bias. So whenever you come across these kind of circumstances, that is a hint for you that here there could be management's bias or lack of neutrality in selecting accounting policies. That's all. Very simple, guys. A bit terminology will make this point complicated, but one simple way to remember it is write a few random points. Like number 1, management will make use of so many assumptions and estimates. Number 2, as an auditor, when you verify, you might find bias or lack of neutrality. Along with that, they are telling you some indicators which will give hint to the auditor there could be bias. Number 1, selective correction of misstatements. Number 2, possible bias in selection of accounting estimates. That's all regarding qualitative aspects. Now coming to specific evaluation, specifically auditor needs to check something. See here they have given some points, like if you read the specific evaluations, they will say whether financial statements are disclosing all the significant accounting policies or not, whether accounting policies are consistently applied or not, whether accounting estimates are reasonable or not, information should be clear and understandable, and even financial statements should give disclosure of all the information conveyed, and along with that terminology used in the financial statements will be appropriate. So if you pay attention to these factors, this is nothing but more or less similar to question number 1, whatever we have revised in the nature, objective and scope of audit. So there we have seen something like points to be considered before expression of an opinion. These points more or less look the same. So you need not remember these separate points. You can write the points from nature, objective and scope of audit, points to be considered before expression of an opinion. So more or less same points are there here also. So with this evaluations also we have revised. This puts an end to the revision of all the 700 series of standards which are talking about how to prepare audit report. We have seen all the contents, different kinds of modification, key audit matters, emphasis of matter, other matter paragraph. So all the things we are successfully done with. Now we will try to proceed further with the reporting requirements under Companies Act, which are given under 3 sections: 143 subsection 1, subsection 3 and subsection 11. So first we will start with the reporting requirements under 143 subsection 1. There are 6 matters which are required to be reported under 143 subsection 1. So let us try to have a quick look at it. First point is regarding loans and advances made by the company. First reporting requirement under 143 subsection 1 is, as an auditor, you need to check loans and advances made by the company. Made by the company means given by the company to the others. So first point is talking about assets of the company. Your client has given loans and advances to others. If yes, if they are on the basis of security, whether they are properly secured or not, and on whatever terms and conditions those loans are made, are they prejudicial to the interest of the company or members? Are they harmful to the interest of the company or members? The terms and conditions on which the loans were given, are they harmful? Sir, when the terms and conditions will be harmful, like company has given loan without charging any interest, they have given loan without offering any without accepting any security, they have given loan without mentioning any repayment period. So these are the examples of terms which could be prejudicial to the interest of the members. So whatever it is, first point we need to verify loans and advances, whatever are there, which are given by the company, whether they are properly secured, and the terms on which they are made, are they prejudicial, are they harmful to the interest of the company or members. Second point is regarding whether transactions represented merely by book entries. Whatever transactions are there, which are there just by way of book entries. Sir, what are the examples of transactions merely by book entries? Provision entries, depreciation. These kind of entries are nothing but just book entries. So whether those transactions which are represented merely by book entries, are they prejudicial? Nothing but whatever provisions etc. are getting created by the company, the provision should be neither over reported, provision should not be under reported. Provisions depreciation should be calculated at exact figures, no over reporting, no under reporting should happen. So that's what we need to check in the second point, whether the transactions represented merely by book entries, are they prejudicial, are they harmful? Entries like provisions depreciation, are they harmful to the interest of the company? Third point, in case if your company is having shares, whether your client company sold the shares at a price less than purchase price. Third point, you need to comment whether your client is holding the shares of any other companies. If yes, whether your client has sold the shares at a price less than purchase price. Nothing but whether your client has sold the shares at a loss. Sometimes in the exam, they will try to confuse you. They will give market price, they will give fair value, all these things they will say. Like for example, one question they might ask you something like this. So they will say that your client company is X Limited, you are conducting audit of this company. This company is holding shares of some other companies. They have bought it at the purchase price of 100 rupees per share. Current market price is 90 rupees, but the company was able to sell it at 95 rupees. Tell whether this transaction is required to be reported under 143 subsection 1. Yes, it is required to be reported. Why? Because selling price is less than purchase price. What is the current market price? That is irrelevant. If you find that the company has sold the shares at a price less than purchase price, you are required to report it. However, this point is not applicable in case if you are conducting audit of a banking company or investment company. This reporting requirement, this particular point need not be reported in case if you are conducting audit of a banking company or investment company. In case if you are conducting audit of other than banking or investment company, then only you need to report on this matter. D point, you need to check whether loans and advances which are given by the company have been shown as deposits. Here also they are referring to loans and advances made by the company. Made by the company means given by the company. So whether your client has given any loans and advances, but instead of showing it as loans and advances, have they shown it as deposits? Find it out and report it here. Whether personal expenses have been charged to revenue. Nothing but whether the personal expenses of management and board of directors, they have been shown as a business expenses, that we need to find out and report. And the last one, where it is stated in the books and accounts of the company that any shares have been allocated for cash. That means if you came to know that your client has issued some shares for cash, if yes, whether cash has actually been received, and in case if the cash is not received, the position stated in the financial statements should be correct and not misleading. That means you should show correct position in the financial statements. Clear everyone? So these are the 6 matters. Number 1, loans and advances given by the company, whether they are properly secured and the terms and conditions are not prejudicial. Number 2, transactions represented by mere book entries are not prejudicial. Number 3, whether the company has sold the shares at a price less than purchase price. Number 4, loans and advances are shown as deposits. Number 5, personal expenses are charged to revenue. Number 6, whether shares have been allocated for cash, if yes, cash has been received or not. In case if cash is not received, position stated in the financial statement should be correct and not misleading. And one more point here, the auditor is required to report on the above 6 matters under 143 subsection 1 only if he gets negative remarks. If he gets positive responses, no need to specifically report on that matter. You need to report on any of the above 6 points only if you get negative responses. That's all. So these are the reporting requirements under 143 subsection 1. Now let us come to the reporting requirements under 143 subsection 3. Under 143 subsection 3, there are altogether some 9 plus 6, 15 reporting requirements are there. Let us see what are they. So there are very remote chances that this question will be tested in the examination. Why? Because as we know in the recent examination, the descriptive question will be tested either for 3 marks or 4 marks. So they might ask you 143 subsection 1, 6 points for 4 marks is fine, reasonable. But 143 subsection 3 is having altogether 15 points. So it will be unfair to expect, I say will ask you to write 15 points just for 4 marks or 3 marks. They will not ask you. So very remote chances of asking it, but we will try to quickly cover these points. So there are a few points which are required to be reported under 143 subsection 3. What are they? Number 1, as an auditor, did you obtain all the information and explanation which is necessary for the purposes of your audit? Whatever information you needed, whatever explanation you needed for the purpose of doing the audit, whether did you get all that information or not, that you have to comment. Number 2, whether in your opinion, proper books of accounts are maintained by your client. Did your client maintain proper books of accounts? And also, did you receive returns from branches? Number 3, in case if there is any separate branch auditor, whether the branch auditor sent his report to you and how you have dealt with that report. You are a principal auditor, one of the branches are audited by somebody else, some other branch auditor is there. If yes, whether that branch auditor has submitted his report to you and how you have dealt with that report. Number 3, whether the company, number 4, whether the company's balance sheet and P&L are in agreement with the books of accounts. Nothing but financial statements are matching with the books of accounts or not. Number 5, whether in the opinion the financial statements comply with accounting standards, whether financial statements are prepared after complying with the accounting standards or not. Next one, if you have any observation or comment on the financial transaction which have an adverse effect, which have a bad effect on the functioning of the company, you need to tell it here under this point number F. Nothing but if you find any financial transaction which is having any bad effect on the functioning of the company, that you need to report. Whether any director is disqualified from being appointed under 164 subsection 2. You need to even comment whether any of the directors of your client are disqualified. Sir, when the directors will be disqualified under 164 subsection 2, listen carefully. If any company did not file annual return or financial statements for 3 consecutive financial years with the ROC, then all the directors of that company will be disqualified for a period of 5 years. Not just in the company in which they are acting as directors. For any company, they can't get appointed as director for 5 years. So when the directors will be disqualified under 164 subsection 2, when a company did not file annual return or financial statements for 3 consecutive financial years, for 3 continuous financial years. If a company is not filing annual return or financial statements with the ROC, all the directors of that company will be disqualified for a span of 5 years. So I need to check and give a comment whether any directors of my client company are disqualified under section 164 subsection 2. Then, if you have any qualification, reservation or adverse remark relating to maintenance of accounts, if you find any mistake in the books of accounts, that comment you have to give it here. Next, whether the client is having adequate internal financial control, whether your client company is having proper internal financial controls and whether those internal financial controls are operating effectively or not. On this also you need to give comment. However, there is one note point here. For some companies, internal financial controls are not at all applicable. Some companies don't need to have internal financial controls only. Which companies, sir? If it is a private company which satisfies the following conditions, either it is a one-person company or small company, or a private company which is having a turnover of less than 50 crores as per audited balance sheet date, and also if they are having turnover less than 25 crores at any point of time during the financial year, then those companies are not required to implement internal financial controls at all. So what are the companies exempted from internal financial controls? One-person company, small company, and a private company having a turnover of less than 50 crores, and also borrowings from banks and financial institutions shall not exceed 25 crores at any point of time. Those companies are not required to implement internal financial controls at all. Now, if you are conducting audit of such a company which is coming under this exemption, what you will do? I will mention the same fact that my client company is not required to implement internal financial controls at all. So reporting requirement does not apply. This fact you have to mention. Now, under J point, there are actually 6 extra reporting requirements which were added over a period of time. So till now, under 143 subsection 3, we have seen point A to point I, 9 reporting requirements we have seen. Now this under clause J, there are 6 more additional matters are there which are required to be reported. Let us see what are they. Number 1, whether the company has disclosed the impact, if any, of pending litigations on its financial position. So as an auditor, I need to comment whether my client company, whatever pending litigations are going on against the company, everything has been disclosed in the financial statements or not, either as a contingent liability or provision. See, in one of the past examinations, they have asked a question, true or false statements they have asked. The auditor is required to disclose the impact of pending litigations in the auditor's report. This is what the true or false statements tested in the exam. Listen carefully once again. The auditor is required to disclose the impact of pending litigations on the financial positions in the auditor's report. Do agree with that? The answer is no. Why? Because 143 subsection 3 is not asking auditor to give disclosure. They are just asking auditor to check whether company gave the disclosure regarding pending litigations, that too in the financial statements. Hope you have paid that attention. The 143 subsection 3 not asking auditor to give disclosure regarding pending litigations. 143 subsection 3 is in fact asking auditor to check whether management gave the disclosure in the financial statements or not. That you need to check. Next one, second one, whether the company has made provision as required under any law or accounting standard for material foreseeable losses on long-term contracts. If your client company has entered into any long-term contract and if they came to know that on that long-term contract they are going to make a loss, your client company should not wait till the completion of the contract to recognize the loss. They have to recognize it immediately. So whether your client created a provision for losses on long-term contracts or not, that you need to check and give a comment. Whether your client has made any delay in transferring the amounts which are required to be transferred to Investor Education and Protection Fund. Is your client company required to transfer any funds to IEPF? If yes, whether they have made any delay in transferring the money required to be transferred to IEPF. Fourth point, I will come to that later. Fifth and sixth point, I will explain now. Whether dividend declared or paid during the year by the company is in compliance with Section 123 of the Companies Act. Whether your client company has declared any dividend, if the client company has declared any dividend, if yes, whether that dividend has been declared as per Section 123 of the Companies Act. So Section 123 talks about this dividend in a detailed manner, whether the client company declared the dividend after complying with Section 123 of the Companies Act or not, that I need to check. And whether company in respect of financial years commencing on or after 1st April 2002, that is from 1st April 2022, the company should use such an accounting software which has the facility of audit trail. From 1/4/2022, the company, whether the company is maintaining such an accounting software which is having the facility of audit trail or not, and whether that audit trail feature should not be tampered during the year. So whether your client is using such an accounting software which has the facility to record the audit trail which has not been tampered, that you need to comment. Guys, fourth point is there here, but it will take a lot of time for me to explain. So what I will do is, in the YouTube, I have already uploaded a detailed video explaining about this extra reporting requirements under clause J. I have done a dedicated video on YouTube to a dedicated video of for some 20-30 minutes of time to make you understand this 6 reporting requirements separately under clause J. That description, that YouTube link, I will give it in the description below. You can watch it. Clear, everyone? So let me show you once here itself. So if you go to my YouTube channel, you will be able to find it there. So just a minute, I will show you. So if you go to my YouTube channel here, so in my YouTube channel, I have already uploaded a detailed video just explaining about this extra reporting requirements under 143 subsection 3 clause J. So you could see here, this is what that particular video is. In this, I have explained in a detailed manner what are that reporting requirements under 143 subsection 3 clause J specifically. Even the link to this video, I will give it in the description below. You please do watch it. So this is what the reporting requirements under 143 subsection 3. So all together, we'll come back to the marathon now. So definitely I will give the link to that video in the description below. So please do watch it. Very important. Why? Because this contain recent amendments and these points are not suitable for revision, because this one point only will take, in order to explain only this fourth point, it will take half an hour of time. So I have already put that effort and uploaded a video, and I will give it in the description below. Please go and have a look at it. So like this, under 143 subsection 3, we have total of 15 matters which are required to be reported. 9 plus 6, 15 matters are there which are required to be reported. But one more thing here, like I told you previously, the matters under 143 subsection 1 are required to be reported only if you get negative comments. But for 143 subsection 3, those 15 matters, whatever we have revised now, these 15 matters are required to be reported whether or not you have a negative comment or positive comment. Irrespective of the answers which you get, all the 15 matters are required to be compulsorily reported. But whereas 143 subsection 1 matters are required to be reported only if you get negative responses. 143 subsection 3, 9 plus 5, 16 matters, whatever we have revised now, those matters are required to be reported in all the circumstances, irrespective of your responses, whether you get positive response or you get negative responses. Clear? Now we are going to discuss the reporting requirements under 143 subsection 11, and these reporting requirements also have an other name which we call it as CARO. Company Auditors Report Order, one of the most important from the examination perspective. From the CARO itself, you can expect minimum 4 to 5 marks. You can expect it only from the CARO. So let us try to spend enough of time on revising this CARO reporting requirements. Totally, we have 21 clauses which are required to be reported under CARO. Let us have a quick look at it. Shall we do it now? Right. So my this file is getting a stuck bit. So what I will do is I will close it and reopen it once again so that it will stop getting stuck. Just give me a minute's time. Yeah. So we can resume our discussion. So we are going to revise now CARO 2020. And how many reporting requirements are there under this CARO? We have a total of 21 matters which are required to be reported under this CARO 2020. Before we can revise what are that 21 reporting requirements, first we will try to understand applicability. Listen, this applicability itself is so important that even in the recent examination also, if you observe, there is a question regarding applicability only. So such an important concept is this applicability related matter. So we will try to spend enough of time in understanding or revising this CARO applicability, and then we will spend significant amount of time on revising the reporting requirements. So first we will talk about applicability. See, CARO is actually an additional reporting requirement which is given by central government after consulting with NFRA, National Financial Reporting Authority. Now, this order is applicable for every company, including a foreign company. However, CARO is exempted for certain class of companies. CARO is exempted for certain class of companies. In case if you are conducting audit of certain companies, CARO will not become applicable for you. So what are they? So number one, banking company. If you are conducting audit of a banking company, CARO doesn't apply. If you are conducting audit of an insurance company, CARO does not apply. In case if you are conducting audit of a Section 8 company, non-profit making company, CARO will not apply. It will not get applicable even for 1% company and even a small company. And it is not even applicable for private limited company. It is not applicable for private limited company if the private limited company satisfies 4 conditions. Not any one condition. If the private company satisfies all the 4 conditions, then CARO will not become applicable. Once again, I am repeating, when a private limited company satisfies any one or all 4, when a private company satisfies all the 4 conditions given here, then auditor need not report on CARO for that company. So what are that 4 conditions? So if I list them out, the company, your client company should not be a subsidiary or holding of a public company. Number 2, your client should not have paid up capital and reserves and surpluses exceeding 1 crore rupees as on balance sheet date. Your client should not have borrowings from banks and financial institutions exceeding 1 crore rupees at any point of time during the financial year. And your client company should have a turnover as per Schedule 3, including revenue from discontinuing operations, not exceeding 10 crores during the entire financial year. So if your client company is a private limited company and if it satisfies all these 4 conditions, then CARO does not become applicable. Now sometimes they have asked a practical question. They will give in the question, so and so company is there, which is a private unlimited company and which satisfies the conditions. CARO applicable or not applicable? They will give you in a question, like for example, even I have included it here for reference. So in this material is a very comprehensive material. We have I have personally put a lot of effort in redesigning and revamping all this material. So please do consider downloading it, and how to download it I have already told you in the description below. Yes. So this is how, assume this is what somewhat a kind of examination question. CA Jayesh is appointed as auditor of KP Private Unlimited, a company registered under Companies Act with unlimited liability. For financial year 2020-21, the company had total revenue of 8 crores, which is less than 10 crores. Borrowings from banks and financial institutions is also within the limit of 86 lakhs. Paid up capital and reserves of 97 lakhs. Explain whether this audit report must include CARO. So now if you observe, look at the conditions, all the conditions are satisfied. So the company's turnover is less than 10 crore, borrowings from banks and financial institution is less than 1 crore, and even paid up capital and reserves and surpluses balance is also less than 1 crore. Now is the CARO applicable or not applicable? CARO will be applicable. Why? Because exemption is there for a private limited company subject to fulfillment of conditions. But in the given case, the client is a private unlimited company. Since the company is a private unlimited company, no need to check for any conditions. CARO will directly become applicable. CARO will be applicable. Exemption is there only for a private limited company subject to fulfillment of conditions. For a private unlimited company, no exemption, nothing. Directly CARO will become applicable. So like this also they might pose you a question. So now let us try to understand these conditions in a detailed manner and special points that need to be kept in mind while doing this calculations. Let us try to do it. Sorry. Yeah. So what is the first condition here? First condition, they are saying that your client should not be a subsidiary or holding of a public company, which means if you are conducting audit of a private limited company, that private limited company should not have a holding company, which is a public company. The private company should not have a subsidiary company, which is a public company. Condition number one, in case if your client company is a private limited company, for CARO to be not applicable, first condition is your client company should not have a holding company, which is a public company. Your client company should not have a subsidiary company, which is a public company. Condition number one. Second condition, your client paid up capital and reserves and surpluses should not exceed 1 crore. That means it shall be less than or equal to 1 crore. Even if it is 1 crore is also fine, but paid up capital and reserves and surpluses shall not exceed 1 crore even by 1 rupee also. Now some special points to be kept in mind while doing the calculation. When I say paid up capital, equity share capital also will be considered, paid up preference share capital also will be considered. And when I say reserves and surpluses, all kinds of reserves will come here. Capital reserves will come, revenue reserves will come, revaluation reserve will come, and even statutory reserves like CRR, DRR, all these things will come. So all kinds of capital is required to be considered. All kinds of reserves and surpluses are required to be considered. Sometimes there will be a debit balance in the P&L account. If there is any debit balance in the P&L account, that could be adjusted again as a credit balance for the purpose of calculation of reserves. Like for example, assume reserves and surpluses credit balance is some 80, but there is a balance in the P&L. P&L debit balance is 20. So this 20 can be adjusted again as this 80. Sometimes what will happen is, even after adjusting against the credit balance of the reserves, there will be excess debit balance left in the P&L account. If I give you one typical example, the company is having paid up capital of 120 lakh rupees. In the reserves and surpluses category, they have credit balance of the reserves, which is 20 lakh rupees, whereas they have a debit balance in the P&L of 50 lakh rupees. Now, out of this debit balance in the P&L, only 20 could be adjusted against the reserves. Even after that, 30 lakh rupees of excess debit balance is left out. Can this be adjusted against the paid up capital for the purpose of calculation? Yes, it can be adjusted. So excess debit balance in the P&L can be adjusted even against the paid up capital also for the purpose of calculation of paid up capital and reserves and surpluses. So these special things you have to keep in mind. Understood? Now coming to the third point, borrowings from banks and financial institutions shall not exceed 1 crore at any point of time during the financial year. Very important thing, at any point of time. Now there are some special points which we need to pay attention here. Borrowings from only banks and financial institutions are required to be considered. Borrowings from individual person, all these things will not be considered. Borrowings only from banks and financial institutions will be considered. When I say borrowings, they could be short-term borrowings, they could be long-term borrowings. Every borrowing should be considered. And frankly speaking, even credit card outstanding amount is also required to be considered. All kinds of balances, short-term, long-term, every kind of borrowing, or even that could be secured, unsecured, every kind of borrowing you have to consider. And you should not see the borrowings amount only as on balance sheet date. At any point of time, the borrowings shall not exceed 1 crore at any point of time. During the year, even for one day also, if the outstanding balance of borrowings has exceeded 1 crore rupees, CARO will become applicable. Like for example, a typical example I will give you, 21-22 financial year, opening date 1/4/2021, borrowings from banks and financial institutions 70 lakh rupees. As on 30th of June 21, the company has taken additional borrowings of 40 lakh rupees. During the current year, the company repaid some borrowings to the extent of some 50 lakh rupees. As on the balance sheet date, that is as on 31st of March 2022, the closing balance is 60 lakh. CARO becomes applicable or not? Yes, it becomes applicable. Why? Because from 30th of June till 30th of September, the outstanding balance is 110 lakhs, which has exceeded 1 crore rupees. CARO becomes applicable at any point of time is very, very important. But when you are checking paid up capital and reserves and surpluses, you need not be concerned at any point of time. Paid up capital and reserves and surpluses balances shall not exceed 1 crore only as on balance sheet date. During the year, anything can happen, but paid up capital and reserves and surpluses balance shall not exceed 1 crore only as on balance sheet date. But for borrowings, at any point of time during the financial year. And few more things here. When I say borrowings, all kind of borrowings are required to be considered. This I have already told you. And one more thing here, this limit of 1 crore is for all banks and financial institutions put together. Collectively, the total borrowings from all banks and financial institutions shall not exceed 1 crore. It should not be like for each bank and financial institution 1 crore of limit. No. The cumulative balance of borrowings from all banks and financial institutions shall not exceed 1 crore. Not for individual banks separately 1 crore limit is given. Now, fourth point, the total revenue of the company shall not exceed 10 crores, should be less than or equal to 10 crore rupees. Now, while calculating this, the special points which you need to keep in mind is revenue from discontinuing operations also should be added. If in the question they are saying revenue from discontinuing operations, that shall be added for that revenue. And from this total revenue, only three things are permitted to be deducted. One is sales returns are to be deducted. If there is any trade discount, trade discount also can be reduced, and along with that, even GST or other tax components also can be reduced. But sometimes in the question they will give you something like this: total revenue of the company 11 crores, GST collected and accounted separately. They will ask you this also: GST collected and accounted separately 1 crore rupees. Now what you will consider for calculation? Will you consider the figure as 11 crore rupees, or will you adjust that 1 crore and consider it as 10 crore? You have to consider 11 crores only when you see the phrase GST collected and accounted separately. The meaning of this sentence, GST collected and accounted separately, is the given turnover does not include the GST component. That's what it meant. See, when the given turnover does not include GST component, why we will deduct it once again? So like this, if you find this terminology, GST collected separately, excise duty collected and accounted separately, that means that the given revenue figure is already exclusive of taxes. We should not reduce it once again. Clear? So these are the things which needs to be kept in mind while calculating total revenue. So keeping all these things in mind, we need to check for these limits in the case of a private limited company. And if all conditions are satisfied, then CARO becomes not applicable. If any of the condition is violated, then CARO becomes applicable. And one more thing, in case of holding company will prepare two sets of financial statements: standalone financial statements and consolidated financial statements. Limits will be calculated only as per standalone financial statements, not consolidated. And while conducting audit of consolidated financial statements, CARO is exempted except one clause, which is clause number 21. If you are conducting audit of consolidated financial statements, your audit report need not include the 20 clauses. Only clause number 21 should be mentioned in consolidated financial statements. In case if the company is having branches, then the limits will be calculated for the company as a whole, including all the branches information. And once CARO becomes applicable for the entire company, all the principal auditor, branch auditor, everybody have to report on this 21 matters in their respective audit reports. Understood? So this is what calculations, applicability criteria. Very important, as I have told, sometimes questions will be tested from this applicability criteria itself. Now let us come to the reporting requirements. What are those 21 matters which are required to be reported? That we will try to understand. First reporting requirement is regarding property, plant and equipment. Regarding property, plant and equipment, you need to check 5 things. How many things? 5 things. Number 1, you need to check whether your client is maintaining proper records relating to fixed assets. Sorry, PPE. Whether your client is maintaining proper records relating to PPE, which should show quantitative details of PPE, situation of the PPE, nothing but location of the PPE. So whether your client is maintaining such a records, which should show me quantitative details as well as situation or location of PPE. Number 2, whether those fixed assets are physically verified by the management at reasonable intervals. Whether your client company has physically verified. They're not asking auditor to do physical verification. They're asking whether management did the physical verification of that PPE at reasonable intervals. Here at reasonable intervals means once in 3 years. For PPE physical verification, reasonable interval can be taken as once in 3 years. And on doing such physical verification, did the management find out any material discrepancy? Any differences were found out by doing that physical verification? If yes, whether they have been properly dealt with in the books of accounts, whether they have been properly adjusted in the books of accounts. So this is the second point regarding physical verification. First point is regarding maintenance of records. Second point is regarding physical verification. Number 3, we need to check titles of immovable properties. Nothing but whether your client is a true owner of the immovable properties or not, I need to check. Sir, how can I check the title of immovable properties? Simply by checking the registration documents, by checking the sale deeds. So whatever land and buildings are there in your client's balance sheet, get the registration documents of all these land and buildings, check whether in the registration document company's name is there or not. If company's name is not there, that means in the registration document, if somebody else's name is there, then I need to report some details. What are they? Description of the property, describe about that property, what is the gross carrying value. If not in the company's name, then it is held in whose name, whether that person in whose name the property is held, is he promoter, director or employee, for what period the company is holding, the asset, and the reason why it was not yet transferred in the name of the company. These reasons are required to be reported in case if the property is not in the name of the company. If it is there in the name of the company, no issue. Now, coming to the fourth point, during the year, whether your client company did any revaluation of the assets. Revaluation means restating the assets. In case if your client has done the revaluation of the assets, whether the revaluation is based on valuation done by a registered valuer. Whatever figure comes to your client's management should not be revalued. The company should go to a registered valuer, get the valuation certificate. As per that valuation certificate, revaluation should happen. So I need to check whether revaluation is based on a certificate from registered valuer. And also specify the amount of change. You need to mention how much amount of change has happened because of revaluation only if the change is 10% or more in the aggregate of net carrying values of each class of property, plant and equipment. Which means you need to tell the amount of revaluation only if because of revaluation the change is 10% or more. Not for individual asset, for aggregate value of entire class of assets. So what do I mean by here is, I will give you one best example to make you understand, very, very important. Assume company is having some buildings under buildings category. 3 buildings are there. Building 1, building 2, building 3. I will give you values before revaluation. I will give you values after revaluation. So before revaluation, the building 1 is having a value of 100 crore rupees. It was revalued to 115 crores. Building 2 is having a value of 50 crore rupees. It was revalued to 53 crores. Building 3 is having value of 100 crore rupees. It was revalued to 87 crore rupees. Now you tell me for which asset I need to mention the amount of revaluation. Will you say here, sir, here change is 15 crores, more than 10% before revaluation. 10% is 10 crores only. Revaluation is more than 10% here. Here only 3 crores of revaluation, less than 10%. Here 13 crores of difference of revaluation, which is also more than 10%. Will you say I will report the amount of change for building 1 and building 2? You are absolutely wrong. You are completely wrong. You are required to tell the amount of revaluation if the change is 10% or more, not for individual asset. If the change is 10% or more for the aggregate of entire class of PPE. For what? For aggregate of entire class of PPE. So what do I mean here? You need to check the value before revaluation or after revaluation for entire class of buildings, not for individual buildings. So if I do the totaling here, it will be before revaluation, entire buildings was 250 crores. After revaluation, the buildings value was somewhere around 255 crores. If I'm not wrong, correct me if I'm wrong with the calculations. So I guess so it is 255 crores. So there is, for the entire buildings category, there is only 5 crores of change because of revaluation, which is hardly less than 10%. Here 10% is only 25 crores, but the effect of revaluation is only 50 crores. No amount is required to be reported. Clear everybody? So fourth point is regarding revaluation, whether your client has revalued any of the property, plant and equipment. If so, whether that revaluation is on the basis of registered valuer certificate, and because of that revaluation, if the change is 10% or more, that too in the aggregate of total value of each class of property, plant and equipment, specify the amount of change also. Next, last point regarding PP, whether any proceedings have been initiated or are pending against the company for holding Binami properties. Whether any case has been filed against your company, or whether any case is already going on against the company for holding Binami property. If yes, whether the company without hiding disclosed the details of that proceedings in the financial statements or not, that I need to comment. Once again, I am telling you here also, the CARO is not asking auditor to disclose the Binami transactions. The CARO is asking auditor to check whether management disclosed the Binami transaction cases in their financial statements. I'm repeating it once again. In this case also, the CARO is not asking auditor to disclose the Binami transactions in his audit report. They are just asking the auditor to check whether company disclosed the details of Binami transactions in their financial statements or not. Clear? So this is the first reporting requirement, PPE. Regarding that, 5 points are there. Number 1 is regarding proper record maintenance. Number 2, whether physical verification done by the management. Number 3, title of the immobile properties are held in the name of the company. Number 4, whether any revaluation happened. If yes, on the basis of registered value, or if the change is 10% or more for each class of asset, mention the amount. Number 5, whether company disclosed the Binami transaction cases in their financial statements or not. That's all. This is the first point. Second point is regarding inventory. Regarding inventory, what I need to do? First, here also I need to check whether physical verification of inventory has been done by management, not auditor. They're not asking auditor to do physical verification. They're asking whether management did the physical verification of inventory at reasonable intervals. Here, reasonable intervals means once in every year. For physical verification of inventory, reasonable interval means what? Once in every year. And whether the coverage and procedure of such verification is appropriate. Whatever coverage management has done, whatever procedure management has followed for doing that physical verification, is that appropriate or not? You have to give the comment. And whether any discrepancies, differences of 10% or more, here also for aggregate of each class of inventory were noticed. For every class of inventory, if you find difference of more than 10%, then you need to mention that amount, and also you have to tell whether it has been properly dealt with in the books of accounts. See, when I say classes of inventory, when it comes to inventory, there will only be 4 classes: raw material, work in progress, finished goods, stores and spares. So if there is 10% or more difference you are able to find for total of each class of inventory, then only you need to report that difference. If the change is there, but less than 10% discrepancy is there for entire class of asset, then you need not report that discrepancy. Next, working capital loans. Second point is regarding, in case your client at any point of time during the year, whether your client has taken working capital loan in excess of 5 crore rupees, giving security of current assets. Second reporting requirement is applicable in case your client company has taken loans. That to which kind of loan? Working capital loan. That too for an amount exceeding 5 crores at any point of time during the financial year. And what they have given as security for this working capital loans? Current assets, mainly stock. So in case if your client has taken any working capital loan in excess of 5 crore rupees from banks or financial institutions, giving the security of current assets, then I need to check whatever quarterly stock statements which my client company is submitting it to the banker, are they submitting genuine stock statements? That means, are those stock statements are in agreement with the books of accounts of the company, or if they are submitting wrong stock statements to the banker, that also I need to check. So this particular point is included to protect the interest of the bankers. Clear everybody? So that is what the second point is about, whether your client has taken any working capital loan, that too in excess of 5 crore rupees at any point of time during the year. If yes, They will generally submit quarterly stock statements to the banker to make the banker aware of what is the current status of the stock. As an auditor, I need to check whatever quarterly stock statements which my client company is submitting to the banker, whether they are matching with the books of accounts. That is, whether they are submitting genuine stock statements or they are submitting fake stock statements. That I need to have a look and give a comment on that. Clear, everybody? So 2 reporting requirements we are done. We are left with 19 more. So let us have a look at them now also. Now we will go to point number 3. So point number 3 is talking about investments, guarantees, security, loans or advances given by the company. So this third point is regarding loans and advances which are given by the company to others. That means this is also talking about assets of the entity, the loans which your client company has given to others. So now in this also 6 points are there. Let us try to understand them. First one, you need to find out whether your client company has given loans to any of the related parties. So third sub-point we are dealing in that 6 points will be there. Point number A, you need to check whether your client company has given any loans and advances or investments or guarantees to any of the related parties. If yes, we need to segregate how much amount of loan was given, aggregate amount of loan given, and balance outstanding. For subsidiaries, associates and joint venture, we have to report that separately. For other than subsidiary, associates and joint ventures, that I need to mention the amount separately. Whether your client has given loan to any of the related parties, if yes, I need to divide aggregate amount of loan given during the year, balance outstanding at the end of the year, for subsidiary, associate, joint ventures separately, for other than subsidiary, associate, joint venture separately. Like for example, the company has given loans of total 100 lakh rupees. Out of that, to total 10 entities the company has given the loan. Out of that, 4 subsidiary, associate, joint ventures are there. So the company has given total loan of 100 lakhs to 10 entities. Out of the 10 entities, 4 entities are having a relationship of subsidiary, associate, joint venture. Remaining 6 are other than subsidiary, associate, joint venture. Now I need to divide out of this 100 lakh rupees of loan, how much was given to subsidiary, associate, joint venture. Assume 60 lakhs was given. How much has been given for other than subsidiary, associate, joint venture? 40 lakh. Not just that, what is the balance outstanding as on the balance sheet date? So they have given loan during the year, but during there some repayments, all that things also would have happened. I need to even report what is the balance outstanding as at the end of balance sheet date from subsidiary, associate, joint venture. Assume it is 50 lakh rupees. And what is the balance outstanding for other than subsidiary, associates, joint venture? Assume it remained the same, 40 lakh rupees. So like that, in case if my client has given loans to any of the related parties, I need to divide aggregate amount of loan given and balance outstanding for subsidiary, associate, joint ventures separately and other than subsidiaries, associates, joint ventures separately. Clear? Second point. This is the first point that I tried to summarize here. Second point, I need to check under whatever terms and conditions the loans are given, whether those terms and conditions, are they prejudicial? Are they harmful to the company's interest? This point we have already covered under 143 subsection 3. They are saying you to check the same thing here also once again. Under whatever terms and conditions your client has given loans to that other parties, are those terms and conditions are genuine or are they harmful? I already gave you examples when the terms and conditions will be considered as harmful. When they will be considered harmful. So if they have been given without charging any interest, without repayment period, without any accepting of security, then they will be considered as prejudicial or harmful. Next, third point. It should not be like just your client has given the loan and ignored it. As an auditor, even I need to check whatever loans that have been given to others, whether repayment of principal and payment of interest is happening regularly on or before the due dates, whether your client, whether the third parties, whoever have taken the loan, whether they are repaying the principal and interest on or before the due dates or not, that also I need to check and give a comment. And if at all, any amount remains overdue for more than 90 days. If your client has given loan to other party and if the other party is not repaying the loan, if it has remained overdue and if it remains overdue for more than 90 days, I need to check whether management has taken reasonable steps for recovery of the principal and interest. Whether the company has taken reasonable steps for what? For recovery of principal and interest. What could be reasonable steps? Selling the security, filing a case on them, etc. Whatever it is, reasonable steps are taken by the management for recovery or not, I need to check. Then we have rescheduling or extension of the loans, which means your company has given some loan in the past and that loan has fallen due during the year. In the current year, the due date is there. When the due date is in the current year, your client should have collected the money. But instead of collecting the money of the loans which have fallen due, what your client is doing is they are either renewing it, or they are extending it, or the fresh loan is given to the same party to settle the old loan. Did you find any of these transactions? Your client has given loan in the past which has fallen due in the current year, but instead of collecting the loan which has fallen due, they are either extending or renewing it. That means they are extending the due date, or for the same party they are giving a new loan. Out of that new loan, he is repaying the old loan. Nothing but indirect way of extending only. So did you find whether your client has conducted these kind of transactions? Instead of collecting the loans, they are renewing, extending, or fresh loans are given to same party. If yes, I need to report what is the total amount of such loans which are renewed, extended, or settled by fresh loans. The total amount of loans I have to report. Along with that, I need to calculate percentage with the total loans and advances. Like for example, the total loans are 100. Out of that, 40 lakh rupees of loans are in the nature of renewal, extension, and fresh loans. So percentage, if you calculate, that will be 40%. That percentage also I need to calculate and report it here. Clear? However, this particular point is not applicable in case if you are conducting audit of such a company whose principal business is to give loans. Nothing but in case if you are conducting audit of banks and financial institutions, this reporting requirement does not apply. For banks, CARO itself will not be applicable. Even if you are conducting audit of any NBFC, then you are not required to report on this matter. Not just this point, even the first point also, this loans to related parties. I told you that segregation, aggregate amount and balance outstanding. That first point is also not applicable in case if you are conducting audit of such a company whose principal business is to give loans, whose main business is to give loans. That is, for banks and financial institutions, you need not report on this matter. And one more last point under this third point, whether your client has given any demand loans. Demand loans means your client is giving loan without mentioning any repayment period. So in case if you find out that your client is giving the loans without mentioning any repayment period, you need to mention in the audit report what is the total amount of such loans given without repayment period. Here also calculate the percentage, how many total loans are there, out of that how much percentage is in the form of demand loans, that calculate the percentage also. And along with that, tell how much amount has been given to promoters and related parties. Out of the total loans, how much demand loans are given to promoters and related parties, that also you need to mention. So coming to the third point, 6 sub points are there which we have seen. Number 1, in case if your client has given loan to related parties, divide between subsidiary, associate, joint venture other than subsidiary, associate, joint venture. Second point, whether the terms and conditions are prejudicial. Third point, repayment of principal and interest is happening regularly on or before due dates. Number 4, if amount is overdue for more than 90 days, reasonable steps are taken by the company for recovery of the principal and interest. Number 5, when the loan has fallen due, instead of collecting it, whether your company has renewed, extended, or fresh loan given to same party. If yes, mention the total amount and also calculate the percentage. Last one, whether your client has given loan without mentioning any repayment period. This is what we call it as demand loans. If yes, mention the total amount of such demand loans. Here also calculate the percentage and report it. That's all. This is what the third reporting requirement. Now coming to the fourth one, very simple. Fourth point is also regarding loans, investments, guarantees which are given by the company. In the fourth point, they simply says that if your client has given any loan, investment, or guarantee to other parties, check whether they are giving it after complying with the section 185 and 186 of the Companies Act. That's all. Fifth point, acceptance of deposits. In case if your client company has accepted deposits, whether they complied with section 73 to 76 of the Companies Act. And regarding that acceptance of deposits, if there are any directives or instructions given by RBI, whether they are complied with or not. And if there is any order of CLB, that is Company Law Board, Court or Tribunal, regarding that deposits, whether those are complied with or not. Very simple. In case if your client has accepted any deposits, provisions of the Companies Act, RBI instructions, court order, whether all these are complied with or not, I need to check. If you find any non-compliance, report what is that non-compliance which has happened during the year. Next one. Sixth point, maintenance of cost records. Nothing but whether your company is coming under that applicability criteria given under section 148 subsection 1. If yes, whether your client is maintaining cost records or not. That's all. Whether for your client cost records are applicable. In case if cost records are applicable, whether your client is maintaining proper cost records or not, you have to comment on that. Next, seventh point, important point, which is regarding statutory dues. First of all, what is the meaning of statutory dues? Statutory dues means those amounts which are required to be paid because of the requirement of law. You are required to pay some amount because of requirements of law. Examples, income tax, GST, PF, ESI, gratuity. So these all will come under statutory dues. And regarding the statutory dues, there are some reporting requirements. And for the purpose of auditors reporting requirements, statutory dues are divided into two categories, undisputed and disputed. So what is this undisputed and disputed? Disputed dues means there is some case going on between your client company and the regulatory authority. That's why some tax amount was not paid. That is disputed. Undisputed means there is no issue, nothing, no one is challenging. So, but still your client did not pay the money. That is undisputed. So, if your client is fighting a case with the regulatory authority regarding one statutory due, that is a disputed due. If there is no case, nothing going, then that will be an undisputed statutory due. So now what are the reporting requirements relating to statutory due? What are the reporting requirements relating to, what are the reporting requirements relating to undisputed? What are the reporting requirements relating to disputed? So first we will talk about undisputed dues. When it comes to undisputed dues, I need to check whether my client company is regular in depositing all the undisputed statutory dues with the authorities. If there is no dispute lying, my client should have paid all the undisputed statutory dues regularly. Regularly means what? On or before due dates, whether my client company is depositing all the undisputed statutory dues with the regulatory authorities or not. If not, the extent of arrears outstanding, if you find some undisputed statutory dues was not paid, then I need to report extent of arrears of outstanding dues, nothing but amount of that outstanding dues as at the last day of the financial year concerned for a period of more than 6 months from the date they become payable shall be indicated by the auditor. So what they are trying to say here, is if at all any undisputed statutory due is there which is not paid to the regulatory authorities, and those statutory dues which are undisputed, which are outstanding for a period of more than 6 months as on the balance sheet date, only those amounts are required to be reported. Once again, I am repeating, not all the undisputed statutory dues outstanding shall be reported. Only those undisputed statutory dues which are outstanding for a period of more than 6 months as on the balance sheet date are only required to be reported. Let me make it simple with the help of example. Assume your client is required to pay some GST. No dispute, nothing. The due date is 31st of January 2022. But your client did not pay till balance sheet date, 31st of March 2022. The amount is 10 lakh rupees. Is this required to be reported? No. Why? Because even though amount is outstanding, it is outstanding for less than 6 months. It is hardly 2 months. Another amount is there. They are required to pay some PF amount. Amount is 20 lakh rupees. The due date is 30th of June 2021. They did not pay it till 31st of March 2022. Is this amount required to be reported? Yes. Why? Because the amount is outstanding for more than 6 months as on balance sheet date. Clear? So this is what the reporting requirements relating to undisputed. Now coming to disputed statutory dues, in case of disputed statutory dues, auditor is required to comment on two things. What is the amount involved in the dispute, and the forum and the court or authority where the case is pending. What is the amount involved in the dispute, and the court when the court or commissioner before which the case is pending. Is it pending before commissioner? Is it pending before court? Is it pending before is it pending before tribunal? Is it pending before Supreme Court, High Court? That need to be mentioned. So two things regarding disputed dues: what is the amount involved in the dispute, and the forum where the case is pending. So this is what regarding statutory dues. Coming to 8th point, disclosure of undisclosed income. In this point, what they try to say here is, during the year, whether your client company has faced any income tax assessment. During the year, whether any tax assessment happened, like income tax raid or return taken up for scrutiny. So like that, whether any tax assessment happened. And as a part of the tax assessment, has your client surrendered or disclosed some previously unrecorded income? Like some income tax raid happened, and in that raid, your client has surrendered some income which he did not offer to taxation earlier. So like this, during the year, whether the client has surrendered or disclosed income as a part of tax assessments. Now as an auditor, what I need to check is, now if you are surrendering for taxation, you would not have recorded in the books also. You would have hidden that income from the books also, whatever you are surrendering now. So just surrendering before the tax authorities alone will not be enough. That unrecorded income, whether it is now recorded in the books of accounts or not, that I need to check. What they're trying to say, if as a part of tax assessment, whether any income is surrendered or disclosed to the tax authorities now, just surrendering to the tax authorities alone will not be enough. That income should have been now brought to the books of accounts also. So I need to check whether that previously unrecorded income, which is offered to taxation now, has been recorded in the current year's books or not. That I need to check here. Next, ninth point is regarding loans which are accepted by your client. Now they are talking about borrowings of your client, not the assets. Now they are speaking about liabilities of your client. So when it comes to loans accepted by the client, we need to report on a few points, like whether your client has done any default in the repayment. So has your company defaulted either in the repayment of principal or payment of interest? Now what do you mean by default, sir? Default means either you are not paying the money, or even if you pay the money beyond the due date, that also will come under default. So whether your client company has made any default in repayment of loans or borrowings. If yes, I need to report the period and the amount of default for each lender. Lender wise amount and period of default should be reported. Not the total amount of default. For each lender, how much period of default has been made, how much amount of default has been made, that needs to be reported. Next, I need to check whether my client has been declared as a willful defaulter by any bank or financial institution. Willful defaulter is a bad credit rating given to the company. So I need to check whether my client has taken any loan from the borrower and whether any bank or financial institution classified my client's account as a willful defaulter. That I need to check and give a comment. Third one is regarding term loans, where I need to check whether my client has taken a long-term loan, but instead of using it for the purpose which was mentioned to the banker, are they using it for other purposes? So in simple terms, if I have to put it, whether your client has applied the term loans for whatever purpose they have got it, they should not have misused it. In case if they have misused the long-term loans, I need to mention what amount of loan has been used for that other purposes and what is that other purpose for which they have used it, that I need to report. Simply if I have to put it, for whatever purpose long-term loans are taken, whether they are used only for that purpose or not, I need to check and report. Now fourth point is regarding short-term loans. In case if your client has taken any short-term loan, whether it is used only for short-term purposes or it has been used for long-term purposes, that I need to check and give a comment. Then whether your client company has taken loan for meeting obligations of your subsidiary, associate, joint venture companies. Your client has taken loan, but not for meeting your client's requirement, but for meeting obligations of subsidiaries, associates, joint ventures. Then I need to report what amount of such loans are taken for meeting obligations of the subsidiary, associate, joint venture, and for what kind of transactions they have spent it, that I need to report. Clear? Next, last point under this last sub point under this point, loans against a pledge of securities or subsidiaries. That means whether your client has taken any loan, but for loan we need to offer security. No, what has been pledged with the banker is the shares which they are holding in subsidiary, associate, joint venture. So whether the company has raised any loans during the year by pledging securities which they are holding in subsidiary, associate, joint venture. Whether your client has got any loan by pledging the shares of subsidiary, associate, joint venture. If yes, give the details like what is the amount involved and how many shares are pledged, etc. And also report whether there is any default in the repayment of such loans taken on the pledge of securities held in subsidiary, associate, joint venture. That's all. So 6 points regarding loans which are taken by your client company. What are they? Whether your client has made any default in the repayment. If yes, amount and period for each lender wise. Number 2, client is declared as willful defaulter. Number 3, whether term loans are used for the set purposes. Number 4, short-term loans are used for long-term purposes. Number 5, loans are taken for meeting the obligations of subsidiary, associate, joint venture. Number 6, whether loans are taken by pledging the securities of subsidiary, associate, joint ventures. That's all. Clear? Now, coming to the 10th point. 10th point is regarding IPO or FPO. So, when it comes to IPO or FPO, they have two sub-points here. Whether your client has raised the money by way of IPO or FPO, including debt instruments. If yes, they will tell some purpose to the investors, no, for so and so purpose we are raising this IPO or FPO. As an auditor, I need to check whatever amount that has been raised from IPO or FPO, whether that amount has been used only for the set purposes. Sir, how will I come to know about the purpose, sir? You will come to know about the purpose from reading the prospectus. So I need to check whatever money that has been raised from IPO, FPO, whether it has been used only for the purposes mentioned in the prospectus. If not, I need to report what defaults have taken place, what delays have taken place, and what subsequent rectifications are done. Everything needs to be reported. Similarly, during the year, if there is any private placement or preferential allotment, see, difference between IPO and this preferential allotment is, in IPO, FPO, the offer will be open for everybody. But in the private placement of shares, shares will be issued, but only for a limited group of people. So in case if your client has raised money by way of preferential allotment or private placement, I need to check whether they have complied with section 42 and 62 of the Companies Act, which contains rules regarding this preferential allotment or private placement, and whatever amount that has been raised from that private placement, whether it has been used only for the purpose for which it has been raised. If not, if they are used for other purposes, then I need to report what kind of non-compliances have taken place. Now talking about the 11th point is regarding reporting of the frauds. So here what they say is whether any fraud by the company or on the company has been noticed or reported during the year. As an auditor, did you notice or report any fraud by the company or on the company? If yes, you need to mention nature and amount involved in the CARO. What is the nature of the fraud along with the amount needs to be reported in the CARO. Similarly, you need to comment whether any of the auditors submitted form ADT 4 during the year. We have reporting requirements under 143 subsection 12. When amount involved in the fraud is 1 crore or more, reporting to central government will happen. So I need to give a comment whether any of the auditors submitted form ADT 4 during the year. Similarly, even I need to give a comment whether as an auditor, did you receive any whistleblower complaints during the year? If any, how you have considered them. As an auditor, did you receive any whistleblower complaints and how you have dealt with them? So 3 points regarding the frauds. What are they? Number 1, whether you notice or report any fraud. If yes, nature and amount involved. Number 2, whether any of the auditors submitted form 84. Number 3, as an auditor, did you consider any whistleblower complaints taken place during the year? Next, 12th point is regarding Nidhi company. In case if you are conducting audit of a Nidhi company, you need to check 3 points. Whether net owned funds to deposits ratio is 1:20. Which means for every 1 rupee of net owned funds of Nidhi company, they can accept a maximum of 20 rupees of deposits only. If they have 1 lakh rupees of net owned funds, they can accept a maximum deposits of 20 lakh rupees only. So whether this net owned funds to deposits ratio of 1:20 is met or not, I need to check it. And whether Nidhi company is maintaining 10% unencumbered term deposits. Out of the total deposits which they have collected, 10% should be kept in a fixed deposit, that too unencumbered, without offering any security. So if the Nidhi company has collected total 100 lakh rupees of money, in that 10%, which will be 10 lakh rupees, that 10 lakh rupees should be kept in a fixed deposit, and that fixed deposit should not be offered as a security for any loan. So whether 10% has been kept in unencumbered term deposits or not, that I need to check. And finally, whether Nidhi company has made any default in repayment of principal or interest to any of the deposit holders. So 3 things I need to comment in case if my client is Nidhi company. Sir, what if my client is not a Nidhi company? I will mention the same fact. My client is not a Nidhi company. Reporting requirements under this clause will not be applicable. Next point, 13th point is regarding related party transactions. So in case if your client has entered into any related party transaction, you need to check whether those related party transactions are as per section 177 and 188 of the Companies Act. And regarding related party transaction, there are so many disclosure requirements as per accounting standards. I need to check whether all those disclosure requirements are given in the financial statements or not. That's all. Compliance with Companies Act, disclosure requirements as per accounting standards. 14th point is regarding internal audit system. I need to comment whether your client is having internal audit system which is commensurate, which is matching with the size and nature of the business. Nothing but whether your client company is having enough of internal audit team which is matching with the size of the company, that I need to comment. Along with that, as an external auditor, did you use the reports of internal auditors? That also you need to give a comment. As an external auditor, did you make use of internal auditor's report? That also you have to comment in your audit report. And finally, non-cash transactions. Whether the company has entered into any non-cash transactions with the directors. Did the company enter into any exchange of goods and services, barter transactions? So I need to check whether company has entered into any non-cash transactions with the directors and other related parties. If yes, whether the provisions of section 192 of the Companies Act are complied with or not. So section 192 will give you some rules and regulations regarding non-cash transactions with the directors or related parties. I need to check whether that section 192 has been complied with or not. Next one, NBFCs. If I am conducting audit of a non-banking financial institution, then I need to check, then I need to comment on certain points whether my client company is required to obtain registration under 45 1A of the Reserve Bank of India Act. 45 IA of the Reserve Bank of India Act. So some NBFCs are required to get necessary registration under this particular section of the RBI Act. I need to check whether my client is getting covered under that section of the RBI Act. If yes, whether they have obtained that necessary registration from the RBI or not. Second one, whether my client company is conducting any non-banking financial activities or housing finance activities without obtaining a valid certificate of registration. Did my client company carry out any non-banking housing finance or non-banking or housing finance activities without obtaining registration from RBI? That I need to check and give a comment. And also, in case if your client NBFC is enjoying a status of CIC, CIC is a status given to some NBFC subject to fulfillment of conditions. So in case if your client company is enjoying that status of CIC, core investment company, as an auditor, I need to check whether they are continuing to fulfill the criteria of a CIC. Like for example sake, if NBFC fulfills some 10 conditions, they will get the status of CIC. So if my client is enjoying that status of CIC, I need to check whether these 10 conditions are satisfied or not. Now, after becoming CIC, if they fulfill some extra 5 conditions, say some extra 5 conditions are satisfied, then they will get even more advanced status, which we call it as exempted CIC or unregistered CIC. In case if my client is enjoying the status of this exempted CIC also, in addition to these 10 conditions, whether these 5 conditions are also satisfied or not, I need to check. Understood everybody? So that's what they try to say here. If I read it slowly here, whether the company is a core investment company as defined in regulations made by RBI. If yes, whether they fulfill the criteria, whether these 10 conditions are met or not. And in case if the company is exempted CIC, then whether it continue to fulfill additional criteria. If it is exempted CIC, this 10 plus 5, 15 conditions are satisfied or not, I need to give a comment. And also, as a part of your client's entire group companies, is there only one CIC or more than one CIC? That means whether your client's group companies contain more than one CIC, more than one of the group companies enjoying the status of CIC. If yes, how many number of that group companies are enjoying the status of CIC? That number of CICs also I need to mention in my report. Finally, 17th point, cash losses. Whether your client company has made cash losses in the current financial year as well as immediately preceding financial year. If yes, amount of cash losses are required to be reported. Did your client company make any cash loss? See, don't confuse cash loss with loss as per statement of P&L. Both are different. Cash losses have to be calculated from the loss as per statement of P&L, loss or profit as per statement of P&L. So you have to take the figure of profit or loss from the statement of P&L, add back all non-cash expenses, reduce all non-cash incomes. The resulting figure which you get will be called as cash loss. So find out whether your client has made any cash loss for the current year as well as last year. If yes, mention the amount of that cash losses. Next, 18th point says that whether there has been any resignation of the statutory auditors. Did any statutory auditor resign during the year? If yes, find out because of what issues, what objections or what concerns the statutory auditors have resigned and how they are affecting your audit, that you need to give a comment. Just check whether any of the auditors resigned. If yes, find out what issues, what objections, what concerns are raised by them and how they are affecting your audit, that you need to have a comment here. And then finally, 19th point, in which they say that, I will give you summary what they say in the 19th point. In the 19th point, they ask the auditor to tell his opinion whether company is able to pay the liabilities which fall due within a period of 1 year, or is there any uncertainty existing. As an auditor, you need to tell your opinion. Is the company is having capability to pay all those liabilities which fall due within the next 1 year, or are they having uncertainty? Are they having any doubtfulness? Is there any doubtfulness regarding the company's ability to pay? That opinion I have to express. See, because of this particular point in the CARO, I need to comment on the future of the company. So but however, it is just an opinion, not a guarantee. So you should express your opinion. Is the company, so let me read this point in a detailed manner, whether the auditor is of the opinion that no material uncertainty exists as on the date of audit report, that company is capable of meeting all its liabilities existing at the date of balance sheet as and when they fall due within a period of 1 year from the balance sheet date. So whatever liabilities are there which fall due within 1 year from the balance sheet date, is the company in a position to pay all that liabilities, or is there any material uncertainty existing? That I need to comment here. And on what basis I have to give this opinion, sir? On the basis of on the basis of calculating financial ratios, on the basis of analyzing expected dates of realization of financial assets and payment of financial liabilities, on the basis of information accompanying the financial statements, and even on the basis of auditors' knowledge of board of directors and management's plans for the future. So you have to consider all this. So by calculating some ratios, by analyzing the dates of realization and payment to the assets and liabilities, by using the financial statements, and by sitting with the management and discussing the plans with them, using all this information, you have to tell your opinion, is the company in a position to pay all their liabilities as on balance sheet date, or is there any material uncertainty existing? Clear? Now 20th point is regarding CSR expenditure. Let me try to summarize this, what they try to say here. Regarding CSR expenditure, they say two things. Assume 21-22 financial year, the company is required to spend some CSR expenditure. Assume 2% of average net profits of the last 3 years. That 2% comes to 2 crore rupees. In the first point, they ask me to check if the company is not able to plan how to spend this 2 crore rupees of money within 6 months from the end of financial year, that amount is required to be transferred to the fund specified under Schedule 7. Now, what does that mean? With the help of example, we'll try to understand. Financial year 21-22, they calculated CSR expenditure, 2 crores they have to spend. Now, company is designing project. Out of this 2 crores, 50 lakhs they will give it as a donation to orphanage. Another 50 lakhs they will give it as a donation to old age home. Some 80 lakh rupees they will use it for the construction of school. A school they will construct. So this is what they have decided. Within 6 months from the end of financial year, from 31st of March 2022 till 30th of September, they are able to decide these projects. But if you observe, the total projects which they have decided is amounting to only 1.8 crores. But how much amount they have to spend? 2 crores they have to spend. So they are unable to decide. They are unable to have a project for that excess 0.2 crore rupees. That 20 lakh rupees they are not able to decide any project. And 6 months from the end of financial year is over, but still they don't know how to spend this 20 lakh rupees. Now this 20 lakh rupees should be transferred to a fund specified under Schedule 7. Sir, examples of the funds specified under Schedule 7. So examples of the funds specified under Schedule 7 are, one is PM CARES fund, other one is Prime Minister's National Relief Fund. So like that, so many funds are there which are given to which are prescribed under Schedule 7. You need to transfer that money to the fund. Which money? The money which you are not able to plan. 6 months over from the end of the financial year, but still you are not able to plan how to spend that. So that money you have to give it to the fund. That means you are, by transferring the fund, you are giving that money to the government. Government will take care of it, how to spend. If you are able to spend it on your own, come up with a project within 6 months. If you don't come up with a project within 6 months, transfer that money to the fund, and that fund will be utilized by the government for public welfare. So that is what the first point in respect of other than ongoing projects. That means if you don't have any project, the company should have transferred that unspent amount to a fund specified under Schedule 7. If you are not able to have any project regarding the CSR expenditure, you should transfer that money to a fund within a period of 6 months of the expiry of the financial year. Within 6 months from the end of the financial year, you should have transferred that money to the fund. Once the money goes to the fund, company will lose control over it. Government will take care of it. Now, second point is regarding a project. You have a project ready, but you did not spend it. Take for example, this example only we will take. Total 1.8 crore rupees, you have a plan ready. 20 lakhs you have transferred it to government. So out of this 1.8 crores rupees, 50 lakhs you want to give it as a donation to orphanage. The company has written a check, given it immediately. 50 lakhs they want to give it as a donation to old age home. They have written a check, given it. And finally they have 80 lakh rupees. They want to construct a school. But as we know, school construction will not happen in a day or two. It will take significant amount of time. So 80 lakh rupees, you have a project ready, but you did not spend it. You will spend it. 80 lakh rupees, you will spend it on school construction only, but it will take some time. So that money which you did not spend relating to an ongoing project, that should be transferred to a special account. Nothing but a separate bank account you have to open, and in that bank account you have to keep this money. See, when you transfer that money to the bank account, in the second case, company only will have control over it. Company only will spend it. For what purpose they will spend it? For social welfare only they will spend it. But just for segregating the normal funds with CSR funds, they are asking you to transfer this 80 lakh rupees to a separate bank account. So you have a project ready, but you did not spend the money yet. You will spend it in the future. Slowly you will spend it, but till the time you spend it, keep it in a separate bank account. But what is the first point? You don't have a project at all. Since you don't have a project at all, you have to transfer it to the funder. That means you have to give it to the government. Clear? So these two things I need to check. If I read the B point now, whether any amount remaining unspent relating to any ongoing project, pursuant to any ongoing project. That means you have a project ready, but you did not spend it. That money has to be transferred to a special account. That money has to be kept in a separate bank account. Clear? And then finally comes the 21st point. This will come only in the audit report of consolidated financial statements. Here what they simply say is, whatever company's information which is getting included in the consolidated financial statements. So as we know, consolidated financial statements includes holding company, subsidiary company, associate company, joint venture company. You need to go through individual audit reports of all these companies which are included in the consolidated financial statements. Particularly, you have to go through CARO reports of all these companies and find out in any of this company's CARO report, is there a negative remark? If yes, I need to mention in the consolidated financial statements audit report which company contains that negative remark and which paragraph contains a negative remark that I have to mention. So while conducting audit of consolidated financial statements, the auditor should go through individual audit reports of all those companies which are included in the consolidated financial statements, find out whether there is any negative remark. If yes, in the consolidated financial statements audit report, he should mention which particular company's audit report contains a negative remark and which paragraph contains a negative remark that needs to be mentioned in the audit report of consolidated financial statements. So this is what point number 21. So whether there have been any qualification or adverse remark by the respective auditors in the CARO reports of the companies which are included in consolidated financial statements. If yes, indicate the details of the companies along with the paragraph numbers of the CARO report. Clear? So this is what 21 clauses of the CARO are. Understood everybody? And one more thing here, all these 21 matters are required to be reported whether or not you have positive responses or negative responses. In all the cases, you have to report on all the 21 matters. So we are almost done with the, not almost, we are done with the audit reporting revision. But I think one more small question will be there. That too regarding how one more small concept is there that anyhow I will try to revise it. How AS1 will have an impact on the auditor's opinion. How AS1 will have impact on the auditor's opinion. So this is one particular small concept which was there in RTPs, MTPs, etc. So how AS1 will have an impact on auditor's opinion, in which they say that because of AS1, sometimes you are required to modify your opinion. When you should modify the opinion, we should modify the opinion in case whatever disclosure requirements are there which are as per AS1, if those disclosure requirements are not given, or if any of the three fundamental accounting assumptions are violated, like going concern, accrual, consistency. If any of these three fundamental accounting assumptions are violated, or if the disclosure requirements as per Schedule 3 or Companies Act are not given, then the auditor should modify his opinion. One small question. So let me show you that question once. So just for your convenience, I will show that once. So if you see here, right. So if you see here, what are the disclosure requirements in auditor's report as per AS1? So very simple. If the accounting policies which are required to be disclosed under Schedule 3 are not disclosed, if you are not disclosing the reporting requirements as given under Schedule 3, or if accounts are not prepared on accrual basis, or if the fundamental accounting assumption of going concern has been violated and no disclosure has been properly given. And also when proper disclosures regarding changes in the accounting policies, that means consistency is violated. So in these circumstances, you need to modify your opinion. So just one normal general question. If they ask you how AS1 will have an impact on the auditor's opinion, this is what you need to write. Just simple 4 points. 3 fundamental accounting assumptions are violated, or disclosure requirements under Schedule 3 are not given. So this is what I thought of revising the chapter audit reporting, important chapter. So there were attempts in which some 12 to 15 marks were also tested from the revision, whatever we had in this video. Clear? Now we will start revising the next chapter, which is audit documentation and audit evidence. Once again, an important chapter, especially from MCQs and true or false statements perspective, and even from the descriptive perspective also, the concepts in this particular chapter are going to be bit important. Now first let us talk about what exactly we are going to discuss in this chapter. So first of all, as you could see in the title itself, this chapter is a combination of two topics. One is audit documentation and the other topic is audit evidence. And the source for this particular chapter, the content from which this chapter has been taken from. So audit documentation related content has been taken from the standard SA 230, whereas audit evidence related content has been taken from the standard SA 500. So this particular chapter, audit documentation and audit evidence, is a combination of two standards. One is SA 230 and the other one is SA 500. So when I say we are revising the topic audit documentation and audit evidence, we are simply revising two standards, SA 230 and SA 500. So first we will talk about audit evidence related content. First, we will talk about SA 500, which is giving guidance on how to obtain the audit evidence and all. So first, if you remember the entire process of audit, so the entire process of audit will look something like this. So it will actually start with auditor's appointment. And once the auditor is appointed, his ultimate objective is to definitely express an opinion. So the ultimate objective of the auditor is to express an opinion. And in order to express that opinion, auditor will has to put some efforts. So the process of audit starts with auditor's appointment and he will not directly express the opinion. After the auditor gets appointed and before he expresses the opinion, in between so many activities will happen. So first thing what will happen is, after auditor has been appointed, he will perform some procedures, he will perform some methods to obtain something called audit evidence, which we call it as audit procedures. So after auditor is appointed, what he will do? He will perform something called audit procedures. And by performing that audit procedures, auditor is going to get something called audit evidence. By performing that audit procedures, auditor will get something called audit evidence. And on the basis of that audit evidence, auditor will express the opinion. So if I ask you what is the entire process of audit, this is what the entire process of audit is. It starts with auditor's appointment, then the auditor will perform some audit procedures. By performing that audit procedures, he will get something called audit evidence, and on the basis of that, auditor will express the opinion, and by expressing the opinion, auditor's objectives will come to an end, auditor's responsibility will come to an end. So this is what happens in the entire process of audit. So we know about this auditor's appointment, how auditor will be appointed, procedure, who is eligible. So all these things we have covered in the company audit chapter. Now the last part also we have already covered, how to express opinion, different kinds of opinion, what is the format of audit report, what should be the contents of audit report. That we have covered in another chapter, which is audit reporting. So we have covered auditor's appointment related matters. We have covered auditor's responsibility related matters. Now we are yet to discuss this audit procedures and audit evidence. First of all, let us try to understand the meaning of these terms. Number one, audit evidence. Audit evidence means the information which supports or which forms the basis for auditor's opinion, that we call it as audit evidence. Any opinion, not just audit opinion. If you take any opinion in this world, if you are expressing opinion about something, you will express that opinion on the basis of some information. You will not just give the opinion in the air. So every opinion that you are giving will be based on some information. Similarly, whatever opinion auditor is giving, be it unmodified, be it modified, be it qualified, adverse, disclaimer, whatever it is, all the opinions of the auditor should have some supporting information. So the information which is used by the auditor in forming that opinion on the financial statements, or to base the opinion on the financial statements, that information which supports or forms the basis for auditor's opinion, we call it as audit evidence. And this evidence will not automatically come and fall in the lap of the auditor. Just because you are appointed as an auditor, evidence will not automatically come and fall in your lap. So as an auditor, you need to put some efforts from your side to obtain that audit evidence, and those efforts or those procedures which are performed by the auditor to obtain the audit evidence, we call it as audit procedures. The procedures which are performed by the auditor to obtain audit evidence, that we call it as audit procedures. So before we can understand the concepts related to audit evidence, first it becomes necessary for us to understand this audit procedures in a detailed manner. So we have to spend our time and energy on understanding now what are different kinds of audit procedures that we are going to understand it now. So let me explain now what are different kinds of audit procedures. So meaning I have already told you the procedures which are performed by the auditor to obtain audit evidence, that we call it as audit procedures. Now these audit procedures are broadly divided into two categories. Number one, risk assessment procedures, and number two, further audit procedures. And these further audit procedures are further divided into two categories. Number one, compliance procedures, and number two, substantive audit procedures. So broadly speaking, audit procedures are divided into two categories. Number one, risk assessment procedures. Number two, further audit procedures. But if I talk in specific terms, audit procedures are divided into three specific categories: risk assessment procedures, compliance procedures, and substantive audit procedures. So let us try to understand what is this risk assessment procedure, what are these compliance procedures, and what are these substantive audit procedures. Very simple. Whenever I go to the client's premises, for example, if I'm getting appointed as auditor of a company, and on one fine day I have started doing the audit, when on that day of starting the audit, the moment I enter the client's premises, I will not directly go to the accounts department and start verifying books of accounts. On day one of audit itself, you will the moment you enter the client's premises, directly you will not visit the client's accounts department and start verifying books of accounts. So first, the moment you start doing the audit, what you are supposed to do is you need to perform some procedures to obtain understanding of three things. To obtain understanding of entity, you need to get an understanding about your client's entity. You need to understand about environment in which your client is operating, and even you need to understand about the client's internal control. First thing what I should do, don't rush to the accounts department and start verifying books of accounts. You need to perform some procedures to obtain understanding of three things. Which three things I need to understand? I need to understand about my client's entity. I need to understand about my client's environment. I need to understand about my client's internal control. Nothing but what business my client will do, to which sector my client belongs, and also what kind of internal controls my client is having, that I need to understand. For what purpose I need to understand about entity, environment, and its internal controls? So the purpose is to identify and assess risk of material misstatement. Why I should obtain understanding of entity, environment, and its internal control? To identify, to find out and analyze risk of material misstatement. So whatever procedures which the auditor is performing to obtain an understanding of entity, environment, and its internal controls, to identify risk of material misstatement, that procedures only I call it as risk assessment procedures. So if somebody asks you to define what is risk assessment procedures, I will say that the procedures which are performed by the auditor to obtain understanding of three things. What are they? Entity, environment, and its internal control. For what purpose? To identify and assess the risk of material misstatement. That procedures I am going to call it as what? Risk assessment procedures. So, okay, I have spent some 1 or 2 days of time in understanding about my entity, environment, and internal control. I identified risk of material misstatement. Next, what I will do? Then I will go to accounts department and start verifying books of accounts? No. Before you go to accounts department and start verifying books of accounts, there is one more procedure which you need to perform, that is compliance procedures. So now what is compliance procedures? So compliance procedures means these procedures which are performed by the auditor to obtain audit evidence regarding operating effectiveness of internal controls. So what are compliance procedures? The procedures which are performed by the auditor to obtain audit evidence regarding operating effectiveness of internal controls. Nothing but whatever internal controls which my client is having, whether those internal controls are operating effectively or not, whether those internal controls are working properly or they are suffering from weaknesses, are those internal controls able to prevent, detect, or correct the fraud and error from happening. So whatever procedures which as an auditor I perform to obtain audit evidence regarding operating effectiveness of internal controls, that I call it as compliance procedures. So if somebody asks you to define compliance procedures, how do you define it? The audit procedures performed by the auditor to obtain audit evidence regarding operating effectiveness of internal controls. So nothing but simply, if I have to put it, I want to know whether controls are working properly or not. For that, I perform some procedures which I call it as compliance procedures. There is other name for compliance procedures. We even call it test of controls also. What do we call it? Test of controls also we do call it. The name itself says here you are going to test the controls in the organization. Next one. Sir, okay, I have spent some another 2 days of time in testing whether the controls are working effectively or not. Now what I shall do, sir? Now finally you have to go to accounts department and start verifying books of accounts, and that procedures we actually call it as what? Substantive audit procedures. So substantive audit procedures means those procedures which are performed in which we will try to verify books of accounts and financial statements to determine whether they are reliable or not, whether they are accurate or not. Nothing but finally at the stage of substantive audit procedures, I am checking entries in the books of accounts and I am checking the financial statements. So the procedures in which I verify the financial information, the procedures in which I verify the books of accounts and financial statements, that procedures I call them as substantive audit procedures. So if you observe carefully, till the stage of substantive audit procedures, I did not verify single invoice, single bill, single item of financial statement. That actual verification of books of accounts and financial statements will happen only at the stage of what? Substantive audit procedures. In the risk assessment procedure, I just understood entity, environment and its internal control. In the compliance procedures, I just verified whether the controls are working effectively or not, whereas actual verification of books of accounts and financial statements happened only at the stage of substantive audit procedures. And this substantive audit procedures can be performed in further two ways. There are two broad approaches for performing There are two broad approaches for performing substantive audit procedures. Number one, test of details, and number two, analytical procedures. I can perform substantive audit procedures in further two categories. Number one is test of details and number two, analytical procedures. Sir, what happens in the test of details? So test of details means nothing but checking the supporting documents. If I want to know whether the books of accounts and financial statements are correct or not, if you want to know whether information in the financial statements is correct or not, what you will do? You will check the supporting documents. Like if I want to know whether the purchases are correct or not, check the supporting document, invoice. If I want to know rental payment is correct or not, check the supporting document, rental agreement. If I want to know whether the client is really the owner of land and buildings or not, check the supporting document, which is this property documents. So like this, one method by which I can obtain audit evidence regarding entries in the books of accounts and financial statements is test of details, which involves checking of supporting documents. And this test of details are further divided into two categories. Number one, test of transactions, and number two, test of balances. Nothing but if you check the supporting documents of P&L items, that we call it as test of transactions. If you check the supporting documents of assets and liabilities, that we call it as test of balances. That's it. So both collectively will come under test of details, which broadly means checking the supporting documents of the entries or items of the financial statements. Now another technique for performing substantive audit procedure, which is analytical procedure. See, in the analytical procedure, we will not check the supporting documents, but what we try to do in the analytical procedure is we will try to evaluate whether the financial information is correct or not by studying relationship between financial and non-financial items. What happens in analytical procedures? Here we will not check the supporting documents, but instead we study the relationship between financial and non-financial items. Thereby we can evaluate whether the financial information is correct or not. So those procedures in which I study the relationship between financial and non-financial item to evaluate the financial information's correctness, that I call it as analytical procedures. Like studying the relationship between number of employees and the salary cost. Studying the relationship between number of employees and the revenue. So like that, I will study relationship between one financial and one non-financial item. Thereby, I will evaluate whether the financial information is correct or misleading. That I call it as analytical procedures. So these are the broad categories of audit procedures. So we understood different kinds of audit procedures. Now, few more conclusions we have to make here. So now one general statement which I have to say, very important for true or false statements. See, we perform compliance procedures, and in fact we perform compliance procedures in order to determine nature, timing and extent of substantive audit procedures. Why we perform compliance procedures? On the basis of results of compliance procedures, we are going to decide the nature, timing and extent of substantive audit procedures. How so? How means, for example, by performing compliance procedures, one of the two outcomes will be possible. Either I might come to a conclusion that internal controls are working effectively, or I might come to a conclusion that internal controls are not working effectively. If I came to know that by performing compliance procedures that internal controls are working effectively, generally as I know, I will perform substantive audit procedures on sampling basis. And if I came to know that controls are working effectively, will I perform more substantive audit procedures or less substantive audit procedures? Here I will reduce my checking. Here I will perform less substantive audit procedures. On the other hand, that means I will verify lesser samples. On the other hand, if I came to know that internal controls are not working effectively, here what I will do? Will I perform more sample? Will I verify more samples or lesser samples? I will verify bigger samples here. So I will perform substantive audit procedures which will be higher. So if you observe carefully, on the basis of results of compliance procedures, I am about to decide how much amount of substantive audit procedures I will perform. So that's what even that sentence means. On the basis of results of compliance procedures, the auditor is going to determine the nature, timing and extent of substantive audit procedures. And one more thing, compliance procedures and the substantive audit procedures both are complementary with each other. Both should go hand in hand. One is not an exception for the other. So what does that mean is, for example, if you perform compliance procedures and if you are not at all able to find any kind of material misstatement, does that mean will you skip altogether substantive audit procedures? No. So even though if you came to know controls are very effective, some minimum substantive audit procedures you have to perform. One is not a substitute for other, both are complement to each other. Now there are some important statements which are particularly important for true or false statements. So let me bring it to your attention here particularly. So these two statements are very important for true or false. The absence of misstatement in substantive procedures does not indicate that controls are effective. That means if you did not find any mistake in the substantive audit procedures, you should not come to a guarantee that controls are superb. No. Sometimes what will happen is you will not be able to find out material misstatement, but still in that area controls might not be working effectively. So why? Because we verify the transactions, we perform substantive audit procedures on sampling basis. So sometimes we will not be able to find out misstatement. Why? Because misstatement did not cover in the sample. So that's why when you came to know that substantive audit procedures, you are not able to find out any misstatement, don't automatically come to a conclusion that controls are effective. Why? Because sometimes controls might be ineffective, still you might not be able to find out misstatement in the substantive audit procedures. On the other hand, if you find a misstatement in the substantive audit procedures, that clearly indicates that something is wrong in the controls. That is what this fourth point. The presence of material misstatement strongly indicates that there is a significant deficiency. If you find misstatement, compulsory, pakka, there is a deficiency in internal control. On the other hand, if you don't find out misstatement in the substantive procedures, don't come to a conclusion that controls are effective. So they can play with you in the exam by asking true or false statements, something like this. For example, the absence of misstatements in substantive procedures indicate that controls are effective. Do you agree with that? No. Why? Because the absence of misstatements in substantive audit procedures does not indicate controls are effective. So like this, they can play with you in the examination, asking you true or false statements. Clear? So this is what regarding audit procedures, one significant discussion from this chapter. Now, since we understood audit procedures, let us now try to revise the concepts regarding audit evidences. So by performing these audit procedures, we will get something called as audit evidence. We are going to get it. Now, what is the meaning of audit evidence? Audit evidence means the information which supports or which forms the basis for auditor's opinion, that we call it as audit evidence. And from where auditor will get the audit evidences? So the sources for audit evidence are undoubtedly auditor will get significant amount of evidence from accounting records. There is no doubt majority of the audit evidence comes from accounting records. Accounting records means what? Books of accounts, vouchers, supporting documents, bills, contracts, all this will come under accounting records. Yes, audit evidence comes from accounting records. But will it be correct to say audit evidence comes only from accounting records? You can say that audit evidence comes from accounting records. Good, this statement is fine. But if I say audit evidence comes only from accounting records, do you agree with that? No, audit evidence doesn't come only from accounting records. Significant majority of the evidence comes from accounting records. But there is one more source from which auditor can get audit evidence, which is other information. When I say other information, it includes like minutes of the meeting, external confirmation, MIS reports. So like this, from other information also auditor can get audit evidence. So audit evidence comes from accounting records, that is books of accounts, as well as other information also. And by performing audit procedures, we will get this audit evidence. And one more thing here, when I say audit evidence, it just doesn't mean only the evidence which is supporting the items of the financial statements. Even if you get the information which is contradicting with the items of the financial statements, that also we call it as audit evidence. Like for example, I'm able to see a purchase entry in the journal for 1 lakh rupees. When I check the supporting documents, in the invoice also 1 lakh rupees is there. Yes. So this information is supporting the item of financial statements. This is evidence. In another transaction, I am able to see that purchase entry is written for 5 lakh rupees, but when I check the supporting documents in the invoice, the amount is 50,000 only. Now this information is contradicting with the information in the financial statements. Even the contradicting information is also audit evidence. So here it is an evidence that financial statements is correct. Here it is an evidence that financial statements contain a misstatement. So when we say audit evidence, it includes information which is supporting the information in the financial statements. It even includes the evidence which contradicts with the information in the financial statements. And in some rare scenarios, absence of the information can also be considered as audit evidence. What also can be considered as audit evidence? Even in some cases, absence of information. If the client is not giving you information, whatever you are requesting, that is also implied evidence that there is something wrong in that concerned area. So like that, evidence can be a supporting evidence, or it could be a contradicting evidence, and in some rare cases, absence of information can also be considered as audit evidence. And while obtaining audit evidence, all the evidence you might not get it by yourself. Auditor by himself might not get all the audit evidences. Sometimes auditor might be required to take the help of experts also. Sometimes the auditor might be required to get the audit evidence with the help of what? Experts. Now, who is expert, sir? When it comes to the context of auditing, expert means a person who is having an expertise in areas other than accounts and audit. From the auditing perspective, when I say auditor is going and consulting expert, who is an expert? A person who is having expertise in areas other than accounts and audit. Why? Because in accounts and audit, auditor himself is an expert. No. You can't say, I don't understand accounting standard, I go to the expert. Then you don't deserve to be a chartered accountant. So when I say I'm approaching an expert, being an auditor, if I say I'm going and approaching an expert, I'm approaching such a person who is having expertise in areas other than accounts and audit, not in the areas of accounts and audit, like a lawyer, a actuary, or some other staff engineer. So like these kind of people also might be involved. Like for example, you want to measure stock, and the client is holding the stock in liquid form. They are having some oils and lubricants as a stock. So now you tell me you want to verify how many liters of stock the client is holding, which are in the form of oils and lubricants. Now when you visit the warehouse, in the warehouse a big containers are there, everything is filled with some oil. Now the client is saying there are 1000 liters of so and so kind of oil in the stock. Now you want to know whether 1000 liters of stock is there in that container or not. 1000 liters of oil is there in the container or not. Will you start measuring? Will you take a bucket and start measuring it? No. Here we have to take the help of expert like an engineer. What he will do? Using the using some mathematics formula, using the mechanics of the physics and all. So what he will do is, using the diameter of that container, he will try to use some formulas and tell you and give you some instrument kind of thing, and he will ask you to dip it in that container, and he will give the markings on that stick or that measurement tool. Now till whatever stage that tool is getting dipped, that many liters are there in that container. So you have to take the help of expert here, like an engineer. Or you want to get a audit evidence regarding pending case, but you are not an expert in legal areas. Now you might be required to go and consult an expert. So like this, while obtaining audit evidence, even auditor might be required to take the help of expert also. So this is what regarding information, introductory information regarding audit evidence. Now let us try to understand what are types of audit evidences. Now, there are various kinds of audit evidence, starting with on the basis of nature or form. On the basis of nature or form, evidence is divided into three categories. Number 1, oral evidence. Number 2, documentary evidence. And number 3, visual evidence. As the name itself says, oral evidence is something which you are getting by way of words spoken. Documentary evidence, which is there in the written format, either electronic or of paper form, or visual evidence, which you are getting by way of actual observation. So three kinds of audit evidence will be there: oral, documentary, and visual evidence. And one more thing, on the basis of source from which you are getting the evidence, evidence will be divided into two categories. Number one, internal evidence, and the other one is external evidence. Now, what is this internal evidence and external evidence? The evidence which is getting originated within the client's organization, that we call it as internal evidence, whereas the evidence which is getting originated outside of the client's organization, that we call it as external evidence. Like purchase invoice. Purchase invoice is an example of internal or external? Purchase invoice is an example of external evidence. Why? Because when your client has bought item, the supplier will give the bill. Or you take an example, you go to the store and buy some item. Will you give the bill or storekeeper will give the bill? The shopkeeper will give the bill. So since purchase invoice is getting generated outside of the client's premises, it is an external evidence. Sales invoice, internal evidence. Bank statement, external evidence. External confirmation, external evidence. Debit notes given by your client, internal evidence. So like this, depending on the source, evidence will be divided into two categories: internal and external. So these are various kinds of audit evidences. And if you do a comparative study between internal versus external, which one is more reliable? External evidence is more reliable than when compared with internal evidence. Why external evidence is more reliable? Why? Because since it is getting generated outside of the client's organization, neither the client's management or client's staff will have control over it. So less scope for manipulation. And between oral, documentary, visual, which one is more reliable? Documentary evidence is much more reliable than when compared with remaining two evidences. And few more differences if we talk about between internal versus external. Which one will be available in large quantities? Internal evidence will be available in large quantities. Majority of the audit evidence, whatever we get, that will be internal in nature. That doesn't mean external evidence is not at all available. External evidence also will be available, but limited in quantity when compared with internal evidences. Internal evidence will be available in bulk quantities. External evidence will be there, but comparatively lesser availability when compared with the internal evidences. And I have already told you reliability. So when you have which evidence is generally more reliable? External evidence is more reliable. Does that mean external evidence always will be reliable? You need not suspect external evidence at all? No. In some cases, I need to suspect external evidence also, especially when you came to know that external source from which you are getting audit evidence, that external source is not independent of the client. Sometimes we need to question external evidence also when you came to know that the external source from which you are getting evidence is not independent of your client. Like for example, you came to know that you are getting a confirmation from the debtor, but you came to know that debtor is a related party of your client. Debtor is very close relative of your client. Now you need to suspect even that external confirmation also. Why? Because here the third party is not independent of the client. Clear? So this is what regarding various types of audit evidences. Now coming to the next aspect, see, whenever the term audit evidence is used in the subject of auditing, it will always be preceded by two terms. Or even wherever you read the content from the standards will not ask the auditor to just obtain audit evidence, but instead what they say is the auditor shall obtain sufficient and appropriate audit evidence. So whenever the term audit evidence is used in the entire subject of the audit, it will always be preceded by two terms: sufficient and appropriate. Now let us try to understand what is this sufficient and what is this appropriate. Sufficiency is a measure of quantity of audit evidence, whereas appropriateness is a measure of quality of audit evidence. Sufficiency is a measure of what? Quantity of audit evidence, whereas appropriateness is a measure of quality of audit evidence. Quantity means what? Number. For example, if you verify 100 invoices, you have a quantity of 100 evidences. If you verify 1000 invoices, you have a quantity of 1000 invoices. If you verify 1 lakh invoices, you have 1 lakh quantity of audit evidences. That measure of quantity, we call it as sufficiency, whereas the measure of quality, how much qualitative the evidence is, that is measured by appropriateness. Okay, understood. Sufficiency is a measure of quantity, appropriateness is a measure of quality. But how much quantity will be called as sufficient, but what quality will be called as appropriate? I'm saying sufficiency is a measure of quantity. Appropriateness is a measure of quality. Sir, but what amounts to sufficient and appropriate? How much quantity will be called as sufficient, sir? If I have 1000 invoices, will it be sufficient? If I have 10,000 invoices, will it be sufficient? Or if I have only external evidences, will it be qualitative? So, how much quantity will be called as sufficient? What quality will be called as appropriate? The thing here is there is no thumb rule, there is no hard and fast rule given in any standard which says this much quality is sufficient, this much quality is appropriate. There is no hard and fast rule in the entire standards on audit. It all depends on auditor's professional judgment. It all depends on what? Auditor's professional judgment. The auditor has to make use of his professional judgment and then decide what amounts to sufficiency, what amounts to appropriateness. That means auditor has to use his knowledge, experience, training, and depending on facts and circumstances of each of the case, auditor will decide how much quantity will be sufficient and how much quality will be appropriate. Clear? So, but there are some factors which will affect the auditor's decision. Like, in order to decide how much quantity is sufficient, the auditor will keep certain factors in mind. Like, what factors they will keep in mind? So, they have given it here. So, let us have a look at it. So if I show you the factors which affect sufficiency of audit evidence, sir, how to decide how much quantity will be sufficient? It depends on some factors like nature and size of the client. So if the client size is very big, if the client is of very bigger size, you need more quantity of audit evidence. When the size of the client is smaller, when the client size is very smaller, you require less quantity of audit evidences. It depends on risk of material misstatement. If you find the risk is very high, the quantity of audit evidence required will be high. If the risk is low, the quantity of audit evidence required will be low. It even depends on effectiveness of internal controls. If you came to know that controls are very much effective, you perform less substantive audit procedures. When you perform less substantive audit procedures, less quantity you will get. On the other hand, if you came to know that controls are not effective, you perform more substantive audit procedures. When you perform more substantive audit procedures, you get more quantity of audit evidences. And it even depends on quality of such audit evidence. Higher the quality, you require less quantity. If the evidence is more qualitative, you ask for lesser quantity. If the evidence is not qualitative, you ask for more quantity. It even depends on materiality. If the item is very material, if some item of financial statements is very important item, you get more evidences. On the other hand, if you find that if the item is not so material, if it is insignificant or negligible, you ask for less quantity. It even depends on size of the population. If the size of the population is bigger, quantity required will be bigger. If the size of the population is smaller, the quantity required will be smaller. It even depends on characteristics of the population. Like if the population is homogeneous, like if it is having similar characteristics, less quantity will be required. On the other hand, if the population is a heterogeneous population, that means if it is containing dissimilar characteristics, you require more quantity of audit evidences. So like this, all these factors auditor will consider, then he will use his knowledge, experience and training, then he will decide what quantity will be sufficient. Similarly, appropriateness, when I say appropriateness is a measure of quality, and quality of the audit evidence depends on two things. One is relevance and the other one is reliability. Quality of audit evidence depends on two more things. Appropriateness means quality. Quality further depends on two things. What is that? One is relevance and the other one is reliability. Relevance means how logically the evidence is connected with your item of the financial statements. Reliability means, as we already know, trustability. And the reliability further depends on source and nature. Like external evidence is more reliable, documentary evidence is more reliable. So like this, appropriateness means quality. Quality further depends on relevance and reliability. Reliability further depends on source and nature of that audit evidence. And relevance means how logically the evidence is connected with the given item of financial statement. The more logically the evidence is connected, the more quality, the more appropriate that evidence will be. So this is what the meaning of the term sufficient and appropriate, and what are the factors which auditor will try to keep in mind while doing this, while determining what amounts to sufficiency and appropriateness. Now coming to the next concept from this particular chapter, now we will be talking about what are methods to obtain audit evidence. What are methods to obtain audit evidence? See, I told risk assessment procedure, we try to obtain understanding of entity, environment and its internal control. Compliance procedures, we try to obtain evidence whether controls are working effectively or not. Substantive audit procedures, we perform to know whether the financial statements and books of accounts are reliable or not. Now, in each of this audit procedure, we have classified them on the basis of outcome which we expect to achieve. But how to achieve that? Outcome? Like in the risk assessment procedures, I am saying auditor will try to understand about entity, environment and its internal control. But how he will get that understanding of entity, environment and internal control? By following some methods or techniques. Similarly, in the compliance procedures, auditor will try to test whether the controls are working effectively or not. But how he will come to know whether the controls are working effectively or not? By following the methods or techniques. Similarly, in the substantive audit procedures, auditor will try to verify whether the financial information is correct or not. But how he will come to know? By following the methods which we are going to understand now. So as per the standard, there are some 7 methods which are available for obtaining audit evidence. So what are that 7 methods which will be used by the auditor for obtaining the audit evidences are? Number 1, inspection. First one is what? Inspection. Sir, what happens in the inspection? So inspection means nothing but documentary examination, checking of the supporting documents, or even it includes physical examination of an asset. Simply, if I have to put it, test of details. So inspection means simply what? Checking the supporting documents. If I want to know whether entries in the financial statements are correct or not, what I will do? I will examine the documents available. If I want to understand about entity, environment and its internal control, I will read their MOA, AOA or incorporation documents. So if you examine the documents, if you check the documents for getting the evidence, that we call it as inspection. The name itself says examination of the documents. And not just that, even if you go and do the physical examination of an asset, if you go and see the asset physically, that also will come under inspection. So the first method which is used by the auditor to obtain audit evidence is inspection, which involves a documentary examination and also physical examination of an asset. Number 2, the second method which is available is inquiry. So the name itself says what happens in the inquiry. In inquiry, we try to get the information from the knowledgeable persons by way of asking the questions. In case of inquiry, we try to get the audit, we try to seek the information from knowledgeable person. We try to get the information from knowledgeable person by asking the questions. Like if I want to get audit evidence, I will go to the employee, ask the questions and get back the responses. I want some information, I go to the management, ask them questions and get the responses. And these inquiries can range from formal written inquiries and it can range up to informal oral inquiries. Formal written inquiries means whatever information I want to ask, all that questions I will write it in a piece of paper, give it to that employee or staff and get back the answers. Informal oral inquiry means whatever information I want to get, just as a informal conversation I will have, just as a normal conversation I will ask the questions and get back the responses. So you can inquiries can be in the form of formal written inquiries, it can be even in the form of informal oral inquiries also. And just asking the questions is not inquiry. The most integral part of the inquiry is evaluation of the responses. Whatever responses you have got to the questions, analyzing that responses is an integral part of inquiry process. Not just asking questions, analyzing the responses is the important part of the inquiry process. And by doing inquiry, anybody will be able to get only 3 kinds of information. Number 1, new information which auditor is not previously aware of. Number 2, information which supports the information which auditor already knows. Number 3, the information which contradicts with the auditor's already aware information. So by doing any inquiry, we get only 3 kinds of information. Altogether, new information which we are not aware, or information which supports the information which we already know, or information which contradicts with the information which we already know. And the problem with the inquiry is it will give you less persuasive audit evidence, persuasive, convincing. The evidence which you obtain by performing inquiry is less persuasive. It is very less convincing audit evidence when compared with all other methods. Why? Because we cannot expect anybody voluntarily come and disclose what mistakes they have done. So inquiry will give audit evidence, but it will be least convincing, least reliable audit evidence when compared with the other methods. Now, third method which is available is observation. Sir, what happens in the observation? So the name itself says if I am obtaining evidence by looking at a process being performed by others, that I call it as observation. If I try to get the audit evidence by looking at the process being performed by others, that I call it as what? Observation. For example, I am sitting and observing physical verification done by the management. Observation. See, observation gives audit evidence, but the problem with the observation is that evidence is reliable only till the point of time such observation takes place. Observation gives audit evidence, but that reliability is restricted only till the point of time such observation takes place. Why? Because when you are not observing, what is the guarantee the same person will do the same activity in the same manner? So that's why observation gives the audit evidence, but its reliability is restricted only to the point of time at which such observation takes place. Number 4, external confirmation. As the name itself says, in the external confirmation, auditor will try to get direct written response from a third party outside of the organization. Like, I want to know whether debtor's balance is correct or not. I can directly write an email or send a letter to the debtor directly and get the response from him. I want to know bank balance is correct or not. I will write a letter or email directly to the banker. So like this, if you are getting evidence as a direct written response from the third party, that we call it as external confirmation. Number 5, it is recalculation. Recalculation means nothing but checking the arithmetical accuracy once again. Whatever calculations which are done in the financial statements, whether they are done accurately or not, checking that, we call it as recalculation. Number 6, reperformance. Reperformance means auditor's independent execution of a process being performed by others. Like, management has already prepared the BRS and given it to you, but as an auditor, you don't want to trust on the management's BRS, so you have prepared it once again. So management has already done one activity, you are doing it once again for obtaining audit evidence. That we call it as reperformance. And finally, last one, we have analytical procedures. Analytical procedures, as we already know, here we try to study the relationship between financial and non-financial information to evaluate whether the financial information is correct and reliable or not. So these are the 7 methods which are available for obtaining audit evidence. List them out once: inspection, inquiry, observation, external confirmation, recalculation, reperformance, and analytical procedures. Now, out of all these methods, the most efficient method, most efficient means, first I will try to explain the difference between efficiency and effectiveness. Most of the people use this term interchangeably, but there is a slight difference between these two terms, efficiency and effectiveness. Efficiency means able to complete the task in less time. In very less amount of time, if you are able to complete the task, you will be called as efficient. On the other hand, if you are doing the work in a perfect manner, that we call it as effective. Efficiency means you are completing the task in less time. Effectiveness means you are doing the work in a perfect manner. Now you tell me, out of all these 7 methods, which one is most efficient? That means which one is very less time consuming? Out of all these 7 methods, the most efficient, the most less time consuming activity is inquiry. Inquiry can be completed in no time. Just you have to ask the questions and get back the responses. So inquiry is the most efficient, but it is not effective. Why? Because the evidence which you get from inquiry is not persuasive. No, it is not convincing. No. So inquiry is efficient, but it is not effective. Whereas the most effective, the best evidence which you get out of all these 7 sources is, the best evidence, if I have to say, the best method for obtaining audit evidence is reperformance. What is the most effective method? Reperformance. It will give you best possible audit evidence, but it is not efficient. Why? Because reperformance is very time consuming. So efficient, the most efficient method is inquiry, the most effective method is reperformance. But which one auditor has to use out of these 7 methods, sir? It all depends on professional judgment. The auditor will use his knowledge, experience and training, and he will analyze the facts and circumstances of each of the case. Then he will decide which method will be used, which method will be suitable, or which combination of methods will be suitable. Understood? Now, before we can go with the concept of audit documentation, one more last question we will revise, which is assertion. Now, what is the meaning of assertion? Assertion means simply the representations made by the management regarding account balances, class of transactions and disclosures. So I say it as ABCD: account balances, class of transactions and disclosures. Nothing but whatever representations, whatever information which the management is conveying regarding account balances, that is regarding the assets and liabilities, or regarding the class of transactions, that is P&L items, or regarding the disclosures, that is notes to accounts, all that information conveyed by the management, represented by the management, that we call it as assertion. So what is the meaning of assertion, guys? Definition is what? Representations which are made by the management regarding account balances, class of transactions and disclosures. And depending on item of financial statements, there will be various assertions which will be made by management. So when we talk about account balances, that is assets and liabilities, management will make here representations like, number 1, existence, which means they try to convey that all the assets and liabilities recorded in the balance sheet are existing with the company as on balance sheet date. And completeness, they also make a representation that they have recorded all the assets and liabilities without ignoring anything. And even rights and obligations is one more assertion made regarding account balances. In respect of assets, rights, that means they say that whatever assets we have shown in the balance sheet, we have rights towards that asset. Whatever liabilities we have shown in the balance sheet, we have an obligation towards that liabilities. Similarly, valuation is also an assertion made regarding account balances. Valuation means what? Nothing but what at whatever value the assets and liabilities are shown, they are shown at correct amount. The calculations has all been done in a proper manner. Then the correct values are shown in the balance sheet. So like this, regarding the balance sheet items, the management will make representations like existence, completeness, rights and obligations, and valuation. When it comes to class of transactions, that is when it comes to P&L items, here management will do the assertions like here existence will not be there, but instead occurrence will be there. Whatever incomes and expenses they have shown in the statement of P&L that have really happened, that have really occurred during the financial year. Completeness, here also it will be there, common, all the incomes and expenses they have recognized, nothing they have ignored. And one more thing, here they have something called cutoff. Cutoff means only those incomes and expenses which belongs to current year has been recorded in the financial statements. None of the future year's income is recorded in the current year. None of the past year's income is recorded in the current year. So all the incomes and expenses recorded in the current year belongs to current year only, not the other years. And finally, they will make an assertion regarding measurement also. Nothing but measurement means the management is trying to convey that they have shown the incomes and expenses at correct amount. See, we can say asset is valued, liability is valued, but it doesn't sound apt when I say income is valued, expense is valued. So that's why we use the term income is measured, expense is measured. But both convey the same meaning. Valuation means assets and liabilities are shown at correct amount. Measurement means P&L, that is incomes and expenses are shown at correct amounts. Clear? So these are all the assertions which will be made by management. So with this, we are successfully done with SA 500 audit evidence related part. We are done. Now we have to start discussing about audit documentation, SA 230. So what is audit documentation? First, we will start with definition. So audit documentation is defined as it is a record, it is a storage, or it is a consolidated record of audit procedures performed, audit evidences obtained, and conclusions reached by the auditor. So what is the meaning of audit documentation? It is a record of audit procedures performed, audit evidences obtained, and conclusions reached by the auditor. That collective information, we give it a name called audit documentation. A record of audit procedures performed, audit evidences obtained, and conclusions reached by the auditor, that we call it as audit documentation. And there are other names for audit documentation. We even call it working papers or work papers, or we even call it as audit file also. We even call it what? Audit file. So all these terms are interchangeably used. Audit documentation, working papers, work papers, audit file, whatever they ask you, the definition is same. It is a record of audit procedures performed, audit evidences obtained, conclusions reached. Nothing but whatever you have done in the audit, everything should be stored. For each and everything, like what procedures you have performed, by performing that procedures, what and all evidences, invoices you have seen, how you have formed the conclusions, all the things which you have done from the audit, from the beginning till the conclusion of the audit, everything has to be recorded. That recorded information only, we give it a name called audit documentation. So now what is the main purpose or objective of this audit documentation? So the main purpose is it will act as a evidence for the basis of your opinion. If tomorrow someone is coming and asking you, boss, on what basis you have expressed the opinion, now I can show the audit documentation as a evidence and tell that, sir, see the audit documentation, I have done the audit perfectly and this is the basis for my opinion. And also it will act as a evidence that auditor has planned and performed the audit as per standards on audit. If tomorrow someone is coming and asking the auditor, how can I believe that you have done the audit as per standards on audit? Now also audit documentation will come to my rescue. So in that circumstances, audit documentation will act as a evidence that there is a basis for my opinion, and also audit documentation will act as a evidence that the audit has been performed as per standards on audit. This is the main purpose or objective with which audit documentation will be given. Apart from this main purpose or objective, there are even other advantages of this audit documentation also. Like if you have audit documentation, it will assist the engagement team members to properly plan and perform the audit. In the audit documentation, if you clearly in the audit documentation, I will include who is responsible for doing which work, who has to do which area within what time. So like that, audit documentation will act as a audit documentation will act as a guideline for the engagement team members to properly plan and perform the audit. And even it will assist the members of the engagement team to direct and supervise the audit work. I can betterly direct I can betterly direct my engagement team members. I can also supervise their work if they have audit documentation. And we can even make them responsible for the work also. In the audit documentation, I will even record who has done which work. If tomorrow something has gone wrong in the audit, I can easily identify who has carried out the work in that concerned area and make him responsible. So responsibility fixation also becomes easier with the help of audit documentation. And if you maintain perfect documentation, that will help you for audit of the future years also. If I maintain perfect documentation for the current year, that will even help me to do the audit of next subsequent years also. And it will enable internal inspections and external inspections to happen. If I want to know whether my engagement team members has done the work perfectly, I can do it only if there is documentation. If there is no documentation, there is no question of review at all. Similarly, if any external inspection has to happen, like peer review has to happen, like some outsiders will come and check whether we are doing the audit properly or not. If any external inspection has to happen, then also it will happen only if there is documentation. If there is no documentation, there is no question of any inspection to happen, either internal or external. So these are various other advantages of the audit documentation. It will assist the engagement team members to properly plan for the audit. It is helpful for directing and supervising the audit work. We can easily fix the responsibility, and even it will help us for the audit of the subsequent years. It will enable both internal and external inspections to happen. And what contents should be there in the audit documentation? So it should include your audit programs or audit plans. It should include whatever analysis you are doing, issue memorandum, nothing but query sheets we call it, inquiries, formal written inquiries I told no. So that should form part of your audit documentation. Significant matters should form part of your documentation. Confirmation letters or representation should form part of documentation. Checklist, communication regarding significant matters, who reviewed the audit work, who performed the audit work, nothing but in short, whatever has been done in the audit, everything will has to go to documentation. Clear? These should be the contents. Now coming to the next concept, what are the factors which affect form, content and extent of documentation? Sir, what should be the format of audit documentation? So is there any prescribed format for maintaining audit documentation? No, the standard did not give you any prescribed format. But instead, what the standard has told is, you maintain documentation in such a format that another experienced auditor having no previous connection with this particular audit should be able to understand what audit procedures were performed, what audit evidences were obtained, what conclusions were reached, that another experienced auditor should understand just by going through my audit documentation. So if I have done some audit of the client X Limited, I should maintain documentation in such a manner that some another experienced auditor having no connection with this audit, he should be able to understand what audit procedures I have performed, what audit evidences I have obtained, what conclusions I have reached. Another experienced auditor should be able to understand just by going through my documentation. This is what the standard has simply told. They did not give any format, just they told that. That means here also if you observe, they are indirectly leaving it to the auditor's professional judgment. We are not giving you any format, boss, but try to make sure that you are maintaining documentation in such a manner that other person is able to understand how and what work you have done just by going through your documentation. And one more thing, they say that audit documentation should be prepared in a timely manner. You have to prepare the audit documentation in a timely manner. Don't delay that process of collecting audit documentation. Why? Because if you gather the documentation in a timely manner, that will increase the quality of audit documentation and even better reviews can happen. And there is one statement which is very important for true or false statements. Let me show you that. Let me show you that particular statement. Yes. So this one, documentation prepared after the audit work has been performed is likely to be less accurate than the documentation prepared at the time such work is performed. So whatever documentation that you are getting as and when the work is performed will be more accurate than the documentation which is prepared after the audit work. For example, if you are believing that first let me complete all the audit, after completing all the audit and after I express my opinion, then I will gather documentation. Another auditor thinks that no, as and when I perform the audit procedures, I should gather documentation. Which one will be more accurate? The second case. If the auditor is believing that as and when I perform audit procedures, I will gather documentation, that will be more accurate than the documentation which you gather once all the work has been completed. Why? Because if you focus on documentation after completing all the work, sometimes you yourself might miss out which areas you have done, what evidences you have checked, what evidences you have checked. You yourself will forget, so you will miss out on some key documents in the audit documentation. So that's why you have to focus on getting the documentation as and when the work is performed. Don't delay that gathering of the documentation process after the work has been completed. So this statement they can play with you in the exam. So they will give a statement that documentation prepared after the audit work is performed is likely to be more accurate than the documentation prepared at the time such work is performed. Is the given statement true? No, false. Why? Because the documentation which is prepared after the audit work is less accurate than the documentation prepared and when the work is performed. So summary is this: whatever documentation you get it as and when the work is performed, that documentation is going to be more reliable. Clear? And then finally, sir, what factors will affect how much content of documentation should be there? What amount of documentation I will have? That depends on what factors? This depends on the factors like size and nature of the entity, the risk of material misstatement, importance of the audit evidence. So all these points will make sense. If I ask you, if I tell you one simple thing, what you can write here is the factors which affect form, content and extent of documentation. Just write the factors which affect the sufficiency of audit evidence. So whatever we have read some factors now which affects the sufficiency of audit evidence. So whatever factors which affect these factors. So whatever factors which affects the sufficiency of audit evidence, the same factors will affect the form, content and extent of documentation. Why? Because see this is not this I'm not saying because a few points are matching. This I am saying it because there is a logic. Why? Because if because of some factor, if my sufficiency of audit evidence is increasing, then automatically my audit documentation also will increase. Why? Because significant part of audit documentation will be audit evidence only. Most of the information which will be there in the audit documentation is audit evidence only. So if because of some factor quantity of audit evidence is increasing, that quantity of audit evidence only will go and sit in my audit documentation. So that's automatically my audit documentation also will increase. So whatever factors which increase the sufficiency of audit documentation, the same factors will even increase the quantity of audit documentation also. Whatever factors which reduce the sufficiency of audit evidence, the same factors will even reduce the quantity of audit evidence also. So that's why if they ask you the question, what are the factors which affect the form, content of audit documentation, no need to remember any extra points. Just write down the factors which affects the sufficiency of audit evidence. Why? Because whatever factors that increase the sufficiency, they will even increase the quantity of audit documentation. Whatever factors which reduce the sufficiency of audit evidence, they will automatically reduce the quantity of audit evidence also. Understood? So now talking about few more things. The next question you will be able to find here, audit file. So what is audit file? As we all know, audit file is just nothing but a other name for audit documentation. Whatever audit documentation you have gathered for one particular client, we will try to arrange it and keep it in one proper file. That arranged documentation of a particular client, we call it as audit file. Like for example, we have done audits of some 10 companies. So in that one of the companies, A Limited, whatever documentation we have gathered for this client A Limited, we have to keep it in a separate file and arrange it. So this arranged file of audit documentation, I call it as what? Audit file. And while maintaining this audit file will be maintained in two categories. One is permanent audit file and the other one is current audit file. Now, what is this permanent audit file and what is this current audit file? I will tell you simple explanation. See, in the documentation, whatever you have gathered, if you feel that some information will not be just used in the current year, that information will have usage in the next year also. That I will keep it in the current audit, that I will keep it in the permanent audit file. Sorry. On the other hand, if I feel that the documentation, whatever I am using, that will be useful only in the current year, that documentation will not have any usefulness in the next year, that I will keep it in the current audit file. So whatever documentation which I expected to use in the next year's audit also, that I will keep it in permanent audit file. On the other hand, if I find that documentation is useful only in the current year, that I will keep it in the current audit file. And then finally, talking about assembly of final audit file. See, whenever you gather documentation, assume a team of 10 people have gone to the audit of A Limited. Now, each of the 10 team members will do their respective work. So, if 10 people are there, each person will do a part of the work. Like person Mr. X, he has done some work related to purchase and assets. Another person Mr. Y, he has done the work related to incomes and some liabilities. Another person Z, he has verified the assets. So, like this, when you as a team go and do the audit, everyone will do a part of the work. We all will have parts of documentation. Now, don't you think all the documentation which is spread across all these 10 engagement team members, that should be arranged in proper order? Yes or no? So all the documentation which is there among different people, we all should gather it, arrange it in proper order, arrange it in some sequence, delete the duplicate documents, etc. And we have to make one final file ready. Sorry. So this process of arrangement of audit documentation, that itself I call it as assembly of final audit file. So once we complete the audit, we will gather documentation. See, I'm not denying with my fact. At the time when I am doing the audit, I will gather documentation. But we all will gather documentation. Whatever documentation we have gathered, that we need to arrange it in proper order. That process we call it as assembly of final audit file. And when this assembly process has to happen? At the time of audit or after completing the audit? After completing the audit, you should do that assembly. Listen carefully. Documentation gathering will happen as and when the work is performed. What I am saying is arranging. This arranging of entire documentation will happen when? After the completion of the audit. I'm not denying my fact here. I told in the previous answer, you have to gather the documentation as and when the work is performed. Yes, I still stand on my words. You have to gather the documentation at the time of performing audit procedures only. But what I am saying is this arrangement of the documentation, arranging all the evidences in a proper order, arranging the folders, moving it out to respective folders, keeping it one proper sequence. This assembly process should happen after the completion of the audit. And that process we call it as what? Assembly of final audit file. Sir, is there any time limit within which this assembly process has to be completed? Yes. Standard SQC 1 says that the assembly of final audit file should be completed in not more than 60 days after the date of auditor's report. Within how many days that assembly process should be completed? From the date of auditor's report, within 60 days, this arrangement of the audit file should be completed. Why? Because if you don't give any time limit, what will happen is next year's audit also will be over. Last year's audit file will not be prepared. So ICAI is having a lot of confidence on its members. So what they have told us, we are giving time limit within 60 days from the date of audit report. You have to arrange and assemble that final audit file. And this 60 days is the requirement. 60 days of time limit is given where? SQC1. Very important. Sometimes they will ask an MCQ question. The auditor is required to complete the assembly of final audit file within 60 days as per which standard? In the options, they will give SA 230, SQC1, SA 500, etc. etc. Now, the moment you look at the question regarding audit documentation, immediately you will go and mark SA 230. But SA 230, yes, SA 230 is talking about audit documentation. But SA 230 did not give time limit for assembly. Time limit for assembly is given under SQC1. So you have to choose the option as SQC1 only. So the point which I want to make here is SA 230 definitely talking about audit documentation, but the time limit for assembly, the 60 days of time limit was not given in SA 230, it was given in SQC1. And when you are assembling this audit file, do you perform any new audit procedures there? While performing this assembly process, while you are arranging audit file, will you perform new audit procedures? Or will you form new conclusions? No. Assembly of final audit file do not involve any performance of new audit procedures, or it does not involve forming any new conclusions. It involves only administrative work. We will not perform any new audit procedures or will not form any new conclusions while assembling the final audit file. We only do what? Administrative work. Like what kind of administrative work, sir? If you find any duplicate documents, deleting it, or sorting, arranging the audit documentation, collating it, gathering it, referencing working papers, nothing but giving the page numbers, and also signing of the documents. These kind of administrative work only will happen at the stage of assembly. We will not perform any new audit procedures. We will not form out any new conclusions. And once you have assembled all the final audit file, can you delete or discard it? Can you throw it away? No. That whatever audit file which you have prepared, that has to be retained. For what duration? So the audit documentation has to be retained for a period of 7 years from the date of auditor's report or the group's audit report, whichever is later. So from the date of audit report, you have to retain that documentation for how many years? 7 years. This 7 years of retention requirement is also the requirement of SQC1. And now you have an audit file ready. No, this is whose property? Ownership. Let us come to the main point, ownership. So whatever audit file which we have created, that is whose property? That contains whose information? Client's information. Then it is whose property? Auditor's property. Agreed, it might contain the client's information, but who gathered it? Auditor. Who performed audit procedures? Auditor. So it is whose property? Audit documentation is a property of auditor. If the client is coming and asking the auditor to share the copies of audit documentation, is the auditor under an obligation to share it? The answer is no. The auditor is under no obligation to share the documentation with the client. It is up to his discretion. The standard has given exclusive ownership to the auditor. Standard is saying you are owner. It is your choice. If you want to give the copies of documentation to others, do it. If you don't want to give it, don't do it. That is completely your choice. There is no compulsion except if there is a legal or regulatory requirement. If there is any legal or regulatory requirement, then also you should not do all this overaction that it is my property, I will not share it. All these things you should not do. If there is a legal or regulatory requirement, you have to share the copies of documentation. Other than legal or regulatory requirement, if somebody else is coming and asking you to share the documentation from you, you are under no obligation to share the documentation. It is completely your discretion. It is completely your choice. There is no compulsion. Clear? So this is what regarding audit file, its retention, ownership. Now few more small concepts are there. Let us try to cover it. Number one, what is audit notebook? So audit notebook, like this one particular small concept is there. See, audit notebook is one simple bound book which will be given to each and every engagement team member for the purpose of two purposes. Number one, you get lot of doubts during the course of audit. If you don't write it anywhere, there is a chance of forgetting that doubts. So that's why whatever doubts which audit staff are getting, they have to write all that doubts in that notebook. And whatever questions you have recorded in the audit notebook, even you should write their responses also. That means whether the question is resolved or not yet resolved. If you write the question as resolved, by looking at what information you got, this doubt is resolved, that evidences seen also should be written in that audit notebook. So every client will be given a notebook, and in that notebook, what auditor should do? Number one, whatever queries you are getting during the course of audit, all that queries should be recorded. Not just the questions, that status of that questions, whether they are resolved or not yet resolved. If they are resolved, you have to write the responses also, how it has been resolved. If it is unresolved, so that you will not forget it, you will keep on following up with the client till the time you complete the audit. And one more purpose why this audit notebook will be used is to record the status of the work each day. Every day how much work you have completed, that status of the work should also be recorded in the audit notebook. Why? Because if the work is stopped temporarily, or if the article assistant is away from the work, and if this work has to be taken by another staff, I have allocated work to one of the person. Now that person has become sick, that work has to be taken up by another person. If that another person don't know where the previous article assistant has stopped the work, he has to start once again from the beginning. So that will be a double work, no? So that's why what you have to do is, what every member of the engagement team should do is, in the audit notebook, they should update every day what status of the work they have done, so that if the work is stopped temporarily, or if this work has to be assigned to another person, that another person will not once again start from the beginning. He will refer the audit notebook, get the status of the work, and he will resume the work from that point of time only. So that is the two purposes of the audit notebook. So for recording queries, and also it will provide links of work when the work is stopped temporarily, or when the concerned assistant is away from the work. And whatever audit notebook that has been given to you, that you should not carry, that should form part of your audit notebook, that should form part of your audit documentation, and generally it will go to current audit file only. Why? Because audit note will contain only questions etc., which might not be useful for the next year. And you should not show your misery here. For every year, a fresh audit notebook has to be maintained. For every year, for every client, a fresh audit notebook should be maintained. So one more concept will be there, audit documentation summary or completion memorandum. Let us have a look at it also. So in big audits, in big and large and complex audits, you will have one detailed audit documentation. But in addition to that, from all this documentation, you have to identify significant matters, and how you have addressed that significant matters, even you have to keep one summary also. Like for example, if you are doing audit of Reliance Industries Limited, the documentation will be some 3,000-4,000 pages. If in future, if you have to reuse a documentation, if you need one document in the future year, now you can't keep on scrolling through that 3,000-4,000 pages of audit documentation. So that's why in big and large companies audits, what we do is we will have a detailed version of documentation which contains some 3000 4000 pages. But in addition to that, from all this documentation, I will find out the key matters in this documentation and how I have addressed that key matters, key issues in that audit. I will prepare one more summary also, which contains some 300 400 pages. So that I call it as that summarized content, that key matters, significant matters from the audit documentation and how they were addressed. I will try to keep one more summary, that summarized version. I call it as audit completion memorandum or audit documentation summary. Understood? That's all. So audit documentation summary is nothing but it is a part of documentation which contains a summary of significant matters and how they were addressed. And generally we keep it only for large and complex audits. We don't keep it for small entities. For small entities, documentation itself will be very less. There also you don't need detailed documentation, summarized documentation, all that you don't need it. So that's why we keep it only for large and complex audits. And it will help you, this preparation of summary will assist the auditor in considering the significant matters, and also it will help you to find out whether all the standards are complied with or not. Normal advantages of audit documentation only. Now we have one more last question which needs to be revised from this particular chapter, which is also a general question, nothing but explaining the concept of true and fair view. As we all know, true and fair view is a fundamental concept on auditing. Why? Because the auditor himself has to express an opinion whether the financial statements are giving true and fair view or not. Sir, but how to say whether, how to define true and fair view, sir? How to know whether there is true and fair view or not? Is there any hard and fast rule? No. So the term, the what constitutes a true and fair view is a simply matter of auditor's professional judgment. It is not stated anywhere what exactly is this true and fair view. It all depends on auditor's professional judgment. So we can't define what exactly is true and fair view. It has to be decided by auditor himself on the basis of his professional judgment. But if someone asks you specifically, boss, tell me exactly what you will verify to know whether there is true and fair view or not. So if someone specifically asks me what things I will check to make sure that financial statements are giving true and fair view. So like this, some examples I can state here. I will check that now assets should be neither overvalued or undervalued. That means all the assets should be shown at correct amount and no asset should have been omitted from the books of accounts. If there is any charge on the assets, if any of the assets are given as security, that should be properly disclosed. Similarly, liabilities should not have been omitted. Balance sheet and P&L should give all the disclosures as required by applicable financial reporting framework. Accounting policies should have been followed consistently and all unusual, exceptional, non-recurring items, nothing but all extraordinary items should have been disclosed separately. Do you think is it a full and final list of points which I will see to know whether there is true and fair view? No, this is not full and final list which we will check. These are just examples, illustrative examples which we will check in order to know whether the financial statements are giving a true and fair view or not. So these are what some illustrative examples which we specifically see to know whether the true and fair view is there or not. That's all. This is what regarding the chapter audit, documentation and evidence revision. We'll be revising the standards on auditing chapter. So as you all are aware, this standards on auditing chapter is such an important chapter where a significant amount of weightage will be there in your examination, and conceptually also it is going to be very important. So that is what going to be the agenda for this video. So we will be doing one quick and perfect revision of the standards on auditing. So first, let me put before you what are the standards which I am going to revise in this particular chapter. So there are 10 standards which are forming part of this chapter. So if you see the index here in the material, see, as we all are aware, the entire syllabus of CA Inter has been taken from standards. If not entire syllabus, so minimum 80% of syllabus, whatever we are reading in the CA Inter auditing and assurance, 80% of the syllabus has been taken from standards only. The remaining 20% of the syllabus has been taken from laws and regulations and other practical concepts. Like if I say, when we discuss the chapter nature, objective and scope of audit, so that nature, objective and scope of audit is in fact taken from two standards, SA 200 and SA 210. When I say I will teach you audit reporting chapter, there also I will teach you some standards on auditing only, like 700 series of standards, SA 700, 701, 705, 706. So like this, whatever chapters which are there as a part of our curriculum, those chapters are actually taken from standards only. But there are some 10 standards which are not covered in any other chapter, which we need to have a exclusive discussion. How many standards are there which are not covered anywhere else in any other chapter? So there are some 10 standards on auditing which will not be covered as a part of any other chapter, which we need to have a dedicated discussion. So those are 10 standards which need a dedicated discussion, which will not be covered in any other chapter. Those 10 standards are forming part of this particular chapter, standards on auditing. And what are that 10 standards which are not covered anywhere else in this anywhere else in any other chapter? That list I have given here: SA 220, SA 250, SA 501, 505, 510, 550, 560, 570, 580 and 710. So these are the 10 standards which will not be covered anywhere else, which we need to have a exclusive discussion, exclusive revision here. So these are the 10 standards which I am going to revise. Very important concepts from the examination perspective. You can expect a minimum of 10 marks, and if a case scenario based MCQ gets tested, you can easily score some 15 marks out of this 10 standards revision. So I will try to cover all the key concepts within the limited time available, and also I will make sure that we are not leaving out any significant things from this particular revision. So without any delay further, let us directly jump into the discussion. Let us directly jump into the revision part. So first I will start with SA 250. First we will revise SA 250. And one more thing before I take up any discussion further. So if you want to download the material which I am displaying here, so please check the description below, or description for this video. There I have given detailed instruction how you can download and how you can get access to this material, which is completely free. So if you want to have access to this material which I am displaying you here on the screen, so check the description below, or check the description of this video once. So now let us without any delay further, let us directly come to our discussion. So first we'll be revising SA 250, which is about consideration of laws and regulations in audit of financial statements. And one more thing, before we go into discussion of these standards, I want to do one quick revision of standard setting process, how the standards will be set. So this discussion is very important for MCQs. For MCQs and true or false statements, this discussion might be very important. So first I will revise the standard setting process. So actually the standards on audit are the thing which we follow in our country, but the content of the standards on auditing has been adopted from something called international standards on auditing. At India level, we have something called standards on auditing, and the content has been adopted from international standards on auditing. Now, first, who will issue this international standards on auditing? So we have an association called IFAC, International Federation for Accountants. It is a global association. So there is a IFAC, International Federation for Accountants, and this IFAC has created a board called AASB, Auditing and Assurance, IAASB, sorry, International Auditing and Assurance Standards Board. And this IAASB will issue high quality standards called ISA, International Standards on Auditing, which are applied, which will be accepted across the world. So these are international standards. IFAC has created IAASB, and that IAASB, under this guidance of IFAC, they will release something called International Standards on Audit. This is at the global level. Now talking about at the India level, the role of IFAC will be played by ICAI, Institute of Chartered Accountants of India, and they have created something called AASB, Auditing and Assurance Standards Board, and this AASB will issue standards on auditing which we follow in India, which are actually adopted from international standards on auditing. And the numbering also will be same, the standards numbering will be same, the content of the standards also will be same, almost the same. 95% of the content is same. Why? Because across the world, wherever you do the auditing will not change. Wherever in the world you do the audit function remains the same, independent examination of financial information. So even numbering is also same. We have SA 200, overall objectives of an independent auditor and conduct of an audit in accordance with the standards. Similarly, we have ISA 200 with the same title, with the same content. We have at India level SA 230 audit documentation. At the international level, we have ISA 230 once again audit documentation. So this is what the standard setting process. This is how the standards will be set. So that's what will be the introductory discussion here. So IFAC has been created. This IFAC is working with the objective of bringing harmony in accounting and auditing profession, not just in one country, at an international level. And they will issue high quality standards, and by creating International Auditing and Assurance Standards Board, which is IAASB, and their objectives are given here. And at our India level, the role of IFAC will be played by ICAI, and they have created something called AASB, and they are giving this standards on auditing in our country. And talking more about this functions of ICAI, whatever documents which are released by ICAI, they will fall under two categories. One is statements and the other one is guidance notes. Whatever documents which are released by ICAI, they fall under two broad categories. One is statements, other one is guidance note. The differentiating factor between the two is statements are something whose compliance is mandatory in nature. Statements are those documents which are released by the institute whose compliance is what? Mandatory. They are to be compulsorily followed. Whereas guidance notes covers those documents whose compliance is recommendatory in nature. Whose compliance is what? Recommendatory. They are not hard and fast rules which everybody should follow. They are just what? Recommendatory in nature. So when I say recommendatory, here there is one thing which we need to be very focused, which is very important for true or false statements. Sometimes they might ask you a question, guidance notes are recommendatory in nature. All guidance notes are recommendatory in nature. If they ask you this kind of question, the true or false statements, you have to write the answer as false. So just now you told guidance notes are recommendatory, but guidance notes are generally recommendatory in nature, except a few guidance notes which are mandatory. The general nature is what? Recommendatory. But there are some two guidance notes whose compliance is what? Mandatory in nature. So that's why if they ask you the question in the exam as a true or false statements, all guidance notes are recommendatory. What should be your answer? The answer should be false. Generally, guidance notes are recommendatory in nature, except a few guidance notes whose compliance is what? Mandatory. So that's how the documents given by ICAI will be divided. One is statements whose compliance is mandatory, and other one is guidance notes whose compliance is recommendatory in nature. Now, standards will fall under which category? Statements or guidance notes? Standards will fall under statements category. Why? Because compliance of standards is mandatory in nature, not recommendatory. So, standards will fall under statements category. Now, coming to the standards, in the standards also, there are different kinds of standards relating to auditing work which ICAI has released. So what are the different kinds of standards which are given by ICAI? So this chart has been given here, but let me try to summarize quickly. So there are four kinds of documents which are given by ICAI, that to standards category. One is SA, standards on auditing. Other one is SRE, standards on review engagements. Other one is SAE, standards on assurance engagements. And finally SRS, standards on related services. So how many are there? Four are there. What are they? Standards on auditing, standards on review engagements, standards on assurance engagements, standards on related services. Now it is very important for us to understand what does this each kind of standard deal about. What do you mean by audit engagement? What do you mean by review engagement? What do you mean by assurance engagement? What do you mean by related services? Talking about standards on auditing, they become applicable whenever audit of historical financial information is conducted. Being an auditor, if someone appoints us to do the assignment, to do the engagement of audit, that too of historical financial information, then standards on auditing we have to comply with. So standards on audit will become applicable when we are associated with engagements of audit, that too of historical financial information. Now talking about SREs, standards on review engagements will become applicable whenever we are associated with review of historical financial information. Which engagement? Review. Now, what is the difference between audit versus review? So, what is the difference between audit versus review? Audit is a reasonable assurance engagement, which we all know, whereas review is a limited assurance engagement. One new terminology. Audit is a what kind of engagement? Reasonable assurance, whereas review is a what? Limited assurance engagement. As we know, reasonable assurance is a high level of assurance, but not absolute assurance. Now, review is even far lesser than reasonable assurance. In review assignment, we don't even get reasonable assurance also. We get only limited assurance. Like for example, if I have to give you one example of review engagement, I will say quarterly financial statements of listed companies will be verified by the auditor, but that verification we don't call it as audit, that verification we call it as review. Why? Because there the scope of auditor's verification is very limited. He will not even check the supporting documents also. He will check whether quarterly financial statements are presented properly or not. That's it. So whenever you are doing assignments like review of historical financial information, then SREs will become applicable. Assurance will become applicable. SAs will become applicable when you are doing assignments, when you are associated with other than historical financial information. When you are doing some work which is related to not historical financial information, which is related to prospective financial information, future financial information. Sometimes as an auditor, we might be required to deal with future financial information, prospective financial information of the company. So whenever you are doing some work which is not related to historical financial information, but in fact related to future financial information, then SAEs will become applicable. Whereas SRS, standards on related services, they become applicable when we are providing related services, or alternatively we can call it as when we are providing agreed upon procedures. When we are providing what? Agreed upon procedures. Being a chartered accountant, we need not always do only verification checking work. Sometimes we perform agreed upon procedures also, like preparing financial statements of the company, etc. So when you are providing related services other than verification work, when you are performing agreed upon procedures, then which standards become applicable? SRS will become applicable. So like these four kinds of standards are given by ICAI. Everything will become applicable depending on the engagement which you are doing. And all these four standards will be collectively called as engagement standards. So when they say engagement standards, what and all they are referring to? Engagement standards include SAs, SREs, SAEs, SRS. So collectively all the four will be called as what? Engagement standards. Now whenever any of this engagement is performed, be it audit, be it review, be it assurance, be it related services, one more kind of standards will be applicable, which we call it as SQC. What do we call it? SQC. What is the meaning of that? Standards on quality control. And they become applicable when you are doing any of the above engagement, be it audit engagement, be it review engagement, be it assurance engagement, be it related services. Whenever you are doing any of the above four engagements, one more series of standards will become applicable, which is what? SQC, standards on quality control. Now what is the purpose of SQC? So they ensure quality in the engagements whatever auditor is doing. Any audit engagement, any review engagement, any assurance engagement, whatever you are doing, there is a requirement to maintain the quality in that engagements. So SQC will help the auditor to ensure the quality in the audit engagements or any other kind of engagement. So these are different kinds of standards given by ICAI: SAs, SREs, SAEs, SRS and SQC, and each one will become applicable depending on the kind of engagement which you will be doing. So this is what key information regarding standard setting process. This information might not be that relevant for descriptive questions, but this is highly important for answering MCQs and true or false statements. So this is what the standard setting process. Now let us try to start discussing the standards itself. So we will start with now SA 250. Let us go to it. So SA 250, as you could see, the title of the standard: consideration of laws and regulations in an audit of financial statements. So as the title itself says, SA 250 is going to talk about laws and regulations while you are conducting audit of the financial statements of the client. So as we all know, as a part of audit, sometimes we are required to check the statutory compliances also. What we even need to check? Statutory compliances also we need to check. Like for example, whether your client is complying with all the laws and regulations or not, that also will form part of one of the scope of the auditor. So now this standard is going to explain in detail what will be auditors' responsibilities regarding laws and regulations while conducting audit of the financial statements. Now, which laws and regulations this standard is talking about? Is this standard talking about those laws and regulations which is auditor's responsibility to comply, or is it talking about those laws and regulations which is management's responsibility to comply? So this standard is talking about those laws and regulations which your client's management has to comply with. Like for example, if you are conducting audit of some company, assume Reliance Industries Limited. As we all are aware, when any business is being run, they need to do the business after complying with so many laws and regulations. Yes or no? So that is what the laws and regulations we are referring to. So this particular standard is talking about the auditor's responsibilities relating to laws and regulations which your client has to comply with. Which who has to comply with? Your client has to comply with. So now let us go into the technicalities of the standard. Let me ask you one simple question first. It is whose primary responsibility to comply with the laws and regulations? If you are conducting audit of the company Reliance Industries Limited, who is primarily responsible to make sure that the company is complying with all the laws and regulations? It is not auditor's responsibility. It is not auditor's primary responsibility. It is always the primary responsibility of the management of your client to make sure that their entity is complying with all the laws and regulations, and to identify any non-compliances. These primary responsibility always and always rest with management. So point number one, the primary responsibility to comply with all the laws and regulations is with management. So now what about auditor's responsibility, sir? Let us come to the point now. So can you expect auditor to prevent all non-compliances? If you are appointed as auditor of a company, can the shareholders or can the management expect the auditor to make sure that the client company is complying with all the laws and regulations? Can they make sure? No. So auditor cannot be expected to prevent the non-compliances. Very good. Can the auditor be expected to detect all non-compliances? No. So auditor cannot be expected to prevent the non-compliances. At the same time, auditor cannot be expected to detect all non-compliances. So does that mean auditor will not be held responsible at all if it didn't find non-compliances? No. Then what about auditor's responsibility, sir? For that only we are reading this standard. That is what the objective of this standard. Clear what I'm trying to say? So auditor is not responsible for preventing all non-compliances. He is not even responsible for detecting all non-compliances. Then what is auditor's responsibility, sir? That's what this standard is going to talk about. So now what does this standard say about auditor's responsibility? So what this standard has done is, for the purpose of discussing auditor's responsibility, the standard has divided laws and regulations into two categories: type 1 laws and regulations and type 2 laws and regulations. For the purpose of auditor's responsibilities, this standard has divided laws and regulations into two categories: type 1 laws and regulations and type 2 laws and regulations. Type 1 laws and regulations are those laws and regulations which have a direct effect on determination of amounts and disclosures in the financial statements. Which laws will come under type 1? Those laws and regulations which have a direct effect, which are going to directly impact the amounts and disclosures in the financial statements, they will come under type 1. Sir, any examples for this kind of type 1 laws and regulations? Yes, there are plenty. If you ask me, Companies Act 2013. Companies Act 2013 is going to have a direct impact on determination of amounts and disclosures in the financial statements. If the company is preparing financial statement, which format they follow? Schedule 3. Where Schedule 3 was mentioned? Companies Act. So Companies Act is going to have a direct impact on determination and amounts of financial statements. Next, not just that, Income Tax Act, tax provision which you calculate, from where the tax provision will be calculated as per the provisions of Income Tax Act. And also employee benefit related laws and regulations like gratuity, bonus, PF. So like that, those laws and regulations which have a direct effect on determination of amounts and disclosures in the financial statements will come under type 1 laws and regulations. Now what about type 2 laws and regulations? So type 2 laws and regulations are those laws and regulations which do not have direct effect on determination of amounts and disclosures. They are not going to directly affect the amounts and disclosures, but compliance is required. even though they don't have any direct effect on determination of amounts and disclosures, but compliance with this laws is also required. Why compliance is required, sir? Either to avoid penalties. If you want to avoid penalties, you have to comply with this law, or these laws are so fundamental to continue business. So what will come under type 2 laws and regulations? Like as we could see in the standards content itself, other laws and regulations that do not have direct effect on determination of amounts and disclosures. But compliance is required because they might be fundamental to continue the business. Or if you want to avoid major penalties, you need to comply with them, even though they don't have direct effect on determination of amounts and disclosures. Sir, any examples for this? Yes, here also there are plenty. Like let me give you example of pollution related laws and regulations. Assume you are a manufacturing entity. If you don't comply with pollution related laws and regulations, what will happen? Either you are supposed to pay a major amount of penalty, or sometimes the government authorities will come and seal your premises. So this pollution law is not having direct effect on determination of amounts and disclosures. But if you don't comply with them, what will happen? Either you might be required to close your business, or you have to pay huge amount of penalties. Or environmental related laws and regulations, or child labor related laws and regulations. So those kind of laws and regulations will come under type 2. Understood? So for the purpose of auditor's responsibilities, this standard has divided laws and regulations into two categories: type 1, type 2. Type 1 which have direct effect on financial statements, type 2 which do not have direct effect but compliance is required if you want to avoid penalties, or these are fundamental to continue your business. Now what is auditor's responsibilities regarding type 1 laws and regulations? The standard says regarding type 1 laws and regulations, the auditor's responsibility is to obtain sufficient and appropriate audit evidence. What is auditor's responsibility regarding type 1 laws and regulations? To obtain sufficient and appropriate audit evidence, to perform in-depth audit procedures, treat it like any other item of financial statement, perform in-depth audit procedures, and try to obtain sufficient and appropriate audit evidence regarding their compliance. Whereas when it comes to type 2 laws and regulations, here auditor's responsibility, the standard says perform only limited audit procedures or specific audit procedures, anything you can say. So when it comes to type 2 laws and regulations, you need to perform only limited audit procedures or specific audit procedures. Sir, what are the specific audit procedures or limited audit procedures, sir? That is mentioned in the same standard itself. So standard is saying for type 1, perform in-depth audit procedures. For type 2, perform limited audit procedures or specific audit procedures. Sir, what are that specific or limited audit procedures? That is given in the standard itself. So what are that specific audit procedures for type 2 laws and regulations? Sometimes they might ask you in the question, what are specific audit procedures for other laws and regulations? So the point which I want to make here is, even if they ask you type 2 laws and regulations, or even if they ask you other laws and regulations, both convey same meaning. Other laws and regulations or type 2, both convey same meaning. So what are the specific audit procedures for type 2 laws and regulations? See here, specific audit procedures are very simple. Only three things they will say. That is also inquiry only. Number 1, you have to inquire with management and where appropriate, those charged with governance. Like you want to know whether company has complied with pollution related laws and regulations. Since it is a type 2, you need to perform only limited audit procedures. So what is the first limited audit procedure? Go to the management and those charged with governance and inquire with them. So did you comply with all the type 2 laws and regulations, or did you make any non-compliance? Inquire. Second one, inspecting correspondence, if any, with licensing or regulatory authorities. Nothing but check whether any notices has been received from regulatory authorities, like any pollution department sent you notice. So like that, check whether any correspondence, whether any communication is happening from licensing or regulatory authority. If there is any in-house legal counsel, if the company is having internal legal department inside their company, go and inquire with entities in-house legal counsel. So if you want to, regarding type 2 laws and regulations, you need to perform only 3 limited audit procedures or specific audit procedures. What are they? One is inquiry with the management, check any communication happened with the licensing or regulatory authorities, and also inquire with entities in-house legal counsel. Whatever internal legal department is there, whatever internal legal team is there, go and inquire with them. That's all. Your responsibility is over. Regarding what? Type 2. But when it comes to type 1, auditor has to treat it like any other ordinary item of financial statements and perform in-depth audit procedures. Clear? Half of the standard we have revised. So that's what the objective of the standard. If you read the objective of the standard, number 1, to obtain sufficient and appropriate audit evidence regarding those laws and regulations which have a direct effect, nothing but type 1. to perform specified audit procedures regarding type 2 laws and regulations, nothing but other laws and regulations. And whatever your findings are there, you have to report them. You have to respond appropriately to non-compliance. If you find any non-compliances with either type 1 or type 2 laws and regulations, you need to respond appropriately. Sir, how to respond appropriately? How to report them appropriately? Before we talk about reporting them appropriately, you need to know the definition of, sir, what is non-compliance? What is non-compliance? I will simply say not following laws and regulations, we call it as non-compliance. But technically they have given definition. How the term non-compliance has been defined: act of omission or commission. You are not doing something, or you are doing something, act of omission or act of commission, either intentional or unintentional, either you are doing it intentionally or unintentionally, which are contrary to prevailing laws and regulations. Very simple. You are not doing something, or you are doing something, either intentionally you are doing or not doing, or unintentionally you are doing or not doing, and whatever you are doing or not doing, that is against to laws and regulations. If you do something or if you don't do something as per laws and regulations, that we call it as non-compliance. And when I say entity made a non-compliance, company made a non-compliance, what do you mean by company making a non-compliance? How can company make non-compliance? A company's building, will it go and do non-compliance? No. Company making non-compliance means in the name of the company, either management, employees, those charged with governance, they are entering into transactions on behalf of the company. That is what we call it as a non-compliance made by company. Clear, everybody? So this is what the meaning of non-compliance. Now let us come to the most important part, reporting requirements. As an auditor, if you find any non-compliance, to whom you have to report, how you have to report. First thing, you have to report the non-compliance to those charged with governance. You have to report non-compliance with whom first? Those charged with governance, top level management. So if you believe that as an auditor, if you believe there is a non-compliance with the laws and regulations, first you have to communicate the matter with those charged with governance as soon as practicable. If you came to know about any non-compliance, first immediately go and report with those charged with governance. See, if low-level employees committed non-compliance, if you report it to top-level management, then it will be of some purpose. What if top-level management themselves are involved in the non-compliance? What if the top level management themselves did the non-compliance? Then what you should do? Let us see what they are saying. If the auditor suspects that management or those charged with governance themselves are involved in the non-compliance, then the auditor shall communicate the matter to next higher level of authority. If you came to know the management itself committed non-compliance, determine whether any next higher level of authority is there. If exists, generally it will not exist. Why? Because beyond those charged with governance, there will be no top level management. If you find any, report it to next higher level of management. Sir, what if no higher authority exists? Or I am confused, sir, I don't know whom to report this matter. Why? Because top level management themselves are involved. Then the standard says you have to obtain the legal advice. What the standard will say? Obtain legal advice. Very simple, guys. You have to report to those charged with governance. But if you came to know the top level management themselves are involved in the non-compliance, then what you should do? Determine whether any next higher level of authority is there. If it exists, report to them. What if there is no higher authority, or if the auditor is confused to whom to report? Then what he will do? He will need to obtain legal advice. You have to go and consult some legal expert like a lawyer. He will let you know what to do. In addition to communicating with those charged with governance, you need to even consider modifying your opinion in the auditor's report. So how it will impact my opinion? Let us try to summarize it in the form of a chart. So impact on auditors reporting. So here the standard has divided into two circumstances. When you obtain sufficient and appropriate audit evidence and concluded that there is a non-compliance. You have obtained audit evidence, and on the basis of that evidence you came to know that yes, company has not complied with some laws and regulations. Now the auditor need to check one thing, whether adequate disclosure given in financial statements, no disclosure given in financial statements. If the management did some non-compliance and they gave proper disclosure in the financial statements, they did not hide anything from the shareholder. They have clearly told these and these laws we have not complied, this much penalty we have paid. Management did not hide anything. Clearly they have given disclosure in the financial statements. The standard says give unmodified opinion only. Give what? Unmodified opinion only. Whereas if you came to know that management, if you came to know that the company has made some non-compliance, but management hidden it in the financial statements, management did not disclose this to anybody. Now tell me, financial statements are containing a misstatement or not containing a misstatement? Obviously, financial statements are containing a misstatement. They are misleading. Management did not disclose. They have hidden it. Now what the standard says is, if there is no disclosure given, directly give the modified opinion. And which kind of modified opinion, sir? Since it is a case of availability of audit evidence, you have to give either a qualified opinion or adverse opinion. Why? Because I told auditor is having evidence. The other case which could be possible is auditor unable to obtain audit evidence. Auditor unable to obtain audit evidence is not in a position to get the evidence to conclude whether laws and regulations are complied or not. He was unable to get evidence. Now what he should do? So now the standard will directly say give the modified opinion. Now which kind of modified opinion, sir? Which kind of modified opinion? Disclaimer. Not only disclaimer, you have to give either qualified or disclaimer. If the possible effect of that non-compliance is only material, I will give qualified. If the possible effect of that non-compliance is material and also pervasive, I will give disclaimer. Here also, when I have evidence and I concluded that non-compliance is there, the effect is only material, qualified. If I know that effect of non-compliance is material and pervasive and I have evidence, I will give adverse. Clear? So in addition to reporting to those charged with governance, in this manner, you need to consider the impact on opinion also. Finally, in addition to that, determine is there any requirement on you to report the non-compliances to regulatory and enforcement authorities. Like in case if you are conducting audit of a bank, in addition to reporting to those charged with governance, in addition to mentioning that in your auditor's report, you even need to communicate this matter to RBI. So determine whether there is any reporting requirements on you to report that matter to regulatory and enforcement authorities like RBI, etc. So this is what the reporting requirements. Now the standard has given one more information. They have given you some indications, some events which give a hint to the auditor that there could be non-compliance. These are not something that compulsory. If you find these indicators, that doesn't mean compulsorily there is a non-compliance. These are just what indicators which give a hint to the auditor. Boss, these kind of things have happened. Please be aware. There could be non-compliance. Nothing but auditor should become more aware when he comes across these indicators. What are they? Investigation. Recently, some regulatory authority or government authority came and did the investigation. That is a clear thing that is a clear factor which is giving hint to the auditor that there could be non-compliance. Or the company is making payments for unspecified services to the consultants like lawyers, related parties, government employees, etc. Or the company is able to purchase the products at significantly higher or below the market price. When each and every of your competitor is paying a certain price, you are either procuring it at very lesser price or you are procuring it at a very higher price. Indicator of non-compliance. Unusual payments in cash, huge cash payments, or unusual payment towards legal and retainership fees. The client is paying huge amount of fees to the lawyers. Unusual transactions with companies registered in tax havens. The company is having transactions in the tax havens. Recent case, Adani. This is what happening in the Adani. So in the Hindenburg report, they have told that Adani is having transactions with the tax havens like Mauritius. They have some 30 companies incorporated in Mauritius. These are the allegations made. So if your client is having transactions in the tax havens, tax-free jurisdictions like Mauritius, that is also indicator of non-compliance. And payments without proper documentation, no supporting documents are there for the payments, unauthorized transactions, improperly recorded transactions, or some bad news is circulating in the media regarding your client company. So if you come across any of these indicators, you should become extra aware that there could be a possibility of non-compliance and become cautious and do the audit. This is what SA 250 is talking about. So successfully we are done with revising the standard SA 250. Now let us start revising the next most important standard. I will give it a top priority. Out of the 10 standards, I will give it a top priority when it comes to importance from the examination perspective. So the standard which we will be revising now is SA 501. So what does this SA 501 deal about? So as you could see, SA 501 is a standard which is talking about audit evidence. But you all might get a doubt. So we already have a dedicated standard talking about audit evidence, which is SA 500. So SA 500 is a dedicated standard talking about audit evidence. Now I am saying SA 501 is also a standard talking about audit evidence. What is the difference between the two? The difference is SA 500 is a general standard talking about overall audit evidence in general. SA 501 is a standard talking about audit evidence, and it is providing guidance to obtain audit evidence regarding three selected items. Special standard, I will say. So SA 500 is a general standard talking about overall audit evidence in general. Whereas SA 501 is a specific standard talking about audit evidence only, but it provides guidance only regarding three selected items. Sir, what are that three items regarding which SA 501 is giving guidance? So, as you could see the objective here, the objective of the auditor is to obtain sufficient appropriate audit evidence. But regarding what? Regarding three things: existence and condition of inventory, completeness of litigations and claims involving the entity, and presentation and disclosure of segment information. So three items which SA 501 is talking about is inventory, litigations and claims, then segment information. So let us try to understand, let us try to revise now how to obtain evidence regarding existence and condition of inventory, how to obtain evidence regarding litigations and claims, how to obtain evidence regarding segment information, and what SA 501 provides the guidance here. So first we will start with existence and condition of inventory. How you can obtain audit evidence regarding inventory. As we all know, inventory is a significant item in the financial statements. So how you will come to know whether the inventory value stated there is correct or not. How you can get to know about it. How you will obtain audit evidence. So the standard also says whatever common sense we have. So if you are an auditor, tell me out of your common sense, if you want to know whether inventory is correct or not, what you will do? What I will do? I will try to do physical verification. That's what even the standard says. The auditor should try to obtain evidence regarding existence and condition of inventory by doing physical verification, not directly doing, by attending the physical verification whenever it is done by the management. So management will be responsible for doing physical verification of the stock. They will do it once in every year. Most of the companies will do it also on the balance sheet date. So whenever management is doing the physical verification of their stock, auditors should go and attend that physical verification. That is the first step. Whenever the management is conducting physical verification, they will let the auditor know about it. Auditor should go and attend that physical verification process. What he should do by attending there, sir? See what they are saying. So you have to attend that physical inventory counting to and evaluate what are the management's instructions and procedures for doing that physical verification. First sit and analyze, first sit and understand what instructions, what procedures management is following for doing that physical verification. Then sit and observe whether they are doing the counting properly or not, whether they are doing that physical verification properly or not. Sit and observe. And also, if you are feeling bored by sitting there continuously, you go and inspect the quality of the stock. And even if you are feeling more bored, go and do the test counts also. Nothing but on sampling basis, you also try to count some inventory. And finally, check as a part of that physical verification whether they match with the quantity as in the books of accounts. That's what the main purpose of physical verification. No, we do it to know whatever stock that is lying there physically at the warehouse, whatever stock that is lying there in the books, both are matching or not. Find it out. That's what the first step. So auditor should obtain audit evidence regarding existence and condition of inventory by attending inventory counting process done by management, and by attending there, evaluate, understand what are management's instructions and procedures, observe how they are counting, inspect the quality of inventory, and you also perform some test counts. Next one. And even check whether the stock is matching with the books or not. Sometimes what will happen is the management will do physical verification, but not as on the balance sheet date. They will do it at a date other than the date of the balance sheet. Most of the companies will do it as on balance sheet date, but some clients might do the physical verification on other than balance sheet date. Assume that your client company is doing verification as on 5th of April, other than balance sheet date, after 5 days from the balance sheet date. Then also you have to attend. But after attending there, just doing the above 4 things alone will not be enough. Even you need to check whatever transactions that have happened from the balance sheet date, that is from 31st of March till 5th of April, whatever additions, deletions are there to the stock, that also needs to be verified. Why? Because the client is verifying stock on 5th of April, and if the stock as on 5th of April is matching with the books, that alone will not be enough. Why? Because stock on 5th of April will not come in the financial statements. Stock on 31st of March will come in the financial statements. Now, how to calculate the stock as on 31st of March? By doing reverse calculation. How to do reverse calculation? So how to do that reverse calculation? You take the stock on the date of verification on 5th of April. This is the stock available. Add back all the sales which have happened from 1st of April till 5th of April. That you have to add it back. Sales or consumptions, whatever it is. Now you have to reduce purchases or additions, whatever have taken place from 1st of April till 5th of April. That you have to, this you have to add it back, sales and consumption, and purchase you have to deduct it. Now whatever balancing figure that you get, that will be the stock available as on 31st of March. Nothing but we are doing reverse calculation. So if inventory counting is happening on other than balance sheet date, check whatever transactions that have happened between the date of financial statements and the date of counting, whether they are really genuine or not. This is very important if stock verification is happening on other than balance sheet date. Now, sometimes what will happen is management will call you for physical verification, but you are unable to attend it because of unavoidable circumstances. Might be you're out of town, or you are busy with other assignments, or you are sick. None of your engagement team members are available. So whatever may be the reason, management has done the physical verification. They even invited the auditor, but auditor was unable to attend. Then what should happen? So then what should happen is, let us see what the standard says. If the auditor is unable to attend physical inventory counting by the management due to unforeseen circumstances, the auditor shall make or observe some physical counts as on some alternative date. Very simple. If you are not going and attending inventory counting done by management on some alternative date, you have to go to physical verification on your own and do some random counts and do some sample counting on along with your engagement team. If you go when the management is doing physical verification, you can just sit and observe. If you did not attend the management's inventory counting, then you have to take your team on some alternative date, go and do the verification on your own. Clear? That's what should happen. So first step, you have to attend management's inventory counting. If not possible, you do physical verification on your own if you are unable to attend management's inventory counting. See, sometimes, and when you go for physical verification on your own, what are the things which you need to pay attention? You need to pay attention to the factors like the nature of inventory. What is the nature of inventory? How much is in the form of work in progress? How much is in the form of raw material? How much is in the form of finished goods? Even when it comes to work in progress, pay attention to stages of completion. Work in progress, is it 50% completed, 60% completed, 70% completed? Why? Because depending on percentage of completion only, cost will be allocated. And what risks are there when it comes to inventory? Are they having CCTV camera? Are they having proper record keeping system? Nature of related internal controls. What kind of internal controls they are having? Whether adequate procedures are expected to be established and proper instructions are given. Whether you are giving proper instructions to your team to do how to do the counting of physical verification. Timing, at what time you are doing. How far from the balance sheet date you are doing it. Whether the entity maintains perpetual inventory system or periodical inventory system, what kind of records are maintained, at what locations the client has stored the inventory, because of the location at which they are kept, are they posing any threat to the quality of the stock, and even whether any expert's assistance is needed. Sometimes in order to check the inventory, your alone expertise will not be enough. You might be required to take some help of another expert. So determine whether any expert's help is needed. So whenever you go and attend physical verification on your own, these are the things which you need to keep in mind. Now, one more thing. Sometimes what else will happen is management conducted physical verification. They invited, you did not go. Then you thought of doing physical verification on your own, but because of some extreme circumstances, doing physical verification has become completely impracticable. Management first called you, you did not go. You thought, okay, I will take my engagement team on some alternative day and go and do the physical verification. But that also did not happen. Why that also did not happen? Why? Because some unforeseen circumstances have occurred, like some calamity is there, some floods are there, so whatever it is, some social riots are happening. So because of unforeseen circumstances, because of unavoidable circumstances, attending the physical inventory counting has become completely impracticable. It is not at all possible for you to go and check the stock physically. You did not attend management's inventory counting. You thought of going on some alternative date. That also did not happen. Now it is completely impracticable. Then what the standard says, sir? Then the standard says you try to perform alternative audit procedures. What the standard is asking you to do? Perform alternative audit procedures. Sir, what could be alternative audit procedures? That's up to your choice. You apply your professional judgment and decide what I can do in this case to obtain audit evidence. I'm not able to attend the premises. I'm not able to do the physical counting. What else I can do to obtain audit evidence? You think of it on your own. So try to perform alternative audit procedures to obtain audit evidence. And sometimes what will happen is even alternative audit procedures are also not giving you audit evidence. You tried to perform alternative audit procedures, but that alternative audit procedures also did not give you audit evidence. Then finally what you should do, sir? You have to finally modify your opinion. Consider modifying your opinion. And what kind of modification, sir? I will say here what kind of modification means either a qualified opinion or a disclaimer of opinion. Sir, why qualified or disclaimer? Why? Because this is a case where you are unable to obtain audit evidence. So consider giving either qualified or a disclaimer of opinion. And one important thing here, the difficulty of time or cost involved. This sentence is very important for true or false statements. The difficulty of time or cost involved is in itself not a valid basis for physical verification impracticability. Very, very important for true or false statements. So what they are saying is you cannot say time and cost as a reason for impracticability. You can't say my client is located at very distant place. I have to travel for 2 hours to do physical verification. That's why impracticable. Can I use that reason as a impracticability? No. Can I say if I have to go to that warehouse where the stock is kept, I need to incur 2000 rupees of charges. That's why it is impracticable. Can I say it? No. The difficulty of time and cost cannot be used as a reason for impracticability. When I say impracticability, that should have happened because of circumstances beyond the control of auditor, which auditor can't control, like natural calamities, riots, etc. So that's what this sentence is. Sometimes they might ask you true or false statements. It will be like the difficulty of time or cost involved is in itself a valid basis for impracticability. Do you agree? No, it is not in itself a valid basis for impracticability. And one more last point regarding inventory. Sometimes you might have a stock forming part of your balance sheet, but the stock is in the custody of a third party. Your client is not having possession. Some third party is having possession of the stock. Like your client is a consignor. The stock is lying with the consignee. That stock will form part of your client's books only. But your client is not having possession. That custody is there in the third party who is consigning. How you will get the evidence, sir? So what the standard says here is when inventory is under the custody and control of third party, but it is material, you should even obtain evidence regarding that also. But how, sir? By performing some procedures. What are they? Number one, request external confirmation from the third party. Ask external confirmation from the consignee. Send a confirmation request. Dear consignee, I am an auditor of your consignor. Let me know how much stock you are having. So request external confirmation. But sometimes external confirmation might not be reliable. Why? Because the consignee is a related party of your client. So you thought they are manipulating. If you find that external confirmation is not giving you complete evidence, then you perform other procedures also. Like if possible, go and attend that consignee's premises also. Or if possible, try to arrange another auditor. If you know any person there at the consignee's location, ask him to go and do the verification on your behalf, and even check appropriate documentation. Check whether any documentation is there regarding the movement of the stock. So when the stock is lying with a third party, but it is material, you should try to obtain evidence in this manner. Try to get external confirmation. In addition to that, try to perform extra procedures also. That's all. This is what SA 501 says to obtain audit evidence regarding existence and condition of inventory. A quick recap if I do. First, try to do physical verification. If you are unable to attend, try to do the verification on your own. If that is also impracticable, try to perform alternative audit procedures. If they are also not practicable, try to modify your opinion. In addition to that, if when any stock is lying with a third party, you should even try to obtain evidence regarding that also. So one aspect of SA 501 we have completed. Coming to the next one. Now coming to the second item regarding which SA 501 is giving evidence, which is related to completeness of litigations and claims. So as an auditor, you need to perform audit procedures to obtain audit evidence whether your client has disclosed all the litigations and claims in the financial statements or they are hiding something from the shareholders. Now, how you will try to obtain audit evidences? So let us see what does the standard say. First, the standard says try to identify whether there is any risk of material misstatement regarding litigations and claims. What the standard will ask you to do first, the auditor, like if I read the sentence here, the auditor shall design and perform audit procedures in order to identify litigations and claims which may give rise to risk of material misstatement, which means as an auditor, first you should find out is there any possibility of hiding some litigations and claims from the shareholders. They are not first asking you to directly identify hiding of litigations and claims. First, what they are asking first to find out, is there any risk, is there any possibility of hiding litigations and claims. So first they are asking you to identify the risk of material misstatement, not directly the misstatement. So how can I identify that risk of material misstatement regarding litigations and claims? So by simply doing three things. What are they? First, go and directly inquire with the management. First, what I should do? Go and inquire with the management. Sir, did you disclose all the litigations and claims or did you hide anything from the shareholder? In addition to that, if there is any in-house legal counsel, go and inquire with them also. Then read the minutes of the meeting of the top level management, this audit committee minutes, board of the directors minutes. Go to the minutes of the meetings and find out whether any external lawyers have been appointed for fighting the cases. And finally, check the legal expenses account also. Try to compare the legal expenses of the current year with the last year. Check whether there is any huge increase or decrease. So first, auditor should do three things to identify, not misstatement, to identify what? Is there any possibility, is there any risk of happening of misstatement in the litigations and claims? By doing three simple things. What are they? First, inquiry. Inquiry with whom? Inquiry with management, those charged with governance, legal counsel. Next one, reading the minutes of the meeting. Then after that, finally, review the legal expenses account. So by doing these three things, there could be two outcomes possible. Auditor might find out risk of material misstatement. Yes, there is some risk of hiding some litigations and claims in the financial statements. Another outcome could be auditor did not find out any risk of material misstatement. He inquired with the management, he read the minutes, he verified the legal expenses, he did not find anything suspicious. See, if he did not find out any risk of material misstatement, you can stop with these three procedures. But in case if the auditor identifies risk of material misstatement, if he comes to know that yes, some litigations and claims are hidden in the financial statements, if he gets that doubt, then he will perform the next step. If he finds that by performing these three steps, he did not find out any risk, there is no possibility of hiding litigations and claims, you can stop by doing these three activities. But in case if you find any risk of material misstatement, then you have to perform the next step. So what is that next step, sir? See the terminology here. If the auditor assesses, that means if the auditor identifies, yes, there is a risk of material misstatement regarding litigations and claims, then only he will perform this extra procedure. What is that extra procedure, sir? Seek direct communication with the entity's external legal counsel. If he finds any doubt, what he should do? He should first go and directly communicate with entity's external legal counsel. Whoever external lawyer is appointed, go and directly communicate with him. Who will communicate? Auditor will communicate. With whom he will communicate? External legal counsel. When he will communicate? If we came to know that yes, there is some risk of material misstatement regarding litigations. If he doesn't find any risk, he will end his audit procedures here only. He will come to this step only when he identifies, yes, there is a risk of happening of misstatement in the completeness of litigations and claims. So auditor should seek direct communication with entity's external legal counsel. Sir, how he will communicate, sir? Through a letter of inquiry. How the auditor will communicate? Through a letter of inquiry. Whatever information he wants to know, he will write a letter of inquiry. But in writing that letter of inquiry, he will take the help of the management. Why? Because you will know only external legal counsel. You don't know how to communicate, whom to communicate, etc. So you will communicate with the external legal counsel through a letter of inquiry, which will be prepared by management and it will be sent by auditor. Management will prepare it, but auditor will send it. And in that letter of inquiry, the auditor will ask external legal counsel to communicate directly with whom? Auditor. So if the auditor finds risk of material misstatement, he shall communicate with entity's external legal counsel through a letter of inquiry prepared by the management, sent by the auditor, asking the external legal counsel to respond directly back to auditor. So for communicate with him. Sometimes what will happen is, see, if everything goes well, no issue. Management prepared the letter of engagement, the external legal counsel responded, everything goes well, no issue. But when the problem arises, is management is refusing to communicate with entity's external legal counsel, or management gave permission, you sent it to external legal counsel also, but external legal counsel is not responding, he is prohibited from responding, your client is prohibiting the external legal counsel to respond back to you, or external legal counsel is prohibited by his rules and regulations, like bar council related rules and regulations, whatever could be the reason, either management is not permitting you to communicate with external legal counsel, or management permitted but external legal counsel is not responding, or he is prohibited from responding. If any of these things happen, then what the standard will say is, that means you are not able to communicate with entity's external legal counsel. Then the standard will say, perform alternative audit procedures. What the standard has told, perform alternative audit procedures, apply your mind, think of any alternative things which you can do to obtain audit evidence and perform that alternative audit procedures. If alternative audit procedures are also not possible, then modify the opinion. If alternative audit procedures are also not possible, then what auditor should do? Modify the opinion. Here also what modification? Either a qualified or disclaimer. Why? Because it is a case of non-availability of audit evidence. And next point, in some cases, the auditor might feel that just communicating through letter of inquiry alone will not be enough. He might feel that it is necessary to directly go and meet, have a direct contact with the entity's external legal counsel. In some cases, generally we communicate with entity's external legal counsel through letter of inquiry. But in some cases, auditor might feel that just communicating with letter of inquiry alone might not be enough. He might be required to go and meet him personally. Sir, when that requirement arises, so that could be the case when the risk is a very significant risk. It is a very big risk, or the matter is very complex. The matter is very difficult to understand, or there is a disagreement between management and entity's external legal counsel, or whatever entity's external legal counsel is saying, whatever your management is saying, both are not matching. Then also you might feel that for extra clarification, you will go and meet with the legal counsel directly. In one of the examination, they have tested only this point as a question. How they have framed a question is, in some cases, auditor might feel that he has to go and meet with the entity's external legal counsel personally. In what circumstances auditor might have that requirement to meet with the entity's external legal counsel? What are the circumstances? So these three circumstances, what are they? When the risk is a significant risk, when the matter is very complex, when there is a disagreement between management and entity's external legal counsel. Clear? And in addition to all that, the auditor should even ask a written representation from the management. Ask the management to give a written confirmation that they have disclosed all the litigations to the auditor, and even they have presented it in accordance with applicable financial reporting framework. That's what you need to do in order to obtain evidence regarding litigations and claims, which SA 501 has suggested. Very simple, a quick recap. First, identify risk of material misstatement by doing three things. Now, by doing that three things, risk of material misstatement could be there, could not be there. If it is not there, well and good. If it is there, auditor should directly communicate with entity's external legal counsel. How he will do it? Through a letter of inquiry prepared by management, sent by auditor, asking external legal counsel to respond back to auditor directly. But either if the management refuses or external legal counsel prohibits to respond, perform alternative audit procedures. If they are also not giving audit evidence, modify the opinion. In some cases, you might feel like going and meeting with the legal counsel directly. What are that circumstances? In addition to all that, even request written representation also. Clear? Now the final thing is segment information. Very simple here, nothing much specific here to revise. So what they simply say here is, we have a dedicated accounting standard talking about segment information, AS 17. So they will ask you to check whatever segment information which your client has presented, whether that information has been prepared and presented as per the requirements of applicable financial reporting framework, which is AS 17. That's all. The summary is that only. Whatever segment information which your client has presented, whether they have presented all that segment information in compliance with what? In compliance with applicable financial reporting framework, which is AS 17. So like if I quickly take you through it, the auditor shall obtain audit evidence regarding presentation and disclosure of segment information. How? First, understand what methods are used by the management in determining segments. Like in AS17, there will be calculation, how to identify primary segments, geographical segments, etc. etc. So first you understand what are the methods used by the management to determine segment information. Then analyze whether that methods are in accordance with applicable financial reporting framework. Whatever methods the management has used, whether they are as per applicable financial reporting framework or not. And wherever possible, test the application of such methods. Since you also have knowledge of AS17, you do the calculations on your own and try to compare it with the management's calculation. And wherever suitable, try to perform analytical procedures on the segment information. And specifically what I will try to understand. So here you are saying obtain an understanding of methods used by the management. No, what methods you will understand regarding the management, what methods you will understand regarding the methods used by the management regarding segment information. So what I will try to understand is like how the sales, transfers and charges have been allocated between the segments, how the sales are divided, on what basis they are divided, how the expenses are divided, how the charges are divided, and how inter-segment elimination has been taken place. That I will understand. And if there are any budgets, I will try to compare the budgeted information with actual segment information. I will try to understand how the assets are allocated and even consistency with the prior periods, whether when compared with the last year, consistency is there or not. Last year geographical segments are presented. In the current year also, whether geographical segments are only there or some deviation has happened. This consistency I will check. That's all. So if I have to end it with one line, I will simply say whatever requirements of AS17 or applicable financial reporting framework are there regarding segment information, whether they have been complied with or not, this is what I need to check. So this is what the guidance provided by SA 501 to obtain audit evidence regarding 3 selected items. What are that 3 selected items? So those 3 selected items are going to be obtaining evidence regarding existence and condition of inventory, completeness of litigations and claims, and finally segment information. Clear? Very important standard for case scenario based MCQs and also descriptive questions. Sorry. So with this we are done with SA 501 successfully. Let us now proceed further with remaining standards. Now we will revise SA 505. So this is also a bit important standard which is relating to external confirmation. So let us do the revision quickly now. What does this SA 505 talk about regarding the external confirmation? First, we need to understand the meaning of external confirmation. So what is the meaning of external confirmation? So the definition says external confirmation is a written confirmation which is obtained by auditor from third party outside of the client. So a written response obtained by the auditor from a third party, either in paper form or electronic form, that we call it as a external confirmation. Like I'm an auditor of a company, I want to know whether bank balances are correct or not. I asked a written response from the bank manager, some third party outside of my client. So if the third party responded, I used external confirmation here. I want to know whether accounts payable balance is correct or not. Send external confirmation. I want to know accounts receivable balance is correct or not. You have communicated directly with the directly with the debtor. External confirmation. So a direct written response obtained by the auditor from a third party will be called as external confirmation. Now, sir, if auditor confirmed the balance over a phone call, can that be called as external confirmation? No. Why? Because the definition very specifically says external confirmation is defined as a direct written response. Written response they are specifically saying. So oral response from a third party will not play any role as external confirmation. Only written response is considered as external confirmation, be it in paper form or it could be in electronic form. Next, this external confirmation request can be of two types. One is positive confirmation request and the other one is negative confirmation request. Now, what is positive confirmation request? Positive confirmation request refers to such a confirmation request where auditor will expect a third party to respond, either the third party agrees or disagrees with the information provided in the request. A positive confirmation request is such a confirmation request where auditor will expect a third party to respond. Either they agree with the information or disagree with the information. Or if the auditor directly asks the information from the third party, that also we call it as positive confirmation. Like I'm asking the debtor, sir, I came to know that you have to pay 10 lakh rupees to this client. Please confirm whether you are required to pay 10 lakhs or not. So I'm expecting a third party to respond, either he agrees or disagrees. Or if I'm asking directly, like, sir, I'm an auditor of this company. I came to know that you are a debtor. Please let me know how much amount you are required to pay. Asking the information directly from the third party. This also will come under positive confirmation request. Whereas negative confirmation request refers to such a confirmation request where we expect third party to respond only when they disagree with the information provided in the request. So if we expect a third party to confirm back to us, to reply back to us only if they disagree with the information contained in the request, that we call it as negative confirmation request. Now, which one is more reliable, sir? Positive confirmation request is more reliable. Does that mean negative confirmation request cannot be used at all? No, you can use it, but that will give less convincing evidence than when compared with the positive confirmation request. Even the standard has told us in what circumstances we can use a negative confirmation request, which we will talk about in a few minutes. So this is what regarding two kinds of external confirmation, positive, negative. There are few more definitions which we need to revise. One is exception. Sir, what do you mean by this exception? So exception means if there is any difference between information which is there in the confirmation request and the response provided by third party, that difference we call it as exception. Like I mentioned in the confirmation request, dear debtor, my client is saying that you are required to pay 10 lakh rupees to my client. Please confirm whether you are required to pay 10 lakhs or not. I got a response from the debtor. He told, no sir, I am not required to pay 10 lakh rupees. I am required to pay only 9 lakh rupees. Now there is a difference between information which is there in the confirmation request and the response provided by third party. This difference itself we call it as exception. But one important thing here is exception doesn't always mean a misstatement. This exception doesn't always mean misstatement. Why? Because sometimes exception could arise not because of mistake in your client's books, but that could arise because of a statement in the third party's books of accounts. So we understood exception. What I'm saying extra is exception doesn't always mean a misstatement. Why? Because sometimes exception could occur because there is a mistake in the third party's books, not in your client's books. Clear everybody? So this is what regarding exception. Now one more definition, which is non-response. So what do you mean by non-response? If you sent a confirmation request, either positive or negative, but that has been returned undelivered, the third party was unable to be found out and you got it back. Like you sent a mail, immediately you got a reply that the email address which you have used does not exist. So it has been returned undelivered, non-response. Or you posted a letter, but the third party was unable to be found, you got that post back. So you send a confirmation request, either positive or negative. If it has been returned undelivered, that scenario we call it as a non-response. Or you have sent a positive confirmation request, it has reached the third party also, but the third party didn't respond appropriately. He did not respond appropriately. That also we call it as non-response. Any confirmation request, either positive or negative, it has been returned undelivered. Or you send a positive confirmation request, it reached the third party also, but the third party did not respond. This also we call it as not response. However, one thing you need to keep in mind, if you send negative confirmation request, if it reached the third party, but the third party did not respond, will this also be called as non-response? No, this will not come under non-response. Why? Because when you send negative confirmation request, when you reach the third party, if he did not give you a response, that means that it is an implied implication that third party has agreed with the information. Why? Because we expect a third party to respond back only when he disagreed. No. So that's why if you send a negative confirmation request, if it reaches the third party, but if he is not responding, this will never come under non-response. Non-response covers only these two cases. Clear everybody? So with this we are done with the definitions. Now let us come to the context of this standard. So the standard says that if you want to obtain relevant and reliable or sufficient and appropriate audit evidence from external confirmation procedure, you need to follow some steps. You need to have control over 4 steps. So what are that 4 steps means? If you want to get best evidence from external confirmation, 4 steps you need to have control. So what are that 4 steps means? That is what has been highlighted here. First, determine the information to be confirmed or requested. First, you have to select regarding which information you have to send a confirmation request. Second step, select the appropriate confirming party. Decide who is the appropriate confirming party. Third one, design your confirmation request. And finally, after that, you have to follow up on your send it and follow up on the confirmation request. So 4 steps, if you maintain control, you will get best evidence from external confirmation. What are that 4 steps? Determine the information regarding which you want to send a confirmation request. Number 2, select the appropriate confirming party. Number 3, design the confirmation request. Last one, send it and do the follow up wherever necessary. So let us talk about each and everything in a detailed manner. First one, determining the information. First, decide which information you want to get external confirmation. So if you give a thought, why we use external confirmation? For getting confirmation regarding which kind of items? So the thought which will come to your mind is, sir, we use external confirmation to use it to confirm whether debtor's balance is correct, whether accounts receivable balance is correct, whether bank balances are correct or not, whether inventory held with a third party is correct or not. So we mainly use external confirmation regarding account balances and their elements like amounts and balances, like bank balances, debtors balances, creditors balances, etc. But do you think the use of external confirmation is restricted only to these amounts and balances? Can you use it only for the amounts? Can't you use it for other purposes? No. We can even use external confirmation for qualitative aspects also. For other than amounts and balances also we can use it. Like what, sir? You want to know whether the terms of the, when you want to confirm terms and conditions of contracts, like whether discount is really given or not, whether credit sale is made or cash sale is made. These kind of terms and conditions also you can get a confirmation. Or whether really a transaction happened between your entity and third party, that also you can confirm. Or even you want to know whether your client has entered into any side agreement apart from main agreement, you want to know, that also you can get a confirmation. And not just that, if your client is saying, sir, our property we have given as security for the banker, so that's why original documents of this land are not there with us, they are lying with the banker. You want to know whether banker is really keeping that original documents of the property. How you can get to know? Send a confirmation request to the banker. So the point which I want to make here is, we use external confirmation, yes, agreed for amounts and balances. But the use of external confirmation is not just restricted to amounts and balances. We can use it for other qualitative aspects other than amounts and balances, like terms and conditions of the contracts, and also side agreements, existence of the transactions, or property documents given to the banker. So like this, we can use it for other qualitative purposes also. So whatever it is, first select the information regarding which you want a confirmation. Then select the appropriate confirming party to whom you have to send the confirmation, that you have to decide. Like for example, Reliance Industries Limited is a debtor for your client. You have to send a confirmation request. Will you send the email to official email address of Reliance Industries Limited? No. You want to know who is the concerned person in the Reliance Industries Limited, with to whom if you send the confirmation request, you will get the response. So like this, you have to select the appropriate confirming party. Why? Because when you send the confirmation request to the appropriate confirming party, then only you will get the responses, then only those responses will be reliable. But in order to know who is that appropriate confirming party, I become helpless here and I have to take the help of the management. Understood? At this stage, when selecting the appropriate confirming party, I need to take the help of whom? Management. Why? Because I will not know who is the concerned person in the third party to whom I have to send the confirmation request. So whatever it is, second step, select the appropriate confirming party. Third one, design the confirmation request now. What do you mean by designing here? Like either you want to send positive confirmation request or negative confirmation request. You want to send it in an electronic form or you want to send it in a paper form. So you have to take that decision, and that decision will be depending on so many factors. It depends on risk of material misstatement. When the risk is very high, then you will go for positive. When the risk is very low, then you will go for negative. And it also depends on presentation, like you have to send a positive or negative. Prior experience, even you can use your past experience here. And also it depends on that concerned item of financial statements. If the item is very, very material, very important item, use positive confirmation request. If the item is very immaterial or insignificant, use negative confirmation request. And also decide on method of communication. Like as I've told, either you want to send it by email or physical post, or even management's authorization. What some third parties will say is, if you send a confirmation request, they will say if you get the approval of the management, then only we will respond back. So now what you should do is first go to the management, get the approval, then only third party will respond. Consider this requirement also. And also how far the third party is ready to respond back to you. Sometimes third parties will have a lot of patience. Even if you ask them invoice wise details, then also they will share that with you. So if I know the third party is such a humble person, I will ask invoice wise details. If I came to know other third party is not so humble, if you ask invoice wise details, instead of responding back, he will delete that email. There you will not take the risk of asking invoice wise details, but instead what you will do, I will ask only total balances. So keeping all these factors in mind, you will design the confirmation request. After designing confirmation request, will you keep it safe in the locker? No. What is the next step? Send the confirmation request. Finally, post or email that confirmation request, and wherever appropriate, do the follow up. Where I will do the follow up? I will do the follow up only in the case of positive confirmation request. I will not do the follow up in the case of negative confirmation request. So why? Because in the positive confirmation request, I expect a third party to respond. Either he agrees or disagrees. So within a reasonable time, if I don't get a response, I will send a pop-up mail. Sir, I have already sent you a mail. Please check it and respond back. In the case of negative confirmation request, if you don't get a response, you will assume that the third party has agreed. So that's why you need to get a confirmation request. You need to send the confirmation request, and wherever suitable you send a follow-up request, and generally where it will be suitable, only in the case of positive confirmation request. And one more thing, I told negative confirmation requests are less reliable. Does that mean you should not use them at all? No, you can use it, but when you can use it, you can use in such areas where the risk is very low, and when you came to know that controls are very effective in that area, and the transactions are very small, homogeneous repetitive transactions, very small in value, or you are expecting a very low exception. In this area, the chances of differences are very rare. And one more thing, when you know the third party very well, that if he finds something wrong, he will definitely respond. When you know the third party very well, that the third party, if he gets the confirmation request and if he finds something wrong, he will definitely respond. Such a confidence you have on third party, then also you can use a negative confirmation request. If I have to end it in one single line, wherever risk is very low, wherever items are immaterial, there you can make use of negative confirmation request. Don't use negative confirmation request as a sole substantive audit procedure, as a only audit procedure in those areas where the risk of material misstatement is high. If you find the risk as very high, don't use only negative confirmation. In those areas, either use positive confirmation request or use negative confirmation in combination with other audit procedures. Don't use negative confirmation request as the only audit procedure. Wherever risk is very high, you can use in these areas like risk is low, controls are effective, items are small and homogeneous, very low exception, and you know the third party very well that he will not disregard your request. And sometimes what will happen is you want to send a confirmation request to the third party, but the management is refusing you to do it. Management is stopping you from communicating with the third party. Now what I should do? So when the management refuses the auditor to send a confirmation request, the standards say first to go and ask the management reason. Sir, why are you stopping me from communicating with a third party? Ask the management to give the reasons. Now whatever reasons management have given, find out whether they are reasonable or not. So whatever reasons which are given by the management, find it out whether they are reasonable or not. So let me try to summarize in the form of a chart here what auditor should do when the management refuses. So if the management refuses, first auditor should find out reasons. Now, at the time of once the management give the reasons, find out whether there is a reasonable justification. Yes, management has given valid reasons why they are stopping me from communicating with a third party. Then what the standard will say is perform alternative audit procedures. If alternative procedures are not possible, if you are unable to obtain evidence even from alternative audit procedures, then modify your opinion. Then what we should do? Then we have to modify our opinion when there is a reasonable justification. Very simple, guys. Try to obtain reasons, find out if there is a reasonable justification. Yes, there is a reasonable justification. Perform alternative audit procedures. If alternative audit procedures are also not possible, then modify your opinion. Now, coming to the other case. Now let us talk about other case. Like you have asked the management, sir, why are you refusing me to communicate with the third party? Now they are giving me reasons for which there is no reasonable justification. They're not giving me reasons for which they're not giving me reasons which are having justification. They're giving some bullshit reasons. They're saying, no, sir, so don't communicate with the third party. We don't have any valid reason. But they're trying to say something, but for which there is no reasonable justification. So if there is no reasonable justification, what the standard will ask you to do is reassess the risk of material misstatement. What as an auditor I should do? Reassess the risk of material misstatement. Why? Because you got to know about the management now. management, when I try to communicate with a third party, they are giving me some reasons and which are not at all valid, and they are stopping me from communicating about third party. Now you got to know about the true nature of the management, that they are not honest, that they are not having integrity. So that's why reassess the risk of material misstatement. Why? Because you got to know the information about the client now. Earlier you thought management is honest, you thought risk would be low, you might have planned less audit procedures, but now you got to know the true nature of the management, reassess the risk of material misstatement and make changes to your audit procedures. So reassess the risk of material misstatement and even consider modifying the opinion in your auditor's report also. So this is what auditor needs to do in case if the management refuses the auditor to communicate with the third party. First, understand the reasons. If there is reasonable justification, perform alternative audit procedures. If alternative audit procedures are also not possible, then modify. If there is no reasonable justification, first reassess the risk of material misstatement and directly modify the opinion. Now, one more last point here regarding external confirmation. What if responses to external confirmation are not reliable, which means management gave permission, you communicated with the third party gave response also, but the problem is those responses are not reliable. When you will generally get that doubt, responses to external confirmations are not reliable, when you came to know that the third party is not independent of your client. That is, your client's management and the third party colluded with each other, and your client made the third party to give you wrong responses. So if you came to know that responses to external confirmations are not reliable, then what you should do? Let us see what they are saying. If the auditor identifies factors that give rise to doubts about reliability of responses to confirmation request, then the auditor shall obtain further audit evidence to resolve the matter. That means you need to perform in-depth audit procedures to find out how far the management's evidences are reliable. And if the auditor determines that confirmation request is only not reliable, why? Because third party is saying something and from other evidences you concluded that responses given by the third party is completely not reliable. That means your management made the third party gave you wrong responses. Here also the auditor need to reassess the risk of material misstatement and make suitable changes to your audit procedures. Why? Because here also you came to know about the true nature of the client, that client has made the third party give wrong responses. That means they are not honest. You got to know this extra information regarding the nature of the management. Now try to make changes to your audit procedures by increasing the risk of material misstatement. Clear? So this is what auditor needs to do when he found that responses to external confirmations are not reliable. This is what simply SA 505 says. So we understood five definitions. Then we have seen that if external confirmations have to give you best evidence, you need to maintain control over 4 steps. What if the management refuses you to communicate with the third party? What if confirmation requests are not reliable? In addition to that, in what kind of circumstances we can make use of negative confirmation request? Clear everybody? So 3 standards we have revised successfully: 250, 501 and 505. Now we will try to revise SA 580. So just now we have completed SA 505, which is talking about external confirmation, whereas SA 580 will be talking about written representation. Now first we will understand what is the difference between external confirmation and written representation. I told that external confirmation is a written response, is a written confirmation obtained by the auditor from third parties, whereas written representation means it is a written confirmation obtained by the auditor from the management of the organization. That I call it as written representation. So once again I am repeating, if the auditor is getting a written response from a third party, that we call it as external confirmation. On the other hand, if the auditor is getting a written confirmation from the management, internal. So from the management, if the auditor is getting a written response, written confirmation, that we call it as written representation. So does that mean to the auditor, financial statements will be given? No. Financial statements will be given to the auditor. Books of accounts will be given to the auditor. Can I include financial statements and books of accounts also in the definition of written representation? No. The written representation does not include financial statements, assertions therein or books of accounts. But regarding that financial statements, regarding the assertions in the financial statements or regarding the books of accounts, if the management gives you some written confirmations, that we call it as written representation. So written representations are confirmations given by management. However, we can't say financial statements, books of accounts as written representation. Regarding that items of financial statements and books of accounts, if the management gives you some confirmations, that I call it as written representation. Now, let us see what role does this written representation play in the audit. Do you think written representation are a evidence? Do you think written representation are a source of evidence to the auditor? Yes, written representation are one of the sources of audit evidence. But the problem is written representation can't act as a sole audit evidence, which means you can't use only written representation as a audit evidence. You can't use it. Written representation are only like supporting evidences. They cannot provide evidence on their own, which means you can't use written representation only as a evidence. You can use it only as a supporting evidences. Clear? Now coming to the next point, regarding what matters you need to get the written representation, for which matters you have to get the confirmation from the management. So SA 580 says in its objective that in two cases obtaining written representation is mandatory. What are that two matters? Number one, every auditor should get a written representation from the management that they have fulfilled their responsibility for the preparation of financial statements, and also they have completely disclosed the information to the auditor. Completely disclosed information to whom? Auditor. They did not hide anything from the auditor. That auditor should ask the management, every management of the client, to get this written representation concerning this matter. Which matter? That the management has fulfilled their responsibility for preparation of financial statements, and also they have disclosed the information completely to the auditor. They did not hide anything from the auditor. That they have to give a written confirmation. Just giving oral confirmation alone will not be enough. The management has to write it on their letterhead, sign it, affix the company's seal, and give it to the auditor. So that is what the first objective here. If you observe, the objectives of the auditor are to obtain written representation from whom? From the management, that they believe that they have fulfilled their responsibility for the preparation of financial statements, and also they have completely provided the information to the auditor. Every management should give this written confirmation. Sir, we fulfill our responsibility for preparation of financial statements. We have completely provided the information to you. We did not hide anything from you. Ask the management to give written confirmation. This is mandatory. And also to support other audit evidence, if there is any requirement of the standard, assume that some standard in some other matter, they ask the auditor to obtain written representation. Like previously we have revised SA 501. There I told that in the second issue, that is when you try to obtain regarding litigations and claims, along with so many audit procedures, they have mentioned even one more thing. The auditor should obtain written representation from the management regarding litigations and claims. Now it becomes mandatory for the auditor to obtain written representation regarding litigations and claims. Why? Because it is a requirement of SA 501. Similarly, when we revise the next standard, which is SA 570, there also they will say auditor should obtain written representation regarding going concern assumption. This is also mandatory. So the point which I want to conclude here is, whenever there is a requirement of any standard, there also it is mandatory for the auditor to obtain written representation. And in rest of the cases, it is up to auditor's choice. In rest of the cases, it is up to auditor's choice to decide for which matter he wants written representation, for which matter he doesn't want written representation. But these two things are mandatory, that he should ask the management to give written confirmation that they fulfill the responsibility and completely disclose the information to auditor. And also whenever there is a requirement of the standard, there also it is mandatory. In rest of the cases, it is up to auditor's choice whether he wants to get a written representation or not. So this is what regarding objective of the auditor. Now, coming to the next point, from whom auditor will request written representation? From whom auditor will request written representation? Obviously, you will say, sir, he will request it from management. That's what you are saying. But when I say he will request from the management, from whom in the management? When I say management, so many people will come in the management definition. From exactly whom the auditor will request a written representation from? So if you ask me, so many people will come under management definition, but we can't expect each and every person will have complete knowledge regarding the items of financial statements. So that's why what the standard says is, you should ask or you should request written representation from that part of the management who is involved in the preparation and the presentation of financial statements, or from whom we expect that they have good knowledge about the items of the financial statements. From that kind of management we have to ask the written representation. Like if you ask me, generally if there is a CFO will be the person who will be concerned with the preparation of financial statements. If there is a CFO, I will ask written representation from CFO. If there is a CEO, I will ask written representation from CEO, or generally audit committee. So I will request written representation from that part of the management who have knowledge about financial statement preparation. Generally, I expect that these people will have complete information regarding financial statements. But sometimes what will happen is, you go to some CEO, CFO or audit committee, you ask them written confirmation, written representation. But they might respond back, sir, we don't have complete information regarding the item which you are asking confirmation for. So that's why we will not provide you with the written representation. Can the management say? Like for example, I went to the management, I went to the CFO and told, sir, SA 501 is asking me to obtain written representation regarding litigations and claims. So please give me written representations. I asked the CFO. Now CFO told me, no sir, I am not the concerned person who is looking into litigations. There is a dedicated legal team inside the company. They will, they are the persons who are looking into that litigations. Since I don't have enough of knowledge, I will not give you written representation. Can the CFO escape saying this as a reason? The answer is no, he can't escape. Then what the standard says is, if the concerned management does not know the information regarding which auditor is asking written representation, then it is the responsibility of that management to go to concerned person in the organization, or even consult the expert, get the required information, then provide confirmation to the auditor. What the standard is saying, no management can escape simply saying we don't have knowledge about it, we will not provide written representation. No, management can't say. If they don't have information, what the management should do? Go to the concerned person or even consult an expert, get the required information, then provide written representation to the auditor. Sir, like who could be that concerned person? Who could be that expert to whom the management can approach and get the required information from? Like as you could see, that expert can be an actuary. Like as an auditor, you are asking the management to give confirmation regarding certain provision. But CFO told, sir, some actuary has calculated that provision. So what CFO should do? Go to that concerned actuary, get the information, then provide confirmation to the auditor. Or he could be a staff engineer. You're asking confirmation regarding some technical matter. CFO doesn't have knowledge. He might go to staff engineer, get the required information, then provide the written representation to you. Or even it could be an internal counsel, like some lawyer. So even if you ask written confirmation from CFO regarding some legal issue, if CFO doesn't have information, go to that legal counsel, get the information, and then provide the written representation to the auditor. So no management can simply escape saying we don't have information, we will not provide written representation. No, they can't say it. Go to concerned person, even consult an expert, get the required information, then provide written representation to auditor. Clear everybody? Now talking about one more important thing regarding written representation, date of written representation, very important. Let me ask you one simple question. Between date of auditor's report and date of written representations, which date should be earlier? Straightforward question I am asking. One very simple question. Between date of auditor's report and date of written representation, which one should be earlier? Should the date of auditor's report be earlier? Should the date of written representation be earlier? The answer is date of written representation should be earlier than the date of auditor's report. Like for example, if you are signing the audit report on 30th of July, date of the written representation should contain date on or before 31st of July. Why, sir? Why date of written representation can't be later than the date of auditor's report? Why? Because written representation is evidence, no? Since written representation is evidence used in expressing the opinion, as we all know, the process of audit starts with auditor's appointment, then he will obtain evidence. After obtaining evidence, only opinion will be given. So that's why date of written representation, since it is a audit evidence will be obtained prior to expressing of the opinion. So that's why the date of written representation should always be earlier than date of auditor's report. It should not go after it. What will happen? It will go after. That will make you a fool. So assume that date of auditor's report is 31st of July and you have mentioned the date as 5th of August. Then what does it look like? It will look like you have given the audit report, then you have obtained audit evidence. So funny, no? So that's why the date of written representation should always be earlier than date of auditor's report. Now, few more concerns. The few more thing is doubt as to reliability of written representation. Sometimes what will happen is you will ask the management to give written representation, but you might have suspicion. You will get a doubt. Management has provided you written representation, but sometimes you will get a doubt how far these written representations are reliable. When you will generally get the doubt regarding reliability of written representations, I will get a doubt regarding reliability of written representation when I have concerns about management's competence, integrity, and ethical values. When I came to know that the management is not capable enough, or the management is not having integrity, that is, they are not honest people, they don't have any ethical values, then immediately I will get a doubt that how far the written representations are reliable. Not just written representations, I should get a doubt regarding overall audit evidence when I have doubts about the management's honesty, competence, capability, etc. So particularly if the written representations are inconsistent with other audit evidences, you got some other audit evidences, you got written representations also, but both are not matching, then you have to immediately resolve the matter. You got some evidences, you did some inspection, got some evidences, that evidences is telling you something, but written representations are saying something else. You should immediately try to resolve the matter by performing audit procedures and find out whether evidences that you collected are wrong or management's representations are wrong. If evidences are only wrong, well and good, fine. But if you came to know that the written representations given by the management are only wrong, then what you should do? If the auditor concludes that written representations are only not reliable, then the auditor shall take appropriate action, including determining the possible effect on the opinion. That means even you should consider modifying your opinion when you have decided that written representations given by the management are not reliable. Clear? So very simple. When you they are saying reliability of written representation, when you will get that doubt, when you have doubt about capability, integrity, ethical values of the management, particularly when evidences are not matching with written representation, immediately resolve the matter. If you have finally decided written representations are only not reliable, then consider modifying your opinion. That's what they are trying to convey here. Now coming to the last point, what if written representations are not provided? This point is you ask a written representation, management gave, but they are not reliable. But this point is what? You ask written representation from the management, but they are not at all giving it. Then what you should do? So if the management does not provide one or more of the requested written representation, then the auditor shall immediately discuss the matter with the management. First go to the management and discuss with them, sir, why are you not providing me the written representation? As a part of that process, re-evaluate integrity of the management. So when you go and inquire with them, they will give you reasons. If that reasons are valid, well and good. If those reasons are not valid, reassess the integrity of the management. Analyze once again how far the management is honest. And then finally take appropriate action, including determining the possible effect on the opinion. That means finally here also consider modifying your opinion. That's it. So this is what the auditor should do if the management is not providing the written representation. Very simple things we have discussed in the standard: definition of written representation, how it can be used as audit evidence, and objectives of the auditor, and from whom auditor will request written representation, date of written representations, what if written representations are not reliable, what if management did not provide the written representation. So these are the things which we covered in SA 580. With this, SA 580 is also over. So 4 standards we have revised: 250 we are done, 501 we are done, 505 we are done, and 580 also we are done just now. Now we will revise the next standard. We will start with SA 510. So what is this SA 510 talking about? So SA 510, the title of the standard is Initial Audit Engagements and Opening Balances. So what is the title of the standard SA 510? Initial Audit Engagement and Opening Balances. So before we talk about what exactly this standard is discussing, first we have to revise the definition of the terms which are used in the title. So talking about initial audit engagement refers to such an engagement where the prior year's financial statements were unaudited. The prior year's financial statements were unaudited, or the prior year financial statements were audited but by a predecessor auditor. Who? Predecessor auditor. So, initial audit engagement refers to such a audit engagement where either prior year's financial statements were unaudited, or the prior year financial statements were audited but by some predecessor auditor. Now, who is predecessor auditor? Auditor from altogether a different audit firm. What do you mean by predecessor auditor? Auditor from a different audit firm who has conducted the audit of the previous year and who has been replaced by another auditor in the current year. If I have to put it in simple terms, initial audit engagement means the current year auditor is different from the previous year's auditor. This is what in simple terminology. If the prior year auditor, if the previous year auditor and the current year auditor both are not same people, then we call it as initial audit engagement. The same thing has been technically defined like this. In case if the prior year financial statements were unaudited or last year's financial statements were audited but by some predecessor auditor, some different audit firm has conducted the audit of the last year. So this is what regarding initial audit engagement. Now coming to the other term which is used in the title, they are saying something called opening balances. Now what is opening balances? As we all know, opening balances are those balances which are there at the beginning of the period. Which are there where at the beginning of the period before passing any transaction for the current year. And these opening balances are nothing but the last year's closing balances. And what information does this opening balances reflect, sir? So as per the standard, opening balances reflect two information. So what are that two information is? Opening balances reflect the effect of transactions which have happened in the previous year, and also they reflect the accounting policies which are followed in the previous year. So as per SA 510, opening balances convey two kinds of information. They convey the effect of the transactions which have happened in the previous year. At the same time, they convey the effect of accounting policies which are followed in the previous year. And when I say opening balances, don't just be of a wrong notion that opening balance includes only those items which are there in the balance sheet. No. Even those items which are there in the notes to accounts also will form part of opening balances. So don't imagine opening balances as only those information which is there in the balance sheet. Opening balances includes that information which is there in notes to accounts also. Like if I say contingent liabilities, where the contingent liabilities will be presented in the notes to accounts. Even contingent liabilities also will form part of opening balances, not just the items in the balance sheet. So we are done with the definition. We revised what is initial audit engagement. I told you what is predecessor auditor and what is opening balances. Now let us come to the objective of this standard. With what objective SA 510 has been introduced? So SA 510 says that when you are doing initial audit engagement, especially when the auditor is doing initial audit engagement, you will have two objectives. You need to obtain sufficient and appropriate audit evidence that opening balances do not contain any material misstatement that could affect the current year's balances. And this standard says, as an auditor, if you are conducting initial audit engagement, you need to obtain sufficient and appropriate audit evidence that opening balances are not containing any material misstatement which could affect the current year's closing balances. And also, you need to obtain audit evidence that whatever accounting policies are there which are reflected in the opening balances, they should have been consistently applied. One of the fundamental accounting assumption, no, consistency. What does consistency say? Whatever accounting policies you have followed in the previous year, the same accounting policies should be applied in the current year also. You cannot say last year I followed SLM, in the current year I will change it to WTB. You can't say that. And also, does that mean the standards will not permit you to deviate from the accounting policies at all? No, the standards will permit me to deviate in some circumstances. So, but even in that circumstances also, if you change the accounting policy, the standards will say that proper disclosure is required, that you need to obtain audit evidence. So two things here: opening balances are not containing any material misstatement, and whatever accounting policies are there which are reflected in opening balances, without any valid reason, they should not be changed. If there is a valid reason because of which accounting policies are changed, then as a auditor I need to check that whether the change in accounting policy has been properly disclosed in the financial statements as per applicable accounting standards. So that is what the objective of this standard. So if we go to SA 510 and check the objective there once. So if I take you through the standard, As you could see here, definitions we are done. So after definitions, objective. So the standard is saying, especially when you are doing initial audit engagement, the objective of the auditor is to obtain sufficient and appropriate audit evidence regarding two things. They are saying opening balances contain any material misstatement that affect the current period's financial statements. And also accounting policies reflected in the opening balances have been consistently applied. That means without any reason, accounting policy should not be changed, or if there is a valid reason because of which there is a change in accounting policy, then I need to obtain evidence that the changes are properly accounted for and adequately disclosed and presented in the financial statements. So these are my objectives as auditor when I am doing initial audit engagements as per SA 510. Now the standard is saying to obtain sufficient and appropriate audit evidence, and we all know that we will obtain sufficient and appropriate audit evidence only when we perform audit procedures. So let us see what audit procedures I need to perform regarding opening balances. So if I quickly take you through it, the auditor, first audit procedure, what they are saying is I should read the most recent financial statements. Whatever recent financial statements are there, I should get a copy of the audited financial statements and I should read them. Especially opening balances related information, I will read it. Then the auditor shall obtain sufficient and appropriate audit evidence whether opening balances contain any material misstatement. But how should I do it? Determine whether prior period closing balances have been correctly brought forward. First, I will get the last year's copies of the audited financial statements, check whether they are correctly brought forward in the current year. I should try to match the current year opening balances with last year's closing balances. And determine opening balances reflect application of appropriate accounting policies. I will even check that whatever accounting policies are there which are reflected in the opening balances, whether they are appropriate. Like when I check the opening balances, I came to know that the client has charged depreciation on SLM basis. I should decide whether that SLM basis is appropriate. When SLM will be appropriate? When the consumption pattern of the machinery is expected to be uniform throughout its useful life. So like this, even I should check whatever accounting policies are reflected in the opening balances, are they appropriate? And even perform specific procedures like if the prior year financial statements were audited, if the last year's financial statements are audited, get the copies of audited financial statements. Get one copy of the audited financial statements of the last year. And evaluate whether any audit procedures performed in the current year provide evidence relating to opening balances. Sometimes you try to verify current year transactions, but that audit procedures will give you information regarding opening balances. Please be aware of that evidences. And finally, perform specific audit procedures. Like what? What is a specific audit procedure here is, I will ask the client to give me the opening trial balance. From the accounting software like Tally, etc., there will be an option to download opening trial balance. You can download the opening trial balance from the company, from the accounting software without any issue. So I will download the opening trial balance from the company's accounting software. I will get the copies of the last year's audited financial statements and I will try to match whatever balances are there in the opening trial balance, they are matching with the last year's balance sheet or not. So these are the audit procedures which I will perform regarding opening balances, and by performing all these procedures, I will be in a position to decide whether opening balances contain a misstatement or not. Now, after performing this audit procedures, I will have my findings now. Now, how that findings will have an impact in my auditor's report. How that findings will affect my opinion. So that's what the E point is about. Audit conclusions and reporting in relation to opening balances. How the findings in the opening balances will affect my opinion. Here they will try to say something which we are already aware of it. If the auditor concludes means what? When we say concludes, whether auditor is having evidence or not having evidence, auditor is having evidence. So if the auditor concludes that opening balances contain a material misstatement, you have performed audit procedures and you have obtained audit evidence, on the basis of sufficient and appropriate audit evidence, you have concluded that opening balances contain a material misstatement. So you have a evidence and you came to know that financial statements contain a material misstatement. What you will do? Will you give modified opinion or unmodified opinion? I will give modified opinion. Which kind of modification here? Since it is a case of availability of audit evidence, which opinion I will give? Which modification? I will give either a qualified or adverse opinion. So once again, I am revising the circumstances. They are saying auditor concluded. I am asking you when the auditor will conclude, when he has evidence or when he doesn't have evidence, when he is having evidence. So auditor is having evidence and on that basis of evidence, he concluded that financial statements contain a misstatement, and now what opinion he will give? Modified opinion. And which kind of opinion? qualified or adverse. On the other hand, one more scenario which could be possible is sometimes auditor will not be able to obtain sufficient and appropriate audit evidence whether opening balances contain a material misstatement or not. So if the auditor is unable to obtain audit evidence, then which opinion? Then which opinion? Then also modified. But which modified here? Either a qualified opinion or disclaimer. If the possible effect is only material, qualified. If the possible effect is material and also pervasive, then disclaimer. So this is what regarding how the findings in the opening balances will have an impact on the auditor's opinion. Similarly, you will have conclusions regarding accounting policies also. Here they say that if the auditor concludes that without any valid reason, accounting policies are not consistently applied. The client is not having any valid reason. Without any valid reason, they have changed the accounting policy in the current year. Last year, they followed SLM. In the current year, without any valid reason, they have changed it to WDV. Or sometimes what will happen is, there is a valid reason for change in accounting policy, but the management did not properly account or disclose for it in the financial statements. There is a valid reason, standard permitted to change the accounting policy. The client has changed it, but what the client has done a mistake is they did not properly disclose it. Observe carefully, guys, listen carefully. I am giving you two circumstances here. Either without any valid reason, accounting policy is changed, or there is a valid reason but management did not properly account for or disclose it. In this both the circumstances, the auditor shall modify opinion. And which kind of opinion? Either he should give a qualified opinion or an adverse opinion should be given by the auditor. Clear? So this is how the findings regarding accounting policies will have an impact on the auditor's opinion. And one more last point from this standard: modification to the opinion in the predecessor auditor's report. That means last year somebody else has done the audit. When I have taken the last year's audit report, I was able to see that the last year auditor gave a modified opinion. Just because last year's auditor's report gave a modified opinion, is there a mandatory obligation on the current year auditor also to compulsorily give modified opinion? The answer is no. Just because last year's audit report contained modified opinion, the current year auditor is under no obligation to mandatorily give qualified opinion or modified opinion. When the current year auditor also will give modified opinion? Because when the last year auditor, because of which reason he has given modified opinion, if the same reason remains unresolved, if the same reason remains material and relevant for the current year, then only current year auditor will modify. If the reason because of which last year auditor gave modified opinion, if that has been rectified in the current year, if that has been modified, that has been adjusted in the current year, if it is no longer relevant in the current year, then the current year auditor unnecessarily will not modify. So current year auditor will modify opinion only when the reason because of which last year auditor gave the modified opinion, if that is not yet rectified, if it is still material and relevant for the current year, then only he will modify. So that's what they try to say here. If the predecessor auditor's opinion regarding the prior period's financial statements included a modification to the auditor's opinion that remains relevant and material for current period's financial statements also, then only the auditor shall modify the auditor's opinion on current period's financial statements, which impliedly means that if the reason because of which last year's auditor gave modified opinion, if that is resolved, rectified, no longer relevant and material for the current year, then no need for the current year auditor to modify his opinion. Clear? So this is what they are in SA 510. Very simple. We understood definitions, initial audit engagements, predecessor auditor, and opening balances. Then we understood what are objectives of the auditor, audit procedures, impact on the auditor's opinion, and finally, what if there is a modification in the prior year's auditor's report. Clear, everybody? So that's all. Very simple standard. SA 510 also we are successfully done. Understood, everybody? Next one. The next standard which we take up will be SA 560. Important standard. Pay attention now. So we are going to take up the standard for revision now, which is going to be about subsequent events, and SA 560 is the standard which is talking about subsequent events. So first we should understand what is the definition of the subsequent events. How the term subsequent events has been defined in the SA 560. See, we all know subsequent events a definition as per accounting standards. So how the term subsequent events is defined under accounting standards? They say that those events which are happening between the date of financial statements and the date of approval of financial statements will be called as subsequent events. See, I am saying definition of subsequent events as per accounting standards. So accounting standards has defined the term subsequent events as those events happening between the date of financial statements and those events happening between the date of financial statements and the date of approval of financial statements. And the accounting standards divides that subsequent events into two categories, which in our common parlance we call it as adjusting events and non-adjusting events. Adjusting events are those events which conform to the conditions existing as on balance sheet date. Adjusting events are those events which conform to the conditions existing as on balance sheet date, whereas non-adjusting events are those events which conform to the conditions existing after the balance sheet date. That we call it as non-adjusting events. So this is how the term subsequent events was defined as per accounting standard. So they might ask you a question, what are subsequent events as per financial reporting framework? So nothing but they are asking you what are subsequent events as per accounting standards. If they ask you, you have to write this. Now, how the term subsequent events is defined under standards on auditing. Whatever I told you, that is definition as per accounting standards. Now, whatever I am going to explain, that is regarding standards on auditing. So even SA 560 has also defined the term subsequent events, but in a different manner. So how the term subsequent events is defined under standards on auditing is those events which are happening between the date of financial statements and the date of auditor's report. Those events which are happening between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge after the date of auditor's report. Those events which are happening between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge when? After you have signed the auditor's report. Assume 22-23 financial year. What is the balance sheet date? 31st of March 2023. Assume that the auditor signed the audit report on 31st of May. So some event happened between this date of financial statements and the date of auditor's report. Some event happened here. But auditor came to know about this event subsequent event after the date of auditor's report. After 31st of March, auditor came to know about it. The event which has happened before after 31st of May, auditor came to know about subsequent event, and that event has actually taken place between 31st of March and 31st of May. See, if the auditor came to know about subsequent event before the date of auditor's report, then there is no requirement of the standard only. When we start looking for guidance, when we need a standard, when I signed the audit report, but after signing the audit report, then I came to know that event which has happened in the past. Then only we start looking for guidance. No. So that's why subsequent events are those events which are happening or which have happened between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge after the date of auditor's report. This is how the term subsequent events has been defined. Very, very important. Events which are occurring between the date of financial statements and the date of auditor's report, but the fact become known to the auditor after the date of auditor's report. Those events we call them as subsequent events. So we understood what are subsequent events as per standards on auditing. Now, with what objective this standard has been given? What is the purpose of giving this standard? What this standard is providing guidance to the auditor? Let us see. So the objectives of the auditor are to obtain sufficient and appropriate audit evidence about whether events occurring between the date of financial statements and the date of auditor's report that require adjustment or disclosure in financial statements are appropriately reflected in those financial statements, which means as an auditor, you need to obtain sufficient and appropriate audit evidence that whatever adjusting events are there, whatever events that are happening between the date of financial statements and the date of auditor's report, and that too they are saying that require adjustment. That means they are specifically referring to adjusting events. So as an auditor, I need to obtain audit evidence that whatever adjusting events are there, whether they are properly reflected in the financial statements or not, and respond appropriately to facts that became known to the auditor after the date of auditor's report that they had been known to the auditor at the date would have caused the auditor to amend the auditor's report. Which means, as an auditor, in case after signing the audit report, you came to know about some subsequent event, and if you believe that, had I known about this event earlier, I would have amended my auditor's report. If such a fact came to your knowledge now, then you have to respond appropriately. Sir, how to respond appropriately? That's what the standard is going to explain. So very simple, two objectives. As an auditor, obtain audit evidence, whatever adjusting events are there, whether they are reflected properly or not. In case if you come to know about subsequent event after the date of auditor's report, then respond appropriately. How to respond appropriately? That we are going to see in a short while now. But first of all, before we can see whether they are adjusted or not, first we need to find out that subsequent events no. So as an auditor, what audit procedures you will perform to find out whether there are any subsequent events or not. So let us try to pay some attention to audit procedures. So what procedures auditor will perform to identify subsequent events? Let us see. So the auditor shall perform below procedures. What are they? First, understand what procedures are followed by the management to identify subsequent events. As we all know, the management, while preparing financial statements, they have to comply with accounting standards. And as per accounting standards, the management is having a responsibility to identify subsequent events. So before auditor, management is already having responsibility to identify subsequent events. So that's what the standard is saying. As an auditor, first you understand what procedures your client's management has followed for identifying subsequent events. Why? Because before the auditor, management is having the responsibility to find out the subsequent events. So first ask the management what procedures they have followed to identify subsequent events, and inquire management and where appropriate those charged with governance as to whether subsequent events have occurred. Directly go and ask the management themselves, sir, did you find out any subsequent events? Ask them. First point, understand the procedures, what they are following. Second point, go and ask the management directly, sir, did you identify any subsequent events? Third one, read the minutes of the meeting. Whatever board of directors meetings are there, shareholders meetings are there, whatever meetings which have taken place after the date of financial statements, after 31st of March, whatever meeting happened, be it shareholders meeting, be it board of directors meeting, be it those charged with governance meeting, read the minutes of all the meetings to find out whether any subsequent event was discussed. And read the entity's latest interim financial statements. If the recent quarterly financial statements are available, read it. And along with that, the auditor shall request the management to even provide written representations also. So auditor will perform these 5 audit procedures to identify whether there are any subsequent events or not. What are the 5 procedures? First, understand procedures which are followed by the management. Then directly go and inquire with the management. Read the minutes of whatever meetings happened after the date of financial statements. Read the latest interim financial statements and even ask written confirmation. So by doing all this, you will get to know whether there are any subsequent events or not. Now, after that, so as I have told in the objective, in case if you came to know about subsequent event after the date of auditor's report, you have to respond appropriately. No. Now, how to respond appropriately? That also this standard is saying. So whatever this standard is trying to convey here in the form of these lengthy paragraphs, that I will try to revise it in the form of one simple chart. Listen carefully, observe carefully. I will explain this slowly. Please pay attention. So what if auditor came to know about subsequent events after the date of auditor's report? What auditor should do? So now here we will divide the circumstances into broadly 2 categories. Case 1, auditor came to know about subsequent events after auditor's report, but before financial statements are issued. Auditor came to know about subsequent event after signing auditor's report. But by the time auditor signed the audit report, the financial statements are not yet issued. Financial statements did not reach any shareholder or outsider. The second case is, by the time auditor came to know about subsequent events after the financial statements are issued. That means by the time auditor came to know about subsequent events, financial statements are already issued to the common public. A shareholder is already having the copy of the financial statements. Clear? So 2 cases. In order to know auditor's responsibility, we have divided it into 2 circumstances. Auditor came to know about subsequent event after the date of auditor's report, but before financial statements are issued. That means by the time auditor came to know about subsequent event, financial statements did not reach shareholder or third party. That is case 1. Case 2, by the time auditor came to know about subsequent events, financial statements have already gone to the shareholders' hands. Which one is more complicated? Second case is more complicated. We'll come to that later. First, we will see what will happen in case 1. What if auditor came to know about subsequent event before financial statements are issued? So first thing what will happen is the standard will say first to go and discuss the matter with the management. Discuss with the management. I will go to the management and discuss with them. Sir, I found out a subsequent event. And as a part of that discussion with the management, we have to determine, whether financial statements need amendment. Why? Because subsequent events could be adjusting or not adjusting. So that's why you go and discuss with the management. As a part of that discussion, determine whether financial statements need amendment. If the financial statements need amendment, inquire how the management wants to address. Inquire how the management wants to address means inquire the management whether they are ready to amend the financial statements or not. So 3 steps: discuss with the management regarding subsequent event, determine whether financial statements need amendment as a part of that discussion, and inquire how the management wants to address. Inquire how the management wants to take this forward, whether they are ready to amend the financial statements or not ready. So here two things can happen. Management agreed to amend the financial statements. Management said, okay sir, we will amend the financial statements. If the management amends the financial statements, what I will do is auditor will perform audit procedures to find out whether amendment is done properly or not. Why? Because we can't blindly believe whatever management is saying. So I will really check myself and confirm whether management did the amendment properly or not. And even I will try to obtain sufficient and appropriate audit evidence regarding that amendment. Management agreed, sir, we will amend the financial statements. Now what I will do? I will perform audit procedures to check whether the amendment happened properly or not. And even I will try to obtain sufficient and appropriate audit evidence regarding amendment. And is there any requirement to modify my opinion here? No. If I am satisfied that yes, management did the amendment properly, and the management I have obtained sufficient and appropriate audit evidence, management did the amendment perfectly fine, I will not give any modification. I will give unmodified opinion and give my audit report. This is very simple case. Now, the other case, that is where the complication will come. Management did not agree to amend. I am saying financial statements need amendment, but the management is saying no, we will not amend the financial statements. Now what will happen? So if the management did not agree to amend the financial statements, here also 2 cases will be there. Case 1, audit report not yet given to the management. You signed audit report, but you have not yet given it to the management. Audit report is still lying with you. You signed audit report today. You thought tomorrow you will give audit report to the management. But before that only you came to know about subsequent event. You told to the management said we will not amend the financial statements. Since audit report is not yet given to you, since audit report is still with the auditor, you are in a favorable circumstance now. What you will do is cancel the audit report whatever you have with you, give a new audit report which contains modified opinion. Why? Because management is not amending, no. So give the new audit report which contains a modified opinion. Whereas when it comes to case 2, which is audit report already given to the management. So you are no longer in possession to the audit report. You have already handed it over to management. So if audit report is already given to the management, first what you should do is instruct the management not to circulate the audit report. What auditor should do? Instruct management. What he should instruct? Instruct the management. Sir, please don't circulate the audit report till I make some amendments. So first give that instruction. Now give the audit report which contains a modified opinion. Why this step will not come here? Why? Because in the case 1, since audit report is not yet given to the management, you need not instruct them. But in case 2, since audit report is already given to the management, first you instruct them, don't circulate the audit report, then give the new audit report which contains a modified opinion, ask the management now to circulate it. But sometimes what will happen is management, without listening to your instructions, they might circulate the audit report. You told not to circulate, but management did not listen to you. They just like that circulated. Then what you will do? Then the standard is saying, in case without listening to your words, management, if they have already circulated the audit report, auditor should take appropriate action. Auditor should take appropriate action to stop reliance on auditor's report. What do you mean by stopping reliance on auditor's report? You should go and you should take some appropriate action to stop the people from believing the audit report. Sir, what could be appropriate action? So that could be a newspaper advertisement, media comment, whatever it is. You should take appropriate action to stop the people from believing audit report. When this will be taken? When even after your instruction also management did not listen, still they have circulated the auditor's report. Then only. If they did not circulate, this step will not arise. Clear? So this is what auditor will do in case auditor came to know about subsequent event after auditor's report, but before financial statements are issued. Now let us come to the complicated scenario. What if auditor came to know about subsequent event, but by the time you came to know about subsequent event, financial statements are already issued. Financial statements have already gone to the public hands. Now what should happen? So now if you came to know about subsequent event, here also same steps. First, discuss the matter with the management. As a part of that discussion, determine whether financial statements need amendment and inquire how the management wants to address. Inquire whether management is ready to amend the financial statements or not. Before we proceed further, here one more step will come. Since the shareholders are already having the copy of audit report and financial statements, I will instruct the management to take appropriate action to stop reliance on the auditor's report. Since financial statements have already reached the hands of shareholders, I will go to the management and say, sir, financial statements have already reached shareholder, but now we have to amend the financial statements. So you take appropriate action to stop the people from believing auditor's report. Now, if the management takes the action, well and good. Sir, here also what could be appropriate action? Same. Giving a newspaper advertisement, media comment, sending emails, whatever it is. If managements take appropriate action to stop the reliance, well and good. Sir, what if the management did not take appropriate action? Then the standard says auditor himself has to take appropriate action to stop the people from believing auditor's report. If management takes the appropriate action, well and good. If the management is not taking appropriate action, then the auditor himself has to take appropriate action. So whatever it is, either management or auditor, someone should take appropriate action to stop the people from believing audit report, whatever they have. Now, once again, after this, the matter will proceed further. Two circumstances could arise. Management agrees to amend the financial statements and management do not agree to amend the financial statements. Now, when the management agrees to amend the financial statements, well and good. Here also, I will perform audit procedures and obtain audit evidence whether amendment has been done properly or not. Now, these amended financial statements will be given no to the shareholder once again. Now, my audit report also will be given once again. So, which opinion I will give here? Unmodified only. There is no need to modify. Why there is no need to modify? Why? Because management agreed to do the amendments and also I have obtained audit evidence that they have done the amendment properly. So, I will give unmodified. But here standard has told one more thing. If you observe carefully, now shareholders will get one more copy of financial statements and audit report. Shareholders have already got one copy of financial statements and audit report earlier. Why? Because financial statements are already issued. Now after this amendment, financial statements and audit report will be circulated once again. Now shareholder will have two financial statements in their hands. They might not be able to understand what is the difference between previously issued financial statements and the now given financial statements. So that's why what the standard will ask you to do is give unmodified opinion only, but in your new audit report, include a paragraph, either emphasis of matter or other matter paragraph you include it. And what I should mention in that emphasis or other matter paragraph, sir, what you should do in that paragraph is you draw users' attention to the amendment. Nothing but you highlight what is the adjustment that has been done in the newly given financial statements, which is not there in the earlier financial statements. Nothing but whatever amendment has been done that you try to highlight in either emphasis of matter or other matter paragraph. Now, when it comes to the other case, what if the management do not agree to amend the financial statements? Obviously, we'll give audit report which contains modified opinion. We'll give modified opinion. Is there any requirement to use emphasis of matter, other matter? Not required. Why? Because when we give modified opinion, the reason anyhow we will explain in basis for modified opinion paragraph. So no need to use any emphasis or other matter paragraph. Here why we are using it? Because we are giving unmodified opinion and we thought it is necessary to draw users attention to the amendment. So that's why the standard is asking us to use emphasis or other matter, whereas in the other case, since we are giving modified opinion, anyhow we will explain the reason in basis for modified opinion. No need to make use of emphasis or other matter paragraph. That is what the auditor's responsibilities are in case if we came to know about subsequent event after auditor's report. So whatever I have tried to summarize in the form of the chart, that itself has been presented in a detailed descriptive format, which now if you refer, it will be very easy for you. Clear? So with this, we are successfully done with SA 560 also. Now we will talk about the next important standard, which is SA 570, which will be related to the going concern assumption. So let us try to revise now SA 570, which is talking about going concern. So as we all know, going concern is a fundamental accounting assumption. And what does the meaning of going concern assumption mean? So going concern assumption means it is basically an assumption that the entity will continue for the foreseeable future. For the coming 1 year, the entity will continue and there is no intention of the management to liquidate the company, or even the situations doesn't want the company to get liquidated. That means the company is having capacity, ability and intention to continue for the coming 1 year. That assumption we call it as going concern assumption, and the financial statements are prepared on the basis of that going concern assumption. And regarding this going concern assumption, which is used in the preparation of financial statements, auditor is having some responsibilities to fulfill, and those responsibilities are given under SA 570. So let us try to revise now what is this, or what are these auditors' responsibilities relating to going concern assumption. So before we talk about this auditor's responsibilities, first let me ask you one simple question. Who is primarily responsible for making an assessment related to going concern? It is whose primary responsibility to make assessment regarding going concern? So the primary responsibility to make an assessment regarding going concern always rests with management of the company. So the thing which I want to say here is the management of the company is primarily responsible for making an assessment regarding going concern. That is whether the entity will continue for the coming 1 year or not. That assessment is basically the responsibility of management of the company. And how the management will do that assessment, sir? On what basis they will decide whether entity will continue for the coming 1 year or not? On what basis they will decide? Will the intention of the management alone will be enough? No. The management's intention to continue alone will not be enough. In deciding whether going concern assumption is valid or not, the management will pay attention to various factors. Like those factors are going to be the degree of uncertainty associated with outcomes. Like, is the company going through any pending cases? Is the company facing any litigations which if the company has lost them, there will be chances of company getting closed down. So like that, they will pay attention to these kind of uncertain events like pending litigations. Even they will pay attention to what is the size of the entity currently, how complex the entity is. Even they will pay attention to nature and condition of the business. What is the current condition of the business? Along with that, even they will try to find out, are there any external factors which have an impact on going concern? Like for example, changes in the laws or regulations. Sometimes changes in the laws and regulations can affect the going concern of the company. So whatever it is, the management is primarily responsible for making an assessment regarding going concern. And when making that assessment, the management will pay attention to these many factors, and then they will decide whether they have a ability to continue in the coming 1 year or not. Now, for what duration the management has to make an assessment? The management shall make an assessment for the coming 12 months. The management should make an assessment for 12 months. So if the management is doing an assessment for less than 12 months, you should not accept. As an auditor, you should insist the management. So in order to decide whether going concern is valid or not, you must compulsorily do the assessment for 12 months, insist the management and ask them to do the assessment for the coming 12 months. If at all, if you want the management to make an assessment for more than 1 year, you can ask it. But in any case, don't compromise if the management is doing an assessment for less than 12 months. So management will do this analysis and they will decide whether going concern assumption is valid or not. If the going concern assumption is valid, the company will value assets and liabilities in such a manner that they will be able to realize it in the ordinary course of business. If the going concern assumption is valid, the management will show assets and liabilities as if they will be able to realize in the ordinary course of business, which means that if the going concern assumption is valid, the entity will value fixed assets at historical cost that they can follow. On the other hand, if the management decided that going concern assumption is invalid, then what management has to do is they have to prepare their financial statements on liquidation basis, or even we can call it as realizable value basis. Which means if the management has decided that going concern assumption is invalid, which means entity will not be able to continue for the coming 1 year, they cannot value fixed assets at historical cost. They have to value all the assets and liabilities at realizable value, and the differential should be taken to the statement of P&L either as a loss or gain. Understood? On the other hand, if the going concern assumption is valid, the company can value their fixed asset at historical cost and current assets and liabilities on a going concern basis. But the moment going concern assumption becomes invalid, all the assets, all the liabilities will be valued on realizable value, and the differentials will be taken to the statement of P&L. So this much impact will be there on the financial statements as a part of that going concern assumption. So whatever it is, management will do assessment, and on that basis, they will prepare financial statements. Now, what is auditor's responsibility? So let us see. So the responsibilities of auditor are, the objectives of the auditor are to obtain sufficient and appropriate audit evidence regarding and conclude on the appropriateness of management's use of going concern basis of accounting. So if you observe carefully, the standard is not asking auditor to make an assessment regarding going concern. No, the standard doesn't say that. But in fact, what standard says is whatever assumption management has made regarding going concern, whether it is valid or not, that auditor need to obtain sufficient and appropriate audit evidence. So if I put it in simple language, if the management is saying going concern assumption is valid, as an auditor, I need to obtain audit evidence whether really going concern assumption is valid or not. If the management is saying going concern assumption is invalid, I need to obtain audit evidence whether really going concern assumption is invalid. So I need to obtain audit evidence, whatever assessment management has made regarding going concern, whether that is valid or not, I need to obtain audit evidence. And as we all know, how I will obtain audit evidence? I will obtain audit evidence by performing audit procedures. Now, and second objective, to conclude on the basis of evidence obtained whether material uncertainty exists related to events or conditions that may cast a significant doubt on entity's ability to continue as going concern. Which means on the basis of whatever evidence that you have gathered, you need to analyze, is there any material uncertainty? Sir, what do you mean by material uncertainty? Material uncertainty means whether entity will continue or will not continue. That is depending on some circumstances which are beyond the control of the management. So what do you mean by material uncertainty? Whether entity will continue or entity will not continue, that depends on some circumstances which are beyond the control of management or auditor. So find out on the basis of evidence whether there is any such material uncertainty. And finally, whatever findings are there, you have to report them. Whatever findings you have, that you need to report them appropriately in accordance with standards. So 3 objectives: obtain audit evidence regarding management's use of going concern assumption, and determine on the basis of audit evidence whether any material uncertainty is existing, and whatever your findings are there, you have to report them as per the requirements of this standard. Now, so the standard is saying try to obtain sufficient and appropriate audit evidence, and as I have mentioned, we will obtain audit evidence only by performing audit procedures. And the audit procedures to be performed by the auditor, they are divided into 2 categories. One is risk assessment procedures, and the other one, as you could see here, further audit procedures. Nothing but in the risk assessment procedure, the standard will ask the auditor to find out whether there are any events or conditions that could cast a doubt on entity's ability to continue as a going concern. So what they are saying, in the risk assessment procedures, we need to find out, is the company going through any events or conditions which can create a doubt regarding entity's ability to continue as a going concern? So what are that events or conditions, sir? First, let me take you through what are that events or conditions that could create a doubt to the auditor that company might be going through problem of going concern. So those events I have given it here, the standard itself has identified those events or conditions which could cast a significant doubt on entity's ability to continue as a going concern. Nothing but, which means if auditor came to know about these events or conditions, immediately you should get a doubt. Okay, the company might have a problem regarding going concern. So that events have been divided under three categories: financial indicators, then we have operating indicators, and finally we have other indicators. Let us see a few examples of that: financial indicators, operating indicators, or other indicators. If I talk about financial indicators, the company is always having net liability position. That is, its liabilities are more than its assets. Definitely, this will create a doubt to the auditor regarding going concern. And also, fixed term borrowings are approaching maturity without any repayment. The company has taken a loan in the past, that due date is coming in the next 1 year, but the company doesn't have money to pay. Obviously, this will create a doubt regarding going concern. Or the company is relying on short term borrowings to finance their long term requirements. So, like that, some financial indicators are given. Similarly, some operating indicators like management's intention to liquidate. The management themselves don't want to continue. When I go and ask the management, sir, do you have intention to continue the business in the coming year? They are saying, no, we don't have any intention. Or the management has lost the key management in the organization. Some key person in the organization has left the organization. Loss of major market, you are losing your market share, you are losing your key customers, you are losing your franchises license. This also created doubt regarding going concern. Similarly, we have some other indicators like non-compliance with capital or regulatory requirements. Like banks are required to comply with CRR SLR ratio. What will happen if they don't comply? RBI will pass a order to close the bank. So when you came to know your client did not comply with statutory requirements, will that create a doubt regarding going concern or not? Yes. Or pending cases against the company, which if successful will result in claims that entity will be unable to satisfy, which means company is going through such bad cases, such big litigations. If the company loses that case, the consequences will be so huge that they will not be able to fulfill. Or some changes in the laws or regulations. So like this, there will be some financial indicators, operating indicators, and other indicators. Now the auditor, by performing risk assessment procedures, he should identify whether any of this financial, operating, or other indicators exist. That is what auditor will do in the risk assessment procedures. Like if I take you through the terminology, when performing risk assessment procedures, the auditor shall consider whether any events or conditions exist that may cast a doubt on entity's ability to continue as a going concern. Nothing but I need to find out whether any of the financial, operating, or other indicator exist, which I have taken through now. Sir, how auditor will find out, sir, whether any events are there or not? Simply what he will say is, go and inquire with the management. What the standard is saying, go and inquire with the management and find out whether any financial, operating, or other indicators exist. That's what they say here. In doing so, the auditor shall determine whether management made an assessment regarding going concern. I told you, management is primarily responsible for making assessment regarding going concern. He will go to the management and ask first, sir, did you make an assessment regarding going concern? Yes, assessment has been performed by the management. Then the auditor will sit with the management and discuss, dear management, did you identify any of financial, operating, or other indicators? If yes, how you are planning to address them? So as an auditor, you need to find out whether any financial, operating, or other indicators exist. And how you can do it? If first go and ask the management whether they have done assessment regarding going concern. Yes, if they have done it, ask them directly, dear management, did you find out many financial, operating, or other indicator? If yes, how you are planning to address it? What if the management has not yet made an assessment? The management did not make an assessment regarding going concern yet. Then what auditor shall do is, the auditor shall discuss with the management the basis for intended use of going concern basis of accounting and inquire the management why they have not yet done the assessment yet. If the management has not yet made an assessment regarding going concern, ask them, sir, without making assessment, how you are able to decide going concern is valid, and inquire them because of what reasons they have not yet done the assessment. So whatever it is, by simply doing inquiry of the management, find out whether any of the financial, operating, or other indicators exist. If you don't find any financial, operating, or other indicator, your responsibility will come to an end with risk assessment procedure only. But in case if you find out any financial, operating, or other indicator, then you will perform further audit procedures. So what will be that further audit procedures? Like, observe the terminology here. If events, conditions have been identified, that means if you find out any financial, operating, or other indicator, then you will perform extra procedures. What are they? Like, if the management has not yet made the assessment, first I will go and ask the management to make the assessment regarding going concern first. Similarly, I will try to sit with the management and ask them what are the plans for their future and check how far those plans are feasible. and also analyze their cash flow forecast. What do you mean by cash flow forecast? Their cash flow budgets for the coming 1 year. So I will try to ask the management, sir, did you prepare projection of cash flows for the coming 1 year? If yes, give it to me. Analyze that cash flows of the future, whether receipts are more than expenses or not. Check it once. And also check whether any additional information is available from the time management made an assessment, and even ask written representation and extra procedures like analyze the cash flow of the company, profit of the company, read the latest interim financial statements, read the loan agreements to know whether they have made any default in the loan agreements, read the minutes of the meeting, inquire with the legal counsel what pending cases are there. So all these things you will do, provided if you find out any financial operating or other indicator. If you do not find any financial operating or other indicator, I will end my audit procedures with risk assessment procedures only. So whatever it is, by performing this audit procedures, you will have findings now. And how to report that findings, impact on auditor's opinion, that is the most important thing in the standard. So how the auditor's findings will have an impact on auditor's opinion, this we will try to summarize in the form of a chart. Please pay attention. So impact on auditor's opinion as per SA 570. So I will typically divide the circumstances into three categories. Number one, going concern is appropriate. Auditor performed audit procedures and I came to know that yes, going concern is valid, no issue with the going concern assumption. What opinion I will give? If I obtained audit evidence, going concern is all perfectly fine, everything is valid, I will obviously give unmodified opinion. There is no need to give any kind of modification. Second one, going concern is inappropriate. Sometimes I perform audit procedures and I conclude that the entity's going concern is invalid. The entity will not be able to continue in the coming 1 year. So I obtained audit evidence and concluded that going concern is inappropriate. That means entity will not continue for the coming 1 year. Now, how this will impact your auditor's opinion? So here directly we can't say modification, etc. Here the standard will ask us to check one more thing before we decide on the opinion. So when the going concern is inappropriate, first we should check whether adequate disclosure is given in financial statements by the management, or there is no adequate disclosure given in the financial statements. When going concern is inappropriate, that means when management has when the auditor has decided that entity will not continue for the coming 1 year, what auditor will check is, he will check whether adequate disclosure given in financial statements or adequate disclosure not given in financial statements. So what do you mean by adequate disclosure given in financial statements? Which means that going concern has become invalid, management did not deny it, management agreed to that, and they have valued all their assets and liabilities at realizable value. They did not value assets at historical cost. They have valued all the assets and liabilities at realizable value. Differential component has also been taken to statement of P&L. That is what the meaning of adequate disclosure given. So if the management has given adequate disclosure, you tell me, are the financial statements giving true and fair view or are they misleading? The financial statements are giving true and fair view only. Why? Because management did not hide anything. So we will give what? Unmodified opinion only. Whereas if the management did not give adequate disclosure in the financial statements, which means what? Auditor obtained audit evidence that going concern is invalid, but still management is continuing to prepare the financial statements on going concern basis, which means management is still valuing their fixed assets at historical cost only. Even after auditor got evidence that going concern is invalid, management is not agreeing. They are still saying, no sir, we will still value our assets at historical cost only. Now what auditor will do? The standard has directly told, go and give adverse opinion. Directly adverse, no need to check for any other options, directly give adverse opinion. Why? Because you have a evidence, and if the management tries to do something wrong with the going concern assumption, the impact will not be just material, it is going to be material and pervasive. Directly give adverse opinion, no need to check for any other kind of modification. Clear? So this is what the standard has told. So if the going concern is inappropriate, this is what will happen. So two circumstances, very easy. Going concern is appropriate, going concern is inappropriate. Now let us come to the third scenario which could be possible here. The third scenario which could be possible here is, auditor has decided that there is a material uncertainty relating to going concern. There is a what? Material uncertainty relating to going concern, which means whether entity will be able to continue for the coming 1 year or not, it is completely uncertain. No one is sure about it. Whether it will continue in the coming 1 year or not, it depends on some circumstances over which management doesn't have control. Even auditor is also not able to decide whether entity will continue in the coming 1 year or not. So if there is a material uncertainty relating to going concern, most important thing here, what will happen is here also the standard will ask the auditor to check whether there is adequate disclosure given in financial statements or no adequate disclosure given in the financial statements. Adequate disclosure given in financial statements, which means there is a material uncertainty. Management did not hide anything from the shareholder. In the notes to accounts, clearly they have told so and so uncertainty we are facing, so and so crisis we are having, whether we will continue for the coming 1 year or not. That is depending on some circumstances which are beyond our control. That management, without hiding anything, clearly they have told this information in the notes to accounts. Now you tell me, if there is an adequate disclosure in the financial statements, should the auditor give unmodified opinion or modified opinion? First of all, are the financial statements misleading here? Not misleading here. They are not at all misleading. Since they are not at all misleading, why? Because management has given enough of disclosure. Auditor will give unmodified opinion here. But the standard will say one more thing here. In addition to unmodified opinion, don't you think this material uncertainty which has already been disclosed in the financial statements, it is fundamental to users understanding of the financial statements? Yes, it is fundamental to users understanding of financial statements. Don't you think this information should be highlighted to the shareholder? Yes. Where it will be highlighted, sir? The standard is asking the auditor to use one dedicated paragraph with the heading material uncertainty relating to going concern. Like this, one paragraph with this heading shall be used in the auditor's report, and in that paragraph the auditor should give reference where the user can go and read that information regarding uncertainty. Understood? So if adequate disclosure has been given regarding material uncertainty, the financial statements are giving true and fair view. Management did not hide anything. So auditor will give what? Unmodified opinion only. But since this matter is very important to shareholders understanding, what the standard is specifically saying, what SA 570 is specifically saying, is asking auditor to use one extra paragraph in his audit report with the heading material uncertainty relating to going concern and bring it to the user's attention. That's all. Sir, what if there is no adequate disclosure? If there is no adequate disclosure, straightforward, we will give modified opinion. Which kind of modified opinion, sir? Either qualified opinion or adverse opinion will be given. If the effect of material uncertainty is only material but not pervasive, qualified opinion. If the effect of material uncertainty is material and also pervasive, then adverse opinion. So auditor will give modified opinion if no adequate disclosure has been given in the financial statements. Here also, is there any requirement to use additional paragraph with the title material uncertainty relating to going concern? No. Why? Because if the auditor is giving modified opinion, the reason will be anyhow explained in basis for modified opinion paragraph. Where the reason will be explained, the reason will be anyhow explained in the basis for modified opinion paragraph. So that's why there is no requirement of using any extra paragraph. Just to give the modified opinion and explain the reason in basis for modified opinion. No requirement of any additional paragraph here. So this is how the auditor's opinion will be impacted based on observations whatever he has regarding going concern. So whatever I have explained here, everything has been given here in the descriptive format that you can understand it and remember it now very easily, keeping this chart handy. Clear? So this is what regarding going concern. With this 7 standards we have successfully revised. We are left with only 3 standards pending for our revision. One is SA 220, then we have SA 550, and even we have SA 710. These 3 standards are not that important from the examination perspective, but still I will not leave them. I will not ignore them. I will try to revise the key concepts from this 220, 550, 710, or I will try to give overview of all this 3 standards now. So we will take up now SA 550 for revision. So what does SA 550 deal about? SA 550 is a standard which is exclusively talking about related parties or related party transactions. So as we all know, when it comes to related party transactions, there are so many accounting requirements as per accounting standards, and even there are so many disclosure and presentation requirements as per Companies Act 2013. Why? Because related parties are such a kind of transactions where there is a huge scope for manipulation. So that's why even ICAI has also given a dedicated standard which will help the auditor to verify related party transactions. So let us try to understand what is this SA 550 saying about the auditor's responsibilities relating to related party transactions. As I have told, I will give a quick overview of this entire standard. So let us now have a look at the standard, what they are trying to explain, or what they are expecting us from this standard. So if I go to SA 550, first thing in the standard, they have defined the term related party. Here, the ICA has played it very safe. So when it comes to definition of related party, what they have told is a party that is either a related party as defined in the applicable financial reporting framework. So what they have told, in case if the applicable financial reporting framework has defined the term related party, that only will come under related party. Like in case if you are conducting audit of a company, the Companies Act, that is applicable financial reporting framework, Companies Act, in the Companies Act, they have clearly defined the term related party. They have given a very huge chunk of relationships which will be covered under related party definition. So even standard is also saying that since applicable financial reporting framework, in our example, since Companies Act has already defined the term related party, that definition will be applicable. Whereas if the applicable financial reporting frameworks provides minimal or no related party requirements, that means in case if the applicable financial reporting framework is not defining the term related party, or they are defining the term but it is a very minimal definition, then the below mentioned definition will be applicable. Hope you are able to get the point. So what the standard is saying, if the applicable financial reporting framework has already defined the term related party, we will follow. In case if the applicable financial reporting framework provides very minimal or no definition of related party, then the standard is giving one definition. What definition? Very simply, three things they will say. Any other entity which is having control over your client's entity, or other entity over which your client is having control, or your entity and other entity both are under common control. That's it. That's what they have simply defined. So like if you see a person or other entity that has control or influence over the reporting entity, nothing but if your client is X Limited, if some entity is controlling or influencing your client, that will come under related party. Second point, another entity over which reporting entity has control. Assume your client is X Limited. If X Limited is controlling or influencing somebody, that will come under related party. Or your entity, your client entity and other entity, if they are under common control, both are having some common control. How that common control can come? That common control can come either by way of common controlling ownership, that is a common ownership, or both the entities owners are some closely held family members, or both are under common key management. When I say common key management, there are same board of directors, same CEO, same CFO, same key managerial person, etc. And when this definition will become applicable, this definition will become applicable in case if the applicable financial reporting framework provides very minimal or no definition to the term related party. However, one important statement for true or false statements, the entities which are under common control by a state, here what they mean is government. If there are two or more entities which are under common control of some government, they will not be considered related unless they engage in some significant transactions to share resources or with one another. So what is the thing they're trying to say is, when it comes to government, if some entities are under common control of the government, like Indian Oil Corporation and Bharat Petroleum, both are under common control of the government, still they will not be considered as related unless both are engaging in some similar transactions, or they are sharing resources, then only they will be considered related. This is exception for the definition. Clear everyone? So this is how the term related party has been defined. Now, nature of related parties, how the related party transactions will occur. Here simply they will try to say one thing, when the related party transaction is also in the normal course of business. Like with the related party also, same terms and conditions, arm's length price, everything is happening in the normal course of business. Like a outsider, if the transactions are happening with the related party, then they may carry no higher risk of material misstatement. When everything is as per normal terms and conditions, when everything is in the ordinary course of business, when the transaction is happening at arm's length price, there is generally no need to suspect. There will be no higher risk of material misstatement. However, in some circumstances, related party transactions may carry higher risk of material misstatement. When everything is as per normal terms and conditions, no need to suspect. But in some cases, you have to become cautious. Why? Because in some cases, related party transactions carry high risk of material misstatement. When related parties are operating through a extensive and complex range of relationships. The relationship is very complex. See, if the client is having direct subsidiary, easy to identify related party. But sometimes what will happen is they will create a chain of group companies. Like one company will be there, they will create subsidiary company. That subsidiary will create another subsidiary. That subsidiary will have an associate. That associate will be a partner in some LLP. So like this, so many things will happen. See, when there is this long chain of relationship, there is a high risk of material misstatement. When the relationship is straightforward, they carry less risk of material misstatement. On the other hand, when they have a complex chain of relationships, then they carry high risk of material misstatement. Not just that, whatever information systems which your client is using for identifying related party transactions, if that information system is ineffective, whatever accounting software which your client is using for identifying and reporting related party transactions, if that accounting software is ineffective, then also related party transactions carry high risk of material misstatement. And even related party transactions, sometimes they may not be conducted under normal market terms and conditions, especially when the transactions are happening without any consideration. So in these circumstances, the risk of material misstatement is very high. When nothing like this is happening, when everything is as per normal terms and conditions, they carry lower risk of material misstatement. So this is about nature of related party transactions. Now, what are auditors' responsibilities? In one word, if I have to end it, the summary of all these points, what they try to say is there are so many accounting and disclosure requirements when it comes to related party transactions. Be that accounting and disclosure requirements are as per accounting standards, be they are as per schedule 3, whatever it is, as per applicable financial reporting framework, there will be so many accounting and disclosure requirements. Now, as an auditor, what is your responsibility is to perform audit procedures and make sure that all that accounting and disclosure requirements are properly given in the financial statements. That's all your responsibility. So there are so many accounting and disclosure requirements as per applicable financial reporting framework, be it schedule 3, be it accounting standards, whatever it is. There are so many reporting requirements, accounting and disclosure requirements. Whether the client has completely given all that accounting and disclosure requirements or not, checking that is auditor's responsibility by performing audit procedures. And finally, you have to make sure that financial statements are giving true and fair view and they are not misleading, especially by related party transactions. That is what your responsibility. And even one more thing they will try to say here, having a related party transaction is even a fraud risk factor also. Why it is a fraud risk factor? Why? Because when the client is having related party, it is very easy to manipulate. It is very easy to collude with the others. See, a third party might not act according to your instructions, but related party always acts according to your instructions. So it is a fraud risk factor. So that's why as an auditor, you have to be very cautious while verifying related party transactions. Sometimes that will help you in identifying fraud risk factors. Sometimes that can indicate you the existence of the fraud also. And apart from that, as we all know, because of inherent limitations of audit, no matter how effectively you do the audit, there is always a unavoidable risk that your opinion can go wrong. And if you remember, the risk of inherent limitations is very high when it comes to related party transactions. Normally, anyhow, we have inherent limitations. But when it comes to related party transactions, the effect of inherent limitations is even higher. That means the chances of auditor's opinion going wrong because of misstatements in the related party transactions is much higher. Why in the related party transactions, the severity of the limitations is very high? Why? Because sometimes management themselves may not be aware of existence of all the related parties. And as I have mentioned, related party relationships will provide greater opportunity. They provide very good opportunity for collusion. As I mentioned earlier, the client cannot, you cannot make a third party to behave according to your instructions, but related party will always act according to the instructions of your client. So because of these reasons, when it comes to related party transactions, the impact of the impact of inherent limitations is also very high. But one thing we can do to do our work effectively, what is that one simple step is, by maintaining an attitude of professional skepticism, we can keep the risk at a very low level. We can avoid our liability by maintaining professional skepticism. So that's what auditors responsibilities are. So if I summarize, first I need to check accounting and disclosure requirements as per applicable financial reporting framework. Be cautious, related party transactions will help you to identify fraud risk factors also. And here inherent limitations impact will be very higher. So in order to avoid that, we need to maintain professional skepticism. Don't accept anything blindly, have a questioning mind. Then finally, how the auditor can come to know which is a related party, which is not a related party. So how the auditor can verify existence of related party. So what the standard says is, they will ask you to refer some documents like verify the entity's income tax returns, and even check the information which has been supplied to regulatory authorities like ROC. Check the shareholder register to know who is having significant shareholding in the company. Even check the statement of conflicts which are submitted by management and board of directors. Check the entity's investment register. This will help you to know who is the client's subsidiary, associate, etc. Check the contracts and agreements which have taken place with the key management or top level management. Check whether any contracts are there which are not in the ordinary course of business. Check the life insurance policies which have obtained by your client. Why? Because that will let you know who are key people in the organization. And similarly, check the internal auditors report, and also check the documents which are filed with authorities like SEBI, etc. So if you refer all these documents, you will get an idea who is related party, who is not a related party. That's all SA 550 says. So we have seen meaning of related party, and also what is the nature of related party transaction, what is auditor's responsibility, and how the auditor can verify the existence of a related party. So this is what SA 550 talks about. Now we are left with two more standards. Now we will start SA 220. Very simple standard. Quickly we will try to wind it up. So SA 220 is the standard which is talking about quality control. So let me take you there. Yes. So SA 220 is the standard which is going to guide us about how to control quality whenever you are doing audit of the financial statements. So as we all know, we chartered accountants do so many audit assignments, and it is very important in all that audit assignments to maintain the quality. Why? Because when we don't do the audit in a qualitative manner, not just one or two persons will be affected, so many stakeholders' financial interest will be at risk. So be it banker, be it shareholder, be it creditors, be it debtors, so many people are going to use your audit report, and they will form the decisions on the basis of your audit report. So if you compromise on the quality of the audit, that wrong audit report will affect the interest of so many stakeholders. So it is very important to maintain the quality control in the audit of financial statements. And SA 220 is trying to help us out how to maintain quality in the audit assignments which we are doing. So that's what, even if you read the objective, you will get an idea. The objective of the auditor is to implement some quality control procedures at the engagement level that will give the auditor reasonable assurance that whatever audit that you have done, that is complying with the professional standards and also legal and regulatory requirements. That means whatever audit you have done, that is as per standards on audit, and also that is as per laws and regulations, and whatever auditor's report has been given, that is appropriate. So the conclusion here is, this standard is going to give you some guidance by which you will get the confidence that yes, whatever audit I have done it as per the standards on audit, and whatever report I have given, that is appropriate. That confidence you should have. That is what the meaning of doing the work in a qualitative manner. Why? Because you will get that confidence only when you have done it in a qualitative manner. So that's what the entire objective of the standard. Now, how that quality can be ensured in the audit? So what SA 220 says is, in order to maintain quality in the audit assignments which we are doing, there should be some policies and procedures which auditors should follow. And that policies and procedures are required to be followed in 6 areas. So what does the standard say? In order to maintain quality in the audit assignments, there should be some policies and procedures which your client, which as an auditor you have to follow. And those policies and procedures are required to be followed in how many areas? In 6 areas you need to follow some policies and procedures. So what are that 6 areas, sir, in which I need to follow some policies and procedures? As you could see here, number 1, leadership responsibility. Number 2, ethical requirements relating to an audit of financial statements. Number 3, acceptance and continuation of client relationship. Number 4, human resources. Number 5, engagement, performance, and number 6, monitoring. So once again, I'm repeating, there are 6 areas over which there should be policies and procedures. What are that 6 areas? Number 1, leadership responsibilities. Number 2, ethical requirements. Number 3, acceptance and continuation of client relationship. Number 4, human resources. Number 5, engagement, performance, and number 6 is monitoring. So if you follow some policies and procedures in these 6 areas, yes, the auditor can ensure that there is quality in the audit assignments which he is doing. So let us try to understand in each of this area what kind of policies should be there. First, talking about leadership responsibility. If as an auditor you want to make sure that there is a quality in the audit assignments, someone should come forward and take that leadership responsibility. Sir, who should come forward and take that leadership responsibility? SA 220 says that engagement partner himself should come forward and take the leadership responsibility. Now, first of all, who is engagement partner? So the act says that engagement partner is a partner, like as you could see, engagement partner is a partner or other person in the firm who must be a member of Institute of Chartered Accountants of India, and he should be in full-time practice, and he will be held responsible for the engagement and also its performance and the report which is issued on behalf of the firm. If I put it in simple terms, if an audit firm is appointed, whoever partner signs the audit report, that person will be called as engagement partner. As simple as that. So that's what they're trying to give it in a technical definition. They are saying something that that person should be a partner or other person in the firm. He should be a member of ICI. He should be in full-time practice and he will be held responsible. How he becomes responsible? By signing the audit report. So whoever is signing the audit report, that person will be simply called as engagement partner. So SA 220 says that someone should come forward and take the leadership responsibility. Who should be that someone? Engagement partner should be that someone who should come forward and take the leadership responsibility. Now, just if you come forward and say, if I am engagement partner, if I come forward and say, I will take the leadership responsibility, by saying just like that, you are not fulfilling your responsibility. Then how to fulfill that leadership responsibility, sir? That's what they say here. If you want to fulfill that leadership responsibility, if you want to make sure that your engagement team is doing the work in a qualitative manner, just saying out loud that you are a leader alone will not be enough. Either by way of your actions or by way of your messages, you should try to highlight some information to your rest of the team members. Being a leader, what I should do? Either by way of my actions, by the way I behave, or by way of my messages, I should make sure that my engagement team members are aware of some information. What information? I should highlight that how important it is to perform the work that complies with professional standards. I have to let my staff know how important it is to do the audit as per standards on audit and laws and regulations. And also how important it is to comply with firm's quality control policies and procedures. How important it is to give the audit report that is appropriate. Let them know what will happen if you give the wrong audit report. And also create such an environment in your audit firm that if any of your engagement team member has concerns, he should be able to come forward and get them clear. He should not have a fear that if I go and ask the question to the engagement partner, how he will behave. Such a bad environment you should not create. Being a leader, you should create such a favorable environment that if anybody is having concerns, they should be able to openly come and communicate with you. And in addition to that, you have to let them know the fact that quality is very essential in performing the audit. So being a leader as an engagement partner, you need to do these things either by way of your messages or by way of your actions. You should highlight how important it is to do the audit as per standards on audit, how important it is to comply with the policies and procedures, create a favorable environment where people will come and ask their concerns, and also tell them how important it is to maintain the quality and also how important it is to give appropriate audit report. So these kind of policies you should have it in the first area, leadership responsibility. Coming to the second one, ethical requirements relating to audit. This ethical requirements, we know it already. We have revised it as a part of nature, objective and scope of audit. 5 ethical requirements will be there. What are 5 ethical requirements? Integrity, objectivity, confidentiality, professional competence, professional behavior and due care. That's all, no? So these are 5 ethical requirements. What are they? Integrity, objectivity, confidentiality, professional judgment, professional behavior, professional competence and due care. So these 5 ethical requirements, if you have, then audit will be done in a qualitative manner. Next, the third point, acceptance and continuation of client relationship. This also we have covered it in nature, objective and scope of audit. So before accepting and continuing client relationship, there are 4 factors which auditor needs to consider. What are the 4 factors? Check the integrity of the management, check whether you will be able to comply with ethical requirements, check whether you have enough of engagement team, whether you are competent enough to complete the audit, and even you should consider significant matters which have arisen during the course of previous audit. So that's why at the time of accepting and continuing client relationship, then only you have to consider these 4 factors which we covered in nature, objective and scope of audit. What are the 4 factors which we need to consider? Number 1, checking integrity of the management, compliance with ethical requirements, competence of the engagement team members, and finally significant matters which have arisen during the course of previous audits. Now fourth area over which you need to have policies and procedures, which is going to be human resources. Why? Because if you human resources means nothing but your staff. If you have good staff, if you have capable staff, if you have competent staff, if you have knowledgeable staff, if you have hardworking staff, then only audit will happen in a qualitative manner. If you don't have good staff, if you are having incompetent people, if not experienced people, not committed people, if you don't have a strong team, you will not be able to do the audit in a qualitative manner. So that's why in your policies and procedures, you need to have those policies and procedures when it comes to your staff also. Sir, what kind of policies I need to have regarding my staff? So like at the time of recruitment, select only those people who are ready to develop their skills and knowledge. Don't give importance for recommendations. Select only those people who are competent enough. And periodically do the performance evaluation. Once in a while, check how effectively they are performing. Capabilities, try to increase their capabilities, try to increase their competence, provide them scope for career development, create some sessions for them. And if you find someone is working very hard, give them enough of give them promotion, give them enough of compensation, and even try to meet their personal needs also. Why? Because employees personal conditions will have an impact on their professional life also. So if possible, try to meet their personal needs. So try to have these kind of policies and procedures when it comes to your staff. Then your staff become more competent, then audit will happen in a qualitative manner. So this is what regarding the fourth area. Now talking about the fifth area, engagement performance. So when the engagement is getting actually performed, then also you need to have some policies and procedures. Like what, sir? Like when you go for audit, don't directly ask the engagement team members to jump into the audit. Give them proper briefing. At least give a brief introduction what they are supposed to do, etc. Why? Because all the engagement team members might not have equal knowledge. Sometimes there could be new staff also. So that's why before audit is getting started, give them a brief about the entire audit. And also let them know how to comply with engagement standards. Don't just say go and comply with standards. Let them know how to comply with the standards also. And do proper supervision of their work. Give them proper training, give them proper coaching. That means when they are actually doing the work, if they are getting stuck somewhere, go and help them out. And don't blindly believe whatever your engagement team members are doing. Even review their work also. Review of work of engagement team members is also highly important. And finally, give them proper instructions to maintain enough of documentation, and give them instructions that to keep themselves updated with all the policies and procedures whatever have been implemented. So like this, whenever you are actually performing the engagement, these kind of policies should be there, like giving proper briefing to your staff, let them know how to comply with engagement standards. Wherever they are getting stuck, supervise them, give them training, give them coaching, review the work whatever they are doing, tell them how important it is to maintain the documentation and make them updated with all the policies and procedures. So these policies you should have when it comes to engagement performance. Then finally, the last one we have monitoring. See, just implementing policies and procedures alone will not be enough. Even we need to do periodical inspection of assignments whatever we have completed, and check whether in that assignments which are already completed, whether the policies and procedures are complied or not. Why? Because just if you take a printout of all the policies and attach it on the walls and cabins, it will not be enough. I need to make sure that whatever policies and procedures which I have designed, whether they are getting really implemented or not, I want to know. How you will come to know? By monitoring, by reviewing. That's what the monitoring stage. Now, what is the purpose of monitoring? Why you have to monitor? Why I have to monitor? Because if I do the monitoring, then only I will come to know whatever assignments I have done till now, whether they are done as per professional standards, whatever quality control system which I have designed, whether it is really getting implemented, whether my staff is complying with those policies, whatever reports I have given till now, whether they are appropriate, and in case if any changes are needed to my policies and procedures, I can do the follow up by the concerned person and make that changes to my policies and procedures. Nothing but you will find out whether you have to make any changes to the existing policies and procedures. So since monitoring will have these many benefits, that's why just implementing policies and procedures alone will not be enough. Periodically, I have to verify or monitor how far these policies and procedures are getting implemented. Is there any requirement to update, delete, or change them? So like this, if you follow these policies and procedures in these 6 different areas, then rest assured there will be quality in the audit assignments. Clear? So that is what the objective of the standard, and this is what the standard is trying to provide the guidance. Now we are left with only one more standard, which is SA 710. Without any delay further, let us try to revise that SA 710 also. So what does SA 710 deal about? So let me take you to that standard. So as I've already mentioned, you can download this material, whatever I am displaying here, and how to download that material, I will give the explanation in the description given below. So from there, you can download this material and have access to it. So whenever you are watching this video, keep that material handy so that you will be able to memorize the content even more. So let us now complete this last standards revision. So as you could see, SA 710 and SA 710, the title itself says it is talking about comparative information and corresponding figures and comparative financial statements. So first of all, if you observe carefully, in the title of the standard, 3 terms are used. Number 1, comparative information. Number 2, corresponding figures. Number 3, comparative financial statements. So like this, 3 terms are used in the title of the standard itself. Number 1, comparative information. Number 2, corresponding figures. And number 3, comparative financial statements. First, we will understand what is the meaning of these 3 terms. Talking about comparative information means nothing but whatever information which will be presented in addition to current year's financial statements. Whatever information which is presented in addition to current year's information. If I put it in simple terms, prior year's information, one or more prior year's information which is presented in addition to current year's financial information, that we call it as comparative information. So what they're trying to say is, assume you have downloaded financial statements of company for the financial year 21-22. Now, when you have a look at the balance sheet, you will be able to find 3 columns there. Number 1, particulars will be there. Then there will be a column dedicated for 21-22 financial year. And there will be even one more column which is related to 2021 financial year also. So this is current year's information. But in addition to current year's information, even prior year's information also will be presented. That prior year's information which is getting presented, we call it as comparative information. And this comparative information can be presented for 1 year also, can be presented even for more than 1 year also. It depends on applicable financial reporting framework. In India, the applicable financial reporting framework is expecting you to present only last 1 year's information. That way we are presenting only 1 year information. In some countries, their respective applicable financial reporting framework says to present 2 years of information. Then 2 years of information like even 1920 also will be added. This both years information will be called as comparative information. So whatever it is, like if you see the definition here, the amounts and disclosures which are included in the financial statements in respect of one or more prior periods, that too in accordance with applicable financial reporting framework, we call it as comparative information. And this comparative information will be of two types. One is corresponding figures and the other one is comparative financial statements. Now, what is this corresponding figures? What is this comparative financial statements? As I have told, both are actually types of comparative information. So, corresponding figures refers to, like if you read the definition, it is a kind of comparative information which is included as an integral part of the current period financial statements, and they are intended to be read only in relation, intended to be read only in relation to amounts and other disclosures relating to the current period. Sir, what does that mean, sir? So corresponding figures means that kind of comparative information which has to be read only in relation to current year's figures. So what is corresponding figures? It refers to such a kind of comparative information which has to be read only in relation. Like for example, if I take 21-22 financial statements, along with that 2021's information is presented. Now this information has to be read only in relation to 21-22 year. You can't read only 2021 information from this financial statements. This column is presented so that you can read it only in relation to last year's information. You can't read only 2021 information from the current year's financial statements. This column is presented only to read in comparison. Only for comparison it has been given. You can't read it separately from this financial statements. And generally in the case of corresponding figures, what will happen is when we are doing audit, in the case of corresponding figures, our opinion refers only to current year. It will not relate to prior years. If you are conducting audit of corresponding figures, whenever we are expressing opinion, our opinion will be related only to current year. Our opinion has nothing to do with the comparative information. In which case? In the case of corresponding figures. So once again I am repeating, corresponding refers to that kind of comparative information which is given to be read only in relation to current year's information, and in that case our opinion refers only to current year. We have nothing to do with the prior year's information. Whereas if it is a case of comparative financial statements, if we are conducting audit of comparative financial statements, our opinion refers to all periods covered in the financial statements. Our opinion refers to what? All periods covered in the financial statements. Like if I am assume this is a case of comparative financial statements. Assume I am conducting audit which is a comparative financial statements. If I am doing audit of 21-22 and in the financial statements even last year's information is presented. Now if it is a case of comparative information, my opinion will not just relate to 21-22, even I will give my opinion on 2021 also, in which case comparative financial statements. If it is a case of corresponding figures, my opinion refers only to if it is a case of corresponding figures, my opinion relate to only current year. I have nothing to do with the prior years. Sir, now which one has to be followed, sir? Should I follow corresponding figures or should I follow comparative financial information, comparative financial statements? It all depends on applicable financial reporting framework. In India, the applicable financial reporting framework is expecting you to follow only corresponding figures. That's what we generally do. In case if you are conducting audit of any company for the financial year 21-22, we will express opinion only on 21-22. Even in the financial statements, 2021's information is presented. We have nothing to do this. Our opinion has nothing to do with this year. So that's why in India we follow what? Corresponding figures. Our opinion refers only to current year. But as I have told, there are some countries which can expect the auditors to even follow comparative financial statements. Some countries will expect you to express opinion not just on the current year, even the prior year's information, whatever is presented on that also you have to express your opinion. But luckily in India, we have only corresponding figures. We need to express opinion only on current year's information. So we understood the definition of comparative information. We understood the definition of what is corresponding figures and comparative financial statements. Both are actually types of comparative information only. Now, what is objective of SS 710? With what objective SS 710 has been provided? The objective is very clear here. As an auditor, you need to obtain sufficient and appropriate audit evidence about whether comparative information, whatever it is presented, whether that is as per applicable financial reporting framework or not. So what is my first objective as per SS 710? Whatever comparative information, be it corresponding figures or be it comparative financial statements, whatever comparative information that is presented in the financial statements, whether it is as per applicable financial reporting framework or not, I need to obtain sufficient appropriate audit evidence, and whatever findings are there, I need to report them in accordance with the standard. And how to report them? That's what we are going to see it in the rest of the standard. Now, there are some common audit procedures which you need to perform regarding comparative information. When I say comparative information, that could be corresponding figures also, that could be comparative financial statements also. Whatever may be the approach, for all the comparative information, there are some common audit procedures. Like I told you, comparative information will be of two types, no? One is corresponding figures, other one is comparative financial statements. Now they are saying audit procedures regarding comparative information, they are saying. That means these audit procedures are going to be common. Be it corresponding figures, be it comparative financial statements, these audit procedures which we are going to read are common for all comparative information. Sir, what are that common audit procedures, sir? Very simple. First one, I need to check whatever information is there, whatever comparative information is there, whether that is as per applicable financial reporting framework or not. If the applicable financial reporting framework is asking you to present only one prior year's information, I will check only 1 year's information is presented or not. If the applicable financial reporting framework is asking the client to prepare last 3 years of information, I will check whether last 3 years of information is presented or not. So whatever may be the approach, be it corresponding figures, be it comparative financial statements, the first common audit procedure is I will check whether comparative information is presented as per applicable financial reporting framework. Then other common audit procedures, whether the comparative information agrees with amounts and other disclosures presented in prior period. Whatever comparative information is there, whether that is matching with the last year's financial statements or not, that I need to check. Be it corresponding figures, be it comparative financial statements. So what they are trying to say is, if I am conducting audit of 21-22 year, corresponding figures will be, comparative information will be what? 2021. Now I need to check whatever comparative information which is presented here. For last year there will be balance sheet, no? Like last year, if you take last year, there will be 2021 and 1920. So I need to check current year's comparative information is matching with financial statements of the last year or not. That I need to check. And similarly, whatever accounting policies are there which are reflected in the comparative information, whether they are consistently applied or not, if at all there is any valid reason for deviation, whether that change has been properly accounted for and disclosed or not. So some other standard should start making sense here, which is going to be SA 510. In SA 510 also we have seen something similar to it. So whether the accounting policies are consistently applied without any valid reason, they should not be changed. If at all there is a change in any accounting policy, I need to check that whether it has been properly accounted for and disclosed or not. The same thing they will try to say here. And when you become when it comes to your notice that there is a material misstatement in the comparative information, you need to perform some additional audit procedures also. And finally, as an auditor, you need to obtain written representations from the management regarding comparative information. So four common audit procedures they are saying: check whether comparative information is presented as per applicable financial reporting framework, check whether it is matching with the prior periods, check whether accounting policies are consistently applied, and if at all if you find any material misstatement, perform additional audit procedures and even ask written representations from the management. Now, when it comes to auditors reporting requirements, first we will talk about corresponding figures. As I have mentioned, in normal circumstances, if it is a case of corresponding figures, your opinion shall refer only to current year. You have nothing to do with the prior period's information. However, there are some exceptions to this rule. The general rule is, if it is a case of corresponding figures, your opinion shall refer only to current year. Your opinion has nothing to do with corresponding years, corresponding figures. That's what the general rule no. Now I am saying there is an exception. That means in some cases, even though it is a corresponding figure, still our opinion will refer to prior periods. So in what case, even though it is a corresponding figures, our opinion will refer to prior period? They will give three exceptions. So what are that three exceptions where even though it is a corresponding figure, our opinion will refer to last year? Number one, last year's financial statements are audited. Prior period financial statements are audited. And because of what, when the last year's financial statements contain modified opinion. Which opinion? Last year's financial statements contain modified opinion. When I say modified, it could be qualified, adverse, disclaimer, whatever it is. So prior periods, last year, take for example, I am doing 21-22's audit. Last year is what? 2021. So last year's financial statements were audited in the last year. And last year's audit report contains modified opinion. When I say modified opinion, it could be qualified, adverse, disclaimer. And because of whatever reason, the last year auditor gave modified opinion, that reason is not yet rectified in the current year. It is still relevant in the current year. It is still relevant in current year. So some reason is there because of which last year auditor gave modified opinion. That reason is not yet rectified in the current year. That reason is still material for the current year. Now for the current year, what auditor will do? For the current year, auditor will give modified opinion. So for the current year also, what the auditor will do modified opinion. Why? Because of whatever reason last year auditor gave modified opinion, that reason is not yet rectified. That reason is still relevant in the current year. So that's why current year auditor also will give modified. And when the auditor gives modified opinion, he will use the basis for modified opinion paragraph. No, in the basis for modified opinion, what auditor will say? If I am an auditor, I will say last year there is a misstatement which is material, which is not yet rectified in the current year. That's why I'm giving modified opinion. So if you observe carefully in your audit report, you are taking reference to last year's figures. What I will say in the basis for modified opinion paragraph, I will say, sir, for the current year, I'm giving modified opinion. Why? Because there is a misstatement which is there in the last year. The same misstatement is there in the current year also. Generally, in normal circumstances, in your audit report, if it is a case of corresponding figures, you should not refer to prior years, no. But here you are taking the name of last year. You are saying in the basis for modified opinion, there is a misstatement in the last year. So whatever it is, you have taken the reference to the last year, no. Which generally should not happen in the case of corresponding figures. So that's why it is an exception. Generally, if it is a case of corresponding figures, nowhere in our audit report will take reference to last year's information. But here you are taking reference to last year's information. Where? In the basis for modified opinion paragraph. Why? This is an exception? No. That's why. So once again, I am telling one exception where even though it is a corresponding figures, we will take reference to last year. When the last year's financial statements were audited, last year auditor gave modified opinion, and because of whatever reason last year auditor gave modified opinion, that modification is still relevant in the current year, then the current year auditor will give modified opinion, but still in the basis for opinion paragraph, he will take reference to prior years, which should not happen in the case of corresponding figures. But since it is an exception, that's why we are saying here it will include reference to prior year. This is case 1. Second exception. What is the second exception is, last year, prior year, financial statements were audited. And in the previous year, the auditor gave modified opinion. Sorry. That is first case. Prior year's financial statements were audited and the last year auditor gave unmodified opinion. He told last year financial statements are giving true and fair view. And after giving unmodified opinion, while you are doing current year audit, you found a misstatement. You found a material misstatement, which is not relating to current year, which is actually relating to previous year. Last year's financial statements were audited. Guys, this standard is a bit complicated. If you understood the concept at least once, then only this revision will make sense. So if this revision is not making sense, that means you don't have conceptual clarity about this standard. If you don't have conceptual clarity about this standard, don't worry about it. I will upload a dedicated video explaining about this SA 710. Matter is bit complex. If you have already listened to the class once, then you will definitely understand. If you are not understanding, don't worry. I will upload a separate video for concept explaining this SA 710 in a detailed manner. After that, if you watch this, then it will start making sense. So anyhow, let us come back to the discussion. Prior year financial statements were audited. Last year auditor gave unmodified opinion, and in the current year the auditor found a misstatement which is relating to previous year. Since it is a misstatement relating to previous year, what management should have done? Management should have shown it as a prior period item. Yes or no? What management should have done? Management should have shown it as a prior period item. But management is not doing it. In the current year, I found a misstatement, and that misstatement is relating to previous year. Management should have shown it as a prior period item, but the management is not showing it as a prior period item. Now in the current year, what I will do is I will give modified opinion. Here also, in the basis for opinion paragraph, what reason you will say? I will say there is a misstatement which is happened in the previous year. Once again, the rule is violated. If you observe here, it is a corresponding figure, but still in your audit report, you are giving reference to previous year, which should not happen. No, this is also one exception. Understood? What is this exception? Once again, I am saying prior year financial statements were audited. Last year auditor gave unmodified opinion, but in the current year auditor found a misstatement which is relating to previous year, and the management is not ready to show it as a prior period item. I will give modified opinion, but in the basis for opinion paragraph, once again I will take reference to previous year. I will say misstatement is related to previous year, which I generally should not do. If it is a case of corresponding figures, I have nothing to do with last year's information, but since it is an exception, I am doing it. One more case where I will mention prior years in my audit report, even though it is a corresponding figures, is when I conducted the last year's financial statements. I'm doing current year's audit, but I came to know that prior years were unaudited. Last year is unaudited. If the prior year's financial statements are unaudited, then what current year's auditor should do is in the other matter paragraph, where in the other matter paragraph of the auditor's report, the auditor should mention that last year's financial statements are unaudited. What auditor should do? If the prior year's financial statements are unaudited, the current year auditor, in which paragraph? In other matter paragraph, he should mention that the last year's financial statements are unaudited. But whatever it is, even in other matter paragraph, you are taking the name of last year's financial statements. No, you are saying in your audit report last year's financial statements are audited. That's all. You have taken reference to last year, which we should not do in the case of corresponding figures, but since it is an exception, we are doing it. Clear, everybody? So three cases generally in the case of corresponding figures, our opinion shall not refer to prior periods, and I told you three cases which are exceptions. That means even though it is a corresponding figures, in these three cases in our audit report, we will take reference to last year. So that is what very important content from this standard. That's why I have spent some time on it. With this understanding, if you read it, you will be able to understand it. Now coming to the last point, audit reporting regarding comparative financial statements. This is relatively very easy. So what is the simple thing here is, since it is a case of comparative financial statements, our opinion will refer to every year. So if I am doing audit of 21-22, last year's information 2021 is also presented, and it is a case of comparative financial statements, my opinion will be on 21-22 also. My opinion, I will give it on 2021 also. So here there is nothing specific here to discuss. So in case of comparative financial statements, auditor's opinion will refer to all the periods. But the standards say one more thing. If the opinion which you are giving on comparative financial statements, and if the last year's auditor's report, if both are not matching, then that differences you have to explain in other matter paragraph. So what I mean to say here is, when I am conducting audit of 21-22, if it is a case of comparative financial statements, I will give opinion on 2021 also. Assume that in the current year, while doing audit of 21-22 year, I gave modified opinion for both the years. But last year also audit would have happened. What will be last year's financial statements? 2021, 1920. But in the last year, I gave unmodified. Same year, as a part of last year's audit, I gave unmodified opinion. For the same year, as a part of current year's audit, I gave modified opinion as a forming part of comparative financial statements. So both are same years, but in both the cases, I have given different opinion. Current year, as a part of comparative financial statements, I am giving modified opinion. But in the last year, for the last year, for the same financial year, I have given unmodified opinion. So whatever reasons are there for the difference in that opinion, that differences are required to be explained in other matter paragraph. So that's what we have given it here in the second point. When reporting on prior periods financial statements in connection with the current period's audit, if the auditor's opinion on such prior period financial statements differs from the opinion of the auditor expressed, then the auditor shall explain the reasons were in other matter paragraph. So these are some key points from comparative financial statements. See, this standard is not actually suitable for revision, so that's why I'm revising the key terms. So this standards you need to have very much conceptual clarity, so that's why I'm telling I will upload a separate video about it. So this is what regarding SA 710. So we understood what is comparative information. We understood what is comparative financial statements, corresponding figures, their reporting requirements, common audit procedures, everything we have understood. So guys, this is what the revision regarding standards on audit. So we have spent somewhere around 3 hours of time, and we have covered lot of standards, 10 standards almost we have covered. So which is actually a very wider coverage. So hope this revision will help you for sure. So this is what I thought of revising from the chapter standards on auditing. And trust me, if you are thorough with this 10 standards, whatever I have covered, there is a possibility in your favor to get minimum 12 marks in the examination. Clear everyone? So this is what regarding standards on auditing revision. Hope this revision has helped you out, and for more such information please subscribe to my YouTube channel to stay updated and also to make your auditing concepts very clear. Thank you guys. Bye.